Hello, my dear students. Hope you guys are all doing good. Hope you guys are all perfectly fine. I hope you're all doing your preparation in a very perfect manner. So, one frequent request which I've been receiving from the students from a very long period of time. So, whenever I check the comment section of my YouTube and whenever I check my WhatsApp messages, or even some students have even reached out to me personally over Telegram and various other platforms. And one frequent request which students are continuously asking me is, Sir, please do the CA final audit marathon. Sorry for the late, guys. So I know it's been a bit late to upload the marathon, but why this delay has happened is because I have been working on all the resources necessary to make this marathon as effective as it could be it material preparation, be it charts drafting, or be it way of presentation. So which chapters I have to take up, so how far I have to go deep into the chapters in each chapter, also which concepts will have a more chances of getting tested in the examination. So I was doing all this kind of analysis. I have taken plenty of time, I have put a lot of efforts to create the resources with only one objective: to make this marathon as effective as it could be. So like the way you have all seen my content, if you have not yet watched my content, so just have a look at our YouTube channel. You'll be able to find a lot of resources. So there are so many videos relating to CA inter audit. There are so many resources relating to even CA final audit also. In the recent times, I have uploaded a lot of content regarding CA final, and your response has always been awesome. So first, I would like to thank each and every student who is watching my content, who is liking my content, who are sharing your positive comments below the videos, and you are sharing my content with your friends and all. So I'm very much indebted to you guys. So keep on showing that love and affection for me. You guys are actually the driving force behind. You are actually the motivating factor for me to do more work. This I always say because I have to admit it. So if I am getting motivation, energy to create these resources, to do the work for the students, the only reason is you once again. So the love and affection which you are showering on me, it's beyond my imagination. So I did not expect this much of love and affection. Thanks a lot for you all. Thanks for giving me all that energy. Thanks for giving me all that motivation. And I give a word from my side. I will keep on working more. I will try to generate even more and more resources. I want to create a lot of value addition in your preparation. I want each and every one of my student, and I want to see each and every one of my student into a complete chartered accountant. So that's what my vision has been. So definitely I will create a lot of resources for you. So keep on supporting me. Thanks a lot for you all, guys. So now, since I have prepared all the resources necessary for our marathon, it's good time so that we can start releasing the marathon videos or revision videos, whatever you want to call it. So like the way you have found value addition in all my videos, the same value addition you will find it even in this revision series as well. So thanks a lot. Having said that, I don't want to waste much of our time and energy. I know our time is very limited and we want to make maximum use of it. So before I actually go into the chapters discussion, I wanted to share a few points with you. There are few things which will help you to make this marathon, to make this revision series more effective. So there are few things I wanted to share with you. So just I will take few minutes, some two to 3 minutes I will take to explain some important points. And once we are done with that, we'll directly jump into the revision. So first thing which I want to bring it to your attention, see, throughout this revision series, I will be using various resources. So when I say resources, what do I mean by that? Number one, resources, the first resource I will be using is my material. CA final main material will be there. So throughout the marathon, you will be seeing this colored version of the material. This material, actually, I have put a lot of effort to bring this colored version of the material before you. So you will actually experience it when we start revising. You will actually feel the quality of that material. So I'll be using that kind of material, colored version of the material I will be using for the purpose of this revision series. So one doubt you will all ask me, sir, where can we get that material? So the soft copy of the material will be available on our website. I will take you to the website also now. Within a few minutes, I will take you to the website, which website and all. So, but just give me a moment before that. So what are the various resources I am going to use that I am going to highlight it before you? Number one, I'm going to make use of one main material, which is going to be comprehensive source. So you will not find anything missing from that comprehensive material. It is completely covered of all the content, whatever is relevant for your examination. You need not refer the study material. I can say that if you have gone through these materials, so that's all will be enough No need to go through the study material also, because I have covered every content which is there in the study material in this comprehensive material which I will be using throughout this revision series. So soft copy of the material, yes, it will be made available on the website. I will show you where to find it also. Number two, throughout this marathon, at various places, I will be making use of charts. I'll be making use of charts. I'll be making use of summarized notes and all. So some interactive things we'll be using for the purpose of this revision series. Sir, where can we find that charts and summaries and all? That also you can find it in the website. I will take you to there in a while. And number three, for the purpose of this marathon series, for the purpose of this revision series, I'll be using notes. I'll be writing the notes, right? So that notes also you'll be able to find it. Everything, whatever I'm going to make use of this, everything, whatever I'm going to make use of for this marathon, everything will be made available in the website. Sir, you are telling website, which website? So just you have to visit our website, www. So I'm writing it here, www.fingains.academy.com. So this is my website. The link you will be able to find it even in the description of this video. You can go to the description also. There also you can find the link. So just you have to visit this link. So once you visit that link, let me show you. So this is actually our website. See, this website is going through some changes, but the overall structure is going to remain the same, because I want to make this website even more interactive. The work is going on for that. So going forward, you will see the different interface, but one thing will remain common. Where you will find the resources, that will be common. So once you open this website, if you are able to see here at the top, so where you are able to see that login button is there, no? But before that, you'll be able to find something called resources. There's a tab called resources. Just go and click there, click on resources. When you open the resources, this kind of Google Drive link is going to get opened. You'll be able to find two folders there, CA Final Audit, CA Inter Audit. Just you have to open the folder CA Final Audit. And as you could see here, two modules of the material is there. Module 1, Module 2. This is a comprehensive material of all the chapters of the CA Final. So PDF copies are there, free for download. You need not pay anything for me. So just you can go and download that Module 2, Module 1, Module 2. These are main materials. And whatever charts I will be using, that charts I will upload in the charts folder. You will be able to see here, charts folder. In the charts folder, you will be able to find all the charts and summary notes. Then whatever marathon running notes I'm using, that also I will create one folder here. Marathon running notes, I will create one folder. Chapter wise, one file I will upload. That also you can download it. Clear? So this is one single comprehensive source where you can get all the resources free of cost. You need not pay me anything for that. Okay. So this is what one more thing which I wanted to share with you. Yes. So one thing I have clarified, resources, where you can get the resources that I have told you. Next. Sir, what is going to be the structure of this revision series? Revision series, you call it marathon, you call it whatever you want to call it, you can call it. So what is going to be the structure? See here in this marathon series, it is completely going to be examination oriented view. So whatever concepts which are going to be important for the examination, which are going to be relevant for your examination, we are going to touch upon each and every concept. If the time permits for me, I will try to make sure I will be covering 100% of the syllabus. If the time permits, we'll try to do it. But in the worst case scenario also, I'll be covering somewhere around 80 to 90% of the content. I will cover it. So this is going to be a one-stop revision requirement for your CFNL audit. That I can assure you from my side. Okay. Once again, most of the students often confuse this marathon with the regular classes. They know it, but even after knowing also, I sometimes get comments from the students, sir, if I am a listener for the first time, I did not read the audit content till now. I did not watch the regular classes till now. I have 1 month before the examination. If I watch your marathon, will I get through the examination? This is what one question I get receiving from various students. I hope you already know the answer. I know student already knows the answer to this question. If you have not, if till now, if you have not yet opened the study material, not yet opened the material, till now, if you have not watched the regular classes, just by watching marathon, just by watching the marathon in a month or two, if you want to clear the examination of the CA final, do you think CA final exams are so simple? If that is the case, then there will be so many chartered accountants you will be able to see it. But it is not the case, right? So it is not that simple. But I will say, if you have not done anything, nothing you have done till now regarding the audit, as a last chance, just you want to give your chance. You have an attempt, you did not prepare, you want to give a chance. So without instead of going to the examination without reading anything, by watching the marathon once you go. But I can't give you assurance that you will get passed. No one will give you that guarantee, right? So just by watching marathons only, is there 100% chance I will get through the examination? That I can't assure you. There might be a very rare probability. If your time is so good enough, there could be a very rare probability. I can't assure you that. But till now you have done enough of preparation. At least you have gone through all the content ones. You have done one round of preparation. Then I can assure you this marathon is going to help you a lot in clearing the CFNL audit examination. That assurance I can give you, not for the first time, not for the person whoever is watching this marathon for the first time. Okay, so I hope I have made that point clear. I know even after saying this also, still I will find comments on my YouTube video, or still I will find messages in my WhatsApp inbox or Telegram inbox, students asking the same thing. I know, yeah, some people expect these kind of things also, but sorry to disappoint you. So I wanted to be very clear about this. Clear, everybody? Yes. So this is one more thing which I wanted to share with you. So that's all, guys. So whatever, a few important things which are necessary before starting marathon that I have brought before your attention. So without any delay further, we will be directly jumping into the revision. Hope you guys will enjoy and learn a lot from this revision series. And if you find this videos informative, kindly do share it with your friends. Leave your positive feedback below these videos. Show your support by liking. You are doing it obviously, but do it more. So have a happy learning and have a joyful learning going forward. Thank you, everybody. So let us go into the revision now. Okay, guys, let us start our revision now with very first chapter, which is going to be Introduction to the Auditing. See, at the CA final level, see, before I go into the revision, one more thing I wanted to clarify. The most important thing, the most important skill which you need to have in order to get through the auditing examination is, the most important thing is conceptual clarity. This I always say, if you're my CA inter student as well, this is what I primarily focus as a part of my teaching. See, if I just read the content from the material and explain that to you, it is not going to help you out in the examination. So today, in order to get through the CA examinations, and it is actually a good sign, ICI not testing, not asking you to mug up the content and reproduce, but instead expecting you to apply the concepts, whatever you have learned, that is actually a very good thing. But what still most of the students lack today who go for the examination, and if the students are failing, the most important skill which most of the students are lacking is ability to understand the concepts. So you have to change your attitude now. So just reading the content, mugging up and reproducing the content in the examination is definitely not going to take you anywhere. So if you want to get to the examination, the most important thing is conceptual clarity. That will be my prime focus in this marathon as well. So mainly I'm going to focus on conceptual clarity. We'll try to understand the concepts in an in-depth manner. We'll try to revise the concepts in an in-depth manner. Number two, the second most important skill which you need to have in order to get through the examination today is question understanding capability. You should have a lot of patience. I will say patience. Patience is very, very important today. So when you look at the question paper, you will find very lengthy questions. You should not get distracted, or you should not get deviated by looking at the size of the question. So you have to read the question very carefully, try to absorb the facts, understand it in a correct perspective, absorb the minute details, whatever they are trying to say here, because today in the question here and there, a few tricky things will be there which will change the entire answer. So I will show you some examples when we go forward. I will bring before you a few examples also to make you understand the importance of reading the question with a lot of caution. So you should have conceptual clarity. Number two, you should have a lot of patience while reading the question. And one more thing, if you understand the concept in a proper way, I am telling you guys, case scenario based MCQs you can easily answer. If you don't have conceptual clarity, answering case scenario based MCQs is going to be a nightmare for you. So don't make your question paper a nightmare. Have the good conceptual clarity so that you can understand the question in a correct manner and reproduce the content in the proper manner. Okay, so what is going to be the prime focus of entire revision series? It's going to be primarily about conceptual clarity. That is going to be my prime focus. So as you all are aware, CA final audit is just an extended version of CA inter audit. In CA inter audit, we understand the basic concepts. On the basis of that basic concepts, we are going to build advanced concepts. We are going to build what? Advanced concepts at the CA final audit. Okay. So at the CA final level, we are going to learn some advanced concepts. So that's why when you look at the title of the subject also, they will call it advanced auditing. Advanced auditing. So why they call advanced auditing? Why? Because here we are going to learn advanced concepts on the basic things which we have learned at the CA inter level. So one thing I always say, if you are weak in your fundamentals, if you are weak in your basics, no matter how hard you try, advanced concepts, you can never ever learn it. If your fundamentals are not so strong, if your basics are not strong, no matter how much effort you put, advanced concepts you will never be able to understand. So one simple analogy which everybody will know. So if the foundation of the building is not strong, the entire building can't withstand any calamity. So that's why we have to make our foundation so strong that on that foundation we can build very complex and advanced topics without any confusion. So since at the CA final audit, we are going to have so many advanced concepts, it doesn't make sense unless we revise our fundamental topics. So unless we quickly revise all the fundamentals relating to the audit, advanced concepts are not going to make sense. So that's why the first chapter which I'm taking up for revision is Introduction to the Audit. Basically, this chapter contains a lot of things which you have already understood at the CA inter level. But I'm telling you, if you don't get hold of these concepts, it is not going to make any sense going forward. So that's why we will quickly revise the basic terminology, the basic terms which we use throughout the subject of the audit, so that these things will stay in our mind. And on that basis, when we start ahead with the next topics, you will be having a lot of clarity. Okay, right. So first of all, sir, you are telling advanced auditing, advanced auditing. First of all, what is the meaning of the term audit? So how can you define the term audit? So there is a definition given to the audit by the standards on the auditing. So the term audit has been defined something like this. So if we go ahead of the definition, it says an audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. So this is what the definition of audit says. Come on, repeat everybody along with me. What does the definition of audit say? An audit is an independent examination of financial information of an entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. So in this definition, there are various important terms are there. So once we get familiar with the terms whatever have been used in the audit, then this definition is going to become complete. So while reading the definition, I have already highlighted those important terms which have been used in the definition. So as you could see here, the first important term is independent examination. Then we have something called financial information. Then we have something called profit oriented or not, size or legal form detailing, and detailing expressing an opinion thereon. So we'll try to understand the definition in bits and pieces. Let us try to do it. So first of all, what exactly happens in an audit? Sir, what exactly happens in an audit? So they say an audit is an independent examination. So what basically happens in the audit is examination is going to happen. What is going to happen in the audit? So examination. When I say I'm auditing, so when you say, for example, you have done your articleship, you have to go to the client's premises. If your partner is telling, go and do the audit, what you will do there? So audit is basically an examination. Sir, what examination? What do you mean by examination? Examination in the sense verification. You are going and verifying, and or you can also call it as scrutiny. You are going and scrutinizing, or you can also say you are going and checking. You can also say you are going and observing. So many things we can say. So what basically happens in the entire process of the audit is, when I say I'm going and doing the audit, I'm trying to do verification, or I'm doing scrutinizing, or I'm going and checking, I'm going and doing observation. So audit is basically a process of examination. When I say audit, I'm doing verification. And audit is not an ordinary examination. It is not an ordinary verification. In the definition, they have told audit is an independent examination. What kind of examination it is? Independent examination. See, this term independent is very, very important from the perspective of the audit. Audit is an independent examination, and this term independence plays a lot of significance in the subject of audit. Sir, what do you mean by independence? What do you mean by general? What is the general meaning of the term independence? When I say I'm an independent person, what do I mean by that? Independent means I'm not dependent on anybody else. I'm free from influence. I don't depend on anybody. This is what the general meaning. But in the context of audit, the term independence means it is referring to a characteristic or quality of a person. In the perspective of audit, when I say independence, I'm referring to a quality of a person. I'm referring to a characteristic of a person. So what do you mean by that characteristic? Sir, what is independence? You are telling that is a characteristic of a person. What is the meaning of that? So in the terms of audit, independence means the ability to take a decision, the ability to take decision without any influence, the ability to take the decision without any influence, or you should not change your decision according to the wishes of the others. Whatever I feel it as right, I should say it as right. If I feel something as wrong, I should say it as wrong. So before saying my opinion, I should not say, oh, if I say this as wrong, what other person will think about it, how it will affect the other person. For example, you have been asked by one of your friend to comment on the food, to taste the food and share your feedback. Your friend, he or she, so they cooked the food and brought it to you. They asked you to taste it and give your opinion. See, you tasted the food, it felt very bad, but you don't want to say it on the face of that other person because you know that the other person will take it in a very wrong perspective. He will get hurt. He will not speak with me. He or she will not speak with me. Next time when I call her, she will not lift my call. So whatever it is, so many things are running in your mind, and you say that even though you don't like the food, you said that no, the food was tasting very good. Tell me, here you are independent? No. Why? Because you did not take the decision in an independent manner. Your decision was influenced by others. Yes or no? So that characteristic of a person where if I am saying my decision, if I am expressing my opinion, I should not change my decision under anybody's influence. Whatever I feel, that I should be able to speak out. That quality, that characteristic of a person, we call it as independence. So in audit, we do examination, we do verification, we check or we scrutinize something, and that is not going to be an ordinary examination. We do that examination in an independent manner, without any influence, without any bias, without any partiality. We do that examination. If we find something as wrong, we should be able to judge it as wrong. If we find something as correct, we should be able to judge it as correct. That quality, we call it as independence. So one thing is clear, what happens in an audit? In audit, examination happen. How that examination will happen? In an independent manner, without any influence. That examination is going to happen. Okay, one thing got cleared. In audit, we do independent examination. Of what? What is the thing we are examining? What is the thing we are examining? So that comes to the next part of the definition. So an audit is an independent examination of financial information. Sir, what is financial information? What is financial information? Financial data. What do you mean by financial information? Financial data. Sir, what do you mean by, can you elaborate it? What is included in the financial data? Okay, sir, you are telling in the audit, we examine financial information. Got it. But what is included in the financial information? See, every entity will prepare something called financial statements. Every entity will prepare something called financial statements. Sir, what is included in the financial statements? We have learned from a very long ago. Financial statements include balance sheet. Financial statements include statement of P&L. Financial statements includes cash flow statement. It includes statement of changes in equity. It includes notes to accounts. So all these 5 items put together, we call them as financial statements. Like I prepare a balance sheet, I prepare P&L, I prepare statement of changes in equity, I prepare cash flow statement. Notes to accounts also will be there. So this we call it as financial statements. When I say financial information, am I referring only to the financial statements? When I say financial information, does that mean only financial statements? No. To prepare these financial statements, there will be one source data. To prepare these financial statements, what will be there? Source data will be there. On some source, these financial statements will be prepared. If I have to put it another way around, there will be one large volume of data. From that, an extract will be financial statements. So what is that source data for the preparation of financial statements? That is nothing but, in our terminology, we call it as books of accounts. So the financial statements and the underlying data on the basis of which these financial statements are prepared. What is that? Financial statements along with the source data, along with that underlying data which has been used in the preparation of the financial statements, that consolidated information, that comprehensive information, we are going to call it as financial information. So in simple terms, a financial information means financial statements along with books of accounts. Along with what? Books of accounts. So when I say you are going to do audit, if I told you, boss, you go and do audit. So what you are going to do in that audit? You are going to go there, examine, and what you will examine? You will examine their books of accounts and financial statements. And how you are going to examine? In an independent manner. Without any influence, you are going to go and examine that financial information. Clear everybody till here? So one thing got cleared. What happens in the audit? In audit, we do independent examination of what? Of the financial information. Next, if you come to the next part of the definition of any entity. So you are going to go to some entity. That entity's financial information you are going to verify. Then the next part of the definition says whether profit oriented or not. So the entity for which you are going and doing the audit, the entity whose financial information you are going and verifying, whether that entity is a profit oriented entity or that entity is a non-profit oriented entity, that doesn't matter. That doesn't matter. That is not going to significantly change my audit. So if I have to give you one example, since you have all done your articleship, so sometimes you might be working in the Big Four. For example, you are working in the Deloitte. Now you are a part of the engagement. You are part of the Deloitte audit team. So one day your partner has came and told, we have to go and do the audit of Reliance Industries Limited. You have to go and do the audit of Reliance Industries Limited. So as we all know, Reliance Industries Limited is a profit-oriented entity. It is a profit-making entity. So Reliance is doing sales, it is incurring expenditure, it is buying assets, it is incurring liabilities. Why it is doing? Does the Ambani have any obligation to serve the society? No. Why he is doing? Why the Ambanis are doing it? For the purpose of making profit. So if you are appointed as auditor and someone is asking you to go and do the audit of the Reliance Industries Limited, what you do in that audit? You are going to independently examine that Reliance Industries Limited books of accounts and the financial statements. See, sometimes you might have, sometimes your partner might have told, today we have to go to so and so trust and we have to do the audit of that trust. You might have done it. You might have heard about it. At least if you are not a part of the team, might be the firm in which you are an article assistant, that firm might have even trust audits, society audits, they say, some religious places audits you might be having. So your firm might be doing audit of one temple, your firm might be doing audit of one church. So like that, sometimes you might be required to call upon, you might be called upon to do the audit of some non-profit oriented entities also, like trust or society, places of religious worship like temples, church, mosque. So whether the entity is a profit making entity like Reliance, or the entity is a non-profit oriented entity like a trust, society, or a religious place, the scope of audit is not going to change. Audit is going to remain the same. If you are conducting audit of Reliance Industries Limited, you go there, independently verify their financial statements and books of accounts. If you are conducting audit of any trust or society, there also that trust or concerned society will maintain books of accounts, will maintain financial, will prepare financial statements. You are required to go and independently examine them. Might be the balance sheet P&L of the title of the financial statements will be balance sheet, P&L, etc. In the case of Reliance, when you go to the society, the titles of the financial statements could be balance sheet, income and expenditure account, receipts and payments account. Titles are going to change, but ultimately there are going to be financial statements, there are going to be books of accounts. No matter whether it is a profit oriented entity, non-profit oriented entity, your scope of audit is not going to change. Everywhere you are going to independently examine their financial information. One more thing also, the definition is telling, irrespective of its size or legal form, which means the size of the entity for which you are doing audit doesn't matter. Take for example Reliance Industries Limited, the so-called 6,000 crores of revenue of a company. If you are conducting audit of that so-called India's biggest conglomerate having thousands of crores of revenue, what you do there? You go there, independently examine their financial statements and books of accounts, And if you are conducting audit of one small ex-private limited, one small company is there, which is hardly making a turnover of 1 crore, which is hardly making a profit of 10 lakh rupees, if you are appointed as auditor of this company ex-private limited, there also your scope is not going to change. Here also you will independently examine their financial statements and the books of accounts. So that's what they say, irrespective of size. The size of the entity doesn't matter. Everywhere your objective, your scope is going to remain same. And one more thing also it says, irrespective of legal form, which means legal form of the entity also doesn't matter. Legal form in the sense legal structure, how an entity is legally recognized. Like some entities might be legally recognized as sole proprietorship firms. Some entities might be recognized as partnership firms. Some entities legal structure will be LLP. Some entities legal structure will be private limited company. Some entities legal structure could be public limited company. So now they are telling even legal form also doesn't matter. If you are appointed as auditor of a sole proprietor, what you will do? You are going to verify their books of accounts and the financial statements. If you are appointed as auditor of a partnership firm, what you are going to do? You are going to verify their books of accounts and the financial statements. If you are appointed as auditor of LLP, same thing you are going to do. If you are appointed as auditor of a company, the same thing you are going to do. Legal form of your client also not going to have a significant impact on your audit. Clear, everybody? So till now, everybody clear with the definition? So till here, what did you understand from the definition of audit? An audit is an independent examination of what? Financial information of an entity. Whether that entity is profit oriented or not, doesn't matter. The size of the entity doesn't matter. Legal form of the entity doesn't matter. Understood till here? Next. Sir, what ultimately you are going to do? What is the ultimate objective of all this? What is the ultimate objective of all this? So the ultimate objective, sir, if I am doing an activity, there should be some purpose. No. What is the ultimate purpose of audit? The ultimate purpose, the ultimate outcome of that entire verification, examination, checking, that independence, what is the ultimate outcome of that entire work is expressing an opinion. Express an opinion thereon. Thereon means on whatever you have verified, on that you have to express your opinion. Sir, what is the thing I have verified, sir? I have verified the financial information, which includes the financial statements and books of accounts. So whatever things you have verified, on that you are required to express your opinion. On that you are required to express your opinion. So you have verified the financial information of a client. On that financial information, express your opinion. What are your views? Express your opinion. See, when you take any opinion in this world, any opinion of a person regarding any object, anything, so opinion of any person regarding anything or any object falls into only two categories. Either an opinion will be either a good opinion or it will fall under a bad opinion. Either it will fall under good opinion or bad opinion, or even you can call it as, it could be a positive opinion or it could be a negative opinion. Like if I give you simple analogy, if you are watching my revision videos, so this video you have watched, after that one of your student has asked your opinion. Boss, you have watched this person's video regarding revision of one of the chapter, did you like it? If you like this video, you will say, yes boss, I have liked it. That is a positive opinion or a good opinion. In case if you did not find this video informative, you will say to your friend, no, this video is not having any value addition. That is a negative opinion. Or if I asked you how my dress looks like, if you like it, you will say, yes, this is looking good, a positive opinion. If it doesn't look good, you will say, no, this is looking very bad on you, a bad opinion. So you take opinion regarding anything, there will be only two things, either a positive opinion or a negative opinion. You can't say it could be a positive also, it could be a negative also. You can't say it. If you say that, you don't have an opinion. If you say that it could be good also, it could be bad also, it is somewhere in between also, that means you are a fool. You don't have any opinion there. So if you have an opinion, that will either fall under good opinion, which is a positive opinion, or that will fall under a bad opinion, which is a negative opinion. Even audit is not an exception. Even audit is not an exception. In audit also, after you have done the independent examination of the entire financial information, you are required to express your opinion on that financial information, and that opinion also will fall under positive or negative opinion. Positive, sir, what does positive opinion in an audit indicate? Like, you have verified the financial statements and the books of accounts of Reliance Industries Limited, and you found that financial statements of the Reliance are accurate. Books of accounts of the financial statements are also proper. They did not do any mistake in that. And but before that, you need to remember one thing. It is whose responsibility to maintain books of accounts and the financial statements? It is whose responsibility to maintain books of accounts and financial statements? Will the auditor prepare it? No. The responsibility for preparation of financial statements and maintenance of books of accounts is always with the management. I know your practical experience might be contradicting, but for the standards' sake, for the concept's formal discussion, the responsibility for preparation of the financial statements and maintenance of books of accounts is always and always with the management. So management has to maintain books of accounts. Management has to prepare financial statements. And then as an auditor, what we do, sir? We go and verify whether that financial statements and books of accounts are given true and fair view or not. Did the management maintain proper books of accounts? Did the management prepare proper financial statements or not? That we have to verify. Now you will come and say, sir, whatever you are telling, that is contradicting with whatever we have done in our real life. I know, I agree with you, but this is what the theory says. Okay, I hope you are getting it, whatever I'm trying to say. Yes. So yeah, what I was telling, yeah, when you verify the financial information, that is financial statements and the books of accounts of Reliance Industries Limited, if you find that, okay, management of the Reliance has maintained proper books of accounts, they prepared financial statements in a proper way, they are as per Schedule 3, management did not do any omission, they did not commit any errors, even I did not find out any fraud also, everything was perfectly fine, then I will say, I will give a positive opinion on the financial statements. I will simply say, okay, financial statements give a true and fair view. Financial statements are giving what? True and fair view. That means there is nothing wrong regarding this financial data. They are conveying correct information only. So when you want to say that financial statements give a true and fair view, that is a positive opinion. You are commenting positively on the financial statements and the books of accounts. On the other hand, when you verified the financial statements and books of accounts, you found that in the books of accounts, some omissions are there. When they prepared the financial statements, they did not prepare the financial statements as per Schedule 3. The profit of the company was overstated. The liabilities of the company were understated. Cash flow statement was adjusted. It was not a genuine one. They have made a lot of changes. Or I am able to find that they did not prepare, the balance sheet was not matching. Whatever could be the reason. On the other hand, if you find anything is wrong with the financial statements and books of accounts, then you will say a financial statement, you want to give some negative comment regarding that financial statements. You don't want to say that financial statements are giving true and fair view because you found something suspicious regarding that financial statements and the books of accounts. So then you will say, okay, financial statements do not give it true and fair view. There is something wrong in the financial statements. So when you give that sort of opinion, that is a bad opinion or a negative opinion. Clear, everybody? So when you find financial statements are giving true and fair view, you will say positive opinion. On the other hand, on the basis of your verification, on the basis of your examination, if you are not happy with the true and fair view of the financial statements, you will give a negative opinion. See, this is layman terminology. Since we are at the introduction, this is a layman terminology, but going forward, we will learn the technical terminology. Positive opinion in the audit will be called as unmodified opinion. The positive opinion will be called as unmodified opinion. Negative opinion will be called as a modified opinion. There are various types of modified opinion also. All that we will revise in the chapter audit reporting. Clear? So this is what the entire definition of audit. With that, I hope everybody is clear with the definition of audit. So tell me, what is the definition of audit? Audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. Now, once we have understood about this definition of audit, the next most important terminology we have to understand. And in order to understand the next important terminology, we need to understand what are objectives of the auditor. So if you are a chartered accountant, so definitely you are going to become that. So please imagine. If you can't imagine something, you can't do it. So just imagine you are all chartered accountants. So you are a chartered accountant. After going through a lot of struggle, you qualified your CFM examination. So you chartered accountant, you are called upon by some company X Limited, they asked you to do the audit. They asked you to do the audit. What you will do? So will you go and say to the management, hey, I'm an auditor, I'm going to do independent examination of financial information, blah blah blah. If you read the definition out there, is the audit coming to an end? No. So if we are a chartered accountant, if we are appointed as auditor of some company, what are our objectives? What is our ultimate objective? Just now, as I have told, the ultimate objective of the auditor is to express an opinion. Just now, as I have told, the ultimate objective of the auditor is to express an opinion. And that opinion is required to be expressed regarding two things. That opinion is required to be expressed regarding two things. So what are that two? That only we call it as two objectives. So what are that two objectives of the audit or auditor? So the ultimate objective of the auditor is to express an opinion. On what? On whether financial statements are free from material misstatements, and also whether the financial statements are prepared as per applicable financial reporting framework. So if we are appointed as an auditor, the ultimate objective is to express the opinion. That opinion is required to be regarding two things: whether financial statements are free from material misstatements, and the other one is whether the financial statements are prepared as per applicable financial reporting framework. Once again, an obstacle. We came across new terminology once again here. We need to understand what is the meaning of the term material misstatement. We also need to understand what is the meaning of the term applicable financial reporting framework. These terms are so damn important. Our entire future discussion is based around or revolving around these terminologies only. So if we don't understand these terms meaning in a correct perspective, we will not understand the remaining chapters also. So we'll take some time, try to understand the meaning of these terms in a much more in-depth manner. So first we will try to understand about applicable financial reporting framework. Very, very important term. At various places you will come across this. So let me take some time to make you understand this. Applicable financial reporting framework. So what is applicable financial reporting framework? Let us try to break this also into different parts. First of all, what is the meaning of the term framework? Have you heard about this term framework? You might have come across at various instances. What do you mean? What is the meaning of framework? The framework simply means rules and regulations to do something. For example, if I say for attending my classes, there is a framework. You have to follow this framework to attend my classes. What do I mean by that? So if you want to attend my classes, there are some rules and regulations you have to follow. Or if I say, if you have to go to some meeting, this is what the framework. What does that mean? In order to attend that meeting, you have to follow rules and regulations. So simply, framework means set of rules and regulations to do some task, to do some activity. Okay, next. Financial reporting. Sir, what do you mean by financial reporting? You have one of your subject at the CA final level. You read a subject called financial reporting. So what do you mean by financial reporting? The financial reporting means the process of preparation and presentation of the financial statements, or the process of preparation and presentation of the financial reports. Sir, what is financial report? Nothing but our financial statements. So the process which is followed for the purpose of preparation and presentation of financial statements. The process which is followed for the preparation and presentation of the financial statements, that we are going to call it as financial reporting. So framework means set of rules and regulations. Financial reporting means the process for preparation and presentation of financial statements. So then what is the meaning of financial reporting framework? Simple, you have to club both. Framework means rules and regulations. Financial reporting means the process of preparation and presentation of financial statements. So then what is the meaning of financial reporting framework? Simply, the financial reporting framework means the set of rules and regulations which are required to be followed in the process of preparation and presentation of financial statements. That only we call it as financial reporting framework. What do you mean by that? Simply, if I have to put it, rules and regulations which you are required to follow in the preparation and presentation of financial statements, that we call it as financial reporting framework. As we all know, if you have to prepare the financial statements, will you prepare the financial statements as per your wish, or will you follow some rules and regulations? Will follow some rules and regulations or not? Like for example, if management, while preparing if the management of the Reliance have to prepare financial statements, will they prepare the financial statements as per their own set of rules and regulations? No. They follow some rules. What are that rules? Schedule 3 they follow, accounting standards they follow. So can I say Schedule 3 and accounting standards as a financial reporting framework? 100% yes. Without any doubt, you can say that. Why? Because Schedule 3 and accounting standards are nothing but the rules and regulations which are getting followed in the preparation of financial statements. So I can call Schedule 3 and accounting standards as applicable as financial reporting framework. So we understood what is financial reporting framework, but they're trying to say something like, what is applicable financial reporting framework? What is applicable financial reporting framework? Let us try to understand this term. As I've told you just now, who is responsible for the preparation and presentation of financial statements? Who will prepare and present the financial statements? Management. So the management of the organization, while preparing the financial statements, keeping in mind the nature of the entity, keeping in mind the purpose of the financial statements, the management will select a framework. The management of an organization, while preparing financial statements, keeping in mind what? Nature of the entity, keeping in mind purpose of the financial statements, the management themselves will choose, the management themselves will select a framework which is applicable for them. That chosen framework by the management, we call it as applicable financial reporting framework. Confusing? Let me give you one example. Take, for example, Reliance Industries Limited. Who is responsible for preparation of financial statements of Reliance? Management. Now, the management of the Reliance Industries Limited, while preparing their financial statements, they thought that, okay, what is the nature of our entity? The nature of our entity is a company. Since it is a company, we will prepare our financial statements using Schedule 3 and accounting standards. Who chosen it? Not the auditor, management. So the management, keeping in mind what? Nature of the entity, they have chosen Schedule 3 and accounting standards they will follow for the preparation of financial statements. So this Schedule 3 and accounting standards will become applicable financial reporting framework for Reliance Industries Limited. Clear? Next, let me give you one more example. SBI. The management of the SBI, while preparing the financial statements, they have decided, keeping in mind the nature of the entity. What is our company? SBI. SBI is what? Banking company. So management of SBI thought, okay, we'll do one thing. We will choose Banking Regulation Act as a framework for preparing our financial statements. Who chosen? Not the auditor. Management of SBI have chosen that they will follow Banking Regulation Act while preparing the financial statements. Now this Banking Regulation Act will become applicable financial reporting framework for SBI. Same Max Life Insurance Company, the management, while preparing the financial statements, keeping in mind the nature of the entity, they have decided we will follow IRDA rules and regulations for preparation of financial statements. IRDA will become applicable financial reporting framework for Max Insurance. So like that, depending on the nature of the entity and purpose of the financial statements, the management will choose. Very important, auditor will not choose. The management themselves will choose which rules they will follow in the preparation of financial statements. That chosen rules, we call them as applicable financial reporting framework. Understood? So if you come to the first objective, they are not asking the auditor to choose the applicable financial reporting framework. They are asking the auditor to express an opinion whether financial statements are prepared as per applicable financial reporting framework. Which means if you are conducting audit of Reliance, if the management has chosen Schedule 3 and accounting standards as their applicable financial reporting framework, as an auditor, I am required to verify whether really these financial statements are prepared as per Schedule 3 and accounting standards or not. In case if I am appointed as auditor of SBI, I need to express opinion whatever financial statements management have prepared, whether that is as per the Banking Regulation Act or not, that I have to give a comment. And if I am conducting audit of Max Life Insurance, I have to verify whatever financial statements of this Max Life Insurance company is there, they have prepared it as per IRDA rules and regulations or not, that I have to verify and give a opinion. I have to verify and give a opinion. Clear? So this is what the meaning of applicable financial reporting framework. I am telling you this term applicable financial reporting framework, we will come across at numerous places. Hundreds of places we will come across this term applicable financial reporting framework. So you have to be very strong in the definition of this term. If you don't understand this term, the discussion is not at all going to have any impact. So I hope you have understood what is applicable financial reporting framework. I know I have taken some little bit extra time for this, but that time is worth spending here. Clear? So I hope everybody is clear with applicable financial reporting framework. And one more thing, and one more most important thing which we need to understand is various types of frameworks. We need to understand what are the various types of framework. So on the basis of purpose, we can divide the financial reporting frameworks into two categories. Listen carefully. This discussion is also going to be a bit important. On the basis of purpose of the financial statements, we are going to divide the frameworks into two categories. One is general purpose framework and the other one is special purpose framework. Listen carefully, guys. Listen carefully because we have a dedicated chapters talking about this. So on the basis of purpose of the financial statements, we can divide the frameworks into two categories. General purpose framework or special purpose framework. Also, you can say general purpose financial statements or special purpose financial statements. Let us try to understand what is general purpose financial statement, what is special purpose financial statement, or what is the meaning of general purpose framework, or what is the meaning of special purpose framework. So general purpose framework means the framework which fulfills financial information needs of various users of the financial statements. If there is a framework, if we follow certain set of rules and regulations which will fulfill information needs of all the users simultaneously. For the purpose of preparation of financial statements, if I follow a set of rules and regulations, and by following that rules and regulations, whatever financial statements I have prepared, that will fulfill information needs of all the users. All the users of the financial statements needs will be satisfied. Every user of the financial statement will be happy if I follow certain rules and regulations. Everybody will accept that framework. We call it as general purpose framework. But before that, we need to understand who are various users of the financial statements. We have seen who will prepare financial statements, but let us see who will use the financial statements. So when I talk about users of the financial statements, see, employees are one users of the financial statements. Employees of the organization will use the financial statements to know whether the company is having, whether their jobs are secured or not. Management themselves will use financial statements for their decision-making purposes. The suppliers of the company will use financial statements to determine whether they can give credit to you or not. Investors will use these financial statements. Customers will use the financial statements. Investment analysts, research analysts will use the financial statements. Credit rating agencies will use the financial statements. Competitors will use the financial statements. Lenders like bankers will use the financial statements. And even government agencies are also going to make use of the financial statements. So these are all different users of the financial statements. Management will prepare, but that financial statements will be used by these many people. Now everybody is having their own requirement. Management wants financial statements for one purpose. Investors want financial statements for one purpose. Customers want financial statements for their own purposes. Everybody will have one dedicated use. Now you tell me, companies whatever are there, like take for example of Reliance only. Now Reliance financial statements are getting used by these many people. Do you think Reliance will prepare separate set of financial statements for every user separately? No, they will not prepare separate set of financial statements for every user separately. But instead, what Reliance will do is, after the completion of the year, they will prepare one set of financial statements following Schedule 3 and accounting standards. The management of the Reliance, after the completion of the financial year, they will prepare one set of financial statements by following Schedule 3 and accounting standard. So they followed a framework which is Schedule 3 and accounting standards. And these financial statements, they will upload it in their website. Now you tell me, those are financial statements which are prepared using this framework which is Schedule 3 and accounting standards and which is uploaded in the website of Reliance. Will that simultaneously satisfy all these users? Yes. So if investor want to know something about this company, he can simply go to the website, download the financial statements, his need will be fulfilled. If banker wants to know some information regarding this Reliance, he can go to the website, download that financial statements, his needs also will be fulfilled. If employees want to go through the financial statements, they can also go to the website, download that financial statements, their needs also will be satisfied. So if you pay close attention here, the company is following one framework, one set of rules and regulations they are following, and that framework is fulfilling information needs of all the users simultaneously. So as I have told, general purpose framework, if you read the definition of the general purpose framework, they say, yes, the general purpose framework refers to such framework which fulfills financial information needs of various users of the financial statements. There are so many users, but all that users requirements are getting fulfilled by one framework. That framework I call it as a general purpose framework. The examples are Schedule 3 and accounting standards. Examples are what? That's what you will see today. All the listed companies which will upload their financial statements on their website, they will be as per Schedule 3 and accounting standards because they fulfill financial information needs of all users simultaneously. So that is one example of general purpose framework. Clear? Okay, sir, we understood what is general purpose framework. Now, what is special purpose framework? If general purpose framework is a framework which fulfills various users' financial requirements, then what could be the meaning of special purpose framework? The framework which fulfills financial information needs of specific users. The framework which fulfills financial information needs of not all the users. For fulfilling information requirements of just some one or two users, if a separate rules are followed, that I call it as special purpose framework. What? To fulfill information needs of just one or two specific user. Some user wants some special kind of rules and regulations to be followed to fulfill that needs of that specific user. If the financial statements are prepared, that we call it as special purpose framework. I will give you one example, one simple example I will give you to make you understand this. Okay, so one simple example is going to be, take for example, this I use it very frequently, one simple example to understand, banker. Okay, so take for example, Reliance Industries Limited went to SBI for the purpose of loan. They went to the SBI and told, sir, we need 100 crore rupees of loan. And along with them, they have taken the last 4 or 5 years of general purpose financial statements also. The financial statements which are prepared as per Schedule 3 accounting standards. They have taken last 3 years of financial statements, went to the SBI manager and told, sir, we want 100 crores of loan. You can use our financial statements to determine our financial power. Please give us 100 crore rupees of loan. Now, the bank manager told one thing interesting. Okay, sir, you want me to give the loan? I will give you. But the thing is, if you expect me to give the loan, I have one requirement. What is that requirement is, you go back, prepare your last 3 years of financial statements on cash basis. On cash basis. See, whatever financial statements you have brought, that you have followed Schedule 3 and accounting standards. So you would have prepared that financial statements on accrual basis. I don't want it. If you want me to give the loan, I have one requirement. Go back, prepare your financial statements on cash basis. Go back and prepare your financial statements on cash basis. On that basis, I will give you loan. See, there is a logic also. Why SBI is asking this? There is a logic also. Why? Because the original repaying capability will be determined by your cash profits, not by accrued profits. How much you will be able to repay, that can be known only by cash profits. For example, as per your books, you have 100 crores of profit. But out of that, you have realized only 80 crore rupees. Will you be able to pay an EMI of 90 crore rupees? You can't pay. Sir, book profit is there, but entirely is not realized. No, your repaying capability is only 80, whatever has been realized in cash. So the banker, to determine the repaying capability, he asked you to go back and prepare the financial statements on cash basis. So now the management of the Reliance came back, they prepared the financial statements on cash basis, gave it to the manager. Manager was happy, gave the loan of 100 crore rupees. So now, if you pay close attention here, Reliance has followed a framework, has followed a rule of cash basis of financial statements, not to fulfill information needs of all the users, to fulfill information need of only one user who is a banker. So this is one example of special purpose framework. Cash basis of financial statements, the rule which has been followed, that is an example of special purpose framework. Why? Because that framework is fulfilling financial information needs of only one specific user, in our example, banker. If you go and give this cash basis of financial statements to other users, they will not accept it. If you go to the government and say, hey, I will pay the tax only on the basis of cash basis of the financial statements, government will say, get lost. We want you to pay the taxes as per on your accrued profit. So that is what the main difference between general purpose framework and special purpose framework. General purpose framework fulfills the financial information needs of various users simultaneously, whereas special purpose framework will fulfill financial information needs of only specific user. And we are going to have a dedicated chapter talking about the special purpose financial statements, how you will do audit of special purpose financial statements when financial statements are prepared for specific persons, for the requirements of specific persons, how you have to do audit of them, that we will see later. We have a dedicated standards talking about it, so we'll talk about it later. So one thing I hope you should have got cleared, the difference between general purpose framework and special purpose framework. Now, next part. Okay, on the basis of purpose, we have seen segregation. Now let us try to understand one more segregation, the most important segregation. There is one more classification of framework on the basis of presentation. On the basis of presentation, we have one more important classification of the frameworks, which is going to be fair presentation framework and compliance framework. On the basis of presentation, the financial reporting frameworks are once again divided into two categories. Number one is fair presentation framework and the other one is compliance framework. Let us try to understand what is this fair presentation framework, what is this compliance framework. So first we will talk about compliance framework, which is very easy to understand. The name itself says. So if we read it, the compliance framework in which the financial statements are prepared as per the requirements of such framework. The most important thing, without any deviation. The most important thing here, without any deviation. So in the case of compliance framework refers to such a framework where you are required to prepare the financial statements as per the requirements of the framework without any deviation. Deviation is not permitted. Whatever has been mentioned in the framework, that has to be strictly followed. Like for example, there is some framework which is asking you to prepare the financial statements as per 10 rules and regulations. If it is a compliance framework, you are strictly required to follow 10 rules. You cannot deviate. By following these 10 rules, whether you get a true and fair view or not doesn't matter. Whatever has been given, whatever rule has been given, exactly you have to follow. You are not permitted to deviate at all. So such a framework which are very strict, where you are not permitted to deviate from the requirements of the framework, where you are required to follow strictly whatever has been mentioned. It doesn't matter by following that rules you are going to get a true and fair view or not, doesn't matter. So deviation is not at all permitted. So that kind of frameworks we call them as compliance framework. The name itself says compliance. You have to strictly follow. Deviation is not permitted. Clear? Next. Sir, what is a fair presentation framework? Let us read it. We'll get to know about it better. So fair presentation framework says the framework in which financial statements are prepared as per the requirements of such framework. In the fair presentation framework also, we will try to prepare the financial statements as per the requirements. Whatever has been told in the framework, we try to follow it. It looks the same like compliance framework, but see the next part of the definition. It doesn't stop there. It says the framework in which financial statements are prepared as per the requirements of the framework. In that, we will try to prepare financial statements according to whatever has been told in the framework, but we may provide additional disclosures beyond the requirements of the framework. That means if we want, we will try to follow whatever has been mentioned in the framework, but here there is a permission for us to give extra disclosure, to give extra explanation beyond the requirements of the framework. So whatever has not been mentioned in the framework, we can give extra explanation in the financial statements. We are permitted to give extra explanation in the financial statements, or even we are given permission to deviate from the requirements. Even what permission is also there? We are even given the permission to deviate. That means ignore whatever has been told in the framework, follow something else also. Sir, why we have been given the permission? See, two permissions they are giving. In the fair presentation framework, we try to prepare the financial statements as per the framework, but here we are permitted sometimes to give extra explanation, or sometimes we are given permission to deviate, ignore whatever has been told and follow something else. Sir, why that permission has been given? Why they are giving us that permission to provide additional disclosure? Why they are giving us a permission to altogether deviate? Because the ultimate objective is to achieve the fair presentation. As the name itself says, in the fair presentation framework, the objective is not compliance, the objective is fair presentation. So in the fair presentation framework, ultimately you have to follow rules and regulations to achieve true and fair view. For the purpose of achieving true and fair view, either you can add extra explanations in your financial statements, or you can deviate also. Whatever has been mentioned in the framework, you can ignore it and follow something else also, but your objective should be to achieve fair presentation. There should be fair presentation. In the case of compliance framework, fair presentation is not the priority. There is no deviation permitted. In the compliance framework, you have to strictly follow. Deviation is not at all permitted. See, I will give you one example to make you understand this compliance framework and fair presentation framework. So this is one example which has been given in the standards itself. That example only I will explain. See, take for example, there is a company which purchased a plant and machinery, which purchased a plant and machinery for a cost of 1 crore rupees. For a cost of 1 crore rupees. Now, as we all know, as per the Companies Act, you have to charge a depreciation either under SLM method or WDV method. We also know that for SLM WDV, the rates are also specified in the Companies Act itself. If you follow SLM, the rate of depreciation is 10%. If you have to follow WDV, the rate of depreciation is 15%. Rate of depreciation is 15%. So, if it is a compliance framework, in the books of accounts, you have to follow strictly this depreciation. I assume residual value as 0. It should not be, but for the simplicity in calculation, I'm assuming residual value as 0. If you are following compliance framework, you have to charge a depreciation either as 10 lakh rupees or 15 lakh rupees. You are not permitted to show any other figure, because without any deviation you have to follow. So Companies Act says either SLM or WDV at this rate. So strictly what you should do, either you have to charge a depreciation in the statement of P&L either as 10 lakh rupees or 15 lakh rupees. Whether that gives a true and fair view doesn't matter. Strictly you have to follow. Now, let me add one more information. Let me tell you consumption pattern of this plant and machinery. What is the consumption pattern? See, this plant and machinery was designed in such a way that it will exactly produce 1 lakh units. Exactly produce 1 lakh units. After 1 lakh units, it will stop working. And in year 1, using that plant and machinery, they have produced 30,000 units. Now you tell me, looking at the consumption pattern of the machinery, some other method of depreciation is looking more appropriate. Looking at consumption pattern, some other method of depreciation is looking more appropriate. What is that? Production units method. So in the production units method, see, the machinery cost is 1 crore. Total units are 1 lakh. Out of that, 30k was used in a current year. So if you go by that rule, if you follow production units method, 30 lakhs should be depreciation in year 1. You tell me, if you follow SLM, 10 lakhs is the depreciation. If you follow WDV, 15 lakhs will be depreciation. If you follow production units method, 30 lakhs will be depreciation. Which one will give true and fair view? Which one will give more fair presentation? As we all know, the method of depreciation should reflect actual consumption pattern. The method of depreciation should reflect actual consumption pattern. Which one is reflecting actual consumption pattern? Production units method. See, if it is a compliance framework, deviation not permitted. Even though 30 lakhs is giving fair presentation, you are still required to show the depreciation as either 10 lakh rupees or 15 lakh rupees. However, if it is a fair presentation framework, you can do two things. Either you can give additional disclosures, or you can deviate. Why? Because we have to achieve fair presentation. The framework says either follow SLM or WDV. But in the fair presentation framework, you are given permission to either add extra disclosure or deviate. Sir, what do you mean by additional disclosure? So if I want to go by additional disclosure, what I will do is, in my statement of P&L, I will charge depreciation either as 10 lakh rupees or 15 lakh rupees. I will charge my depreciation either as 10 lakhs or 15 lakhs. But in the notes to accounts, I will add one extra explanation. What explanation I will add? See, in the statement of P&L, we have charged a depreciation as either 10 lakh rupees or 15 lakh rupees because it is a requirement of Companies Act. But looking at the consumption pattern, production units method is more appropriate. If we would have followed the depreciation method, the depreciation would have been 10 lakh rupees and our profit would have been this much. What I am doing? Extra disclosure, extra explanation, I am giving it in the notes to accounts. Is it required by the framework? No. I am voluntarily coming forward, giving one extra explanation. For what purpose? Why I am adding this extra explanation? For better presentation, for achieving fair presentation. I have an intention that if someone comes and read this point, he will get extra better clarity. So for fair presentation, I have provided additional disclosure. This is one option. Another option is I can deviate. So here what I can do is, in my statement of P&L, I will directly charge the depreciation as 30 lakh rupees. Here what I am doing? Ignoring whatever has been told in the framework, following something else. Sir, why I have deviated? Because my objective is to achieve a fair presentation. So if that permission is there, what is that? If that permission is there, what permission? To either provide additional disclosure or deviate from the requirements of the framework For what purpose? To achieve fair presentation. Such a kind of frameworks I'm going to call it as fair presentation framework. Such a framework I'm going to call it as what? Fair presentation framework. Clear? So you tell me, between compliance framework and fair presentation framework, where there will be always true and fair view? In the fair presentation framework, there will always be true and fair view, but in the compliance framework, there may or may not be true and fair view. It is not guaranteed. True and fair view may not be guaranteed in the compliance framework, but fair presentation framework always will have true and fair view. Clear? Able to understand? Now, so I want to put one important doubt in the minds of you. See, companies like Reliance or all other listed companies, on their official websites, you will be able to find the financial statements. My doubt is, Schedule 3 and accounting standards, whatever we are following, is it a fair presentation framework or is it a compliance framework? All the listed companies who are preparing their financial statements and uploading it in their websites. So whatever financial statements they have prepared, whether they are as per fair presentation framework or compliance framework. Which means I'm asking, are the companies permitted to deviate or the companies not permitted to deviate? If you say, sir, companies are not permitted to deviate from Schedule 3 and accounting standards, they have to strictly follow. It could be Ind AS also. So if you are telling companies are not at all permitted to deviate from the requirements of Schedule 3 and accounting standards, they have to strictly follow, then it becomes a compliance framework. If you are telling, no, sir, companies are given the permission. If they want, they can deviate from the Schedule 3 and accounting standards. Then you are telling fair presentation framework. Tell me your answer now. So the companies which are preparing their financial statements, uploading it on their websites, are they following fair presentation framework or compliance framework? Are they permitted to deviate or they are required to comply with it without any deviation? The answer is what? The answer is not compliance framework. The answer is fair presentation framework. The companies are actually permitted to deviate from the requirements of Schedule 3 and accounting standards. This I am not saying. Companies Act 2013 itself is telling. Who is telling it? Companies Act itself is telling if the companies want, they can deviate from the requirements of Schedule 3 and accounting standards to get a true and fair view. Sir, no, sir, you are cheating. I will prove you. So in order to know where they are telling it, so you have to go to section 129 of the Companies Act. So section 129 of the Companies Act is actually the section which is talking about the preparation of financial statements. So if you go to the, yes, come on, it is not coming. Okay, so just for the sake of our convenience, I'm showing section 129 of the Companies Act. So if you see the section 129 of the Companies Act, and in that also subsection 1, if you see, they say, the subsection 1 says the financial statements shall give a true and fair view. What it is telling? The financial statements shall give a true and fair view of the state of affairs of the company and comply with accounting standards, and also in the form as prescribed in Schedule 3. Yes, section 129 is telling you are required to comply with accounting standards in Schedule 3, but beyond that, the priority has been given that the financial statement shall give a true and fair view. The Companies Act is telling you to follow Schedule 3 and accounting standards, but even prior to that, the more emphasis is on true and fair view. That means Companies Act is asking you to prepare the financial statements that give a true and fair view, and where true and fair view is possible, in the fair presentation framework it will be possible. But most of the students will not get convinced with this explanation. They will still come back and say, okay sir, the Companies Act is telling give true and fair view, but also it is telling you to comply with the financial statements in Schedule 3. I will call it as compliance framework only. Might be Companies Act is telling you to give true and fair view, but they're also asking you to check the compliance with Schedule 3 and accounting standards also. No, I will call it as compliance framework only. Okay, even I want to convince this category of the students also. Let us come to subsection 5. The same section 129, subsection 5. If you come here, subsection 5 says without prejudice to subsection 1. That means ignore whatever has been mentioned in the subsection 1, where the financial statements do not comply with the accounting standards. In case if the financial statements are not complying with the accounting standards in subsection 1, the company shall disclose in the financial statements the deviation from the accounting standards. That means subsection 5 is indirectly telling if you don't want to comply with the standards, don't comply, give a disclosure. That means indirectly subsection 5 is permitting you to deviate from the requirements of accounting standards. For what purpose? For achieving fair presentation. So the conclusion which I want to make here is today the companies, whatever financial statements they are preparing as per the Companies Act, Companies Act is actually offering a fair presentation framework. It is giving you permission to deviate to achieve true and fair. Clear? Right. So yeah, this is what one more important discussion. So what is a compliance framework? What is a fair presentation framework? And one more thing, most of the special purpose financial statements will follow compliance framework. Most of the general purpose financial statements will follow fair presentation framework. Nothing but general purpose financial statements are those which will fulfill information needs of many users now, and most of the users information needs will be fulfilled only when they are giving true and fair view. So that's why most of the general purpose financial statements are prepared as per fair presentation framework. Clear? So where our discussion started, why we discussed all these types of the framework, where our discussion originated, why? Because we are learning something called objectives of the auditor. In that, one of the objectives was the auditor has to express an opinion on whether the financial statements are prepared as per applicable financial reporting framework. As a part of that objective, we understood what is applicable financial reporting framework, and as a further extension, we also understood various types of framework. On the basis of purpose, we have understood general purpose framework and special purpose framework. On the basis of presentation, we have understood compliance framework and fair presentation framework. Clear? So one objective we are done. There is one more objective. The auditor shall express an opinion whether financial statements are free from material misstatement. So this is one more fundamental term in the audit. So we have to get aware of it. Misstatement. So we have to understand the meaning of the term misstatement. This is very, very important term. So what is the meaning of the term misstatement? Statement means what? Saying something. Misstatement means what? Saying something in a wrong way. And that means conveying wrong information. I can say that. So misstatement means conveying something in a wrong manner. Conveying wrong statements. What do you mean by misstatement in the financial statements? If something is wrongly stated in the financial statements, that only I call it as a misstatement. If something is wrongly stated, if there is some mistake in the financial statements, if I put it in simple terms, I always say try to simplify the concept as much as you can. Mistake, a misstatement in the financial statements means a mistake in the financial statements. This is a simple definition. This is a simple meaning. But we all know we don't, examiners don't like simple things. They want to complicate everything. So simple meaning of the term misstatement is a mistake in the financial statements, but they have even made this definition very complex. The definition of misstatement, something they have given like this, but ultimately it will say the same thing, mistake in the financial statements only. Even after deeper analysis of the definition also, you will come and say, sir, simply it means mistake only, no? Yeah, so I will make sure that you will say it. So if you read this is some complicated definition for this term misstatement. Let us see what they are telling. So misstatement means the difference, okay, between what? Amount, classification, presentation, disclosure, which is there in the reported financial statements, and amount, classification, presentation, disclosure, which is required as per applicable financial reporting framework. As I've told, nothing will be able to understand. So I will give you time, read the definition once, try to understand what they are trying to say. So I have given simpler version also. A misstatement means a mistake in the financial statements. This is my simpler version, but this is the definition, standard version. So what basically they are trying to say is, if there is any difference between amount, classification, presentation, disclosure, which is there in reported financial statements, the financial statements which are already prepared by the management, amount, classification, presentation, disclosure, which is there in the reported financial statements, and amount, classification, presentation, disclosure, which is required as per applicable financial reporting framework, if there is a difference between the two, that we call it as mistake. That's it. So the difference between amount, classification, presentation, disclosure, which is there in the reported financial statements, and amount, classification, presentation, disclosure, which is required as per applicable financial reporting framework. So that difference we are going to call it as a misstatement. For example, take for example, as per some Ind AS, as per Ind AS 115, the revenue which the company is required to recognize is 1 crore as per applicable financial reporting framework. But in the reported financial statements, in the financial statements prepared by the management, they have shown an amount of revenue as 1.5 crore. So there is a difference in amount which is there in the reported financial statements and the amount which is required as per applicable financial reporting framework. This difference we call it as what? Misstatement. Or as per some Ind AS, some expenses required to be classified as capital expenditure, but in the financial statements prepared by the management, they have shown it as a revenue expenditure. Difference in classification, misstatement. Or presentation. As per Schedule 3 and accounting standards, the management is required to present the financial statements in the vertical format, but in the financial statements prepared by the management, they have followed T format of the financial statements: assets, amount, liabilities, amount. There's a difference in presentation, misstatement, or there is some disclosure, some explanation is required to be given in the notes to accounts as per applicable financial reporting framework. As per some Ind AS, some extra notes to account is required to be given, but in the financial statements prepared by the management, either that disclosure is not given, either that explanation is not given in the notes to accounts, or that explanation has been given in a wrong way. There could be a difference in the disclosure also, that also we call it as a misstatement. So if there is any difference between amount classification, presentation, disclosure, which is there in the reported financial statements, and amount classification, presentation, disclosure required as per applicable financial reporting framework, that we call it as misstatement, and misstatement only we call it as simply a mistake in the financial statements. And here one important key takeaway from this discussion is, see, when I say mistake in the financial statements, most of the people will imagine, or just now you imagine, if I am telling there is a mistake in the financial statements, what immediately comes to your mind? The thing which you will imagine is, okay, there is something wrong in the profit, there is something wrong in the asset, there is something wrong in the balance sheet, there is something in the cash flow statement. Always you think in monetary terms only. But remember, a mistake in the financial statements need not always happen only in the amounts and balances. A mistake in the financial statements can also happen in the notes to accounts. In the notes to accounts also, there could, in the notes to accounts also, if there is something wrongly stated, that could also cause a misstatement, change your perception. Going forward, when I say there is a mistake in the financial statements, don't just imagine only the monetary amounts. There could be a misstatement in the notes to accounts also. Clear? Understood? Right. So in the definition, in the objectives, they have used the term material misstatement. They did not just say misstatement, they have used the term material misstatement. So now it becomes necessary for us to know what is material. So materiality is also one of the very important term, one of the very fundamental term in the various chapters at various places. Hundreds of times we are going to come across this term material. So what is material? In simple terms, materiality means something which is significant, something which is important, something which is major. So something which is significant, important, major, something which is influencing the decision of a reader of the financial statements, we call it as mistake. We call it as material. Like, for example, if you are reading financial statements of Reliance, you came to know that in the Reliance company, there is a 10 lakhs worth of fraud happened. So you are a person, you have some 1 lakh rupee of money, you want to invest your money in Reliance Industries Limited. Before you invest your money, when you are reading the financial statements, you came to know there is 10 lakhs worth of fraud which happened in Reliance. The Reliance is of the size of 6,000 plus crores of revenue. So as a reader of the financial statements, when you came to know about this misstatement of 10 lakhs, will it influence your decision? Will you stop investing your money in the Reliance after coming to know about 10 lakhs rupees of fraud? No. Why? Because 10 lakhs is nothing. The company, the Reliance financial statements are rounded off to crores. The Reliance company's financial statements itself are rounded off to crores. So this 10 lakhs will go in rounding of error itself. So you came to know there is a misstatement, but that is not going to impact your decision. That is not going to have an influence on your decision. So this we don't call it as material misstatement. There is a misstatement, I will say there is a mistake in the financial statements, but I don't call it as material. Why? Because it is not impacting a decision of the user. On the other hand, you are an investor, you have 1 lakh rupees of money, you are reading the financial statements of X Limited company, its revenue is hardly 1 crore, you came to know in this company 10 lakhs worth of fraud has happened, will you stop yourself from investing the money in the company? 100% yes. Sir, same misstatement, same 10 lakhs here, same 10 lakhs here. But facts and circumstances are changing. Okay, so whatever is material in one circumstance may not be material in other circumstance. So we can't say 10 lakhs is material, 1 crore is material, 10 crores is material. We can't express in exact terms what is material, what is not material. It all depends on facts and circumstances. Like 10 lakhs might not be material in Reliance. The same 10 lakhs could be material for a company X Limited, which is hardly having a turnover of 1 crore rupees. So as an auditor, you need not be concerned about each and every misstatement. You need not bother yourself with each and every small amount of misstatement. You should be bothered only about material misstatement, only which could be significant, major. So the term materiality has been defined something like this. So if you come here, material means significant or important. A misstatement will be considered as material if it influences the decision of user of the financial statements. Because of a misstatement, if a user's decision is getting influenced, like as I've told, I'm an investor. Even after coming to know about 10 crores worth of fraud, I did not change my decision. I did not change my decision. So that is not material. Whereas in some other company, I stopped myself from investing. There it is material. Okay, so materiality is a relative term. So whatever is material in one circumstance might not be material in another term. Might not be material in another circumstance. Clear, everybody? So for the time being now, this much is enough. What is material? Which is significant or major, which could influence the decision of users of the financial statements. More about the materiality we will learn in the standard SA 320. We will discuss something called SA 320. There we will get to know more about this materiality. For the time being now, just remember this much portion. So the first objective is, as an auditor, you need to express an opinion whether financial statements are free from material misstatements. You have verified financial information now, whether that contains a misstatement or that does not contain any material misstatement, that you have to express your opinion. And also you are required to express your opinion whether financial statements are prepared as per applicable financial reporting framework. So I will say the most important discussion which we had in this chapter that will be useful in our subsequent chapters is what is the meaning of applicable financial reporting framework and types of framework, what is the meaning of the term misstatement, what is the meaning of the term materiality. These are very fundamental terms. If you don't understand it, there is no discussion about the subsequent chapters. Clear? Right. And one more thing we often come across, engagement. One more thing which we often come across is the term engagement. Sir, what is the meaning? We say audit engagement, assurance engagement. So like that, we continuously come across the term engagement. Sir, what is the meaning of the term engagement? You will say something which happens before marriage. That is not the only engagement. The term engagement means any mutual promises between two persons. We call it as engagement. Like a doctor agreed to treat a patient, patient agreed to pay the fees to the doctor. There is an engagement between doctor and the patient. That doesn't mean doctor and patient are going to get married. A lawyer has agreed to fight the case for his client, client agreed to pay the fees to the lawyer. There is an engagement. That doesn't mean lawyer and client are going to marry. So the engagement which you know is only one form of engagement. The term engagement is very broader. An agreement, a contract for mutual promises, we call it as engagement. Similarly, we chartered accountants also do engagements only. Like for example, one day I'm a chartered accountant, I'm sitting in my office, a client came to me, sir, you please do the audit. I told yes, the client told, and I said, sir, you please pay me the fees. I will do the audit, you pay me 1 lakh rupees of fees. So now there is a engagement, audit engagement between the client and the auditor. Clear? So going forward, engagement means simply an agreement to do some work with mutual promises. That's it. And one more thing at this point, I would like to bring it to your attention. See, we are chartered accountants. I'm a chartered accountant, no doubt about it. You will also become chartered accountant. Definitely you will become chartered accountant at some point of time in the future. Be it in the coming 2 months, be it in the coming 6 months, be it in the coming 1 year. At certain point of time, you're all going to become the chartered accountants. And I hope you will become as early as possible. Okay. So you are a chartered accountant. Do you think being a chartered accountant, we do only audits? Do you think we do only audits? Definitely not. Audit is only one form of engagement. Audit is only one form of engagement. If you are already into articleship, especially into big four entities, if you are into articleship, apart from audit, you might have done various other engagements. So in audit, we verify historical financial information and express an opinion. That is one form of work we are doing. So audit is not the only engagement. Audit is one of the engagement. Apart from audit, we do various other works also. So there are different kinds of engagements. Like sometimes we do something called review engagement. Sometimes we do something called assurance engagement. Sometimes we do something called related services. So like that, the way we chartered accountants can make money, can make a living are enormous. It doesn't mean we only do the audit to make a living. Apart from the audit, there are various other kinds of engagements which we can do. Some engagements we call them as review engagements, some engagements we call them as assurance engagements, some engagements we are going to call it as related services. What are all these different engagements? In review engagement, what we will do, in assurance engagement, what we will do, in related services, what we will do, all this we will discuss in our subsequent discussions. So we have a dedicated chapter which is talking about review engagement. We have a dedicated chapter talking about assurance engagement. We have a dedicated chapter talking about related services. But just I want you all to open up your mind that we don't generate revenue only from audit engagement. We can make a living out of doing separate kind of engagements. Clear? So this much clarity you need to have. So with this discussion, introduction to audit revision part, I will try to complete it here. Remaining discussion we'll try to revise in the subsequent chapters. Clear, everybody? Yeah. Hey guys, welcome back to the revision series. So in the previous session, we have successfully revised the chapter Introduction to the Audit. So in which we got familiar with what are all the basic terms which will be used throughout the subject of the audit. We got familiar with basic terminology like what is the meaning of the audit, what is the meaning of applicable financial reporting framework, what is the meaning of the term misstatement, what is the meaning of the term materiality. So these are all going to be the terms which we are going to use throughout the subject of the audit. Unless we are strong in that fundamentals, all the advanced concepts are not going to make any sense at all. So that's why we spend some amount of time in revising all the content of the chapter relating to introduction for audit. So now the next chapter which I am picking up for revision is going to be audit reporting. So very important chapter from the examination perspective, not just from the examination perspective, even from the practical perspective, even for your real life also, even your real life practice or job also, this chapter is going to play a very significant role. So that is going to be the next chapter which we are going to take up for revision. Once again, I am telling you, very important. A significant weightage will be there in the examination from this chapter. And one more important thing here is this chapter is very interesting. It is going to be damn interesting. So I will try to revise all the content from this chapter, audit reporting, in a very short span of time. Okay, right. We'll not rush through the things. We will spend time wherever required. We'll go deep in certain concepts. Revision will the concepts that are not so important, that will cover them quickly. So I will do it in a proper way so that it will be beneficial for the students. So the next chapter which we are going to revise is audit reporting. See, but before revising audit reporting, it will be making more sense first if we pick one more small standard and complete that revision, which is audit evidence. So SA 500 we will try to pick up first and we'll try to complete it. Why? Because SA 500 is also one of the foundational standard. If we become familiar with the concept of audit evidence, then the revision of audit reporting is going to make even more sense. So that's why what we will do is, before we proceed for revising audit reporting chapter, first we will quickly try to wind up audit evidence chapter. Okay, not audit evidence chapter. From the audit evidence chapter, a small standard, SA 500 standard, we'll try to wind it up. Once we are done with that, we can happily proceed further with the audit reporting. So let us now try to understand, let us now try to revise the concept relating to audit evidence. Guys, if you remember from the previous chapter's revision, I have told what is the ultimate objective of the auditor, what is the ultimate outcome, what is the final outcome of the entire process of the audit. So I have told you that the ultimate outcome of the entire process of the audit is auditor's opinion. So the auditor is doing independent examination of financial information irrespective of profit orientation, size or legal form, all that we have seen. But ultimate objective, the process of audit will actually come to an end by the auditor expressing an opinion. So, and as I've already told you, opinion can be of two broad categories. Either that could be a positive opinion or that could be a negative opinion. But if tomorrow someone is coming and asking you, for example, you have been appointed as auditor of some company, Reliance Industries Limited. You verified their financial information, you verified their books of accounts, you verified their financial statements, and you have given your opinion, be it positive opinion, be it negative opinion. If I go into technical terminology, be it unmodified opinion, be it modified opinion. So you have given some sort of opinion. Don't you think if tomorrow someone is coming and asking you, boss, you have given this opinion, what is the basis for your opinion? On what basis you have given the opinion? So if someone is coming and asking you, you should have some information to prove your point or not. Obviously, right? It is not just in the audit. If you have given opinion regarding anything, for example, as I have told you, if someone has asked you your opinion regarding this revision series, you will tell your opinion whether these revision classes are good or bad. You will give your opinion, but there should be some basis on which you have given that opinion. Even auditing is also not an exception. If tomorrow someone is coming and asking the auditor, boss, you have given opinion on so and so company's financial information, either that could be positive or negative. What is the basis? What is the information on the basis of which you have given the opinion? Every opinion needs some underlying information. Even for expressing opinion also, there should be some information on the basis of which auditor has given the opinion. So that information which forms the basis for auditor's opinion, that we are going to call in the audit terminology as audit evidence. What we are going to call it as? We are going to call it as audit evidence. So what is the simple meaning of the term audit evidence? The information which is used by the auditor to form an opinion. So whatever opinion you have given, there should be some supporting information. That supporting information, we are going to call it as audit evidence. If you give the opinion without any evidence, that opinion is not going to have any value. That opinion is not going to have any value. So most important thing, ultimate objective of the auditor is to express an opinion, but just in fluke, we cannot express our opinion. We need some supporting information to express that opinion. That supporting information, we call it in the audit terminology as audit evidence. And as we all know, just because you are appointed as an auditor, evidence will not come and fall in your lap. Take for example, I am a practicing chartered accountant. One day, Infosys company has came to me and told, boss, you have to act as an auditor for our company. So I'm a practicing chartered accountant. I was appointed as auditor of the company Infosys. After the completion of audit, as I've just now told, I'm required to express my opinion. But as I've just now once again told, before for expressing opinion, I need audit evidence. See, just because you are appointed as an auditor, the moment you go inside the client's premises, evidence will not automatically come and fall in your lap. It is not some God's activity where you go into the moment you are appointed as an auditor, you will get a dream, all the evidence you will get. It is not going to happen. So in order to derive that evidence, we need to perform some procedures from our side. 100% that is required. If you want to get that evidence, it is not just going to come to you just like that. You need to perform some procedures. So those procedures which are performed by the auditor to obtain that evidence, we are going to call that as audit procedures. We are going to call it as what? Audit procedures. So if tomorrow someone is coming and asking you, boss, what are audit procedures? Audit procedures are nothing but those procedures, those efforts which are put by the auditor to obtain the audit evidence. We call them as audit procedures. So by performing the audit procedures, we are going to get the information which forms the basis for opinion, that we call it as audit evidence. And on the basis of that audit evidence, we are going to express our opinion. Clear, everybody? Now, to go deep into that, sir, what is the meaning of evidence? What are different types of audit procedures? And what are the different methods by which I can obtain audit evidence? What are the various types of audit procedures? All that discussion will be there in SA 500. So SA 500 is a standard which is talking about all the foundational aspects, all the basic things relating to audit evidence, which is the most important step. The majority of the work, whatever we do in the audit, that goes for obtaining that evidence only. 99% of the work, whatever we do in the audit, that we are doing it for the purpose of obtaining audit evidence only. So now let us go into the topic of this audit evidence. What are various types of audit procedures? What methods are available? That we will try to understand. So to know that, we have to go to SA 500. Now, so in the SA 500 also, first I will try to start my discussion with types of audit procedures. What are various types of audit procedures? Once again, I'm telling you guys, this discussion is damn important. If you don't get clarity about this discussion, there is no purpose of discussing the remaining chapters only. So please be active and listen carefully. So what are various types of audit procedures? So as I've just now told, audit procedures means procedures performed by the auditor to obtain evidence. And these audit procedures to obtain audit evidence can be broadly divided into two categories. Sir, what are they? Number one, risk assessment procedures. Number two, further audit procedures. Whatever audit procedures which are performed with the auditor can be broadly divided into two categories. One is risk assessment procedures and the other one is further audit procedures. And this further audit procedures can be further divided into two categories. One is compliance procedures and the other one is substantive audit procedures. And in the substantive audit procedures also, there will be two more categories. One is test of details and the other one is analytical procedures. The one is analytical procedures. So let us try to get familiar with this terminology. Sir, what is risk assessment procedure? What is further audit procedure? What is compliance? What is substantive? This we will try to understand. So this will try to understand with a simple imagination. So for a few minutes, I want you to step into the shoes of the auditor. So this is you, he or she. So if you are he this, if you are she this, okay. So whatever you imagine. So you are a practicing chartered accountant. You have been appointed as auditor of some company X Limited. What you will do first? As I've told, our ultimate purpose is to verify their financial information and express the opinion. So the moment you are appointed as an auditor, will you immediately go into the accounts department and start verifying the books of accounts? No. So basic thing what you should do is the moment you are appointed as an auditor and when you start doing the audit, first thing what you should do is you should get to know about the entity. So what is this client X Limited doing? What is their business? What is their environment? In what kind of environment they're operating? Like to which industry they belong? What are the laws and regulations which are applicable for them? What is their applicable financial reporting framework? So I need to understand what kind of environment in which my client is operating, what my client's business is, what products they are selling, what services they are offering. So who are their suppliers, who are their customers, how they are deriving the revenue. So I need to understand about client's business. I need to understand about client's environment. I need to understand about client's internal controls also. What kind of internal controls the client is having. So more about internal controls, I will talk about it in the chapter risk assessment and internal control. But first thing, the moment you are appointed as an auditor, you will not immediately go to the accounts department and start verifying their books of accounts. The first and foremost thing which you do is you try to obtain an understanding of entity, environment, and its internal control. What you will do? You will try to obtain an understanding of entity, environment, and its internal control. For what purpose, sir? Because by understanding the entity, environment, and its internal control, you will try to identify, and assess risk of material misstatement. What you're going to do? By studying the client's environment, by studying the client's business, by understanding their internal controls, you will try to identify, you will try to find out risk of material misstatement. What is the chance of happening of misstatement in the financial statements, where something can go wrong in the organization. Like for example, I have been appointed as auditor of IT company. I went to the company, I studied about the business of the IT company, I studied about their environment, I studied about their internal control. By understanding all that, I came to know that in this client's IT company, revenue, in the area of revenue, there could be a problem, there could be a risk of material misstatement. Chance of happening of misstatement, that chance, that probability, we call it as risk of material misstatement. Clear? So that procedures, the first thing whatever we are going to do in the audit, the moment we start doing the audit, the first thing what we do, we perform some procedures to obtain understanding of entity, environment, and its internal controls. For what purpose, sir? To identify and assess the risk of material misstatement. That procedures we call them as risk assessment procedures. The name itself says risk assessment procedures. You are assessing the risk. How you are assessing the risk? By understanding entity, environment, and its internal control. Clear? Okay, sir, I went to the organization. I spent some 1 day of time, 2 day of time. I studied their entity. I studied their business. I studied their internal control. I found out risk of material misstatement. Okay, my risk assessment procedures are done. Next, what I should do? Should I now immediately rush to the accounts department and start verifying the books of accounts? No. You should do one more thing here. Before you go to the books of accounts, you should do one more thing. You should perform something called compliance procedures. Sir, what do I mean by that? Nothing but in the compliance procedures, what I do is whatever internal controls I have understood, as a part of risk assessment procedures, whether those internal controls are operating effectively or not. Whether those internal controls are operating effectively or not, I try to test operating effectiveness of internal controls. What I try to do, I try to perform audit procedures to obtain audit evidence regarding operating effectiveness of internal controls. Those procedures I'm going to call them as compliance procedures. I will give you example to make you understand. So take for example, once again, let us take the IT company example. I have been appointed as auditor of some company, Infosys. First, what I have done is, first 1 day, 2 day, I understood about what is the client's business, what kind of environment, what kind of internal controls they are having. For example, in the initial 1 2 days, when I was walking around the company, I came to know a lot of internal controls. Like the company is having security mechanism. If anyone has to enter inside the company, they have to scan their identity card, give their biometric, then only the door will open. Now, when it comes to the finance department, I came to know some internal control like segregation of duties. Like accountant is writing a cash entry, someone is approving it. Okay. And also there are I came to know that there are some internal controls in their accounting software also. I came to know that there is a voucher mechanism. I came to know that there is a proper hierarchy for check. 10,000 check can be signed by an accountant. More than 10,000 to 1 lakh, it could be signed by deputy finance head. More than 1 lakh, that check should be signed by finance head only. So like that, I came to know these many controls are there. Okay, you understood. There are somewhere around some 20 internal controls are there in the accounts department. You understood. See, just because controls are there, that doesn't mean they are operating effectively. Now, whatever controls, whatever 20 controls I understood, whether those controls are really working effectively, whether those controls are really working effectively or not, that I will try to perform procedures to obtain evidence. Those procedures I call them as compliance procedures. There is other name for compliance procedures. We also call compliance procedures as test of controls. The name itself says you are testing internal controls, whether the controls are working effectively or not, you are testing. So that's why compliance procedures or test of controls both convey the same. Understood? Okay. So you have been appointed as an auditor. 2 days of time you have spent on performing risk assessment procedures. Some 2 days of time you have spent on performing compliance procedures. If you pay close attention here, till now, you did not go to the accounts department. Our ultimate objective is to verify financial statements, but till the stage of compliance procedures, we did not go and verify even a single entry. So some 4 days you have spent in the name of risk assessment procedures and compliance procedures. Now ultimately you have to come to your duty. So now what I ultimately do is, after I have tested internal controls, now I will try to go to the accounts department, get their books of accounts, get their financial statements, and I will start verifying those books of accounts and financial statements. And that procedures which you are performing to actually verify the books of accounts and financial statements, to identify the misstatements in the financial statements, that procedures I am going to call them as substantive audit procedures. So what are substantive audit procedures? Those procedures which you are actually performing to verify the financial statements, books of accounts, to identify whether there is any actual misstatement, whether entries in the books of accounts are correct or not, whether financial statements are prepared properly or not, is there any error, is there any fraud. To find out that whatever procedures you are doing, that we are going to call them as substantive audit procedures. Understood, everybody? So first procedure, risk assessment, then compliance, then we perform something called substantive audit procedures. Now in the substantive audit procedures also, there could be two categories. For example, I will ask you, before I explain, I ask you, you want to know whether in the books of accounts of the client there is a misstatement or not. What you will do? If you want to know whether in the books of accounts and financial statements there is a misstatement or not, you want to know it. What is the first step you will do? If you are an auditor, what you will do? What I will do is I will test the details. Like for example, if expenses are there, I will try to check the supporting documents. If sales are there, I will try to check the sales invoice and all. If there are assets, fixed assets, I will go and physically verify whether the assets are there or not. So these kind of basic checking, we call it as test of details. And these test of details also will be of two categories. One is test of transactions, test of balances. If you are checking the supporting documents of incomes and expenses, if you're checking supporting documents of incomes and expenses, we call it as test of transactions. On the other hand, if you're checking the supporting documents of assets and liabilities, we call them as test of balances. Common thing, most basic thing. So if you want to know whether there is a misstatement, whether there is something wrong in the books of accounts and financial statements or not, first thing what you do is you go and do the checking of the details. That we call it as test of details. There is one more way by which we can find out whether there is a misstatement or not, where we will not do that routine checking of the supporting documents and all, but instead what we do is we try to study the relationship between financial items and the non-financial items, and by studying the relationship between financial and non-financial items also, we can find out whether there is a misstatement in the financial statements or not. The name itself says analytical procedures. Here you are going to do analysis. You are not going to do the routine check of supporting documents. You are going to apply your mind. You are going to think analytically. Sir, how do we think analytically? By studying the relationship between financial and non-financial information. Like one simple example, number of employees and salary cost. Last year, previous year, the number of employees were 1 lakh. Salary cost was 50,000 crores. In the current year, the employee count has increased to 1,10,000, but the salary cost of the current year is 40,000 crores only. Do you find something fishy here? Yes. What is the thing you are able to find? When number of employees have gone up, the salary cost also should have gone up, but to my surprise, number of employees have increased, but salary cost has come down. So here, by doing this analysis also, you are able to identify the misstatement. From this, you can conclude that, okay, the salary cost might have been understated. So here also, if you find out, here also, if you pay close attention, I'm trying to find out a misstatement in the financial statements, not by doing the routine checking, but how I am trying to find out the misstatement is by studying the relationship between financial and non-financial items. Like number of employees are non-financial item, salary cost is a financial item. By studying the relationship between the two, I'm actually trying to find out misstatement. These procedures, I'm going to call it as what? Analytical procedures. Clear? So to perform substantive audit procedures, either I can perform test of details or I can perform analytical procedures. Clear, everybody? So whenever you go and do the audit, this is what you basically do. You might have been already doing this, but you might not be able to identify the technical terminology. This is what typically happens. So tell me, audit procedures are broadly divided into two categories: risk assessment, further audit. Further audit procedures are further divided into two categories: compliance, substantive. Substantive audit procedures can be done in two ways: test of details, analytical procedures. Understood? Next. Okay, we understood audit procedures. Now, so by performing this audit procedures, what we get? Audit evidence we are going to get. Audit evidence we are going to get. Now, there are various types of audit evidences. There are what? Various types of audit evidences. On the basis of nature, evidence can be divided into three categories. On the basis of nature, evidence can be divided into three categories: oral, documentary, visual. The names itself say whatever evidence which you have by way of words spoken, oral evidence, which is there in written format, either in paper or electronic form, that we call it as documentary evidence. If you see something and get the evidence, that we call it as visual evidence. Clear? So on the basis of nature, evidence can be divided into three categories. Then on the basis of source, from which you are getting evidence, evidence can be divided into two categories: internal evidence and external evidence. On the basis of source, evidence can be divided into two categories: internal, external. So now what is internal? What is external? Internal evidence refer to that evidence which is originated, or you can also say which is generated within the client's entity. Within the client's organization itself, if the evidence is getting generated or originated, that we call it as internal evidence. On the other hand, external evidence is something which is originated or generated outside of the client's business, outside of the client's organization. I will give you one simple example. Sales invoice. Sales invoice. Is it internal evidence or external evidence? Sales invoice is an internal evidence. When your client is making the sale, your client itself will give invoice. It is generated within the client's business. That is the internal evidence. Purchase invoice. Purchase invoice. Tell me, is purchase invoice internal or external? Purchase invoice is external. Why? Because if you go and purchase, the other person will give you invoice. So it is getting generated outside. So purchase invoice is an example of external evidence. Bank statement, external evidence. External confirmation, external evidence. Debit note, credit note generated by your client, internal evidence. So like that, depending on the source, we can divide into two categories. Now, which one is more reliable? Between internal versus external, which one is more reliable? External evidence is little bit more reliable than internal evidence, because since it is getting generated outside of the client's organization, no one is going to have control. Your client's staff will not have control over it. So that's why it tends to be more reliable. And when you compare these three, oral, documentary, visual, documentary evidence is more reliable, more trustable. Understood? So this is one thing. So what we have understood in SA 500 till now, different types of audit procedures, types of evidences. Now, one more important thing here. The term audit evidence, whenever it is used in the subject of the audit, that will always be preceded by two more terms, which is sufficient and appropriate audit evidence. So if you read somewhere the content of the standards, they will never say auditor should obtain evidence. Instead, what they will say is auditor should obtain sufficient and appropriate audit evidence. Auditor should obtain what? Sufficient and also appropriate audit evidence. So now it becomes necessary for us to understand what is sufficiency, what is appropriateness. Sufficiency is a measure of quantity. Sufficiency is a measure of quantity. Appropriateness is a measure of quality. So quantity of audit evidence, sufficient evidence means what? These many, for example, if I have 10,000 supporting documents, 10,000 is a quantity. So that measure of quantity, we call it as sufficiency, whereas appropriateness refers to quality. But what quantity amounts to sufficiency? what quality can be called as appropriate? There is no hard and fast rule. What will be sufficient and appropriate, that has to be decided by the auditor himself using his professional judgment. So professional judgment is also one more important term which we come across very frequently. Professional judgment means ability to take the decisions using knowledge, experience, training. Ability to take the decisions using knowledge, experience, and training. That ability of a person, we call them as professional judgment. So standards only say sufficiency is a measure of quantity, appropriateness is a measure of quality, but what amounts to sufficiency and appropriateness? How much quantity can be called as sufficient? What quality can be called as appropriate? That all has to be decided by the auditor using his professional judgment. Clear? But however, there are various factors. Various factors are going to affect. So what quantity can be called as sufficient? That depends on various factors, like it depends on nature and size of the client, it depends on risk of material misstatement, it depends on effectiveness of controls, it depends on quality, materiality, etc., etc. This question they will not ask you at the CA final level, but it is important for us to have these basics. These are the concepts important for CA intern. Okay, so you need not worry about it. So sufficiency refers to quantity, and there are various factors which will decide how much quantity will be sufficient. Similarly, appropriateness means quality, and whether evidence is qualitative or not, it depends on relevance and reliability. The evidence is more reliable, it will be more qualitative. Like internal, external, which one is more reliable? External. So I will say external evidence as more qualitative than internal evidence. So like that, appropriateness depends on relevance and reliability. Understood? So there is one more last thing which I would like to revise from this essay 500, one more important discussion, which is what are the various methods to obtain audit evidence. See, universally, if you want to obtain audit evidence, there are only 7 methods available. Universally, you go anywhere in the world. So that's why I say the beauty of the subject of audit is it is a universal subject. So country to country accounting policies can change, but country to country auditing policies are not going to change. It is going to remain uniform throughout the world. If you are an auditor in India, if you want to do audit of some Indian company, whatever methods you have, the same methods will be applied even if you are doing audit of a US company in the United States. Because everywhere audit we have to do verification. So that is the beauty of the subject of audit. It is an universal subject. Globally, the things are going to remain the same. So across the world, anywhere audit is happening, if you want to obtain evidence, there are only 7 methods available. So, sorry. So I caught a little bit of cold. Sorry for that. Yeah. So universally, there are only 7 methods available. The 7 methods are inquiry. Okay, I will read it from here. So these are the 7 methods which are universally available for performing audit or for obtaining evidence. Inspection. Then we have something called inquiry. Then we have something called observation, external confirmation, recalculation, reperformance, and analytical procedures. So wherever you go in the world, if you want to obtain evidence, these are the only 7 methods which are available. So what are they, guys? Inquiry, inspection, observation, external confirmation, recalculation, reperformance, analytical procedures. Sir, what does each of this method mean? I will try to simplify it in a simple way. Inspection. What do you mean by inspection? Checking of the supporting documents, or going and physically examining the asset, that we call it as inspection. Like as I've told, if you want to know whether an expense is genuine or not, you check the supporting document. You want to know whether asset is really there or not, you go and see it physically. So checking of supporting documents or physical examination, I call it as inspection. So then what is inquiry? Inquiry means asking the questions and getting the responses. If you want to get some information, what you can do, you are conducting audit, you want to know some information, you go to the client, you go to the management of the client, you ask them questions, whatever information you want regarding that, you ask the questions, get the responses. That we call it as inquiry. See, inquiry can be a written inquiry also, inquiry can be a oral inquiry also. It is up to you. Anything you can use. So 2 methods I have discussed: inspection, inquiry. Then observation. Observation means what? Looking at a process being performed by others. Say I want to obtain evidence regarding physical verification of the stock, whether the client is doing proper physical verification of stock or not. I want to obtain evidence. What I will do, whenever the management and the client's staff is doing physical verification, I go there, sit and observe. So that is what observation, looking at something and getting the evidence. Then we have external confirmation. External confirmation means what? For example, if you are conducting audit of some client, in the client's books of accounts, there is one debtor, amount is 1 crore. You want to know whether that debtor's balance is correct or not. What you can do? You can go and directly call that debt. You can go and write a mail to the debtor. Sir, I am an auditor of so and so company. My client is saying that you are a debtor to them. Tell me how much amount you are required to pay. So like that, a direct written response obtained by the auditor from a third party, like confirmation from debtor, confirmation from banker, confirmation from creditor, confirmation from consignee. So these kind of written responses obtained by the auditor from a third party, we are going to call it as external confirmation. We have one dedicated standard talking about external confirmation, SA 505, which we will talk about it later. Then recalculation. See, recalculation today is not relevant. Nothing but checking of arithmetical calculations, whether balance sheet totals are correct or not, profit calculation is correct or not. So nothing but additions, deletions, subtractions, whether the mathematical calculations are correct or not. You do it once again and check. That we call it as recalculation. This is no longer relevant today because today the calculation part is all taken care by software. Then we have reperformance. Sir, what is reperformance? Reperformance means, for example, the client's staff has already prepared BRS, but you also know how to prepare the BRS. So what the auditor is doing is he is preparing the BRS on his own and he's comparing it with the management's BRS. So nothing but one activity has already been performed by client's management or staff, but you are doing it once again to check whether it is correct or not. So this we call it as auditor's independent execution of a process or procedure which is already performed by client. So that we call it as reperformance. Finally, analytical procedures. Analytical procedures I have already explained. Studying of relationship. In the analytical procedures, we study the relationship between financial and non-financial items. And by studying the relationship between financial and non-financial items, we try to analyze whether there is a misstatement in the financial statements. So that we call it as analytical procedures. So wherever you go, globally, universally, we have only sorry, we have only 7 methods available. What are they? Inspection, inquiry, observation, external confirmation, recalculation, reperformance, analytical procedures. So all this discussion you need to have in the back of your mind. So with that discussion, I will wind up SA 500. So SA 500 revision also we are done. Why I have taken up SA 500 revision is because having this knowledge is very, very important for us to have even better understanding of the audit reporting chapter. So since we are done with SA 500, we can successfully go ahead and revise the audit. So since we are successfully done with revising SA 500, now we will go ahead and try to revise the chapter audit reporting. So once again, I'm telling you, one of the most important chapter, both from the examination perspective and also from the practical point of view. So what exactly we are going to discuss in this? What kind of content will be there in this chapter, audit reporting? So let me give you an overview. So once again, if you go back to the basics, when we have understood the definition of the audit, the ultimate objective of the auditor is to what? Is to express an opinion. The final outcome, the entire outcome of the entire process of audit is auditor expressing an opinion on the financial statements. He will independently examine them, and finally, whether they are giving true and fair view or not, he is going to express an opinion. So by expression of opinion by the auditor, the process of audit actually comes to an end. So this thing is everybody clear with. So now the thing is, when I said auditor has to express an opinion, how he is going to express an opinion? How the auditor will express opinion? Will he come before the shareholders, take a mic and say that he is giving a positive or negative opinion? Do you think that oral expression of opinion will be enough? No. So even the standards also says the same thing. When the auditor expresses the opinion, he has to express that opinion in the form of a written report. How he has to express it? He has to express the opinion in the form of a written report. That written report or that written document which contains the opinion of the auditor, that we are going to call it as auditor's report. If someone is asking me, if someone is going to ask me a question, sir, what is auditor's report? I will simply say it is a document which contains the written auditor's opinion, that we are going to call it as auditor's report. Okay, so now we got one thing clear. The process of audit comes to an end by expression of opinion, and that opinion will be expressed in a written format, which we call it as audit report. Now the next question which should come in your mind is, sir, how to prepare that auditor's report? How to prepare that report? So I am a practicing chartered accountant. I did audit of some entity X Limited. After completion of my audit, I will give one audit report. Now, there is another practicing chartered accountant who has conducted audit of Y Limited. After completing audit, he will express his opinion in the form of a written report. Now, don't you think there should be one common guidance for all these practicing chartered accountants to give one audit report? Do you think guidance is required? Yes. And also, do you think uniformity is required in the auditor's report? See, like the way today we are seeing all the financial statements of the companies are uniform. Uniformity in the sense they are comparable. So if you pick up the financial statements of Reliance and if you pick up the financial statements of Adani Enterprises, they follow a standard format. Why? Because that uniformity is very much required. When someone wants to do a comparison of these two companies, when someone wants to understand the financial data, if they're in a standard format, it becomes very easy to understand. Similarly, if someone is reading the auditor's report and he wants to compare two auditors' report, unless they are unless they are prepared using one standard format, that audit reports will not be uniform and it will create a lot of trouble for the person whoever is reading that auditor's report. So like the way we have achieved the uniformity in the financial statements, the same kind of uniformity has to be achieved even in the form of auditor's report also. And how that uniformity can be achieved? See, today the financial statements are uniform. The logic behind it is we have dedicated accounting standards, Schedule 3. So like that we have some rules and regulations for the preparation of financial statements. So if you want to achieve the same kind of uniformity in the audit report, even for the preparation of the auditor's report also, we need some rules and regulations, we need some guidance, we need some standard principles and procedures. So where that standards, where that guidance has been given. So audit report should be in this format. These content should be there. This should be the format. This should be the heading. This should be the paragraphs. So that guidance has actually been given. Sir, where that guidance has been given? The guidance has been given in the form of standards on audit, and particularly speaking, SA 700 series is the series of the standards which is going to talk about the preparation of the auditor's report. So which series of the standards is going to contain all the guidance regarding preparation of audit reports? SA 700 series of standards is going to contain all that required information. And in that SA 700 series also, particularly four standards, SA 700, then we have SA 701, then we have SA 705 and also SA 706. So these four are the dedicated standards which will give all the guidance required for an auditor for the expression of an opinion for the preparation of the audit report. So that's what we are going to discuss in this particular chapter. So apart from these four standards, there are also certain reporting responsibilities on the auditor put under Companies Act 2013. The standards on auditing has put some reporting requirements on the auditor in these four standards. In addition to that, in case if you are conducting audit of a company, in addition to the standards on auditing, Companies Act has also put some reporting requirements on the auditor. And those reporting requirements are contained under 143 subsection 1, 143 subsection 3, 143 subsection 11 and 143 subsection 12. So like that, under various sections of the Companies Act, there are various reporting requirements. That reporting requirements also we are going to revise this chapter. So this is going to be the main agenda for this chapter. So first we will be concentrating on these four standards which are talking about preparation of auditor's report. In that also, first standard which I will take up for discussion will be SA 700, which contains the format, which contains the contents of the auditor's report. So how to prepare the audit report, what contents should be there in the audit report, all that discussion has been given in SA 700. Let us start our discussion with SA 700. So I will directly go to the contents of the auditor's report. So how the audit report should be, what kind of paragraphs should be there, what information should be used, what language should be used. So first I will come to the contents of the auditor's report. So if you see here in the SA 700, they have given list of various contents which should be included in the auditor's report. The list is something like this. There should be title, addressee, opinion, basis for opinion, material uncertainty relating to going concern, key audit matter, emphasis of matter, other matter paragraph, responsibilities of the management, responsibilities of the auditor, reporting on legal and other regulatory requirements, signature of the auditor, date of signature, place of signature, UDIN. So like that we have various contents. Now we will try to dig deeper into this contents. We will try to understand what is there in each and every content, what exactly should be presented, that we will try to understand in a detailed manner. And for the purpose of this understanding, we will take help of some practical audit reports. So we'll take the help of one or two practical audit reports and we'll try to learn the theory part. Along with that, practicality also we will take hand in hand. Okay, all right. So let me open one sample audit report for the purpose of our discussion. So just give me a minute. Yes. So for the purpose of our understanding, I will keep open one audit report. So here we have Reliance Industries Limited Auditor's Report. So as I've told, we will try to learn the theory as well as practicality, both hand in hand. We will try to take it. So let us talk about the first content in the auditor's report. So the first content which should be there in the auditor's report is title. Title is nothing but heading. There should be an appropriate heading to the auditor's report. So generally, in the case of the statutory audits, the title which will be given is Independent Auditor's Report. So what will be the title generally? Independent Auditor's Report. So like that, there should be one appropriate title which has to be given to the standard. The same thing you will be able to find even in here also. So if you see here, the first content is title, there should be appropriate title. So they have used the title Independent Auditor's Report. Fine. Then after that, after you have given appropriate title, the next content which should be there in the auditor's report is addressee. The audit report is basically a document through which you are expressing an opinion to whom you are expressing the opinion. Basically, the persons whoever has appointed us, they will be our addressee. In the cases of the companies, generally the addressee will be shareholders. If it is a partnership firm, the addressee will be partners. If it is a sole proprietorship firm, it will be generally that sole proprietor. So depending upon the legal form of the entity, you have to address the concerned person. So since Reliance is a company, if you see here, the address is to the members of the Reliance Industries Limited. So there is one appropriate addressee also. So title is there, addressee is there. Now let us come to the next content. So after you have given appropriate title and addressee, the standard says directly come to the point. The main objective why you are giving that auditor's report, the main purpose of the auditor's report is communicating your opinion. No, so first come to the point. After you have given title, after you have told addressee, first directly come to the point, express your opinion. Tell your opinion. You have to tell your opinion on the financial statements. Now we will try to understand the various types of opinions in a detailed manner. So we'll try to understand various kinds of auditors' opinions. As I've already told you in the introduction to the audit, like in any world, like the world in the world regarding any object, anything, any person, opinion could be only of two categories, either a positive opinion or negative opinion. Now, since we are laymen at that point of time, we use a simple terminology. Now we will give technical names. Till now we are calling positive opinion, negative opinion. But going forward, when I say what are the two broad categories of opinion, we have to use this particular terminology. There are two broad categories of opinion. One is unmodified opinion and the other one is modified opinion. One is what? Unmodified opinion and other one is what? Modified opinion. So unmodified opinion is nothing but till now simply whatever we are calling it as positive opinion, that is a technical name for the positive opinion, whereas modified opinion is something we are calling till now as negative opinion. So now let us try to understand the definition of unmodified opinion and modified opinion. So first we will concentrate on unmodified opinion. Sir, when unmodified opinion will be given, as I've told in simple terms, it is nothing but a positive opinion. So when unmodified opinion will be given, the standard says if as an auditor you are satisfied, you performed audit procedures, you obtained sufficient and appropriate audit evidence, and if you are satisfied that yes, financial statements are free from material misstatements, after performing all the audit procedures, after obtaining all the audit evidence, you are convinced that the financial statements do not contain any material misstatement, and also you are convinced that financial statements are prepared as per applicable financial reporting framework. Nothing but these two are the objectives whatever we have seen for the entire process of the audit. So after performing all the audit, after performing all the procedures, after gathering all the evidence, you have sufficient and appropriate audit evidence that financial statements do not contain any material misstatement, and also they are prepared as per applicable financial reporting framework. If you have that evidence, that means you don't have any objection, any remark regarding the financial statements and books of accounts, then you will give unmodified opinion. Sir, how to identify whether the opinion is an unmodified opinion? You will not be able to find anywhere in the auditor's report unmodified opinion. The term you will not be able to find out. So what the standard has actually told is, when you give unmodified opinion, you have to use one particular phrase. What the standard has told, when you have to use unmodified opinion, we are giving you two options. Only choose that two options. Don't use your own creativity. Don't use your own communication skills. We will tell you what phrases you have to use in case if you are giving unmodified opinion. Only use any of the two phrases. Don't use your creativity. Sir, which phrase I have to use if I have to give unmodified opinion? So the phrase which you have to say, which you have to use is this one. You have to say in your opinion paragraph that financial statements present fairly in all material respects, or alternatively, what you can use the phrase is financial statements give a true and fair view. So if you are giving unmodified opinion, only one of these two phrases you have to use. Apart from that, nothing else you can use. So if you are giving an unmodified opinion, your opinion paragraph should contain any of these two phrases. Either you have to say financial statements present fairly in all material respects, or you can alternatively use the phrase financial statements give a true and fair view. Only any of these two phrases you have to use. So the moment you find any of this sentence in the auditor's report, that is what unmodified opinion. So if I have to show you an example, so this is the opinion paragraph. So if you see this opinion paragraph, I will come to this part later. This part I will talk about it later. So the main opinion will be there in the second paragraph. So if you see here, in our opinion and to the best of our information and according to the explanation given to us, the aforesaid standalone financial statements required give the information required by the Companies Act, and they give a true and fair view. So without any objection, without any negative remark, auditors are telling it is a what? Financial statements are what? Giving a true and a fair view. So the moment you read this phrase, which opinion should strike your mind? So this is an unmodified opinion. This is a what? Unmodified opinion. Clear, everybody? Right. So this is what regarding unmodified opinion. Okay, we understood what is unmodified opinion. Now let us come to the most important discussion, which is modified opinion. Which is what? Modified opinion. Sir, when I will give modified opinion? Obviously, it is pretty straightforward. When I am not satisfied with the true and fair view of the financial statements, I verified financial statements, I verified books of accounts, I have some objection, I have some remark. I don't want to say financial statements are giving true and fair view because I found something wrong in the financial statements. So then I will not give unmodified opinion. Then I can't completely say financial statements present fairly or financial statements give true and fair view. I want to add a negative remark in my opinion paragraph. So if you are giving a negative remark in the opinion paragraph, that opinion we are going to call it as a modified opinion. Now, this modified opinion also, you can give it in three ways. This modified opinion also, how many ways you can give? This modified opinion also, we can give it in three ways. So what are that three different kinds of modified opinion? Number one is qualified opinion. Number two is adverse opinion. And number three is disclaimer of opinion. So when you have to give a negative comment regarding the financial statements and books of accounts, you will give a modified opinion, and that modification you can do it in three ways. So qualified, adverse, disclaimer. See, qualified is also a negative opinion only, adverse is also a negative opinion only, disclaimer of opinion. All these three are nothing but different versions of negative opinion. But what is going to change is the severity of the negative remark is changing. So we will get to know once we understand when qualified will be given, when adverse will be given, when disclaimer will be given. So we'll actually get to know which is more severely negative, which is less severely negative. Okay. So this different kinds of opinion, we'll try to understand it with the help of few examples. Take for example, you are conducting audit of some company and this is a extract of the financial statements. You have fixed assets worth 1000 crore rupees. Under current assets, you have inventory some 500 crores. You have trade receivables some 300 crores. You have cash and cash equivalents some another 400 crores. Okay. So totally somewhere around 2200 crores of assets are there, and some liabilities are also there. I'm not going into details. Even the total of the liabilities also 2200 crores. So now you started performing audit procedures on these items of the financial statements. This balance sheet you have started verifying. So when you are verifying the balance sheet, you came to know that fixed assets are all okay. You are unable to find out any material misstatement in the fixed assets. Inventory also, you are unable to find out any material misstatement. Cash and cash equivalents also, you are unable to find out any material misstatement. But in the liability side also, you are unable to find out any material misstatement. Everything is perfectly fine except one item. So when you performed audit procedures, you came to know that you obtained audit evidence. You performed audit procedures and you obtained audit evidence. And by performing that, on the basis of audit evidence, you came to know that one debtor's actual balance was 10 crore which was stated in the books of accounts, but originally he is required to pay only 5 crore rupees. So instead of showing actual debtors balance as 5 crore rupees, they are overstating that debtors balance by 5 crores. You performed audit procedures, you have evidence for that. You have proof also that management has overstated their trade receivables by 5 crore rupees. So finally, what I wanted to say is, when you performed audit procedures on this entire financial statements, you obtained audit evidence that there is a misstatement. There is a what? Misstatement amounting to 5 crore rupees. And this 5 crores is material. 5 crores is a material amount. So you performed audit procedures, you obtained audit evidence, and on the basis of that evidence, you concluded that financial statements contain a material misstatement. Okay. Now you tell me here, can you say in your opinion paragraph, financial statements give a true and fair view? Do you think, can you say that? No, you can't say financial statements give a true and fair view. So compulsorily you have to add a negative comment. For that negative comment also, I'm giving you two options. One option number one, directly telling financial statements do not give true and fair view. You can directly go ahead and say financial statements do not give true and fair view. Option number two, you can do one thing. You can say except trade receivables which contain a misstatement of 5 crores, rest of the financial statements are giving true and fair view. Except one or two items, financial statements are giving true and fair view. You tell me, in this given scenario, which one looks more suitable? I will say the second option looks more suitable. I know there is a material misstatement in the financial statements, but the misstatement is not so big enough to say financial statements are completely wrong. I agree there is a misstatement. I agree there is a material misstatement, but that material misstatement is not so big enough to say financial statements are completely wrong. It is not so big enough to say financial statements completely wrong. I can't say that. So that's why I'm not giving a completely positive comment, but I'm adding a negative remark by saying that except trade receivables, rest of the financial statements are giving true and fair view. But anyhow, I'm giving a negative opinion. No, negativity I'm attaching to my opinion. So whenever you find these kind of sentences in the opinion paragraph, it will be a qualified opinion. It will be what? Qualified opinion. So when you will give qualified opinion, one example, one circumstance I have told, I will give qualified opinion when I performed audit procedures and I obtained sufficient and appropriate audit evidence. I have sufficient and appropriate audit evidence. On the basis of that evidence, I concluded that financial statements contain misstatement. I have evidence financial statements contain a misstatement. The misstatement is material. The misstatement is what? Material. But it is not a very big misstatement to say financial statements are completely wrong. So that very big kind of misstatements which make the complete financial statements wrong, I call it as pervasive. So here the thing is, I performed audit procedures, I obtained audit evidence, I found a misstatement which is material but not pervasive. It is not so big enough to say financial statements are completely wrong. So when I have sufficient and appropriate audit evidence, and when I came to know that financial statements contain a misstatement, that misstatement is material but not pervasive. Pervasive definition we'll see it in a while. But for the time being now, for the sake of simplicity, understand pervasive as a very big misstatement to say completely financial statements are wrong. Here there is a misstatement, I agree, but that is not pervasive. So in this case, I will give qualified opinion. And how to identify qualified opinion? You will find the phrases like this modified opinion discussion and all is contained in SA 705. So in order to understand different kinds of modified opinion, we have to go to SA 705. So this is SA 705. If you see here, how to identify the modified opinion is, you have to use the phrases except for the effects or except for the possible effects, or the financial statements give a true and fair view. So it will start something like this: except for certain items, financial statements give a true and fair view. So when you find this phrase, this is what kind of opinion? Qualified opinion. Understood? So I told you one circumstance where you will give qualified opinion. Now let me change some facts here. Let me give another scenario here. Okay, so we'll copy this. I'll take the same example to make you understand. Wait. Come on. Here we will paste it. Right. So now I will give a little bit of facts we will change here. So here, once again, let us take another scenario. I am conducting audit of this financial statements. Client has given me this balance sheet. So I am trying to perform audit procedures to obtain audit evidence. So when I performed audit procedures, I obtained audit evidence that fixed assets contain a misstatement of some 10 crore rupees. I have evidence. I have evidence that there is a misstatement of 10 crores in the fixed assets. There is a misstatement of 5 crores in the inventory. I have evidence that there is a misstatement of some 10 crores in the trade receivables. In the liabilities also, I am able to find in share capital, I am able to find 10 crores of misstatement. In current liabilities, I am able to find some 15 crores of misstatement. So this is the case. I performed audit procedures, I have evidence, and there is a misstatement in so many items. So now here also, you definitely can't say financial statements are giving a true and fair. Here also you have to give a negative opinion. But here if I give you two options to choose from, which option will you choose? Will you say financial statements are not giving true and fair view, or will you say except a list of items of financial statements is giving true and fair view? Which one looks more suitable here? In this case, the first option suits more suitable. Yes or no? So here, instead of fixed assets, instead of inventory, except for trade receivables, except for blah blah blah, financial statements give a true and fair view. Do you think does it sounds good? No. Here, the misstatements are very big enough to say financial statements are completely wrong. Here I can comfortably say financial statements completely wrong. Financial statements do not give true and fair view. So the moment you find this a phrase in the opinion paragraph, which phrase? Financial statements do not give true and fair view. Financial statements do not give true and fair view. The moment you find this phrase, that will be an adverse opinion. So let us try to make out the circumstances in which adverse opinion will be given. Number one, you performed audit procedures. You have obtained sufficient and appropriate audit evidence. You have enough of evidence available. And on the basis of that evidence, you have concluded that financial statements contain a misstatement. And here, the misstatement is not just a material, it is pervasive. It is big enough to say financial statements are completely wrong. So the moment you find sufficient and appropriate audit evidence and you have misstatement, and that misstatement is not just material, that is also pervasive, then we will give adverse opinion. So what kind of terminology will be there in the adverse opinion? So if you see here, the financials in the opinion paragraph, you will find the phrase, the accompanying financial statements do not present fairly or do not give a true and fair view. Either you can say financial statements are not presenting fairly, or you can alternatively say financial statements are completely wrong. They are not giving true and fair view. The moment you find this phrase, that will be an adverse opinion. So till now, I have told you one circumstance where you will give qualified, one circumstance where you will give adverse. Adverse related discussion is over. Adverse related discussion is over. Qualified, not yet done. So one more thing is there. Let me try to come to that point. So once again, I will take this example, okay? So here, I will change little bit of facts. Okay. So I am performing audit procedures on this financial statements, on this extract of the balance sheet. In the fixed assets, I am unable to find out any material misstatement. It is perfectly fine. Inventory, perfectly fine. Cash equivalents, perfectly fine. All the assets in all the liability side also fine. But here the problem is regarding trade receivables. In the trade receivables, there is one debtor amounting to 10 crore rupees. There is one debtor amounting to 10 crore rupees. I am unable to obtain sufficient and appropriate audit evidence regarding that debtor. What I'm doing? I'm unable to obtain whether that debtor's balance is correct or not. So I tried to verify the books of accounts. I did not get convincing evidence. I tried to communicate with the debtor. Instead of calling, I'm sending the emails. That debtor is not responding. The thing I wanted to say here is rest of all the items are all perfectly fine. But regarding one item, one amount, 10 crore rupees, I'm unable to obtain sufficient and appropriate evidence. I'm unable to conclude. I'm unable to conclude. So now you tell me, in this case, will it be suitable for me to say financial statements give a true and fair view? Can I give completely positive opinion? No. So definitely, I also have to add some sort of negativity to my opinion. So here I will say two options. You can say, I'm unable to express an opinion. In the opinion paragraph, you can say, I'm unable to express an opinion. Since I'm unable to obtain audit evidence, I can't express my opinion. One option. Or another option, you can say, except for trade receivables in which I am unable to obtain evidence regarding 10 crore rupees. Rest of the items are giving a true and fair view. Except for trade receivables where I am unable to obtain audit evidence regarding this trade receivable because of the possible effect. That means even if this 10 crores goes wrong, the possible effect of that misstatement is material, but here it doesn't sound pervasive. So you tell me which options will you choose. I hope the facts are there in your mind. You are unable to obtain evidence regarding 10 crore rupees. Which option will you choose? So I will say, saying unable to express an opinion is a little bit of extreme side. Which sounds more suitable is, this sounds more suitable. Except for trade receivables, rest of the financial statements give true and fair view. So this sounds more suitable, no? Now I have already told you, the moment you find these phrases, it is what kind of opinion? It is a qualified opinion. So the point which I want to conclude here is, there is one more case where I can give qualified opinion. The second case is, I am unable to obtain sufficient and appropriate audit evidence regarding certain items. And possible effects, very important, this term you have to use. And possible effects of that undetected misstatements. That means regarding 10 crores, I am unable to obtain evidence. Even that 10 crore goes wrong, the possible effect of that 10 crores is, that means even if that 10 crore goes wrong, the effect is material, but it is not pervasive. It is not so big enough to say financial statements are completely wrong. So I'm unable to obtain sufficient and appropriate audit evidence regarding certain item. And the possible effect of that undetected misstatement is going to be only material, but it is not pervasive. In these two circumstances, I will give qualified. So finally, qualified opinion will be given in how many circumstances? Two circumstances. Number one, I have performed audit procedures. I have evidence. On the basis of that evidence, I have concluded financial statements contain a misstatement. That misstatement is only material, but not pervasive. Second case, I am unable to obtain audit evidence and the possible effect of that misstatement is only material but not pervasive in any of these circumstances. So summary is, whether you have evidence or you don't have evidence, the effect of the misstatement should be only material but not pervasive. Then I can give qualified. And I told you adverse will be given in one case, you have evidence available and you have concluded misstatement is material as well pervasive. Now there is one more thing we have to see. So I'm going to little bit extend my example. So we'll use the same thing. Come on. Yes. So now in this typical scenario, what I'm doing is, in the fixed assets, regarding some 50 crores of assets, I'm unable to obtain evidence. Regarding 50 crores of inventory, I'm unable to obtain evidence. Regarding some 10 crores worth of data, I'm unable to obtain evidence. In the liabilities also, some 15 crores, I'm unable to obtain evidence. Some 20 crores, I'm unable to obtain evidence. So if that is the case, you tell me, can I completely say financial statements are giving true and fair view? No. Here also I have to give negative comment. Now once again, if I give you two options, which options will you choose from? Will you say, I am unable to express an opinion because I am unable to obtain evidence? Or will you say, except for a list of items, financial statements give true and fair view? Which one do you think will be more suitable? In this typical scenario, second opinion, the first one sounds more suitable. So here regarding so many items, I am unable to obtain evidence. And if all that items goes wrong, the possible effect is not just material, the possible effect is even pervasive. So if that is the case, I can directly say I am unable to express an opinion on the financial statements. The moment you find this phrase, I am unable to express an opinion on the financial statements in the opinion paragraph, that opinion we are going to call it as disclaimer of opinion. What do you mean by disclaimer? Disclaimer means stopping yourself. Disclaimer of opinion means what? You are stopping yourself from expressing an opinion. So the same thing you are telling, we are unable to express an opinion. The moment you find this phrase, that will be what? Disclaimer. So when disclaimer of opinion will be given? So the circumstances are, I am, as an auditor, I am unable to obtain sufficient appropriate audit evidence. And the items which I am unable to obtain evidence, if that go wrong, the possible effect, what is that? The possible effect. See why I'm using the phrase possible, because I don't know whether they're wrong or right. I don't know. I'm just estimating if that goes wrong. So the possible effect of those items regarding which I'm unable to obtain evidence is not just material, it is also pervasive. In that case, I will give disclaimer. And what will be the wording when I use disclaimer of opinion? So in the opinion paragraph, I will say I am unable to express an opinion on the financial statements. I will show you one example to make you understand this. So here I have an example. This is practical audit report of Eveready Industries. Yes. So if you go to the audit report part here, and if you go to the opinion paragraph in the auditor's report, just a moment. Yes, here it is. Yeah. So if you read the opinion paragraph, so this is the opinion paragraph. In the opinion paragraph, if you see this phrase, they are telling we do not express an opinion on the accompanying financial statements. So the moment you find this phrase, what kind of opinion it is? It is a disclaimer of opinion. Understood? So this is what three kinds of modified opinion. Qualified opinion will be given in two cases. Adverse will be given in two cases. Sorry, adverse will be given in one case. Disclaimer will be given in one case. And one more important thing which you have to remember is to give adverse opinion, there must be audit evidence. To give disclaimer of opinion, there must not be evidence. Why? Because in the adverse opinion, I am telling financial statements are completely wrong. When you are telling something is completely wrong, you should have compulsory evidence for that. And in the disclaimer, you are telling you are unable to express an opinion. To say you are unable to express an opinion, you should not have evidence. Understood? Clear and comfortable, everybody? So this is what regarding different kinds of modified opinion. Understood? So this discussion is going to be damn important. This is where MCQs can be tested. This is where a theory question can be tested. This is even where a case scenario based question also can be tested. A practical application oriented question also can be tested. Understood? Right. So where all this discussion is there, qualified in SA 705. Different types of modified opinion are explained in SA 705. If you see here, all these three are negative only. Severity is changing. Qualified opinion is less severe. Qualified opinion is what? Less severe. Whereas adverse and disclaimer are extreme. More severe opinions, more severe negative comments are getting included here. Qualified is little bit less severe. Understood? Now, one more important thing which is important for the examination is pervasive. What is the meaning of the term pervasive? I told you in a simple way for the purpose of our understanding. Till now I was telling the misstatement which is not so big enough to say financial statements are completely wrong. That we call it as pervasive. So, but there is one technical definition. As we all know, simple things don't work in the examination. So basically all this is standards. What they try to do is simple things they try to complicate. In the same manner, what they have done is the meaning of the term pervasive has also complicated. Simple meaning, pervasive, a very big misstatement, but the same thing they try to say it in a very complicated way. So here if you read it, we can call a misstatement as pervasive, that in the auditor's judgment, if it is not confined to specific element. If the misstatement is not restricted to one item, if the misstatement is spread across so many items, then we can call that misstatement as pervasive. That's what even we have seen in the example also, where misstatement is not just restricted to one account, it is spreading across so many accounts. So that we call it as misstatement, that we call it as pervasive misstatement. The same thing we have used in the example. Or sometimes what will happen is misstatement will get confined. Misstatement will be limited to only one or two accounts, but the amount, it will represent a substantial portion. So if you see here, even if it is confined to one or two items, it represents a substantial portion of the financial statements. Like if I have to give you an example for this, take this financial statements only. So in this financial statements, imagine that there is a misstatement only in fixed assets. There is a misstatement only in fixed assets and the amount of the misstatement is 600 crores. Here, the misstatement is confined. The misstatement is restricted only to one item, but it is representing a very big portion, a very big chunk of the financial statements it is presenting. Then also we can call this misstatement as pervasive. Or the pervasive misstatement did not always happen only in amounts. It could also happen in notes to accounts also. If the management has made any mistake in the notes to accounts, which are very fundamental to users' understanding. Like for example, management has given a wrong disclosure regarding going concern. Management has given what? Wrong disclosure regarding going concern. Entity will not be able to continue as a going concern, but still management tried to state in their notes to accounts going concern is valid. So if the misstatement is happening in the notes to accounts also, there could be pervasive misstatement. That's what I told. So in the initial class itself, I have told we have to change our perception. So whenever I say misstatement, don't just imagine a mistake in the amounts. There could also be a misstatement in, sorry guys. Yeah. So the misstatement need not always happen only in the amounts. Misstatement even could happen in the notes also, and even pervasive misstatements can happen in the notes. So just keep that in the mind. So this definition is also very important. A misstatement can be called as pervasive in any of the three cases. If it is not confined, if it is not just restricted to one or two items, it is spread across so many items. Even if it is confined, it is representing a major portion of the financial statements or in relation to those disclosures which are very fundamental to users' understanding of the financial statements. Then we can call that misstatements as pervasive. Clear, everybody? So this is what a few important contents from SS 705. We will come back to SS 705 later. We will go back to SS 700. We are actually discussing the contents of the auditor's report. There we will go back. Right. So from where we have gone to where we are seeing contents of the auditor's report. So we have seen title, we have seen addressee, we are looking at opinion. So in the opinion paragraph, what could be different kinds of opinion we have seen. But one important thing you have to remember, see, everywhere I have shown you some two audit reports. In the audit reports, if you would have paid close attention, the opinion paragraph is very lengthy. If you pay close attention, here it is. Yes. So if you see here, the opinion paragraph is very lengthy. This much opinion paragraph is there. This completely is an opinion paragraph. So actual opinion of the auditor will be contained in the second paragraph. Opinion paragraph contains two sub-paragraphs. Actual opinion of the auditor will be there in the second paragraph, but there is, apart from that main opinion, there is some other content also which is given. Apart from the main opinion, there is some one more paragraph also here. Now what is there in this paragraph? So this makes me come to the next point. So what SA 700 says is, you have to include opinion paragraph. In the opinion paragraph, you will express your opinion. Along with the opinion, there are some important things. There are some mandatory things which must be included in the opinion paragraph. Sir, what are that mandatory things in addition to the opinion which has to be included in the opinion paragraph? Nothing but I am referring to this first sub-paragraph. So what exactly? Oh God, it got closed. Okay, anyhow, as I've told, they are exactly referring to that first sub-paragraph of the opinion paragraph. So what content should be there in addition to the opinion you are expressing? So SA 700 says in the opinion paragraph, you have to give a proper heading, opinion, one appropriate heading should be given. In addition to that, you have to state 5 things in the opinion paragraph. You have to identify the entity whose financial statements you have audited, nothing but name of the client you have to mention. Then you have to mention a fact that financial statements have been audited, and you have to identify title of each statement comprising in the financial statements. Nothing but you have to say financial statements contain balance sheet, statement of P&L, cash flow statement. You have to describe each element of the financial statements. You have to give a reference to the notes to accounts, and in addition to that, you have to specify the date or period covered by the each financial statement component. So in the opinion paragraph, along with the main opinion which I am expressing, 5 things must come in my opinion paragraph. I have to identify the entity whose financial statements I have audited. I have to state the fact that I have audited the financial statements. You have to describe the title of the components of the financial statements. You have to give a reference to the notes to accounts, and also you have to mention the period and the date covered by the financial statements. The same thing you will be able to find even in the opinion, even in that first paragraph. So quickly, for the sake of our convenience, we'll go through it once. Sorry, I have to scroll once again. Yes, anyhow, we got it very quickly. Okay, yeah. Just let me erase this. Right. So second paragraph contains main opinion. Now let us come to the first paragraph. Whatever 5 things we have seen, whether they are there or not, we will see. Number 1, if you see here, we have audited the accompanying standalone financial statements of Reliance Industries Limited. In this one single line, 2 things are covered. They are identifying the name of the entity whose financial statements they have audited. They are also mentioning the fact that they have audited the financial statements. We have audited the accompanying standalone financial statements. So they are also mentioning the fact. Next, which comprises balance sheet, statement of P&L, statement of cash flow, statement of changes in equity. Nothing but they have identified the components of the financial statements. And also it includes notes to the standalone financial statements. A reference to the notes is also given. Last item, you have to mention the period covered by the financial statements. So they are given, we are conducting audit as of for the financial statements as at 31st of March. So whatever 5 components we have read in the standard, the same 5 components have been as it is included in the opinion paragraph. So this comes to an end. The discussion comes to an end regarding opinion paragraph. Understood, everybody? So 3 contents we have covered. Title we have covered, addressee we have covered, opinion we have covered. Next one, basis for opinion paragraph. Now the standard says, okay boss, you are giving your opinion. But why anybody should trust your opinion? Why anybody should trust your opinion? So that's why what the standard is telling is, after you have given the opinion paragraph, you have to tell on what basis you have given the opinion. You have to tell what, on what basis you have given the opinion, that you have to tell, and that thing has to be explained in SA 700 in basis for opinion paragraph. What exactly has to be stated in the basis for opinion paragraph, that also has been given here. So SA 700 says, in the basis for opinion paragraph, 4 things you have to mention. What you have to mention? 4 things you have to mention. You have to mention that you have conducted the audit as per standards on audit. You have to tell that there is a dedicated paragraph talking about auditor's responsibility. Please refer that. You have to give a reference to auditor's responsibility paragraph. Nothing but if you look at the contents, there is one paragraph talking about auditor's responsibility. Give reference to that auditor's responsibility paragraph in the basis for opinion only. Nothing but in the basis for opinion, you have to say, boss, we have so many responsibilities to fulfill. Those responsibilities are actually given in a dedicated paragraph. So you have to give a reference to auditor's responsibility paragraph. And also you have to mention a fact that you are independent and you are also complying with ethical requirements. You have to say that I have done my audit in an independent manner. I complied with my ethical requirements. What are ethical requirements? We will see it in the professional ethics chapter. And also you have to say whether you have obtained sufficient and appropriate audit evidence or not. These 4 things you have to compulsorily include, where in the basis for opinion paragraph. The same thing even you will be able to find at this in this case. So here it is a basis for opinion paragraph of the Reliance. So if you could see here, the same 4 things whatever we have read in the material as it is will be there. So they are telling we have conducted the audit as per standards on audit. Our responsibilities are given in auditor's responsibility paragraph. Nothing but reference to auditor's responsibility. And they are also telling we are independent of the company and we comply with ethical requirements. Okay. And we believe that audit evidence obtained by us is sufficient and appropriate. So these 4 things must be there in the basis for opinion paragraph. Now SA 705 says one more thing. What SA 705 says is, if you are giving unmodified opinion, which opinion? If you are giving unmodified opinion, if you state these 4 things, it will be enough. If you are giving unmodified opinion, if you state these 4 things, it will be enough. But in case if you are giving modified opinion, in addition to these 4 things, you have to tell in the basis for opinion paragraph the reason why you have given the modified opinion, because of what reason you have given the modified opinion, and also you have to quantify the misstatement. What is the amount of the misstatement because of which you are giving the modified opinion? That also you have to describe in a detailed manner, where in the basis for opinion. So once again I am telling, in case if you have given unmodified opinion, basis for opinion paragraph only contain 4 things. But in case if you are giving a modified opinion, in addition to these 4 things, you have to also mention because of what reason you are giving a modified opinion. I have a literal example for this. So if you look at audit report of Adani Enterprises Limited. So this is the audit report of Adani Enterprises Limited. So let us have a quick look at it. So here the auditors have given qualified opinion. Fast. Yes. Okay, here we have. So independent auditors report. So if you see here the auditors have given qualified opinion, and here they have given the basis for the qualified opinion. If you pay close attention, those 4 things, whatever must be there in the basis for opinion paragraph, here it is there. Whatever we have seen in the Reliance Industries Limited, as it is copy pasted paragraph is there. But in addition to that, if you find, come on, sorry guys, it is getting stuck. So just quickly I will show and wind it up. Yes. So in addition to this information, there is the basis for qualified opinion is even more elaborated. It is even more elaborated. Sir, what is this extra information here? This extra information is nothing but the auditors are explaining, since they have given a qualified opinion, why they have given a qualified opinion, that reason they are explaining. So along with the reason, if possible, they have to even quantify, state the amount of the misstatement also. So where it is mentioned in SA 705, it is mentioned. So if we go back to SA 705, just I wanted to take you through that important discussion. Yes. So here it is. So in case changes to be made to the basis for opinion paragraph in case of modified opinion. In case if you are giving a modified opinion, what you should do. So Number one, I will come to that later. Number two, describe and quantify the misstatement. Because of which misstatement you are giving a modified opinion, explain it, and also, if possible, quantify it. Sir, I'm unable to quantify. I'm unable to determine the amount of the misstatement. If you are unable, if it is not practicable to quantify, state the same thing. That we are unable to quantify the misstatement, you can state the same thing. If you're able to quantify, tell the amount. If you are unable to quantify, state the fact. In case you are giving a modified opinion because of wrong disclosure, not because of misstatement in the figures, management has given wrong explanation, wrong notes to accounts, that's why you are giving modified opinion, then what I should do? I have to explain what are that disclosures which are misstated, which explanation was given wrong, that I have to explain where in the basis for opinion. In case management did not give disclosure, that's why you are giving modified opinion. Management is required to give some disclosure in the financial statements, but they did not give it, that's why you are modifying. Then you have to say that non-disclosure, because of which non-disclosure you are giving modified opinion. If possible, you have to include that omitted disclosure in your auditor's report if it is permitted. What is the disclosure that was missed by the management because of which you are giving modified opinion? If there is no restriction on you from any law or regulation, you have to include that disclosure in the basis for opinion paragraph. You will give modified, but in addition to that, explain that disclosures also. And if you are unable to obtain audit evidence, that's why you are modifying. I have told you, you can give qualified opinion even if you don't have audit evidence also. If you don't have audit evidence, you can give disclaimer also. Even disclaimer is also a modified opinion. So in case if you are modifying your opinion because you are unable to obtain audit evidence, then you have to explain even reasons for that inability also, because of which reasons you are unable to obtain audit evidence. All this you have to update in your basis for opinion paragraph. And the standard SA 705 says also one more thing. In case if you are giving unmodified opinion, the title of the opinion paragraph will just remain opinion, and the title for basis for opinion paragraph will just remain basis for opinion. But in case if you are giving a modified opinion, the title of the opinion and basis for opinion paragraph also will change. As you would have observed in the case of Adani Enterprises, since the auditors have given qualified opinion, the opinion paragraph heading was qualified opinion and basis for opinion was changed to basis for qualified opinion. Did you pay attention when I have shown you that? Oh, it's not going to that page. So I will load it in my note writing app only, so that we will not have this trouble again and again. So for one last time, just bear with this. Where are you? Yeah, here it is. So if you would have paid attention, here the title heading of the opinion paragraph was changed to qualified opinion. Heading of the basis for opinion paragraph was changed to qualified opinion. Same thing will happen even for adverse and disclaimer also. If you are giving adverse opinion, opinion paragraph title will be changed to adverse opinion, basis for opinion will be changed to basis for adverse opinion. If you are giving disclaimer of opinion, the opinion paragraph will be changed to disclaimer of opinion and basis for opinion will be changed to basis for disclaimer of opinion. So these changes are required to be made to the headings of opinion and basis for opinion paragraph also. So this is what the content which has to be included where in the basis for opinion paragraph. So we are done with opinion paragraph, we are done with basis for opinion paragraph also. Then there will be one more content immediately after that. There should be some content with the heading material uncertainty relating to going concern. What is this material uncertainty relating to going concern paragraph? What kind of information will be presented in this paragraph? This we will not discuss in this chapter. When we take up the standards on audit, when we discuss SA 570, there we will get to know more about this paragraph. What is this material uncertainty relating to going concern paragraph? What kind of information will be included in this paragraph? That we will get to understand it when we take up SA 570. So this will be for later discussion. After that, there will be some three special content. Number one, key audit matter, emphasis of matter, other matter paragraph. This we will have a separate discussion. First, we will complete SA 700 and 705 fully. After that, we will take up discussion 701 and 706. In that standard, we will come to know what is key audit matter. So to know key audit matter, we will discuss SA 701, and to know emphasis of matter and other matter, we will discuss SA 706 immediately after completion of SA 700. We'll complete all other contents. After discussing all other contents, then we will take up key audit matter separately, emphasis of matter and other matter separately. Okay, right. Then you have to include, after these special things, you have to include a paragraph where you will explain the responsibilities of the management for the financial statements. So what are the responsibilities of the management that you have to include in your auditor's report? And particularly in this paragraph, you will talk about 4 things. In this paragraph, you have to say that management is responsible for preparing the financial statements in accordance with applicable financial reporting framework. You should also mention that management is responsible for implementing internal controls to make sure that financial statements are free from material misstatements. And also, you have to include one line that management is responsible for making an assessment regarding going concern, whether entity will be able to continue as a going concern or not. That assessment, making that assessment, is also responsibility of management. That line also you have to include. And even you should identify who is having oversight of the financial reporting process, who is looking after that financial reporting process, who is the person, who is the team who is monitoring that financial reporting process. That authority in the organization also you have to identify. So these are 4 things must be included in the responsibilities of management paragraph. What are they? Number 1, preparation of financial statements. Number 2, implementation of internal controls. Number 3, assessing the entity's ability to continue as a going concern. Number 4, oversight of who is having oversight of financial reporting process. So after these responsibilities of the management paragraph, the next paragraph which you have will be auditor's responsibility paragraph. In the auditor's responsibility paragraph, you have to tell all your problems. Nothing but whatever your issues are there, whatever your responsibilities as an auditor are there. So all that responsibilities you have to mention. Like you have to say that you are responsible for obtaining reasonable assurance. You have to give an audit report. Auditor's opinion is reasonable assurance is a high level of assurance. Auditor is not giving guarantee. The misstatement can happen from fraud or error also, but you will be concerned only about material misstatement. You have to exercise professional judgment. You have to maintain professional skepticism. These are all qualities of the auditor, which you might have read it in the CA inter level. Then you have to identify the risk of material misstatement. You have to understand the internal controls. You have to check the accounting policies. You have to analyze whether going concern assumption is valid or not. Nothing but management will do assessment of regarding going concern. Whether that assessment is correct or not, you have to evaluate it. And also, you have to check whether financial statements are prepared as per the fair presentation framework or not. In case this SA 600 point, we'll talk about it later. SA 600 will have dedicated discussion. And also you have to communicate that, and also you have to say that there are some reporting responsibilities on you. You have to communicate certain matters with those charged with governance. This we will discuss in SA 260 and SA 265. Simply, you have some communication requirement of those charged with governance that you have to state, and various other matters you have to communicate with those charged with governance. So all that responsibilities as an auditor, whatever your responsibilities are there, that list of all the responsibilities you have to include in which paragraph? Auditor's responsibility paragraph. So first there will be management responsibility paragraph, where you will explain management responsibilities. After that, as an auditor, what are your responsibilities? That also you have to explain. So I'm not going into details. So that is what regarding auditor's responsibility paragraph. After that, you will be able to find something called report on legal and other regulatory requirements. Nothing but apart from the standards on audit, if there are some other reporting requirements of the auditor, that you have to include in this paragraph. Like as I've told, you have to prepare your audit report as per the standards on audit. But in addition to that, there are some reporting requirements on the auditor as per Companies Act also. Like we will see in this chapter, there is some 143 subsection 1. Under that, 6 matters are there which are required to be reported. 143 subsection 3, some 9 plus 6, some 15 matters are there which are required to be reported. And under 143 subsection 11, which is nothing but CARO, there are 21 matters which are required to be reported. So in addition to the standards on audit, as per the Companies Act, auditor is required to report on these many points. Sir, where he will include that in the auditor's report? In this paragraph. In this paragraph. As the name itself says, report on legal and other regulatory requirements. Apart from the standard, as per some other law or regulation, if you are having any reporting requirements, use this paragraph. Here you can come and report it. So like that, you will have a one paragraph reporting on legal and other regulatory requirements. After including all the contents, you have to sign the auditor's report. Without your signature, the report will not have any validity. So you have to sign it. If you are an individual practicing chartered accountant, you will sign your name, you will mention your membership number, you will mention. In case the auditor is appointed as auditor appointed is a partnership firm or LLP, if they are appointed as an auditor, one partner will sign on behalf of the entire firm. And while signing, this partner should sign. He has to mention his name. He has to mention his membership number. Along with that, he should also mention the firm's name, firm registration number also you have to mention. If you are an individual practicing chartered accountant signing the audit report, just mention your name, your signature, your membership number. But if you are signing on behalf of a firm, You have to mention along with your name, your membership number, you have to mention the name of the firm, and also firm registration number also has to be mentioned. And you have to mention the date of signature, on what date you are signing, the date of signature, along with that place of signature, nothing but the city where you are signing it. And finally, UDIN also you have to mention. Without UDIN, as you all are aware, today chartered accountant signatures are not at all valid if they don't have UDIN number. UDIN is a unique document identification number. Every time any document you are signing, you have to go to the UDIN portal, log in there, a unique number will be generated. Unless and until you mention that UDIN number below your signature is not going to be valid. So even that UDIN number is also required to be mentioned. So these are all the contents of the audit report. So there are some 4 special contents are there, which are yet to be discussed. Out of that 4 special contents, 1 content, material uncertainty relating to going concern, this we will discuss in SA 570. But other contents we are yet to discuss. What is the key audit matter? What is the emphasis of matter? What is other matter paragraph? This is yet to be discussed. Now we will discuss them. So with this, overall, almost all 700 and 705 discussion is over. 700 and 705 discussion is over. Now we will proceed ahead and try to understand 701 and 705. 706, sorry. 701 will be talking about key audit matter, and 706 will be talking about emphasis of matter paragraph and other matter paragraph. Clear, everybody? So first we will take up SA 701 to understand this key audit matter paragraph. What is this key audit matter paragraph in a detailed manner? Okay, shall we do it? Let us do it now. So SA 701 is a standard which is talking about key audit matters. So let us go ahead and try to understand SA 701. So SA 701 title, if you observe, the title of the standard is Communicating Key Audit Matters in the Auditor's Report. See, first of all, let us try to understand what is this key audit matter. What actually led to the introduction of this content of key audit matter. See, all the contents were earlier there, like opinion, basis for opinion, auditor's responsibility, management responsibilities. So all these paragraphs are there for a very long period of time. But this key audit matter is one of the content which has been introduced after a certain period of time. This content is not there from the beginning. So this content, the key audit matter, has been added very recently. So what led to the introduction of the key audit matter? Let us try to understand that first. See, key audit matter, what actually led to the introduction of this matter is, as I have told you, today there is a uniformity required in the auditor's report. Today there is a uniformity required in the audit reports. Whenever you pick up 2 audit reports, they should look similar. So today, because of the standards on auditing, we have achieved that level of uniformity. And in fact, practically telling, today we have achieved so much of uniformity that if you take 2 audit reports which contain same opinion, they will look exactly copy pasted. Only name of the company will change. Apart from that, nothing will change. Apart from that, nothing is going to change. Why? See, the standards has used strict terminology. So in fact, what I will say is, in SA 700, when you download the bare SA 700 standard from the resources, and if you go to the end of the SA 700, you will find something called appendix. At the end, they have clearly given what should be the format if you give unmodified opinion, what should be the format if you give modified opinion. Detailed format has been given. So today, once you have done the audit, you have decided the opinion, you need not apply your mind. What you have to do is, just you have to download that SA 700, go to the appendix. If you are giving unmodified opinion, there will be a format for unmodified opinion. Copy that information, paste it in a Word file, change the name of the company, date, etc. Do all that cosmetic changes, audit report will be ready. So ICA has actually reduced your work. You need not use your creative skill, communication skill to prepare the audit report. Just you need the copy pasting skill. So because of that extreme guidance, today audit reports have all become very similar. Exactly copy pasted information, you will be able to find it. Now industry started crying. See, whatever we chartered accountants do, industry will always have a problem. See, when audit reports were not uniform, the industry cried and told, hey, audit reports are not looking similar. We are having difficulty in understanding. Please make the audit reports similar. Now when ICA has put the effort, gave the standards, and we have achieved uniformity, now industry is complaining, hey, today audit reports are all looking similar. We are not getting any value addition by reading your audit report. What the industry started complaining? we are not getting any value addition by reading your audit report. It is exactly copy pasted information. If I read Reliance audit report and Infosys audit report, if both the auditors are giving same opinion, exactly copy pasted information, I am not finding any value addition. Now ICA has to do something to bring that value addition to that auditor's report. So that's why they have told, okay, you want more communicative value from the auditor's report, we will do one thing. We will bring one new content in the audit report. That content will be called as key audit matter, where our auditors will explain some of the matters which are most significant in the auditor's judgment. From the entire audit, whatever matters which auditor feel as most significant, most important, those matters auditor will explain. Like, for example, if I am conducting audit of Infosys Limited, I found a very difficulty in obtaining audit evidence regarding revenue. I obtained audit evidence, but it was little bit difficult for me. I performed more procedures. I have to go through a lot of struggle. I have to verify so many documents to obtain audit evidence regarding revenue. So now what standard has told is, okay, you can select this revenue as a key audit matter. Explain how you have dealt with that revenue, how you tried to obtain audit evidence, what procedures you have performed, what difficulties you have faced, why you have faced difficulty. Explain it. Now, there is some other auditor who has conducted audit of Reliance Industries Limited. Now, while he is conducting audit, he faced difficulty in obtaining evidence regarding litigations and claims. He faced difficulty obtaining evidence regarding litigations and claims. Now, the auditor of Reliance Industries Limited will explain that litigations as a key audit matter. So like this, now what will happen is, for the key audit matter, it all changes from entity to entity. Whatever difficulty Reliance auditor has faced, the same difficulty Infosys auditor might not face. Why? Because here company is changing, industry is changing, circumstances are changing. Whatever I felt as significant in one entity, the same matter might not be significant in another entity. For Infosys, revenue might be significant matter. For Reliance, litigations could be significant matter. For Adani, something else could be a significant matter. So that's why what the standard has told is, hey boss, dear auditors, industry is complaining, they are not getting any value addition by reading the audit report. You do one thing, give your opinion, basis for opinion, auditor's responsibility, management paragraph, management responsibility paragraph, everything you do. But in addition to that, from the current year audit, whatever you have done, you identify a few matters which you feel it as most significant and explain about them in the auditor's report. So that guidance has been given, and accordingly, this key audit matter paragraph has come into picture. Let me show you an example here. So here we have Adani Enterprises audit report, and here you could see after the basis for opinion paragraph, they have included key audit matter. If you look at the key audit matter, like auditors of Adani has selected contingencies relating to taxation, litigation and arbitration as a key audit matter. So might be the auditors of Adani has found difficulty, or they have faced some struggle in obtaining audit evidence, and they felt it as most significant area. So what Adani Enterprises auditors have done is, they have explained this matter as a key audit matter. So first they will explain why they have selected it as a key audit matter, why you are feeling it as most significant. So that reasons they will explain. Like if you see here, the provisions and contingent liabilities relating to ongoing litigations. There are so many litigations which the company is going through. They are related to direct tax, indirect taxes, any other legal proceedings are also there. As at the year ended, the amounts involved were very significant. Whatever amount that is involved in the litigation, that is a very big amount. The assessment of provision or a contingent liability requires significant judgments. In estimating that provisions and contingent liabilities, a lot of assumptions will be involved, and it is very complex. The amount recognized as a provision is a best estimate of the expenditure. All these are provisions, litigations, contingencies, whatever they have created, that is purely an estimate. And the provisions and contingent liabilities are subject to changes in the outcomes of litigation claim. Whatever provision they have created now, that actual liability might be different. So it involves a significant judgment and estimation to determine likelihood of outflows, etc. So they are simply explaining here why they have selected this matter as a contingent matter. Because there are so many estimates involved, the amounts were significant. So that's why auditor has decided this as a significant matter. They have explained it. Okay, now you are telling this as a significant matter. No, you should also explain how you have dealt with that. What kind of audit procedures you have performed. So that's why here auditor is going to explain what procedure he has performed, what things he has checked, what audit procedures he did, what estimations, how he has checked the estimations, how he has used the experts, So nothing but basically you are telling this as a significant matter. You have told the reasons why it is a significant matter. You should also explain how you have dealt with that, what kind of audit procedures you have performed. Similarly, if you see one more matter is also selected as a key audit matter, revenue recognition. Might be auditors of this entity Adani, they might have felt difficulty in obtaining evidence regarding revenue recognition. So they will explain why they have selected this as a key audit matter. They will also explain how they have dealt with this matter, what audit procedures they have performed. One more, they might have faced difficulty in obtaining evidence regarding measurement of inventory quantities of coal. They might have they selected this as a key audit matter, and they have explained why they have selected it as a key audit matter, what procedures they have performed. So like this, the auditors, whenever they are doing audit, so they have given so many key audit matters, like this fourth one is also there, fifth one is also there. So like that, some 5 matters they have selected and have explained them as a key audit matter. So now when you open the Reliance Industries Limited audit report, similarly, the auditor of Reliance Industries Limited, while doing the audit of Reliance, he might have his own difficulties. He will explain those difficulties in his audit report. Now, if someone downloads the Adani report and Reliance report, they have this different information of key audit matters. Now they will not complain, no, audit reports are looking similar, we are not getting any value addition. I will say, boss, go and read the key audit matter. You will get more value, more communicative value. So with that introduction, key audit matter was introduced. But here, one important point I want to clarify here. So most of the students will often have a misconception that, see, auditor of Adani, he has explained contingencies and litigations as a key audit matter. Does that mean he is commenting negatively regarding this point? No. Just change your perception here. So most of the people will feel that if auditor is explaining something, there is something wrong about it. No. So if auditor has explained this as a key audit matter, he is not giving any negative comment regarding this matter. Just he is telling what difficulties he has faced, how he has dealt with the matter. Similarly, if he is explaining this revenue recognition as a key audit matter, he is not giving any negative comment, just he is telling what difficulties he has faced, how he has dealt with the matter. So you have to change that attitude. Whenever auditor says something, he's not commenting in a negative way. By explaining key audit matter, auditor is not commenting any negative thing. Just for value addition, he's explaining you what difficulties were faced and what significant matters are there. That's the only purpose. Clear? So this clarity, you need to have it in the back of your mind. So since we got to understand what is the purpose of the key audit matter, how it will be presented, we can quickly wind up the standard in just a few minutes. So let us have a look at it. So if we go back here, first of all, what is a definition of a key audit matter? So key audit matter is something defined like this. Key audit matters are those matters that in the auditor's professional judgment, very important, that in the auditor's professional judgment, whereof most significance in the audit of the financial statements of the current period. While you are conducting audit of the current period financial statements, whatever matters that you have felt as most significant, most important, that you have to explain. And once again, here there is no hard and fast rule. So which is a significant matter, which is not a significant matter, that has to be decided by the auditor himself using his professional judgment. So the auditor, using his knowledge, experience and training, he has to decide which matter is a significant matter. It is nowhere exactly stated this will be exactly a significant matter, no hard and fast rules. Auditor, depending on facts and circumstances, using his knowledge, experience and training, he has to determine it. And one more thing, if you want to explain some matter as a key audit matter, first you have to communicate with those charged with governance. Those charged with governance are top level people in the organization, top level management in the organization. We call them as those charged with governance. So if you want to include certain matters in the key audit matter paragraph, first go and communicate with those charged with governance. Here also you have to be very careful. They are not asking you to take the permission. They are just asking you to let them know. That's all. Okay. Now, sir, what is the purpose of key audit matter? Why this key audit matter has been introduced? I have already told you the purpose of key audit matter is to enhance the communicative value, to increase the communicative value of the auditor's report, to add more value addition to the readers of the auditor's report. And most important thing, communicating key audit matters provide additional information to the intended users that will help them to understand the audit report in a much more better way. And this is also the important point. Most of the people have misconception that, sir, SS 701 has asked the auditor to include key audit matters in the auditor's report. Now let us assume a typical scenario. You are conducting audit of Reliance Industries Limited. management prepared the financial statements and gave it to you. And after they have given the financial statements, while I'm doing the audit, while I'm preparing my audit report, management of the Reliance Industries Limited came to you and they told, sir, there is one disclosure which is required to be given in the financial statements. We are required to include some explanation, the notes to accounts as per Schedule 3 and accounting standards. But we forgot to include it in the financial statements. You do one thing. Since we forgot, anyhow, in the audit report, you will give a key audit matter paragraph now. Whatever disclosure we forgot to give in the financial statements, you please include that in the key audit matter paragraph. Management is coming and requesting you. If I have to simplify, management forgot to give some disclosure in the financial statements, and now they are approaching the auditor. Whatever disclosure they have forgot, add it in the key audit matter paragraph. Do you think it is acceptable? Do you think the purpose of the key audit matters is this? Is the key audit matter has been introduced as a substitute for including disclosures? No. Key audit matter has been included for the auditor to explain what difficulties and what significant matters he has found. Not that if the management forgets something, they can come and ask the auditor to include it. No, that is not the purpose. So that is the first point they say, communicating key audit matter in the auditor's report. It is not a substitute for disclosure in the financial statements that applicable financial reporting framework requires the management to make. If the management is required to make some disclosure, they are only required to do it in the financial statements. They can't come and ask the auditor to include it in key audit matter. The purpose of key audit matter is not that. And one more thing, some intelligent auditors have thought that, assume I am conducting audit of Infosys. While conducting audit of Infosys, I found a material misstatement. So when I found a material misstatement, what is my course of action? I should have given modified opinion. But one auditor is thinking like this. Okay, I will do one thing. I found a material misstatement. I will not give modified opinion. I will give unmodified opinion only. That material misstatement, I will explain it in the key audit matter paragraph. Do you think it is acceptable? If you find any material misstatement, instead of giving a modified opinion, can you just highlight it in the key audit matter paragraph? Is the purpose of key audit matter is that? No. That is the second point. Key audit matter is not a substitute for the auditor expressing a modified opinion. If you are required to express a modified opinion, you have to give a modified opinion only. You can't use key audit matter paragraph as a substitute for that. Similarly, it is also not a substitute for matters which are required to be included in material uncertainty relating to going concern paragraph. Now, what is this? This point you will not get clarity, but just I will try to explain it. See, if you remember, in the contents of the auditor's report, I told you one paragraph I will explain it in the SA 570. So this paragraph, material uncertainty relating to going concern. There will be certain matters which will be included in SA 570. In this paragraph, if some matter is required to be included here in this paragraph, instead of including it here, can I explain the key audit matter paragraph? Is key audit matter paragraph is a substitute for material uncertainty paragraph? No. The simple meaning of that is, if something is required to be included in the material uncertainty paragraph, the matter has to be included here only. You can't use key audit matter as a substitute. If I have to put it in a much more simpler way, whatever has to go here only it has to go. It should not come here alternatively. Okay. So that's what they try to clarify. Sir, but what will come in that material uncertainty paragraph? To know this, we have to wait till the time we discuss SA 570. Okay. So that's what they say. It is not a substitute for material uncertainty. And also, by explaining the key audit matter, auditor is not giving any separate opinion on any of the matters. He is not separately giving opinion on any of the key audit matter. Just he is explaining what matters were significant, why they were significant, how he has dealt with that. Understood? Now, the next doubt comes. Sir, is the auditor required to include key audit matter for every audit? Not required. As I have told, key audit matter was a recent addition. They did not make it mandatory for now for all the entities. Currently, key audit matters are applicable, mandatory only for listed company audits. In case if you are conducting audit of a listed company, then only you have to include key audit matters in your audit report. If it is an unlisted company, there is no such requirement for the time being now, but in the future, they may make it mandatory for all the companies, but for the time being now, it is now currently mandatory only for listed companies. So that's what they say here. The auditor shall communicate key audit matters for audit of listed entities. If you are conducting audit of a listed entity, then you have to compulsorily include in the key audit matter. In some cases, the entity might not be a listed entity, but law or regulation might require you. For example, some bank is there which is not listed, but Banking Regulation Act is asking you to include key audit matter. Then you have to include it. If it is a listed company, you have to include. If it is not a listed company, then you have to check, is there any specific requirement from law or regulation? Then you include it. If there is no requirement for law and regulation and it is also not a listed company, no need to include it. And in other circumstances, the auditor himself might decide. If you are conducting audit of an unlisted company, if there is also no requirement of any law or regulation, but you using your professional judgment, you thought that, okay, in this company, even though it is unlisted, even though there is no requirement of law or regulation, if I include key audit matter, that will be better, keeping in mind the interest of the shareholders. So if you have any voluntary decision out of your own choice, if you want to do it, you can do it. But mandatory requirement only in the case of listed entity when there is a requirement of law or regulation. Other cases, the auditor himself can decide, but not a mandatory thing. Okay, next. One more thing here, sir, how to present the key audit matter? You have to include a separate paragraph, key audit matter, separate heading should be there. If you have more than one key audit matter, separate subheadings should be there for each key audit matter. That's what we have seen in Adani Enterprises. One main heading is there, key audit matter, and for each of the key audit matter, they have given subheadings. 1, 2, 3, 4, 5. 5 key audit matter subheadings are there, no? So that format you have to follow. So you have to use a main heading key audit matter, and for each key audit matter, you have to use a subheading. And before explaining key audit matter, you have to give some 2-3 lines of introductory information. You have to give some 2-3 lines of introductory information. Nothing but one paragraph you have to give before you explain the key audit matters for clarity of the shareholders. I will show you that also. Yes. Here, if you see, key audit matters are explained now, but before that key audit matters, they have given one paragraph. They have given one paragraph where they are trying to say something. What they are trying to say, key audit matters are those matters that in our professional judgment were of most significance while conducting audit of financial statements. These matters we have addressed while conducting audit. We do not provide a separate opinion. So this paragraph you have to compulsorily include this introductory information, this introductory language you have to use before explaining the key audit matters. The same thing they have told in the standard also. So this introductory information you have to give. Same, whatever we have read in the audit report, same thing will be there. Key audit matters are those matters that in the auditor's professional judgment were of most significant. These matters were addressed. We do not express a separate opinion. And most important thing here, if you don't have a key audit matter, you are conducting audit, but you did not find anything significant, then what you should say? You should say that there are no key audit matters. You have to use a heading and say there are no key audit matters. Especially in the case of listed company, you are conducting audit, but you are unable to find any key audit matter. You did not find anything as most significant. Then you have to say there is a no key audit matter. That fact you have to mention if there is no key audit matter. Clear, everybody? Only in case of listed and legal and regulatory requirements. Why? Because in other entities, key audit matter itself is not mandatory. If it is mandatory, but you don't have key audit matter, then you have to say this. Clear? Next. Sir, there are some circumstances where key audit matters are not required to be communicated. Even though you are conducting audit of a listed company, or even though there is a requirement of law and regulation to report key audit matter, but still in some circumstances, you are exempted. When, sir? If you are giving a disclaimer of opinion. You are giving what? You are giving a disclaimer of opinion. So the standard has clearly told, if ultimately you are giving a disclaimer of opinion, there is no compulsion on you. Even though you are conducting audit of a listed company, no need to include key audit matter paragraph. The logic is very simple. When you are giving disclaimer of opinion, what is exactly happening there? You are trying to say that you are unable to do the audit. When you are unable to do the audit only, how can someone expect you to identify significant matters from the audit? Sense only, no? It is quite illogical to ask you to report significant matters when you are unable to do the audit only. So that's why the standard has told, in case if you are giving disclaimer of opinion, there is no requirement to include key audit matter paragraph. Because you are unable to do the audit, we are not expecting the key audit matter paragraph from you. And also, there are some matters which shall not be communicated as key audit matter. Like when there is a restriction from law or regulation. Sometimes law and regulation will put a restriction on certain matters. This matter should not be communicated openly. Such matters you can't explain it as a key audit matter. Like for example, some law has told if you are conducting audit of some defense related company, no matter should be explained as a key audit matter. Or some sensitive matters should not be explained anywhere publicly. Those matters you can't include it in the key audit matter. So when there is a prohibition from law and regulation, or the auditor determines that because of communicating key audit matter, instead of positive consequences, there will be negative consequences. Like for example, let us take some company which is going through a very bad phase. Let us take through some company which is going through a very bad phase. Take for example S Bank. S Bank has been going through a very bad phase. So here the auditor has found obtaining audit evidence regarding loans as a bit difficult. He wants to explain regarding loans as a key audit matter. But since the status of the company is very bad, when I, with a positive intention, when I explain key audit matter, but people may perceive it wrongly, they might feel that, okay, once again, S Bank has started something wrong with the loans and advances, and they might misunderstand it. With a very positive intention, there is no misstatement in the loans. You found a difficulty, that difficulties you are explaining. But since company is having a bad track record, even with a good intention, you try to explain something, people will perceive it in a wrong way, in a negative way. So when you have such a feeling because of communicating key audit matter, instead of positive consequences, there will be negative consequences only. If you are of such a judgment, then don't include that matter as a key audit matter paragraph, include something else. Clear? And also, if the auditor concludes that the matter is highly confidential or sensitive, in some cases you might find some information as highly confidential, highly secretive, that information also you don't include it in the key audit matter. So these are the circumstances where key audit matter shall not be communicated. Broadly, if you are giving disclaimer, no need to communicate the key audit matter. And in other cases, if there is any law regulate, if there is any prohibition from law and regulation, or if the auditor feels that because of communicating key audit matter, there will be more negative consequences, or if the matter is highly confidential or sensitive, these kind of information should not be communicated as a key audit matter. And one more last thing, sir, you are telling which is a key audit matter, which is not a key audit matter. This auditor himself has to decide using professional judgment. But it is very rude, no, sir. Standard should give at least some guidance where to look for key audit matters. That standard at least should give some sort of guidance, no? Yes, the standard has given some guidance. The standard has told what kind of factors you have to look, or in determining key audit matter, what you should take into account. If I put it in simple language, where you can start looking for key audit matters, in what kind of areas you can start looking for key audit matters, standard has given you some hint. So whatever areas where you feel the risk of material misstatement is very high, in those areas you can go searching for key audit matters. Or those areas which involve so many judgments or estimates, those areas where so many assumptions and estimates are involved, like provision, contingencies, in those areas you can start looking for key audit matters. Or if you find any significant event or transactions that occur during the period, like acquisitions, mergers, from these significant events and transactions also you can start looking for key audit matters. So nothing but the standard is trying to throw some light where you can go and start looking for the key audit matters. They have given 3 examples. Number 1, you can go and look for key audit matters in those areas where there is a high risk of material misstatement, or those areas where significant assumptions and estimates are involved, and also those significant events or transactions. If there are any major events or transactions which have taken place during the year, in that areas also you can go and look for key audit matters. So that's all regarding SA 701. So what we have understood in SA 701, what is the definition of a key audit matter, what is the purpose of communicating key audit matter, and when you should not communicate key audit matter, when it is mandatory applicable, and what is the presentation requirements, and what are the factors which you have to consider, how you can determine the key audit matters. This is what one simple standard, very small standard, important from the examination perspective. So this is regarding SA 701. So now we have one more standard left for discussion, which is SA 706, which is talking about 2 contents, emphasis of matter paragraph, other matter paragraph. Emphasis of matter and other matter paragraph, very simple standard like SA 701. It is very simple. In a similar manner, SA 706 also will be very simple. Let us try to understand now SA 706, which is talking about 2 contents, emphasis of matter and other matter paragraph. So let us try to understand it. So now let us come to SA 706. So as I was telling you, SA 706 actually talks about 2 contents in the audit report. Number 1 is emphasis of matter paragraph and the other one is other matter paragraph. First, I will start my discussion with emphasis of matter paragraph. Sir, what is this emphasis of matter paragraph? The general meaning of the term emphasis or emphasize is to highlight. Is to what? Highlight. So emphasis of matter paragraph is actually used by the auditor to highlight some information which is already presented or disclosed in the financial statements by the management. So the meaning of this is very simple. Generally, who will prepare the financial statements? As we all know, management will prepare the financial statements. So they will prepare balance sheet, they will prepare P&L, they will prepare cash flow statement, they will prepare statement of changes in equity, they will prepare notes to accounts. So management in the financial statements, whatever they have prepared, they have already included certain information. The management, without their fault, they have already presented and disclosed certain information. But as an auditor, you felt that this matter should be highlighted somewhere in the auditor's report. It doesn't contain anything wrong. The management has completely exactly stated whatever has happened. There is no mistake from the management side. They have correctly, properly presented some information. But as an auditor, you felt that this matter is very fundamental to users' understanding of the financial statements. Better I highlight it somewhere in my auditor's report. Then what you can do is you can use a dedicated paragraph called emphasis of matter paragraph, and there you can highlight that information which is already presented or disclosed by the management in the financial statement. I will give you one simple example to understand. Okay, take some statement of P&L. Take some company. Look, if you look at the statement of P&L, there is statement of P&L, revenue, expenses, all are there. Then there is one item, P&L before extraordinary items. P&L before extraordinary items, 100 crore. Then there is some extraordinary item. There is some extraordinary item. Some extraordinary loss is there. Some one-time loss is there. Some 60 crore rupees of loss is there. And P&L net profit after extraordinary item, it was 40 crore rupees. Now, what is this extraordinary item? The management, without their fault, they have explained that clearly in note number 27. They have given reference here, note number 27. Now, if you go to note number 27, there the management has clearly explained what is the extraordinary item. So might be they have explained that there was a fire accident which has taken place, is one of the factors of the company. The total loss arising from that fire accident was 100 crore rupees, but they're able to get 40 crore rupees of insurance compensation. Net loss from that fire accident was 60 crore rupees. The same thing was reflected in the financial statements. On the statement of the P&L, the same thing is reflected. The management did not hide anything about it. Clearly, they have explained in the note number 27 the details of that extraordinary item. So you tell me, did the management commit any mistake in the preparation of the financial statements? Did they hide anything from the shareholder? No. So you tell me, if that is the case, whether these financial statements contain a material misstatement? No, financial statements are not containing any material misstatement, because when we say financial statements are materially misstated, when management is trying to hide something or management is trying to convey wrong information, then we say financial statements are materially misstated. But here, as I was telling, management did not hide anything. Without their mistake, they have clearly told what has happened. So we can't say here financial statements are materially misstated. But management clearly presented that in the financial statement. But as an auditor, I felt that it is better. This is very much important for the user's understanding of the financial statements, because most of the users will not read each and every content in the financial statements. They will just look at the bottom of the P&L. They will think, okay, profit of the company is 40 crore rupees. They might feel that this is the average profit of the company. But if they read in a deeper manner, if they read and go to that note number 27 and read it, then they will get to know 40 lakhs is not the normal profit for the company. The normal profit will be 100 crores. There was one extraordinary event, fire accident happened. That's why this loss of 60 crores has happened. That's why the net profit was 40. If this fire accident is not there, the profit would have been 100 crores. So the average normal profits of the company are around 100 crore rupees. This user will become aware only when he goes and read that note number 27. But most of the readers will not do it. So as an auditor, I felt that, okay, management already presented some information in note number 27, but it is important for the user to understand it. So what I thought is, let me highlight this somewhere in the auditor's report so that the readers will not miss it. Sir, how can I highlight it? Can I modify my opinion and highlight it? You can't do it. You can modify the opinion only when the financial statements are materially misstated. But here you are only telling financial statements are not materially misstated. So I can't highlight this by modifying the opinion. So standard has given a way out. You can do one thing in the auditor's report, use one paragraph, emphasis of matter paragraph. In that you highlight what information you want to highlight. Also give a reference to the note number where they can go and find that information. So in this case, I will use the emphasis of matter paragraph and I will say, I draw your attention to note number 27, where management has explained about the extraordinary item. Please go and read it. So that any reader who is reading that financial statements, he will not miss that point and he will make a correct decision. Understood? So that's all. This is what regarding emphasis of matter paragraph. So simply, if you look at the definition of the emphasis of matter paragraph is a paragraph which is included in the auditor's report that refers to a matter which is appropriately presented or disclosed in the financial statements. There is some information which is already presented or disclosed in the financial statements. Just I want to include in my auditor's report because it is fundamental to users' understanding of the financial statements. Clear? So once again, if I simplify, some matter is already presented or disclosed in the financial statements. You want to highlight it, you can use emphasis. As simple as that. So now they have given more about emphasis of matter paragraph. So when you will use the emphasis of matter paragraph, let us see. The auditor shall include an emphasis of matter paragraph in the auditor's report, provided the auditor would not be required to modify the opinion because of some matter. Which means that, see, you can highlight those matters. You can highlight only those matters in the emphasis of matter paragraph which are not materially misstated. If some matter is materially misstated, the appropriate option will be to give a modified opinion, not just highlighting it in the emphasis of matter paragraph. So you can highlight only those information in the emphasis of matter paragraph which is not materially misstated. Management did not hide anything. Management did not convey wrong information. Some information is correctly presented that you want to highlight. Then you can use emphasis. If some item contains a material misstatement, the correct option is to give a modified opinion, not just highlighting. So very, very important point you have to keep in mind. Emphasis of matter paragraph will be used to highlight only those matters which are not materially misstated. And also, if a matter is already determined to be a key audit matter, just now we have discussed SS 701. If some matter is already determined to be a key audit matter, then you can't present it once again in the emphasis of matter paragraph. So if some matter is a key audit matter, present it in the key audit matter only, don't bring it in the emphasis of matter paragraph. So two things they have told. You can highlight only those matters which are not materially misstated, which does not require you to modify the opinion. And you cannot present such information in the emphasis of matter paragraph which is already a key audit matter. Clear? Next. So they have given some examples also, some scenarios they have given, some examples of the circumstances which can be included in the emphasis of matter paragraph, like an uncertainty relating to future outcome. If there is any pending case going on, management has disclosed in the notes to accounts, but still you want the user to read that, you can highlight that in the emphasis. Or if there is any subsequent event, if any adjustment has been done regarding the subsequent event in the financial statements, management presented it, but you thought the user might miss it out, that also you can highlight it in the emphasis of matter paragraph. Or your client has made early adoption of the accounting standard. Your client has early some accounting standard they have adopted a little bit early than the actual effective date. This you want to highlight in the emphasis. Or if there is any major catastrophe like any calamity, etc., like fire accident and something, that also you can highlight it. These are only examples. And once again, this is not a conclusive list. This is just a illustrative list. These are only few examples. Ultimately, it is a professional judgment of the auditor. Whatever you feel it as most important, which is required to be brought to the user's attention, there you can use emphasis of matter paragraph. And how you have to present that? So as I have told, emphasis of matter paragraph should be presented in a separate section. You should give separate side heading, emphasis of matter paragraph in your audit report. I think here it should be there. Just let me check whether here there is any emphasis of matter paragraph. So in the Adani report, I think there is no emphasis. See, there is no requirement in every audit report that should be emphasis. If required, then only it will be given. Let me check anywhere else it is there. Okay, here it will be there. Just for the sake of showing it to you, I'm taking you through this practical example I wanted to give. Yes. Oh no. See here it is there. Emphasis of matter paragraph. You should use a separate side heading for that. So use a separate heading, emphasis of matter paragraph, and also include in the paragraph a clear reference to the matter being emphasized and to relevant disclosure that fully describe the matter where it can be found in the financial statements. So you have to, even as I mentioned, give a reference to the note number also where they can go and find it out, where the reader can go and get more information. So like as you see here, they will say, we draw your attention to note number 35.1. That means in note number 35.1, some information is already there. I'm giving you reference to just go and read that once. Next, and indicate that auditor's opinion is not modified. You should also mention that you are just highlighting this information, you are not modifying your opinion because of this. So that line also you have to add it. Okay, here it is not there, but generally at the end they will add a line. So our opinion is not modified in respect of this matter. So like that one line also you have to add it. Next. Now this paragraph is similar whatever we have read in key audit matter paragraph. I told key audit matter is not a substitute for three things. It is not a substitute for disclosure, which is required to be given in the financial statements. It is not a substitute for giving a modified opinion. It is also not a substitute for material uncertainty relating to going concern paragraph, as it is for whatever three matters. Key audit matter paragraph is not a substitute. Emphasis of matter paragraph is also not a substitute for the same three matters. So that's it regarding emphasis of matter paragraph. Sir, now what is other matter paragraph? This standard is talking about two things. One, we got to know. Now what is other matter paragraph? Very simple. So what they technically say is emphasis of matter paragraph is used to highlight that information which is already presented or disclosed in the financial statements. In case if you want to say something which is not presented or disclosed in the financial statements, you have to use other matter paragraph. That's it. So if you read it, the same thing you will find. Other matter paragraph is a paragraph included in the auditor's report that refers to a matter other than those presented or disclosed in the financial statements. If something is not presented or disclosed in the financial statements, and if you want to include in the auditor's report, then you can use other matter paragraph. Practically speaking, we use other matter paragraph mainly for explaining auditor's responsibilities. So here only they have given, we use mainly other matter paragraph for auditor's responsibilities. Like for example, if you are not the branch auditor was someone else, you wanted to say that I am the principal auditor, branch audit is done by somebody else, where you can say that other matter paragraph, you can say that. Or you are one of the joint auditor, there are other joint auditors, you want to tell that, where you can say that other matter paragraph. So if there is any addition of responsibilities or reduction of responsibilities to explain that responsibility matters, we can use that other matter paragraph. And finally, one more thing they say here, if you want to use emphasis of matter paragraph or other matter paragraph, first you have to communicate with those charged with governance. First you have to communicate with those charged with governance. So if I give you summary, if you want to give a modified opinion, first you have to communicate with those charged with governance. If you want to include a key audit matter paragraph, that also you have to communicate with those charged with governance. If you want to include emphasis or other matter paragraph, that also you have to communicate with those charged with governance. Clear? That's it. This is what the simple and small standard SA 706. So with this, we are successfully done with 4 standards which are talking about auditor's report. So SA 700 we are done, 701 we are done, 705 we are done, 706 also we are successfully done with. So this is what the revision of this 4 standards. Clear? Hey guys, welcome back to the revision series. So in the previous session, we are actually halfway through the revision of the chapter audit reporting. So if you remember what we have revised in our previous session, so we have actually covered 4 standards, 4 SA 700 series of the standards, which are actually talking about the preparation of audit report, what should be the contents of the audit report, what should be the format of the audit report. So 4 standards we have covered in the previous session. So those 4 standards are actually SA 700, SA 701, 705 and 706. So 700 talks about overall audit report, what should be contents and all. So that all discussion we have covered in 700 and 700. 701 is a standard which is talking about key audit matters. 705 is talking about different kinds of modified opinion, in which circumstances you will modify, when you will give qualified, when you will give adverse, when you will give disclaimer. And 706 is a standard which is talking about emphasis of matter and other matter paragraph. So all these 4 standards put together, they are going to discuss about the preparation of the audit report, contents of the audit report, format of the audit report, terminology we have to use. So everything we have covered in a detailed manner. Hope you would have enjoyed that video in the previous session. So now there are a few more contents which are left out from this chapter audit reporting, which are actually important from the examination perspective. So those are reporting responsibilities of the auditor under Companies Act 2013. We have seen what are the reporting requirements of the auditor under standards on auditing. So nothing but when we simply discussed that 4 series of the SA 700, we are actually talking about what are the reporting responsibilities of the auditor as per the standards on audit. But apart from the standards on audit, the Companies Act 2013 has also put some reporting requirements on the auditor, and those reporting requirements are actually given under 4 subsections of section 143, section 143 subsection 1, 143 subsection 3, 143 subsection 11, and 143 subsection 12. So these are the various sections of the Companies Act under which there are various reporting requirements of the auditor. Out of all that, the most important thing from the examination perspective is 143 subsection 11 reporting requirements. This only we call it as CARO. These reporting requirements only we call it as CARO 2020. So that is the most important thing from the examination perspective. So quickly we will be covering that. So but before that, I will also try to cover 143 subsection 1. What are the reporting responsibilities of the auditor under 143 subsection 1? So under 143 subsection 1, the auditor is required to comment regarding 6 matters. Under 143 subsection 1, the auditor is required to comment regarding how many matters? Regarding 6 matters, auditor is required to comment. So what are that 6 matters, sir? Very simple. Number 1, the auditor has to verify whether loans and advances which are made by the company. Made by the company in the sense the loans and advances which your client company has given. If they are on the basis of security, whether they are properly secured or not. Nothing but your client has given some loans and advances, and in their balance sheet they have shown as secured loans and advances. Now you have to verify whether they are properly secured, whether they are adequately secured. For example, the client has given a loan of 1 crore rupees and they are calling it as secured. And I'm asking the client, sir, what is the value of the security you have taken? So they're telling me that, sir, we have taken one two-wheeler as a security which is costing around 1 lakh rupees. You tell me, is this loan properly secured? No. So that is what you need to verify and give a comment. So first thing, we need to verify whether loans and advances which are given by my client company to others, if they are stated as they are properly if they are stated as secured, we need to verify whether they are properly secured or not. Properly secured in the sense whether they are adequately secured or not. And also the terms on which they have been made are prejudicial to the interest of the company or its members. Nothing but on whatever terms and conditions these loans and advances were given, are they prejudicial? Sir, what is the meaning of the term prejudicial? Prejudicial means harmful. So on whatever terms and conditions your client company has given the loan, are they prejudicial? Are they harmful to the interest of the company? Sir, when we can say terms are harmful to the interest of the company is giving loan without any interest rate, without any repayment period, or interest rate which is far below the market interest rate. So these are the few examples of the terms which are prejudicial. So I need to verify whether my client company has given loan and on what terms and conditions they have given the loan. Are they prejudicial? Are they favorable terms? Or are they unfavorable terms? So that I have to comment. So first point under 143 subsection 1 is regarding loans and advances given by the company. Now, second point which is required to be reported under 143 subsection 1, whether transactions of the company which are represented merely by book entries. Sir, what do you mean by transactions represented merely by book entries? Nothing but here you can say provisions. Here you can say depreciation. So these are just book entries. Actual substance of the transaction will not be there. So I need to verify these kind of transactions like provision, depreciation, and any other entry which is represented merely by book entry. Is it prejudicial to the interest of the company? Nothing but in simple terms, I need to verify provision, depreciation, and I need to check whether those provisions and depreciations, etc., are created at appropriate amounts or they are overstated or understated. So that I need to give a comment. So second point is regarding book entries. Next, third point. Whether company not being an investment company or a banking company, whether so much of the assets of the company as consisting of shares, debentures have been sold at a price less than the purchase price. If I put it in simple terms, that is what the summary of this. So I need to verify, is my client company holding any assets in the form of shares, securities or debentures? If yes, have they sold that securities? If yes, did they sell it above the purchase price or did they sell it below the purchase price? Simply, if I have to put it, I need to verify whether my client company has sold their assets which are in the form of shares, debentures, etc. at a loss. Have they sold it at a price less than purchase price? However, if you pay close attention here, they're telling the company not being an investment company or banking company, which means this reporting requirement will not become applicable for an investment company or a banking company. If your client is either an investment company or banking company, you need not comment on this point. Next. Fourth matter which is required to be reported, whether loans and advances made by the company are shown as deposits. Did your client company give loans and advances? Here also they are talking about assets only given. Here also they are talking about assets only. Has your client company given any loans and advances? If yes, have they really shown it as loans and advances or they are showing it as deposits? In case if I came to know my client has given loan to others, but instead of showing it as loan, they have shown it as a deposit, I need to report it here. So fourth point is also regarding loans and advances. Fifth point, whether personal expenses have been charged to revenue account. Sometimes the management of some companies could be very fraudulent, very mischievous. So what they will do is the board of directors or some top level management of the company, they incur the personal expenditure for their personal purposes, but they will show it as a business expenditure. So that I need to verify. So I need to comment whether whether in my client company's books of accounts, whether any personal expenses of management, employees, whatever it is, have been shown as business expenditure. That I need to comment. Next, last point, which is required to be reported under 143 subsection 1. If it is stated in the books of accounts that the company has any shares allocated for cash. Did the company state anywhere in their books of accounts that they have issued the shares for cash? If yes, have they really received the cash? Whether cash has been really received. In case if the cash is not received, whether the position as stated in the accounts and the balance sheet is correct, regular, and not misleading. So in case if your client is stating, yes, we have given issue the shares for cash, have they really received the cash? In case if they haven't received the cash, whatever position that has been stated in the books of accounts, whether it is correct or not, like calls in arrears, etc., these kind of adjustments they have to show. Clear? So these are the 6 matters which is required to be reported under 143 subsection 1. First point is regarding loans and advances. Second point is regarding book entries. Third point is regarding shares, sale of shares. Fourth point is also regarding loans and advances. Fifth one is regarding charging personal expenses to revenue account. And finally, the last one is relating to company issuing the shares for cash. But however, 143 subsection 1 says that you are required to report on any of these points only when you have a negative comment. Only when you have a negative comment, only when you have unfavorable answers, then only you are required to comment on any of these points. In case if you have verified all the 6 points, for everything you got a positive response, for everything you got a satisfactory responses, you need not report it. Only when you get a negative response, then only you are required to report those specified points. So these are the reporting requirements under 143 subsection 1. Okay, we are done with that. Now coming to the next section of the reporting requirements, we have 143 subsection 3. See, under 143 subsection 3, we have total 9 plus 6 or 14 matters are there. 9 plus 6, 15 matters are there which are required to be reported. Now, what are these 15 matters? See, this subsection is not that suitable for revision. Why? Because even if I try to revise all these 15 points, it will be just like recollecting. It will be just like reading the points whatever have been given in the material. But anyhow, I have already done detailed videos regarding reporting requirements under 143 subsection 3. Those links I will add it in the description. Those links where I will add in the description, I will add. You can go and watch them for your sake of understanding. So now I'm skipping it for now, 143 subsection 3. Why? Because even if I revise it also, there is no much concept in such. I will be just taking you through this. I will be reading like this, whether you have sought obtained all the information explanation necessary, proper books of accounts are maintained or not. So like this, I have to just read the content. That is not the objective behind this marathon series. As I've already told you, this marathon series is going to completely concentrate on conceptual clarity. So here there is no much clarity which I have to give. It is just reading out the points. So in the description, I will add detailed video. There will be some half an hour time of video in which I will explain in a detailed manner reporting requirements under 143 subsection 3. You can watch it later. In the description, you can find it. Okay, so this I am not doing it for now. Next, we have reporting requirements of the auditor under 2 more subsections, 143 subsection 11 and 143 subsection 12. 143 subsection 11 is very important, which is nothing but CARO. But before that 143 subsection 11, I will try to explain reporting requirements of the auditor under 143 subsection 12. 143 subsection 12 actually talks about fraud reporting. So if you are an auditor of a company, while conducting the audit of the company, in case if you come across any fraud, in case if you have a reason to believe that a fraud has taken place in the company, then there are some reporting requirements which you have to fulfill. There are some reporting requirements which you have to fulfill. Very, very important, guys. This question is having a high chance of getting tested. So let us try to understand what they're trying to say. So in case if you are a practicing chartered accountant and you are conducting audit of a company, if you come across, if you have reason to believe that a fraud might have taken place in your client's company, then you are required to fulfill some reporting requirements. Sir, what are that reporting requirements? The reporting requirements are divided into 2 categories on the basis of amount involved in the fraud. If the amount involved in the fraud is 1 crore or more, there are different reporting requirements. If the amount involved in the fraud is less than 1 crore, then there are different reporting requirements. So on the basis of amount involved in the fraud, reporting requirements are going to change. So if the amount involved is 1 crore or more, what will be the reporting requirements? So the reporting requirements are, here central government reporting will become applicable. If the amount involved in the fraud is 1 crore or more, what has to be done? Central government reporting has to be done. Here, there is no central government reporting. You need not report the central government. There are some different reporting requirements. So what are that reporting requirements if the amount involved is 1 crore or more? So basically you have to report to central government, but there is one manner of reporting. So what is that manner of reporting? First, we have to communicate the matter to the audit committee. If there is an audit committee in the client company, report to audit committee. In case if the audit committee is not there, then to the board of directors. Within 2 days of knowledge of the fraud. Here there is one minute point which you have to pay attention. Most of the students often confuse that. The moment you came to know about the fraud, it is up to the choice of the auditor to decide whether he can report to audit committee or board of directors. No, this is wrong perception. This section 140 subsection 12 clearly says if audit committee is there, then you report to audit committee only. In case if in the client company audit committee is not there, then report to the board of directors. It is not a choice given to the auditor to choose one from audit committee or board of directors. However, there is a pattern set in 143 subsection 12. If there is audit committee, first report to audit committee. If audit committee is not there, then report to the board of directors. Within how many days? Within 2 days of knowledge of the fraud. Today, if I came to know about the fraud, by tomorrow or day after tomorrow, I have to communicate the matter to the audit committee if it is there. If it is not there, to the board of directors. Then after communicating, give them 45 days of time. For what purpose? To give their replies. After you have communicated the matter with audit committee or board of directors, give them 45 days of time in order to respond back. Now, within this 45 days, two things can happen. Reply received, and the other case could be reply not received. In case if the reply is received, within 15 days of receiving reply, within how many days? Within 15 days of receiving the reply, you have to report the matter to the central government. You have received reply within 45 days, you have to report the matter to the central government and in form number ADT4. Sir, how I will report to the central government? In form number ADT4. In the central government, to whom I will report? To the Secretary, Ministry of Corporate Affairs. It's a central government, you will not report to the Prime Minister of the country. So you have to address your form ADT4 to the Secretary, Ministry of Corporate Affairs. And what and all you have to report to the central government? Original report which you send to audit committee or board of directors. On that, what responses you have received from the board of directors or audit committee. On those responses, what are your remarks? What are your remarks? So within 15 days of receiving the reply, you have to report the matter to central government in form number ADT4 to the Secretary, Ministry of Corporate Affairs. What and all you have to report? The original report which you have sent to audit committee or board of directors, along with the responses whatever you have received. On that responses, if you have any remarks, all these three things you have to report to the central government. Sir, what is reply? What is reply is not received? I have given 45 days of time, but the client is not responding anything. Then what I should do? Then also 143 subsection 12 says, then also report to the central government. Then also report to the central government. All the things are going to remain same. ADT4, it is going to be addressed to Secretary, Ministry of Corporate Affairs. But here what you will send is, you will send original report which you have sent to audit committee or board of directors along with a comment that no reply has been received. Along with a comment that no reply has been received. So whether you receive a reply or you don't receive a reply, you have to report it. But what you are going to report, that is going to change. Clear? So this is what regarding amount involved in the fraud is 1 crore or more. In case if the amount involved in the fraud is less than a crore, no need to report to central government. But here what you should do is you have to report to audit committee as usual if it is there. If it is not there, to the board of directors within how many days? Here also within 2 days. Sir, what and all I have to communicate? What and all I have to report to audit committee or board of directors? Nature of fraud along with description. Who are the parties involved in the fraud? And what is the amount involved in the fraud. So these three things you have to report to audit committee. Nature of the fraud, briefly describing it, who are the parties involved, what is the amount involved. With that, auditor's responsibility will come to an end. The moment you report to audit committee or board of directors, your responsibility will come to an end. But after that, board of directors will have a responsibility. They will give something called board's report. In that board's report, they have to report these three things. They have to mention in their board's report the above three things: nature, parties involved, amount involved. Along with that, what remedial actions are taken. So auditor reported the fraud. As a board of directors, what rectification actions you have taken, those remedial actions are also required to be reported where? In the board's report. So here auditor's responsibility will end the moment he communicates to audit committee or board of directors. Giving a disclosure in the board's report is the board of directors' responsibility. Clear, everybody? So these are the responsibilities of the auditor given under 143 subsection 12 whenever he comes across any kind of fraud. Understood? Clear and comfortable, everybody? So now we will try to proceed further and understand the reporting requirements under 143 subsection 11. And as I have told, those reporting requirements only we call them as CARO 2020. So let us try to revise it. Important from the examination perspective. Yeah, where are you? Yes. Fine. So let us try to understand the reporting requirements in CARO 2020. Now, under this CARO, there are a total of 21 matters. Regarding 21 matters, we are required to report. How many we have total? So we have a total of 21 matters regarding which the auditor needs to verify and give a comment in his auditor's report. See, before we talk about what are those reporting requirements, what are those 21 matters which are required to be reported, first we will try to understand applicability. Sir, does auditor of each and every company is required to report on all these 21 points? The answer is no. So generally, they have given some exemptions. Under Companies Act, they have given some exemptions. If you are conducting audit of any company which is falling under that exemptions category, then your audit report need not contain these 21 matters. Sir, what are those companies which are actually exempted from reporting requirements of CARO? Let us see. So this order applies to every company, including a foreign company. That means these reporting requirements are applicable even for a foreign company as well. Whenever in the Companies Act we use a term foreign company, we are referring to a company incorporated outside India but having a place of business in India. Because if a foreign company doesn't have a place of business in India, and if we go to them and ask them to comply with our Indian laws and regulations, they will ask you to get lost. So when I say foreign company, I'm always referring to a company which is incorporated outside India but having a place of business in India. So this order applies to every company, including a foreign company also. But however, this shall not apply to the following classes of companies. That means in case if your client company falls under any of this category, the client for whom or the client company for whom you are doing the audit, if it falls under any of these categories, then your audit report need not contain CARO reporting requirements. Sir, which companies it is exempted? Number one, banking company. If you are conducting audit of a banking company, no need to report on CARO. Why? Because for banking company, there are already plenty of reporting requirements under Banking Regulation Act. So Companies Act told we don't want to overload you with extra reporting requirements. So for a banking company, we don't require you to report on CARO. Similarly, insurance company. If you are conducting audit of an insurance company, then also no need to report on CARO. And a company licensed to operate under Section 8, non-profit oriented companies. For that companies also, we don't want you to report on CARO. One-person company, small company. If your client company is a one-person company or if your client company is a small company, no need to report on CARO. And a private limited company. In case if your client company is a private limited company, but not every private limited company. If your client is such a private limited company which fulfills 4 conditions, not any 4, all 4, very, very important. So if your client should be a private limited company, and if it should satisfy all these 4 conditions, then the CARO will be exempted. Sir, what are that 4 conditions which are required to be fulfilled by a private limited company to be exempted from CARO? Let us see. A private limited company which should not be a subsidiary or holding of a public company. So your client company, which is a private limited company, it should not have a holding company, which is a public company. It should not have a subsidiary company, which is a public company. I'm not telling your client company should not have holding or subsidiary. Your client private limited company can have a holding company, can have a subsidiary company, but that holding and subsidiary company should not be a public company. So if that is the case, for example, your client is X private limited, but your client is having one holding company, which is Y limited, which is a public company, then CARO will become applicable for you. So neither the holding company nor the subsidiary company of your client company should be a public company. And see, and when they are using the term and, they are expecting you to comply with all the conditions. So first condition, I hope everybody is clear. Second condition, the total paid up capital and reserves and surpluses shall not exceed 1 crore as on the balance sheet date. As on the current year's balance sheet date, for example, if you are conducting audit of the financial year 23-24, as on the balance sheet date, as on 31st of March 2024, the total of paid up capital along with the reserves and surpluses shall not exceed 1 crore. That should be less than 1 crore or less or equal to 1 crore, but it should not go beyond 1 crore. And this limit you have to see as on the balance sheet date. As on 31st of March of the respective year, you have to see what is the cumulative balance of paid up capital and reserves and surpluses. If it is less than or equal to 1 crore, well and good. Then you have to start checking for remaining 2 conditions. Next condition, the total borrowings from banks and financial institutions shall not exceed 1 crore, the most important term here, at any point of time during the financial year. So what is the third condition they are telling? You have to calculate the borrowings. Not all borrowings, you have to calculate borrowings only from banks and financial institutions. So you have to calculate, you have to take borrowings only from banks and financial institutions. Every kind of borrowing, secured, unsecured, short-term, long-term, every kind of borrowing from banks and financial institutions shall not exceed. That means it should be less than or equal to 1 crore, not just as on the balance sheet date, at any point of time during the financial year. At any point of time, from 1st of April till 31st of March, at any point of time, if the borrowings from banks or financial institutions exceeds 1 crore, then CARO will become applicable. So if you pay close attention in the previous point for paid up capital and reserves and surpluses, they are not concerned what is happening during the year. For paid up capital and reserves and surpluses, they are asking you to check this figure only as on balance sheet date. But when it comes to borrowings, they are asking you to check at any point of time during the financial year, the borrowings from banks and financial institutions should not have exceeded 1 crore rupees. Clear? And then finally, last one, total turnover calculated as per Schedule 3, including revenue from discontinuing operations, shall not exceed 10 crores during the entire financial year. So for the previous financial year, the cumulative value of revenue shall not exceed 10 crores. It should be less than or equal to 10 crore rupees. If all these four, not anyone guys, if all the four conditions are satisfied, that too by a private limited company. So if a private limited company satisfies all these four conditions, then for that company is also CARO exempted. So what are that four conditions? Very important. Number one, not being a subsidiary or holding of a public company. Number two, paid up capital and reserves and surpluses shall not exceed 1 crore as on the balance sheet date. The borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. And finally, the turnover should not exceed 10 crore rupees. If all these four conditions are satisfied by your client company, you need not report on CARO. And one more thing here, see what things you have to consider, what things you should not consider in the calculation. Everything has been given here. You can go through it on your own. So majority of the points I have covered. And one more thing you need to consider here. See, if you take holding companies, the companies, holding company will be required to prepare two set of financial statements. One is consolidated financial statements, other one is standalone financial statements. So as per the requirements of the Companies Act, if a company is a holding company, it needs to prepare two sets of financial statements, consolidated and standalone. Audit will happen for which financial statement? Audit will happen for consolidated financial statements also. Audit will happen for standalone financial statements also. There will be an audit report on consolidated financial statements. There will be an audit report on standalone financial statements also. But here in the CARO, what they have told us, in the audit report of standalone financial statements, all the 21 matters are required to be reported. All matters should be there in the CARO. However, in case of audit report of the consolidated financial statements, generally CARO is exempted. Only one clause, clause number 21 is required to be reported in audit of consolidated financial statements. For the standalone financial statements, audit report will contain all the points, but clause number 21 only needs to be reported in the case of consolidated financial statements. The initial 20 clauses need not be reported. Only 21st clause, only one clause will come in the audit report of consolidated financial statements. In the standalone financial statements, all the clauses are going to come. Understood? So these are some special points which you need to consider in the calculation. So since now we have become clear with applicability, which company auditors are required to report on CARO, which company auditors are not required to report on CARO. Since we become clear with that, now we will try to understand what are that 21 matters which are required to be reported. What are those 21 matters which will be reported? So as you could see here, there will be a total of 21 matters are there which are required to be reported. We'll take up one by one and we'll try to close it. Okay, right. Everybody, are you all ready? Fine. So first matter which is required to be reported is property, plant and equipment. So they are talking about all kind of fixed assets, work in progress, intangible assets, everything they are collectively addressing. So regarding property, plant and equipment, there are some matters which are required to be reported by the auditor. What are they? So regarding property, plant and equipment, there are 5 matters which are required to be reported. How many? 5. See, overall, this is one reporting requirement only. Under this one point, there are 5 sub points which are required to be reported. Let us see what are they. Number 1. As an auditor, we need to check whether proper records regarding the PP are maintained or not. They are not asking auditor to maintain the records. They are asking the auditor to verify whether the management of the company has maintained proper records regarding PPE, and from that records, they should show quantitative details. Nothing but in that records, we should be able to find the details of how many number of PPA are there, and also situation where they are located, where that PPE is located, whether it is located at head office, whether it is located at branch office, that details must be captured in the records. So whether your client's management is maintaining those kind of records for PPE, which will show quantitative details and also situation of the PPE or not, I need to check and give a comment. That is the first point. Second one, physical verification. Now, whether this PPE are physically verified by the management at reasonable intervals. Here also, they are not asking auditor to do physical verification. Very, very important point. They are not asking the auditor to do physical verification. They are asking the auditor to verify whether the management has physically verified their fixed assets at reasonable intervals. Now, here the gray area is, so they are telling, CARO is telling to verify whether fixed assets are physically verified by the management at reasonable interval. Now, what could be reasonable interval? Once in every year? No. As per the guidance note, reasonable interval will be at least once in every 3 years. At least once in every 3 years. So the management of the client company, whether they are verifying their PPE at least once in 3 years or not, that I need to check and give a comment. If yes, the management has done the physical verification, whether any material discrepancies were found out. On doing such physical verification, did the management find out any discrepancies? Discrepancies mean what? Differences. Between what? Between the PPE as per the records and the PPE as per physical existence. For example, as per the physical records, there are some 21 plant and machinery. But when it is physically verified, there are only 20 plant and machinery. So this is a discrepancy. On doing such physical verification, whether material discrepancies were noticed, if so, whether they have been properly dealt with in the books of accounts. On finding that differences, whether management has properly adjusted that in the books of accounts or not. That also I need to give a comment. So 2 points we have seen. First one, regarding maintenance of proper records. Number 2, whether management did the physical verification at reasonable intervals, any discrepancies were found out, how they were adjusted. Next, third point is particularly regarding immovable properties. Third point is specifically talking about immovable properties. When I say immovable properties, they're talking about land and buildings. So here what they say is, when it comes to immovable properties, we need to check the title of the immovable properties. Nothing but go to the client company, ask them, sir, give me a list of all the land and buildings you are having. Now you should ask the management, give the title deeds. Property title deeds will be there, no? Ask the management to give the title deeds. Now I need to check in the title deeds of all that land and buildings, I need to check that these immovable properties are in fact registered in the name of the company. If I find something else in the title document, the land is there in the company's balance sheet, but when I open the title document, it is not registered in the company's name, somebody else's name is there, then I need to report some details. The same thing they say here, whether the title of the immovable properties is held in the name of the company. If not, no, the immovable property is not there in the name of the company. In the title deed, I am not able to find the name of the company, somebody else's name is there. Then I need to report some details. Sir, what I need to report? Description of the property. Please describe that property. What is its gross carrying value? It is held in whose name? If not in the company's name, then whose name it is there? Whether that person in whose name the property is there, is he a promoter, director or employee? Give that relationship with the company also. For what period that asset is being held, and also why it is not there in the name of the company, that reasons. These details you are required to report regarding immovable properties. So 3 points we have covered. Number 1, maintenance of proper records. Number 2, physical verification by the management at reasonable intervals. Number 3, immovable properties. Number 4, revaluation. I need to check whether my client has done a revaluation of its PP. If yes, on what basis they have done the revaluation? Whether they have done it on the basis of a valuation report given by the registered valuer or not. The companies are open to do revaluation, but they can't revalue the assets at their on their own choice. They have to revalue the assets on the basis of a report which have received from registered valuer. And as a result of that revaluation, if change is 10% or more in the aggregate of net carrying value of each class of property, plant and equipment or intangible assets. By doing that revaluation, if for each class of asset, if the change before and after is more than 10%, then you have to mention that amount also. So here there is a tricky thing here. Most of the students will do the mistake here. Let us take, for example, there are buildings. The management has done the buildings revaluation. There are 3 buildings, building 1, building 2, building 3. Before revaluation, the figures are 100, 100, 50. Now, after revaluation, these figures are, this has become 120, this has become 85, This has become 48. This is the revalued figures. Now you tell me the amount is required to be stated for which asset. So in the CARO they have told if the change is 10% or more, then you have to report. Now you will say, sir, for building 1, the change is 20 crore, which is more than 20%. If I calculate, there was a revalued amount of 20, it has increased by 20 crores. So that means roughly 20% change is there. For building 2, the change is 15, net change is 15. Here also 15% change is there. Here it is 2, that means hardly 4% change is there. You will say, sir, I have to report the amount for building 1 and building 2. You are wrong. You are wrong. They are not asking you to check the change for each asset. They are asking you to check the amount of change for entire class of PPE. So I have to check for the entire building, what is the value before revaluation? It is 250. What is the value after revaluation for this entire building? It will be how much? It will be 120, 85. It will be 205. 205 plus 48. It is somewhere around 253. Correct me if I am wrong. I think you should be correct. Yeah. So 253. So if I check before revaluation, what is the value of the entire class? After revaluation of what is the value of the entire class? The change is hardly 3 crore, which is not at all 10%. So am I required to report the amount here? No, you are not required to report the amount here. So you are required to report the amount only when the change is 10% or more, not for individual asset, for the entire class of asset. If before revaluation, after revaluation, the change is 10% or more, then mention the amount. That is the fourth point. So regarding revaluation, 2 things: whether it is done on the basis of a registered value, if the change is 10% or more, for the carrying value of entire class of PPE, mention the amount. Next, last one, Binami transactions. So here I need to report whether any proceedings, any legal proceedings have been either initiated or pending against the company for holding any Binami property under the Binami Transactions Prohibitions Act. That means, has anybody filed the case against the company, or is the case already going on for holding any Binami properties as per the Binami Transactions Act? If yes, whether the same has been appropriately disclosed. They are asking the auditor to check, has the company facing any legal cases regarding Binami transactions? If yes, whether company disclosed that in the financial statements or not. They are not asking auditor to disclose the details of the cases. They are asking the auditor to check whether company disclosed the details of their pending cases where in the financial statements or not. That you have to check and give a comment. So this is the first matter which is required to be reported in the CARO, which is regarding PPE. Regarding PPE also, 5 sub things. Number one is regarding maintenance of proper records. Number 2, physical verification at reasonable intervals. Number 3, immobile property titles. Number 4, revaluation. Number 5, Binami transaction proceedings. Clear? Next. Now let us come to the next matter. Out of 21, we are done with 1. Second matter which is required to be reported is inventory. So regarding inventory, what I needed to verify. Let us see. So physical verification. Here also, first thing which I need to report regarding inventory is whether my client company, whether the management of my client company has done physical verification of inventory. Here also they are not asking auditor to do physical verification. They are asking the auditor to comment whether your client company has done the physical verification of inventory at reasonable intervals. Now the question here is, sir, here what do you mean by reasonable interval? For PPE, I told reasonable interval could be once in every 3 years, but for inventory, reasonable intervals is once in every year. Once in every year, the management should have done the physical verification of their asset, of their inventory. If yes, whether the coverage and procedure of such verification by the management is appropriate. Now you have to give a comment, whatever procedure they have followed, whatever coverage they have given for physical verification, is it appropriate? That means, did they cover everything? Did they spend enough of time on that? So I have to comment on coverage and procedure. Then in case if any discrepancy is there, if you find any discrepancy on doing that physical verification, if the management found any discrepancy in the aggregate for each class of inventory were noticed, and that to 10% or more, I need to comment whether they have been properly dealt with in the books of accounts. So on doing that physical verification, if discrepancy of 10% or more has been found out in each class of inventory, like for example, what is the total raw material? 4 kinds of raw material are there, A, B, C, D. So total value of raw material as per books, total value of raw material as per physical stock. If the difference is 10% or more, I have to comment whether it has been properly dealt with in the books of accounts or not. If it is less than 10%, I need not comment it. So that is the first question, whether physical verification of inventory has been done by the management at reasonable intervals. whether the coverage and procedures are appropriate, if the change is, if there is a difference of discrepancy of 10% or more, whether they have been properly dealt with in the books of accounts. One more point is also there regarding inventory, regarding working capital loans. So here, what they try to say here is whether your client company has taken loan. For example, X Limited is the company. It has taken loan from SBI and they have a exposure of 5 crores or more. They have taken a working capital loan of greater than or equal to 5 crores. In case if your client company has taken working capital loan from a bank in excess of 5 crores, and for taking this loan, they have given their current assets as security. They have given their current assets as security. Generally, the banker will give you loan only when you offer security, no? So your client company has went to the bank, SBI. They told, sir, we need 10 crore rupees of loan. The banker will ask for security. Your client company is telling, okay, sir, we will give our current assets like stock, debtors. We will give our current assets as a security. You give us 10 crore rupees of loan. Okay, the bank has given 10 crore rupees of loan to your client company, and your client has given your current assets as a security. Now, in case of working capital loans, the company, the borrower is required to submit periodical stock statements because stock will keep on changing. They have given the stock as a security, right? And this stock will not remain constant. This stock will keep on changing. So borrower needs to submit periodical stock statements. So your client company, after taking the loan periodically, once in every quarter, they will send stock statements. Now, as an auditor, they are asking me to check whatever stock statements your client is submitting to the bank. Are they submitting genuine stock statements or fake stock statements? In the recent times, some fraudsters, what they have done is they submitted fake stock statements for the bank to get excess loan. So in order to tackle that, they put a responsibility on the auditor now. In case your client company has taken working capital loan, that too in excess of 5 crore rupees, and they have given their current assets as security, they will submit periodical stock statements. Generally, quarterly stock statements they will submit. As an auditor, my responsibility is to check whatever quarterly stock statements which my client is submitting to the bank, whether they are genuine stock statements, whether they are matching with the books, or they are submitting fake stock statements. I have to comment. In order to protect the interest of the banker, they have put this additional reporting responsibility on the auditor. But here you have to remember one thing, this reporting requirement will become applicable only when your client has taken a working capital loan in excess of 5 crore. In case if your client company has taken a working capital of less than 5 crore rupees, you need not comment on this. Clear? So these two are the matters which are required to be reported regarding inventory. What are they? Physical verification at reasonable intervals. In case of working capital loans, periodical stock statements are genuine or not. Clear? So 2 matters we are done. Out of 21, how many we are done? 2 we are done. Now, third point. So third matter which is required to be reported is regarding investment guarantees, securities, loans or advances which are given by the company, your client company's assets. So if your client company has given any advances to others, they have given any guarantees, they have given any securities, they have given any loans and advances to others, regarding them, I need to check certain points. Third point is very, very important. First thing, I need to check whether my client company has provided any loans or provided any advances in the nature of loans, or they have acted as a guarantor, or they have provided any security to any other entity. If yes, nothing but your client company has given loan, advance, security or guarantee to other entities. If that is the case, I have to report what is the total amount of such loan given and what is the balance outstanding for subsidiary, associate, joint venture separately, for other than subsidiary, associate, joint venture separately. Very simple. So if you see here, once again, if I read it, I will give you an example to make you understand. So whether during the year the company has provided loans, advances, etc., etc. If so, indicate what is the aggregate amount and also balance outstanding with respect to such loans or advances or guarantees or security to subsidiary, joint venture and associates, and what is the aggregate amount and balance outstanding with respect to such loans and advances to parties other than subsidiary, associate, joint venture. I will give you a simple example to make you understand. Take for example, you are conducting audit of the client X Limited. Your client company has given loans to 10 companies. They have given loans to 10 companies, to 10 other entities. Out of that 10 other entities, 2 subsidiaries are there, 1 joint venture is there, 1 associate company are there. Remaining 6 are other than subsidiary, associate, joint venture. Now I need to report what is the total amount of loan given for subsidiary, associate, joint venture, and what is the balance outstanding as on 31st. As on 31st of March, what is the balance outstanding for these 4 entities? I have to give the total for that. For these 6 entities which are other than subsidiary, associate, joint venture, what is the aggregate amount of loan given? What is the balance outstanding that I have to divide and report separately? That's all. Divide the aggregate amount and balance outstanding for subsidiary, associate, joint venture separately, for other than subsidiary, associate, joint venture separately. However, this point is not becoming applicable to companies whose principal business is to give loans. This is very, very important. This point will not become applicable to companies whose principal business is to give loans. So whose principal business is to give loans? Banks. But anyhow, for banks, CARO itself is not applicable. However, NBFCs also can have a principal business of giving loans. For NBFCs, CARO will become applicable, but this point will not become applicable. You need not report this point in case of NBFCs. Clear? Simple, no? Very simple, guys. In case if your client company has given loans, divide how much amount has been given for subsidiary, associate, joint venture, how much amount has been given for other than subsidiary, associate and joint venture, divide and report it. This point will not become applicable for those companies whose principal business is to give loans. Second point, I need to check, I need to verify on what terms and conditions these loans are given. Like for example, what is the interest rate? What is the repayment period? So what is the repayment schedule? I need to check what are the terms and conditions, and I need to give a comment whether these terms and conditions are prejudicial, whether these terms and conditions are harmful to the interest of the company or its members. Like the company is giving loan without any security, without any interest, without any repayment period. So these are all the terms which are prejudicial. So I need to check this. Same we have seen under 143 subsection 1, the same point they're asking you to comment here. So terms and conditions, whether the investment made, guarantee provided, security given, and the terms and conditions of the grant are not prejudicial. They should not be harmful to the interest of the company. Third one, repayment. So I need to check the company should not just like that give a loan and ignore it. They should also ensure that repayment of principal and payment of interest is happening regularly on or before the due dates. The company is receiving the repayment EMI amount or not. That also I need to check. So that's what they say in respect of loans and advances, whether schedule of repayment of interest and schedule of repayment of principal and interest has been stipulated, and whether the repayments are regular or not. Next, in case if the company has given any loan and if it remains overdue for more than 90 days, I need to check what steps are taken by the company for recovery. The company has given loan, it has become overdue. What do you mean by overdue? Due date is over, but still the amount is not received. Now the company should not sit idle. They should have taken some steps for recovery. I need to verify what steps they have taken for recovery and give a comment. For which kind of loans? Which remain overdue for more than 90 days. Next one, fifth point, rescheduling or extension of overdue loans. So now this is what? I'll give you one simple example. Take for example, we are in the financial year 23-24. I am conducting audit of the client X Limited. In the previous year, the company has given loan. In the current year, it has fallen due. In the current year, what happened? It has fallen due. Fallen due means the due date is in the current year. Now, when the due date falls in the current year, what the company should have done? They should have recovered that amount. But instead of recovering the overdue loan, what the client is doing is they are extending it. They are extending the due date, or they are renewing it, or they are giving a fresh loan to the same person to repay the old loan. If the company is doing these transactions, you tell me, is it a normal transaction or it is something mischievous? It is mischievous. When the loan has fallen due in the current year, the company should have recovered it. Instead of recovering, they are either renewing it or extending the due date, or they are giving a fresh loan to the same person to repay the old loan. So if that is happening, I need to comment about these kind of transactions also. That's what they say here. Whether any loan or advance in the nature of loan granted which has fallen due, in the current year, its due date has come. It has been either renewed or extended. Instead of collecting the repayment, they have extended, or fresh loan has been given to the same person to settle the old loan. If these kind of transactions are happening, I need to report what is the aggregate amount of such dues which are renewed, extended, or settled by fresh loans. How much amount of such loans were renewed, extended, or fresh loans are given to the same parties. The total amount I have to mention. Along with that, I need to also comment on percentage to the total loans and advances. So take for example, if the company has renewed, extended, or given the fresh loans to the same parties to the amount of 50 crore rupees. So I will comment it's 50 crore rupees. Also, I need to calculate what is the percentage in the total loans. For example, total loans given during the year are 200 crores. Out of that, 50 crores are in the nature of extension, renewal, or fresh loan. If I calculate the ratio, it will come to somewhere around 25%. So this percentage also I have to report it. Understood? Next one, demand loans without repayment period. Whether your client company has given any loan without mentioning any repayment period. You tell me, if the client is giving loan without mentioning any repayment period, is it good thing or bad thing? It is a bad thing. Then you have to report it. So what do you have to report? So whether the company has granted any loans or advances in the loans either repayable on demand or without mentioning any repayment period, I have to mention what is the aggregate amount and also percentage. Here also I have to mention the percentage, and also out of these demand loans, how much amount was given to promoters and related parties. That amounts also separately I have to state it. Clear? So this is the third matter under CARO regarding investments, guarantees, loans, advances given by the company. In that, 6 sub matters are there. Number 1, I need to segregate the amount for related parties and other than related parties. I need to check the terms and conditions. Number 3, if I have to check whether repayment is getting collected on time or not. If it remains overdue for more than 90 days, what steps are taken for recovery? And in case if the loan has fallen due in the current year without getting repayment, they are renewing, extending, I need to report those details. And in case if they have given demand loans, I need to comment on that demand loans as well. So this is regarding the third point. Now, let us come to the fourth point, very simple one. Fourth point is also regarding loans, investments, guarantees made by the company only. This is also talking about assets of the company, receivables of the company. Here simply what I need to check is, in case if the client company has given loan, investments or guarantee, they are doing it after complying with the provisions of 185 and 186 of the Companies Act. So section 185 and 186 of the Companies Act gives some conditions, gives some restrictions regarding giving of loans and advances. I need to check and give a comment whether those provisions of 185 and 186 are complied with by the client company or not. That also I need to check and give a comment. Very simple one, not important from the examination perspective. Second one is, fifth one is acceptance of deposits. In case if your client company has accepted deposits, I need to check 3 things. Whether provisions of the Companies Act are complied with or not. 73 to 76 of the Companies Act contains details regarding deposits, whether that 73 to 76 of the Companies Act are complied with or not. Whether they have, in some cases RBI will issue guidelines for acceptance of deposits, whether those guidelines are followed or not. In case if there is any order of court or CLB, I need to check whether that order requirements are also followed or not. If any of these things are contravened, I need to report the details. As simple as that, nothing else. So in case if your client company has accepted deposits, compliance with 73 to 76 of the Companies Act, directives issued by the RBI, order given by any CLB, court or tribunal. If any non-compliances is there, explain the nature of non-compliance. Simple. Next, sixth matter which is required to be reported is regarding maintenance of the cost records. As we all know, each and every company is not required to maintain cost records. Section 148 of the Companies Act is there, which is giving some applicability criteria. If the company fulfills the criteria given under Section 148, then only they are required to maintain cost records. I need to check whether my client company is fulfilling the requirements of Section 148. If yes, whether my client company has maintained the cost records or not. So simply whether Section 148 is applicable. If yes, whether they have maintained the cost records or not. Seventh point, this is going to be important. Seventh point is regarding statutory dues. Seventh point is regarding statutory dues. So first of all, what are statutory dues? Nothing but those amounts which are required to pay because of the requirements of law. Nothing but legal payments. So when I say legal payments, income tax, GST, PF, ESI. So all these payments we are making because there is a law which is making us mandate to pay this. So regarding the statutory dues like income tax, GST, PF, ESI, etc., there are some reporting requirements. And for the purpose of reporting requirements, we are dividing statutory dues into 2 categories. Number 1 is undisputed and number 2 is disputed. Sir, what is undisputed? Undisputed means there is no issue. There is no issue. There is no fight between any department or SSC. Both are agreeing. For example, income tax department sent a notice. You please pay 10 lakh rupees of income tax which you have evaded. The SSC is also not having any objection. He is not fighting. Income tax department sent a notice. The client did not fight. That means there is no issue going on. There is no dispute going on. On the other hand, dispute means there is some issue going on. See, department is telling you are required to pay this much amount of tax. Client has filed a petition. No, I'm not required to pay the tax. The case is going on before assessing officer, commissioner or court, tribunal. Somewhere the case is going on. The fight is on. So that we call it as disputed. So regarding undisputed statutory dues, there are some reporting requirements. Regarding disputed statutory dues, there are some reporting requirements. When it comes to undisputed statutory dues, the requirements are, I need to check, is the company regular in depositing undisputed statutory dues? within the due date they are depositing all the undisputed. If there is no dispute, you should have paid it on or before the due date. So I need to check whether the client company is depositing all the undisputed statutory dues regularly. Regularly means on or before the due dates. If not, no, my client company is not paying some statutory due. There is no dispute also. Then I need to comment extent of arrears of outstanding. Nothing but that amount of outstanding statutory dues as at the last day of the financial year concerned, which is outstanding for a period of more than 6 months from the due date, then they become payable, shall be indicated by the auditor. What they should do, if not, if the company is not regular in depositing undisputed statutory dues, I need to find out as on the balance sheet date how much amount of statutory dues are there which are outstanding for more than 6 months. That amount only I have to report. I'll give you one example to make you understand. Take for example financial year 23-24. Okay, the company is required to pay some TDS amount. Take for example, they are required to pay the TDS amount on 7th of January 2024. 10 lakhs they are required to pay. They did not pay it till 31st of March 2024. This 10 lakhs is still outstanding. This 10 lakhs is still outstanding. There is no dispute also. Am I required to report this amount? Not required. Why, sir? The amount is outstanding, agreed, but it is not outstanding for a period of more than 6 months as on balance sheet date. Let me give you another case. The company is required to pay some GST for the month of September or for the month of July. The due date is for the month of June only, you think. So the due date is 20th of July 2023. They are required to pay some GST amount of 20 lakh rupees as on 20th of July 2023. This amount is remaining unpaid as on 31st of March 2024. Am I required to report here? Yes, this amount is required to be reported because it is outstanding for a period of more than 6 months as on balance sheet date. So simple regarding undisputed statutory dues, whether the company is regular in depositing on or before due date it is depositing. If not, the amount which is outstanding for a period of more than 6 months, you report it. If it is a disputed dues, so the company has not paid some amount because there is a dispute going on, there is case going on. Regarding the disputed dues, what are the things I am required to report? I need to comment what is the amount involved in the dispute, for how much amount the case is going on, and the forum where the dispute is pending, before which authority case is pending. Is it pending before court? Is it pending before tribunal? Is it pending before commissioner? So that forum also I have to comment. Clear? So these are the reporting requirements regarding statutory dues. Once again, an important point. Now, let us come to the 8th point. Disclosure of undisclosed income. Now, what is this? Nothing but in this point they say that I need to check whether during the current year, whether any income tax assessment happened. When I say income tax assessment, the return has been taken up for scrutiny, or there is some proceeding, there is some income tax raid which has taken place. Like that, during the year, whether any income tax assessment has taken place, that could be scrutiny, income tax raid, whatever it is. And as a part of that income tax assessment, my client has surrendered some income which he did not previously surrender. Previously he has hidden some income, but now as a part of assessment, take for example, he's disclosing, he's surrendering 1 crore of income now. So if that is the case, surrendering this income before the income tax authorities alone will not be enough. This income would have missed from the books of accounts also. Now I need to check whether this undisclosed income is also recorded in the books of accounts or not. This undisclosed income is recorded in the books of accounts also or not. Now, if you did not offer for taxation, that means you would not have recorded in the books of accounts also. Now during the year, income tax raid happened, you are surrendering the income. Now surrendering alone will not be enough. You have to bring that income into books of accounts also. Whether that has happened or not, I need to check. Sir, if during the previous year no assessment has taken place, simple, you need not comment anything. You can simply say no assessment has taken place under Income Tax Act. As simple as that. So if I read it for your comfort, whether any transaction not recorded in the books of accounts have been surrendered or disclosed as income during the year in the tax assessment under Income Tax Act. If yes, whether previously unrecorded income has been properly now recorded in the books of accounts or not, I have to give a simple comment. So this is the 8th point. Now 9th point is regarding repayment of the loans. See, we have spoken so many things about loans given by the company. Now there is one dedicated point which is talking about loans accepted by the company. In case if your client company has taken loan, regarding those borrowings, you need to comment certain points. What are they? Default in repayment. Whether your client has done any default in the repayment. Sir, what do you mean by default in the repayment? Default could mean two things. Either you are not repaying, or even if you are repaying after the due date, that is also default only. Either you are not repaying altogether, default, you are repaying it, but after the due date, that is also default only. So I need to check whether my client has made any default in the payment of the loans. If yes, I need to comment what is the amount of the default and what is the period of the default. That too, I have to report it lender wise. For each lender wise, what is the amount he has defaulted, for what duration he has defaulted, I need to comment it. So this is the first thing, whether there is any default in the repayment of loans. Number two, whether your client has been declared as a willful defaulter by any borrower, by any lender, sorry. Your client has taken any loan, but they have violated some terms and conditions regarding the loan they have taken, and their account has been classified as willful defaulter. Sir, how will you get to know? If you go through their credit score reports, CIBIL score reports, you will get to know whether they are classified as willful defaulter. So that is the second point I have to comment, whether the client has been declared as a willful defaulter by any lender. Third one, purpose of the term loan. In case if your client company has taken any term loan, long-term loan. So generally, when you need some long-term loan, you have to go to the bank, tell them purpose. If the banker is convinced with the purpose, he will give you loan. Now, what some companies started doing is they go to the bank, tell some convincing purpose. They will say, sir, we are going to build a factory. For that, we need loan. The bank has given loan. But instead of using that for the purpose of construction of the factory, they are using it for some other purposes. If you find any such transactions done by your client, report it. So that is the third point, whether term loans were applied for the purpose for which they have been obtained. If any amount is diverted, I need to comment. Next, usage of short-term loans. Similarly, your clients also will get short-term loans, working capital loans. Instead of using for short-term purposes, whether they are using for long-term purposes. Short-term borrowings should be used only for short-term purposes. You can't bring a short-term capital and use it for long-term purposes. If you find any such transactions happening, report it. So C and D are talking about usage of long-term and short-term loans. Fifth one, loans taken to meet the subsidiary company needs. In case if you find that your client company has taken loan, not for meeting the obligations of your client company, but for meeting the obligations of its subsidiary company, associate company, or joint venture company, those amounts also you are required to report. Your client has taken loan, not for your client's requirements, but for the subsidiary, associate, joint ventures requirements, your client company has taken loan, report that transactions. Next, loans against pledge of securities of the subsidiary. Now, last point, your client has taken loan for your client's purpose only, but for taking loan, they have to give some security. No, what they have pledged is whatever shares they are holding in subsidiary, associate, joint venture, that shares they are given as a security and they got the loan. If that is the case, report that loans also. So there is a thin line of difference between fifth and sixth point. Fifth point is talking about your client has taken loan, not for your client's requirement, for subsidiary, associate, joint venture. Sixth point, your client has taken loan for your client company's requirement only, but they have to offer something as security. No, what they have offered as security is they have pledged the shares of subsidiary, associate, joint venture. Clear? So these are the points which are required to be reported regarding repayment of loans. Once again, this is going to be important from the examination perspective. Next point, 10th point, it is regarding utilization of IPO and FPO. Sir, what is this? In case if your client company has made IPO or FPO, they will tell the purpose. No, they will tell the purpose in the prospectus for which they are raising the money. So I need to check whatever money they have raised by way of IPO or FPO, whether they have utilized the same for the purpose for whatever they have stated. In case if they have not used for the said purposes, I have to report any default is there, any delay is there, or even if there is any subsequent rectification. That means initially they misused, later they compensated. Even that subsequent rectifications also I have to report. Similarly, if in case if the client company has done preferential allotment or private placement of the shares, even for preferential allotment also, private placement also, there will be prospectus. So you will say something to the investors, sir, we are going to raise this money for this purpose. There also I need to check whatever money they have raised by way of preferential allotment or private placement, whether they are using it for the said purposes or they are misusing it. In addition to that, I also need to check the compliance with the provisions of section 42 and 62 of the Companies Act. So if I read it, whether the company has made any preferential allotment or private placement of the shares, fully or partly convertible debentures during the year. If yes, check the compliance with 42 and 62. And also I have to check whether amount has been used for the purpose for which it has been raised. If not, I have to report the details. Clear? How many we are done? Out of 21, 10 we are done. Now, 21st one, reporting of frauds. If you see here, we have already seen reporting requirements under 143 subsection 12. In addition to that 143 subsection 12, you are also required to report on frauds in CARO also. So in CARO, what I have to report? Let us see whether any fraud by the company or on the company has been noticed or reported during the year. If yes, I have to comment what is the nature and amount involved in the fraud. If any fraud has been committed by the company or on the company, I need to comment what is the nature of the fraud, amount involved in the fraud in the CARO also. In addition to that, I should also comment whether any of the auditors have submitted form number ADT4. We have seen reporting requirements under 143 subsection 12. If the amount involved in the fraud is 1 crore or more, you have to submit form number ADT4. Now I need to comment whether any of the auditor, not just me, either company auditor, secretary auditor, whoever it is, has any of the auditors submitted form number ADT4? That I need to give a comment. Along with that, I should also comment whether there are any whistleblower complaints, whether the auditor has considered any whistleblower complaints. I hope you all know about whistleblower complaints. If something is going wrong in the company, then internal people only will report to the regulatory authorities. Whether any such whistleblower complaints are there, and as an auditor, have you considered them or not? So these are the three simple things regarding CARO: nature and amount involved in the fraud, whether any ADT4 has been submitted, and auditor has considered whistleblower complaints or not. Let us come to this 12th point, Nidhi company. 12th point is applicable only for Nidhi company. In case if your client company is a Nidhi company, then you are required to comment on this. Sir, what if my client company is not a Nidhi company? Tell the same thing in the auditor's report that your client company is not a Nidhi company. So in case if your client is a Nidhi company, 3 points you are required to comment whether net owned funds to deposits ratio in the ratio of 1:20 or not, which means for every 1 rupee of net owned funds, Nidhi company can accept a maximum of 20 rupees of deposits only, whether that ratio is fulfilled or not. And also whether Nidhi company is maintaining 10% in the unencumbered term deposits. Whatever money they have raised, out of that 10%, they have to keep in fixed deposits, that too without any charge. So that is also fulfilled or not. And next one, whether there has been any default in the payment of interest or repayment of deposits. So this point is common anyhow. Nidhi company I need to comment whether my client company has made any default in the repayment of principal or interest. So these are the few things which I need to comment regarding Nidhi company. As I have told, if your client company is not a Nidhi company, the same thing you will try to say there. Then we have 13th point is regarding related party transaction. Very simple. In case if my client is having any related party transaction, I need to check whether section 177 and 188 of the Companies Act are complied with or not. 177 and 188 of the Companies Act contains the provisions regarding related party transactions. I need to give a comment whether my client company has done the related party transactions as per section 177 and 188. And regarding related party transactions, there are so many disclosures which is required in the financial statements. Even I need to give a comment. All that disclosures which are required as per accounting standards are given or not. Accounting standards or Ind AS, whatever it is. So checking the compliance with sections of the Companies Act and checking the disclosure requirements. So this is point number 13. Then we have 14, internal audit system. I need to give a comment regarding internal audit also. I need to comment whether whatever internal audit team my client is having, is it commensurate? Is it matching with the size and nature of the business? Like for example, my client is of the size of Reliance, but their internal audit team only 2 persons are there. You tell me, is the internal audit matching with the size of the company? No. So I have to give that comment whether the client's internal audit team is commensurate. Is it matching with the nature and size of the company? And also, as a statutory auditor, have you considered the reports of the internal auditors? Did you use any internal audit reports for the purpose of your work? That also you have to give a comment. So two simple things: whether internal audit team is commensurate, whether the size of the internal audit team is matching with the size of the business, and have you considered any internal audit reports? Then finally, 15th one, non-cash transactions. If your client company has entered into any non-cash transaction, like if they have entered into any barter transaction with the directors, they can't do it in whatever manner they want. There are certain details, certain rules which have been given under section 192 of the Companies Act. So I need to check if my client company has entered into any non-cash transaction with the directors, whether the provisions of section 192 are complied with or not. Next, 16th point is regarding NBFC. In case if your client is a NBFC, then you are required to report on these details. Sir, what if my client is not a NBFC? As usual, you will say the same thing. My client is not a NBFC, reporting requirement under this clause will not become applicable. But in case if your client is a NBFC, then you have to comment certain things. What are they? Number one, whether your client NBFC is required to get registered under 45 IA of the Reserve Bank of India Act. If yes, whether they have obtained the registration or not. So first point, you need to check the registration requirements under RBI Act. Number two, whether your client is doing any non-banking financial or housing finance activities without obtaining certificate of registration from the RBI, that also you need to check. So first point, in case if they're required to get registration under 45 IA, did they get that registration or not? Second point, without getting certificate of registration from RBI, is your client company doing any non-banking housing or financial operations? And core investment company. See, after becoming NBFC, if you fulfill some conditions, NBFC will get a status called CIC, core investment company. If you get CIC status, you will enjoy some benefits. So I need to comment whether, if, for example, after becoming NBFC, if you fulfill 10 conditions, you will get status of CIC. So in case if my client is enjoying the status of CIC, I need to check whether those conditions are fulfilled continuously or not. So that's what they say, whether the company is a core investment company as defined in regulations made by Reserve Bank of India. If yes, whether it continue to fulfill the criteria of a CIC. In order to become CIC, some criteria is there. Whether that criteria they are fulfilling or not, I need to check. Now, after becoming CIC, if you fulfill some extra conditions, you will get another status called exempted CIC or unregistered CIC. For example, after becoming NBFC, if you fulfill 10 conditions, you become CIC. After becoming CIC, if you fulfill some 5 extra conditions, you will get a status of unregistered or exempted CIC. In case if your client is a exempted or unregistered CIC, whether they fulfill this extra 5 criteria also or not, I need to give a comment. Clear? So if you read it slowly here, whether it continues to fulfill the criteria of a CIC, and in case the company is an exempted or unregistered CIC, whether it continues to fulfill such additional criteria also or not. And also I need to comment if my client company is a group of companies. In that entire group, is there only one CIC? If there is more than one CIC, and indicate how many number of CICs are there as a part of the group. As a part of entire client group, if there is only one CIC, well and good. If there is more than one CIC, for example, holding company is also CIC, subsidiary is also CIC, associate is also CIC. As a part of group, 3 CICs are there, indicate that number. Understood? So this is what regarding point number 16. So 3 simple things. First one is regarding registration under 45 IA of the Reserve Bank of India Act. Number 2, obtaining valid certificate of registration. Number 3 is regarding CIC. Next. 17th point, cash losses. Whether your client company has made any cash loss in the current year as well as previous year. If yes, mention the amount. It should have made cash loss in both the years. In the current year and also in the previous year. In both the years, if they have made a cash loss, you have to report it. Sir, what is cash loss? Will it be equal to the loss as per statement of P&L? No. Cash loss is something which you have to calculate separately. You have to take profit or loss as per the statement of P&L, and you have to add back non-cash expenses, reduce non-cash incomes. The balancing figure you get, that will be either a cash profit or loss. In case if it is the cash loss both in the current year as well as in the previous year, mention that amount of cash losses in your CARO report under clause number 17. Now, coming to the clause number 18, resignation of auditors. You have to comment whether there has been any resignation of the statutory auditors during the year. If so, you need to consider the issues, objections or concerns raised by the outgoing auditors. Because of what reasons they have been resigned, because of what objections they have resigned, because of what issues they have resigned, you need to consider that as well. Understood? Now, 19th point. 19th point is a bit interesting. Here you have to comment on future viability of the company. Here you have to comment on future viability of the company. This is the only exception to the general audit. Generally in audit, we comment only on historical financial information. But here, because of this point, because of clause number 19 in the CARO, we are even required to comment a little bit on future also. But once again, we are not giving any guarantee of the future. Just we are giving our opinion. So in this point, what they say is, as an auditor, you have to give your opinion. So first we'll read the B point. Whether auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that company is capable of meeting its liabilities existing as at the balance sheet date and when they fall due within a period of 1 year from the balance sheet date. Nothing but, as on the date of signing the audit report, you have to give your comment. Is the company able to pay its liabilities which fall due within a period of 1 year? So if I have to put it in simple terms, whatever current liabilities are there, is the company in a position to pay all their liabilities which fall due within 1 year? Or is there any material uncertainty existing? Nothing but, in the coming 1 year, whatever liabilities which fall due, is a company in a position to pay that liabilities, or is there any doubtfulness is there? You have to give your opinion. Sir, but how can I comment? Will I toss a coin and say, I am tossing a coin, if head comes, company will be able to pay, if tails comes, company will not be able to pay? You have to do in that way? No. You have to give this opinion, but there should be basis for that opinion. What is the basis for that opinion? That they are telling in the first point, on the basis of financial ratios, by doing ratio analysis, and also by doing aging and expected dates of realization of financial assets and payment of liabilities. You have to do the aging of on what date I will realize my financial asset, on what date I have to make the payment of financial liabilities, and also by using other information accompanying the financial statements, by using other information which is added to the financial statements, and also by using auditors' knowledge of the board of directors and management plan, by sitting with the management and understanding their plans. So you have to do all this. You have to do ratio analysis, you have to do aging analysis, you have to use the financial statements, you have to sit with the management, know their plans. After doing all this analysis, you have to give your comment. Is the company in a position to pay all its liabilities which fall due within 1 year, or is there any doubt existing in your mind? Clear? See, once again, this is just an opinion. This cannot be taken as a guarantee by anybody else. And then we have 20th point, which is regarding unspent CSR expenditure. So this is a bit tricky point. I will try to simplify it. So here they say two things, number one, number two. So assume that your client company is required to spend CSR expenditure. As we all know, some 2% of average net profits of the last 3 years, they are required to spend on social welfare. So assume that company is required to spend 10 lakh rupees of money on CSR. Now, up within 6 months from the end of the financial year, take for example 23-24. So till 31st of March 2024, this is a balance sheet date within 6 months. That is on or before 30th of September 2024. Is the company having any plan to spend this money? Is the company having any plan to spend this money? In case if the company is not having any plan, I have to report whether they have transferred to a specified fund as per Schedule 7. So let me read it first, then you will get the clarity. Whether in respect of other than ongoing projects, the company has transferred unspent amount to a fund specified in Schedule 7 to the Companies Act within a period of 6 months from the expiry of the financial year, as per the in accordance with the compliance with 135 subsection 5. So what does that mean is, take for example for the year 23-24, I will elaborate it. 10 lakh rupees they have to spend on social welfare. Now, how to spend this 10 lakh rupees? The company is having a project ready. They want to give 2 lakhs as a donation for a orphanage. They want to spend 4 lakhs for providing shelter for old age people. Some 3 lakh rupees they want to use it for construction of the school. These are the only projects they have decided. I'm not telling they have spent that actual money. They have the projects for this much amount. How much they have to spend? 10 lakh. They have projects ready for how much amount? 2 plus 4, 6, 6 plus 3, 9 lakhs. I'm not telling they have spent 9 lakhs. They have a project ready. What they want to do, they know for 9 lakh rupees. Now balance sheet date is over. After that 6 months also over. They don't know what to do with the remaining 1 lakh rupees. Total they have to spend 10 lakh. Out of that they have a project ready. I'm not telling they have spent, but they know what to do with the 9 lakh rupees. They have an ongoing project. But within 6 months from the end of the financial year also, they don't know what to do with this 1 lakh rupees. Now the Companies Act says, if you don't know what to do with this, you transfer to the fund as given under Schedule 7. That means in Schedule 7, some funds are specified. One example is Prime Minister National Relief Fund. So Prime Minister, some funds are there. So some funds are given, which will be managed by the central government. You have to transfer that money to the fund, which has been specified under Schedule 7. Government will take care of that money. Once the money goes to the fund, you will not get it back. So that's why if you don't want the money to donate to the government, you want to do it by yourself, you should at least have what projects you are going to take care of it within 6 months. They're not asking you to spend, but keep the project ready. If the project is not ready within 6 months, if you are unable to decide what to do with that money, that will go to the fund, like Prime Minister National Relief Fund, etc. PM CARES fund also comes here. So that money will go to the fund and you are not going to get it back. So that I need to give a comment. So if I read it once again, whether in respect of other than ongoing projects, that means you don't have any ongoing project. The company has transferred unspent amount to a fund specified in Schedule 7 to the Companies Act within a period of 6 months from the expiry of the financial year in compliance with 135 subsection 5. Now one more point regarding CSR expenditure is there. Take this 10 lakh rupees only, 9 lakh rupees you have a project ready, 1 lakh has gone to the fund. Now in this 9 lakhs also, see 2 lakh rupees immediately you have written a check donated to the orphanage. 4 lakh rupees, this also you have written a check given it to the old age home. But this 3 lakh rupees, you want to use it for the construction of the school. But we all know construction of the school will not happen in a day or two. It is going to take some time. So what you should do is, this money, for this money of 3 lakh rupees, you have a project ready, but it is taking some time to spend it. Now what you should do is, you should open a separate account, unspent CSR account you have to open in the bank, and keep that 3 lakh rupees of money in a separate bank account. In a separate bank account, and from that account you spend for CSR. See, on this 3 lakh rupees, company only will have control. But the purpose of the Companies Act is separate CSR funds from the normal funds of the company. So this 3 lakh rupees, you have a project ready, but don't mix it with the regular funds of the company. Open a separate account, keep that money in a separate account. Company only will have control over that amount. They will spend it slowly. Okay. In the first point, the amount has gone to the fund. You are not going to get it back. In the second point, the company only will have control over it, but just they are dividing the funds. Understood? So that is the second point. If you see here, whether any amount remaining unspent pursuant to any ongoing project, there is a project going on, but still you are required to spend money. That amount you have to transfer it to a special account, a separate bank account. You have to keep it. In the previous one, if you don't have a project ready, transfer it to the fund of the central government. Government will take care of it. Clear? So this is regarding clause number 20. Now we have clause number 21. As I have told, this point will come in the audit report of consolidated financial statements. This point will come where? In the audit report of the consolidated financial statements. Sir, what I have to give the comment here? Very simple. Take for example, X Limited holding company is there. It is having some subsidiary company, associate company, joint venture company is there. Now for all these companies, individual audit reports are there. For all these companies, individual audit reports are there. For this holding company also, individual audit report will be there. Now, while I am conducting consolidated financial statements audit, as an auditor, I have to go through individual audit reports of the companies. And there also, I have to go through CARO reports of these individual companies. Now I have to comment in the audit report of the consolidated financial statements, whatever companies which are included in the consolidated financial statements, in their company audit report, in their CARO reports, did the auditor give any negative comment? If yes, for which paragraph the negative comment was given, I have to explain it. So once again, if I give you example, so X Limited company is that, which is holding company, Y Limited subsidiary, Z Limited associate, and we have some A Limited, which is a joint venture. Now holding company will have standalone financial statements. They will have the audit report. They will have CARO in that audit report. This company will also have a separate audit report. This company also will have a CARO. This company also will have a CARO. This company also will have a CARO. Now all this company's financial information will be clubbed together and consolidated financial statements will be prepared. Now on this consolidated financial statements also audit report will be given. Now I am the auditor conducting the audit of consolidated financial statements. What I should do? I should open this company's CARO report and check whether any of the paragraph contains negative remark. Okay, no paragraph contains negative remark. I open this company's audit report. I am able to find one negative comment in para number 10. Para number 10 contains negative report. I open this company's audit report. In the CARO report, I have seen para number 11 contains negative remark. In this A Limited company, no negative remarks. Now I have to mention in the audit report of the consolidated financial statements, I will say in so and so company Y Limited, which is an associate company, para number 10 contains a negative remark. In so and so company Z Limited, which is my subsidiary company, para number 11 contains a negative remark. This information I have to include in the audit report of my consolidated financial statements. That's what they say here. If I read it, whether there have been any qualifications or adverse remark by the respective auditors in the CARO reports of the companies which are included in the consolidated financial statements. If yes, indicate the details of the companies and the paragraph number of the CARO report containing the qualification or adverse remarks. That's all. These are the 21 matters which are required to be reported. And one more important thing here. See, whether you get a negative comment or positive comment for any of these points, all the matters are required to be mandatorily reported. Irrespective of whether you get positive comments or negative comments, all the 21 matters are compulsorily required to be included in the auditor's report. So this is what regarding CARO, guys. With this, we are done with the audit reporting revision, audit reporting chapters revision. Here and there, some important other information is also there. Essay 299 is also there, which is talking about how to conduct joint audit of the financial statements. This essay 229, I will cover it along with the 200 series. I will do one revision series for SA 200 series. In that SA 200 series, I will try to cover SA 299 there. Not now. In 299, I will try to cover. In 200 series video, I will try to cover joint audit. So with this, I will completely, with this, I have done the revision of all the important concepts of audit reporting chapter. Hello, my dear students, welcome back to our revision series. So in the previous session, we have completed revising the chapter audit reporting. So in that, we have discussed various things, 4 standards we have discussed, a few sections of the Companies Act which are talking about the reporting requirements of the auditor. That is 143 subsection 1, 143 subsection 11, 143 subsection 12, something called as CARO. So all these things we have revised in our previous session. So now in this session, we are going to start revising one new chapter. The chapter which we are going to take up for revision is going to be risk assessment, internal control, and materiality. So the chapter which we are going to take up now for revision is what? Risk assessment, internal control, and materiality. So as you could see in the title itself, this chapter actually contains 3 parts. Number 1 is risk assessment. Number 2, the second part is internal control, and the third part is materiality. So 3 parts are there. Risk assessment part, a few questions we will have. Internal control, that will be a significant portion of this chapter. And then we have a small concepts called materiality. And whatever content we are going to discuss in this chapter, so that has actually been taken from through 2 standards. One is SA 315 and the other one is SA 320. So SA 315 is a standard which is going to talk about risk assessment part and internal control part, and whatever materiality related discussion is there, that is actually taken from SA 320. So when I say I'm trying to revise the chapter risk assessment, internal control, and materiality, in fact we are trying to revise the 2 standards, SA 315 and SA 320. So between these 2 standards, first we will take up SA 315 and complete the risk assessment and internal control part. So in that also, first I will be taking up risk assessment. So if you remember risk assessment, this term we have already come across. This is not the first time we are coming across this term. So we have come across this term when we are discussing SA 500. In SA 500 revision, I told audit procedures can be broadly divided into 2 categories. One is risk assessment procedure and the other one is further audit procedures. So there we have actually come across the term risk assessment procedures, those procedures which are actually performed by the auditor to obtain an understanding of the entity, environment, and its internal control to identify and assess the risk of a material misstatement. Those procedures we are going to call it as risk assessment procedures. So in this risk assessment part, we need to dig deeper into the concept of risk while doing the audit. So what will be the risk when we do the audit? Now, before I explain the actual content, I would like to put before you one simple question. You tell me, I'm a practicing chartered accountant. I have been appointed as auditor of some client X Limited. So now I will be verifying this company's books of accounts, this company's financial statements, and after that, I'm going to express an opinion on that financial information, whether they are giving a true and fair view, and I will give my opinion accordingly. And finally, I will draft an audit report. In that audit report, my opinion will be there. By giving that audit report, my work is coming to an end. You tell me, in this entire scenario, the moment I have accepted as an auditor and I completed my auditor's work, do you find any risk to the auditor in this entire process of the audit? Do you think, being a practicing chartered accountant, tomorrow you also will become a chartered accountant, you might also go into practice, you might also be requested by some clients to do the audit for them. So in case if you have accepted an audit engagement, did the audit, given your opinion, prepared your report, do you find any risk there? Yes. So there is unavoidable risk in audit. Whenever you are doing an audit, there is always a risk associated with that function of audit. Sir, what is that risk? So let us think in the most layman terms. We will not use the technical jargons. So just we will try to think it from a very practical perspective. You think and analyze in this entire scenario, what risk this practicing chartered accountant is facing. The risk is whatever opinion which the auditor has given on the financial information of this client X Limited, that opinion could be inappropriate. That opinion could be inappropriate. Or in simple terms, if I have to put it, the opinion given by the auditor could be wrong. Whatever your opinion you are giving, that opinion could go wrong. There is a risk of giving an inappropriate opinion. Might be you are giving an opinion which is inappropriate. See, as we all know, the moment we give our audit report, this audit report will be used by so many people to take the decisions. An investor is going to take a decision whether to make the investment in this company or not on the basis of your audit report. The banker is going to decide whether to give a loan to this client or not, whether to give a loan to this company or not. That banker is going to rely on your auditor's report for making that decision. So like that, so many stakeholders are there who are going to make use of your report and make a decision. So when these many people are relying on your audit report, if you give inappropriate opinion, all these stakeholders' interests are going to get affected. So that risk, we call it as audit risk. That risk, we call it as what? Audit risk. In simple terms, if I have to put it, the risk of auditor giving an inappropriate opinion. Whatever opinion the auditor has given, that opinion might be inappropriate. Auditor might give a wrong opinion. The risk of giving that wrong opinion, there is a chance that the opinion given by the auditor could go wrong. That risk only, in the audit terminology, we are going to call it as audit risk. This is what simply, if I have to put it. But as we all know, things are not going to work in simple way. In the examination, we have to learn the technical definitions. So now, if you look at the definition, this is how the term audit risk has been defined. Audit risk means risk that auditor gives an inappropriate opinion when the financial statements are materially misstated. What is the definition telling? This definition is very, very important. So a lot of interpretations are involved here. So please stay with me for a while. So audit risk is a risk that auditor gives an inappropriate audit opinion when the financial statements are materially misstated. Now, the deeper analysis of this definition will give us more insights. Assume that financial statements are materially misstated. Financial statements contain a material misstatement. See, if the financial statements contain a material misstatement, what will be appropriate opinion? You tell me. In the previous session only, we have completed the audit reporting chapter. If you have conducted audit of the financial statements, and if that financial statements are materially misstated, which opinion will be appropriate? Will modified opinion will be appropriate or unmodified opinion will be appropriate? Here, modified opinion will be appropriate. Which opinion will be appropriate? Modified opinion will be appropriate. Why? Because financial statements are materially misstated. But instead of giving an appropriate opinion, the auditor is giving inappropriate opinion. The auditor is giving inappropriate opinion. That means what he is doing? When the financial statements are materially misstated, you are supposed to give a modified opinion, but instead of that, auditor is giving unmodified opinion. Instead of that, what you are doing? Unmodified opinion you are giving. So when modified opinion is appropriate, auditor is giving unmodified opinion. When you are required to give a negative comment regarding the financial statements, you are telling financial statements are giving a true and fair view. So take for example, you have conducted audit of some client X Limited. This company, in this company's books of accounts, there is actually a fraud. Actually, a fraud has taken place. You are unable to identify. What you have told is these financial statements are giving a true and fair view. The financial statements contain a fraud, but you did not identify. So you told that financial statements give a true and fair view. Relying on your decision, one shareholder, one innocent shareholder, he thought that, okay, auditor is telling financial statements are giving true and fair view. Let me invest my 1 lakh rupees of hard earned money in the shares of this company. After he has invested his 1 lakh rupees of money in the company, then the fraud was exposed. Now, whatever money he has invested, now that has become 10,000 rupees. Now, the shareholder will get irritated or not? Yes. So first thing what he will do, he will go and file a case against the auditor. This auditor gave the inappropriate opinion. That's why I have lost my money. Now you have to face all the legal consequences. You have to go before the court. You have to prove yourself. So all that mess you have to clear up. So this risk which auditor is going to face legally, this is only we call it as audit risk. By doing the audit only, you are coming across this risk, right? So this is what the definition of the term audit risk. Able to understand now? So what is the definition of audit risk is telling? Risk of expressing inappropriate opinion when the financial statements are materially misstated. Now, let me give you a typical scenario. Take for example, financial statements are not containing any material misstatement. Financial statements are not materially misstated. There is no material misstatement in the financial statements. If that is the case, what should be appropriate opinion? Appropriate opinion should be unmodified opinion. When there are no material misstatement, you should have given what? Unmodified opinion. But auditor is giving inappropriate opinion. Inappropriate opinion means what he is doing? He is giving a modified opinion. When unmodified opinion is appropriate, but auditor is giving modified opinion. That means when you could have said financial statements are giving true and fair view, but instead in your opinion paragraph, you are giving a negative remark. Sir, can we call this second scenario also as audit risk? if you literally go by the definition, this we can't call it as audit risk. Only first scenario will come under audit risk. Why? Because if you technically look at the definition is telling risk of giving an inappropriate opinion when financial statements are materially misstated. That means the financial statements contain a material misstatement and you are giving an inappropriate opinion. If I further simplify it, when modified opinion is appropriate, you are giving unmodified opinion. This only will come under audit risk. Where unmodified opinion is appropriate, but you are giving modified opinion, this will not come under audit risk. Technically also, even practically also, if you think, take for example, you could have told financial statements are giving true and fair view, but you are telling no, financial statements are not giving true and fair view. There is one small amount of misstatement. Now, will you face any legal consequences here? In this case, you will not face any legal consequences. Why? Because you are a very conservative auditor. You are concerned about small misstatements also. That's why you give negative opinion. You are very conservative. Legally, you will not face any trouble here. Now you will all say, sir, legally there might not be any trouble, but client will become unhappy. No. When unmodified opinion is appropriate, if I have given a modified opinion, client will become unhappy. Let him be unhappy. Who is bothered? That if he becomes unhappy, he will not appoint us for the next year. Let him not do it. But legally, I am not facing any consequences. No. There is a possibility of losing your client. That is a business risk. Audit risk is different. Business risk is different. Clear? So that is what the concept of audit risk. So the same thing that they have told here in simple terms, if the auditor expresses unmodified opinion, when modified opinion is appropriate, that only will be considered as audit risk. Sir, what will not be included in the audit risk? If you are giving a modified opinion when financial statements are not materially misstated, that means you could have, now they're referring to the second case, you could have given an unmodified opinion, but still you are giving a modified opinion. Here you are only a conservative auditor. Here you will not find any kind of legal consequences. And also, what will not be included in the audit risk is business risk faced by the auditor. Audit risk is different, business risk is different. The examples of business risk, loss of client, loss of reputation, these are all business risk. Audit risk is different, business risk is different. When I say audit risk, I am referring to what consequences auditor is going to legally face because of doing the audit. Understood? Now, so since we have understood the meaning of the audit risk, now it is appropriate time for us to understand what are the components of audit risk. So audit risk is made up of two components. One is risk of material misstatement and the other one is detection risk. Audit risk is made up of two components. One is risk of material misstatement and the other one is detection risk. Sir, what is risk of material misstatement? The chance of happening of misstatement in the financial statements. The risk, the possibility of happening of misstatement in the financial statements, that I call it as risk of material misstatement. See, this risk is something which will be there whether audit happens or does not happen. It doesn't matter. Like for example, in the client organization, there are no internal controls. The warehouse, wherever the stock is kept, there is no security guard, there is no CCTV camera, no one is monitoring. You tell me there is a possibility of theft of inventory in that area or not? Yes. That is what risk. Risk of happening a misstatement, I can call it as risk of material misstatement. Or there is no one who is approving the payments. Is there a possibility of happening misstatement? Yes, this is what we call it as risk of material misstatement. So simply the risk, the chance, the probability of happening of misstatement in the financial statements, that I call it as risk of material misstatement. It has nothing to do with the auditor. Whether audit happens or does not happen, it doesn't matter. For example, if in the warehouse there are no internal controls, whether auditor is appointed or not appointed, the chance of happening misstatement will always be there. So that's why risk of material misstatement, who is responsible for this risk? The client organization is responsible for that risk, not the auditor. So auditor will only identify what is the risk of material misstatement by performing risk assessment procedures. So whether audit happens or doesn't happen, this risk will always be there. So that is what simply we call it as risk of material misstatement, the chance of happening of misstatement in the financial statements. And this risk of material misstatement further contains two components. One is inherent risk and the other one is control risk. If I put it in simple terms, inherent risk means absence of internal controls. Those risks which cannot be, those risks for which you can't implement internal control. Those risks for which you can't implement any internal controls. Control itself is missing. You can't implement internal controls in that area. So that kind of risk we call it as inherent risk. Like if I have to give you a few examples here. So like as you could see, inherent risk, susceptibility of an assertion to a misstatement. That could be material, assuming that there are no internal controls. In simple terms, absence of internal controls, we call it as inherent risk. and most of the cases inherent risk is unavoidable, something which is built into the system. You can't implement internal control for that. A few examples if I have to say: technological developments might make a particular product obsolete, thereby causing inventory to be more susceptible to overstatement. See, some kinds of businesses will exclusively depend on technology. When the people adopt to new technology, that old technology products will become obsolete. So this risk is always there. This risk will be there for certain businesses. You can't avoid it. So this is one particular example of inherent risk. So if I put it in simple terms, absence of internal control, I'm going to call it as inherent risk. But then what is control risk? Control risk means internal control is there. The organization has implemented internal control to prevent, detect or correct a misstatement, but that internal control failed miserably to prevent a misstatement from happening. The organization has adopted internal control, but that internal control has failed. That internal control was unable to prevent, detect or correct a misstatement on a timely basis. That failure of the internal control, I call it as control risk. So both inherent risk and control risk, both collectively put together, give rise to risk of material misstatement. It happens because of both, either absence of internal controls or failure of the internal controls. And one point you have to remember, whether audit happens or not, this risk will always be there. Now, what is detection risk? Detection risk refers to that risk where audit procedures performed by the auditor may not be able to detect a material misstatement in the financial statements. So as an auditor, your objective is you will perform audit procedures. By performing that audit procedures, you will try to obtain sufficient and appropriate audit evidence to identify whether there is a misstatement or not. So in some circumstances, what could happen is you performed audit procedures, but you were unable to find out a material misstatement. There is a fraud already happened in the books of accounts. You performed audit procedures, but you are unable to identify. There is an error in the financial statements or books of accounts. You performed audit procedures, but your audit procedures were unable to identify. So the audit procedures not being able to identify a misstatement in the financial statements, that we call it as detection risk. So this is something for which auditor will be responsible. For detection risk, who will be responsible? Auditor. And which kind of risk which auditor can control is detection risk he can control. Risk of material misstatement is not in the auditor's control. Risk of material misstatement, auditor can only identify, that too by performing risk assessment procedures. After identifying risk of material misstatement, the auditor will plan the audit procedures. If he performs proper audit procedures, he can keep the detection risk at a low level. On the other hand, if he performs inappropriate audit procedures, he has to increase his detection risk. So detection risk is something which is completely in the auditor's control, and the only thing which auditor can control is detection risk. Clear, everybody? Able to understand? So, but whatever it is, risk of material misstatement and detection risk both collectively give rise to audit risk. So here there is one more important thing which we need to understand here: the interrelationship between components of internal control. Between risk of material misstatement and detection risk, what kind of relationship exists? There exists an inverse relationship. What relationship? Inverse relationship. Sir, how come inverse relationship? For example, if the auditor identified risk of material misstatement as very high, then what he will do? He will plan more audit procedures. If he is performing more audit procedures, he will detect more misstatements. If he is detecting more misstatements, that means he is reducing his detection risk or not? Yes or no? On the other hand, if the auditor identifies the risk of material misstatement to be low, he will perform less audit procedures. If he performs less audit procedures, less misstatements he will be able to detect. If he is detecting less misstatements, that means the detection risk is going to be high. So in this manner, between the components of risk of material misstatement, between the components of audit risk, that is risk of material misstatement and detection risk, there exists an inverse relationship. Understood, everybody? So this is what regarding risk. This is what the concept of audit risk, important from the examination perspective. Very basic foundational concept. You should have clarity regarding this at any point of time. Clear? Everybody comfortable? So coming to the next concept now. See, as we have seen in the audit evidence chapter, first we will perform risk assessment procedures. What is the outcome of the risk assessment procedures? By performing risk assessment procedures, we need to identify risk of material misstatement. As I have told, what is the chance of happening of misstatement in this financial statements? In which area there is a chance of happening misstatement? So that we need to find out. So how we will find out? We will try to find it out by understanding entity, environment and its internal control. That procedures only we call it as risk assessment procedures. This is not something which I'm telling you now. This is something which we already know as a part of SA 500. So as per SA 500, by performing risk assessment procedures, we need to identify risk of material misstatement. But now I'm going to elaborate on that discussion. So SA 315 says we need to identify risk of material misstatement at two levels. We need to identify risk of material misstatements at two levels. So those two levels are risk of material misstatement at the financial statement level, and the other one is risk of material misstatement at the assertion level. Sir, what is this risk of material misstatement at the financial statement level, and what is the risk of material misstatement at the assertion level? I will try to explain it in very simple terms. See, if you find certain scenario and you find that because of this there is a chance of happening of misstatement, and because of such circumstance the risk of happening of misstatement is not just restricted to one or two items, there is a chance of happening of misstatement in the entire financial statement. The risk which is having a potential to cause a misstatement not just in one or two items of the financial statements, it is having a potential to cause a mistake, is having a potential to cause a misstatement in the entire financial statements. That kind of risk I call it as risk of material misstatement at the financial statements level. Then what could be the meaning of risk of material misstatement at the assertion level? If you find certain risk but that is having a potential to cause misstatement in just one or two items of the financial statements, there is a risk and that risk is having a potential to cause a misstatement, but there is no such big potential to cause a misstatement in the entire financial statements. That risk is having a potential to cause a misstatement in just one or two items of the financial statements. That we call it as risk of material misstatement at the assertion level. Let me give you a few examples to make you understand. See, I came to know that the management has appointed a person for preparing financial statements. The person who has been appointed to prepare the financial statements, he has no knowledge about accounting standards. He is having no complete knowledge about Schedule 3. Now you tell me, if you came to know the person who is required to prepare the financial statements, if he doesn't have a knowledge of accounting standards, if he doesn't have a knowledge of Schedule 3, is there a chance of happening of misstatement? Yes. And also, is that having a chance, is that risk having a potential to cause a misstatement in the entire financial statements or just one or two items of the financial statements? The person who is required to prepare the financial statements, if he doesn't know accounting standards, if he doesn't know Schedule 3, will entire financial statements are having a chance of misstatement or just one or two items? There is a chance of happening of misstatement in the entire financial statements. Now, I will call this risk as risk of material misstatement at the financial statement level. Let me give you another example. Take for example, inventory. The inventory, the warehouse, wherever the inventory is kept, in that warehouse, there is no CCTV camera, there is no security guard. You tell me, because of that, there is a chance of happening of misstatement? Yes. Now you tell me, this is having a potential to cause a misstatement in the entire financial statements or just one or two items? It is having a potential to cause a misstatement only in the area of inventory. Now this risk, I call it as a risk of material misstatement at the assertion level. So initially I told by performing risk assessment procedures, you need to identify risk of material misstatement. But now I'm elaborating that discussion. I'm telling that you need to identify risk of material misstatement at two levels, at the overall financial statement level and at the assertion level. Financial statement level risk refers to that risk which is having a potential to cause a misstatement in the entire financial statements. On the other hand, assertion level risk will have a potential to cause a misstatement in just one or two specific items of financial statements. Clear? So like this, we need to identify risk of material misstatement at two levels. Next most important concept from the risk assessment part is risk-based audit. What is that? There is a concept called risk-based audit. This is also important for the examination. RBA also we call it in short. Sir, what is this concept of risk-based audit? This also, let us try to understand it with the help of example. See, you are a practicing chartered accountant. You have been appointed for conducting audit of the client X Limited. I will tell you two options, two approaches for audit. Approach number one. See, the approach number one is, as we all know, if you have to conduct audit of the financial statements, in this financial statements of the company, there will be incomes also, there will be expenses also, there will be assets also, there will be liabilities also. In approach one, what I do is, since I am appointed as an auditor, I want to audit within 10 days of time. I want to do the audit within 10 days of time. In approach one, what I do is, for all the four areas, I will try to allocate equal amount of time. For incomes, I spent, for conducting audit of incomes, I spent 2.5 days. For conducting audit of expenses, I spent 2.5 days. For conducting assets, 2.5 days. For conducting liabilities, 2.5 days. This is approach one. This is traditional audit approach where I try to spend equal amount of time and resources for each and every area. Then I will tell you one more approach. There is another approach for audit, approach number 2. See, in this approach, what I will do is the same scenario. I have been appointed as auditor of X Limited. I need to conduct the audit of their financial statements and books of accounts. First, what I will do is I will try to identify the risk. I will perform risk assessment procedures, identify the risk of material misstatement. I will try to find out those areas wherever the risk is higher and those areas wherever the risk is lower. Like I performed risk assessment procedures. From that, I came to know that assets and expenses are having a high risk. On the other hand, liabilities and incomes have a low risk of material misstatement. So now what I am doing is, since I came to know in which areas risk is high, in which areas risk is low, I will try to allocate more amount of time for greater risk areas. Like for example, since assets are having a high risk, for assets I will spend 3 days. For expenses also I will spend 3 days. On the other hand, there are two areas, liabilities and incomes. These two areas are having low risk of material misstatement. For these two areas, I will spend less amount of time. Are you able to identify the difference between approach 1 and approach 2? In the approach 1, I did not pay any attention to the risk. Just randomly for all the areas, I am equally allocating the time. Whereas in approach 2, what I am doing is, first I am identifying, studying the organization, identifying the risk, identifying those areas where the risk is higher, identifying those areas where the risk is lower. I am trying to allocate more amount of time, more amount of resources. For those areas where the risk is very high, I will try to allocate less amount of time, less amount of resources for those areas wherever the risk is low. So the point I want to conclude here is, while you are conducting audit, each and every item of the financial statements do not deserve equal importance. You need not spend each and every area of financial statement do not deserve equal attention. There will be some areas which require high attention. There will be certain areas which require less attention. So first you need to identify which areas require high attention, which areas require less attention, and the deciding factor for that is the risk of material misstatement. And accordingly, you have to dedicate your time and resources. You tell me which approach is correct. Approach 1 is more reasonable, or approach 2 is more reasonable? Approach 2 is more reasonable. That approach only I call it as risk-based audit approach. That approach only I call it as what? Risk-based audit approach, RBA. This is what today all the auditors are doing. If you are doing the articleship with so-called reputed firms and all, you might also be doing the same thing. Risk-based audit only today happens in the industry. Clear? So this is one last topic I want to cover from this area. So if we have a look at that, yes, this question. So what is risk-based audit approach? I will try to quickly take you through this discussion. So risk-based audit approach is an approach to audit that analyzes audit risk. First we identify the audit risk and then we analyze it, and we will set the materiality on the basis of risk. On the basis of whatever risk we have identified, we set the materiality levels, and we will develop audit program in such a way that larger portion of audit resources are dedicated to high risk areas. Able to understand? So three things. Risk-based audit involves three steps as per the definition. First, we have to analyze audit risk. On the basis of risk, we have to set the materiality. We will see it in the same chapter, how to decide the materiality. And we have to design the audit program in such a way that more resources are allocated for high risky areas. So this is what we call it as risk-based audit. The same thing they try to analyze here. It is based on risk, or it focuses on areas of greater risk. Wherever higher risk is there, to that areas more focus will be paid. And it focuses primarily on identification and assessment of financial statement risk, and we will develop the framework in such a way that we will reduce the impact on the financial statements because of the risk. And this risk-based audit contains 3 steps. Risk-based audit contains how many steps? 3 steps it is going to contain. Number 1 is risk identification. Okay, anyhow it is there in the material, so here only we will do. So risk-based audit has 3 phases. Number 1 is risk assessment. Number 2 is risk response. Number 3 is reporting. Very simple. That's what even we have also understood. Simple things only, they try to add more points. First thing is risk assessment. Nothing but in the risk assessment phase, what will happen is, as I have told, we will perform risk assessment procedures. We will try to identify the risk of material misstatement. We will try to find out in which areas what kind of internal controls are there, where the risk is higher, where the risk is lower. That we will try to identify. That is the first step. What is that? Risk assessment. Assessment means what? Analysis. Nothing but performing risk assessment procedures, identifying and prioritizing. The same thing they say here. What we do in the risk assessment phase, we decide whether to accept the client or not. We will plan our overall engagement, and we mainly perform risk assessment procedures to understand the business and its environment. We will identify internal controls, what risks are there, what internal controls are there, and then we will analyze whatever risk of material misstatement we have identified. And from that risk we have identified, we will find out which risk are significant risk, that means which kind of require more attention, that we will analyze. And finally, if you find any weaknesses, that we will communicate with the management, and we make an informed assessment of risk of material misstatement at the financial statement level and at the assertion level. As I have told, we will identify risk of material misstatement just now at two levels, at the financial statement level and also at the assertion level. You tell me which kind of risk requires more attention. Financial statement level risk requires more and more attention. So basically we'll try to identify in the risk assessment phase. After that, what we do, whatever risk we have identified, for that we will plan responses. How do we plan responses? For example, if I find the risk as very high, I will try to perform more further audit procedures. I will try to perform test of details. I will try to perform analytical procedures. I will take big samples. Wherever low risk is there, I will try to verify smaller samples. Wherever low risk is there, I will try to spend less time, less resources. These are all nothing but what? Responses. Basically, how do you respond to the risk is by performing further audit procedures. By risk assessment procedures, we will try to identify, and whatever risk we have identified, on the basis of that, we will try to plan our further audit procedures. The same thing we have told here. This phase of the audit is to design and perform further audit procedures, which will provide the evidence necessary. To obtain audit evidence, we will try to perform further audit procedures. So here we will try to verify all kinds of internal controls, or manual controls, automated controls, everything we are going to verify. So yeah, once again, internal control point. And in some cases we perform analytical procedures. I have already told you analytical procedures. We try to study the relationship between financial and non-financial information, and we try to identify the misstatement. And also we'll try to do surprise checks. We'll try to bring in element of unpredictability. Element of unpredictability means surprise check. If you do surprise checks, you can find out more misstatement. So we can do surprise checks also. So all these kind of further audit procedures we will perform, right? So we have identified the risk, we have planned our responses. Now what? So by planning your responses, by performing all these further audit procedures, you will identify the material misstatements. Whatever your findings are there, that you are required to report. We will finally prepare the audit report. How we will prepare the audit report? As per the standards on audit, SA 700 series. That is the final phase of the audit. So that's what they say here. The final phase of the audit is whatever evidence you have obtained, that you have to analyze whether that is sufficient and appropriate or not. And at this stage, you have to draw your conclusions on the basis of whatever evidence you have got. You have to form your conclusion, you have to form your opinion, and if you find any additional risk, that also you have to address. After addressing all the risk, you have to, whatever your audit findings are there, that you have to report to the management and those charged with governance, and you have to form your opinion. That opinion should be given in the form of a written report. If you do that, then the audit will come to an end. So these are the three phases involved in risk-based audit. So what are the three phases, guys? Repeat everybody along with me. Number one is a risk assessment, where we basically perform risk assessment procedures. Number two, we respond to that risk basically by performing further audit procedures, and what are our findings are there, that we will report it in the form of a audit report, where we will express our opinion. So these are the major concepts relating to risk assessment part. So with this risk assessment part revision, we are done with. Now we will try to proceed further with internal control part, since we are done with risk assessment part. So now the second part of this chapter is dealing about internal control. So let us try to revise quickly the concepts relating to internal control. First of all, we will try to understand what exactly is the meaning of the term internal control. See, this term internal control also will come across in various chapters, and whatever we have done till now, there also at various instances we have come across this term internal controls. Now we will try to spend some time to understand what exactly is the meaning of internal control. So internal control is defined something like this. Internal control means any policy or procedure which is designed, implemented or maintained by management by management or those charged with governance or other personnel. So internal controls are basically any policy or procedure which is designed, implemented or maintained by management or those charged with governance or other personnel to provide reasonable assurance to the entity regarding achievement of the objectives. So basically, what I mean to say here regarding the term internal controls is any process, any policy which is getting designed, implemented or maintained by the management of the organization to achieve their objectives. That policies and procedures, I call them as internal control. See, this is the technical definition. If I put it in simple terms, any policy which is getting implemented in the organization to prevent a mistake from happening. Any policy which has been implemented in the organization to prevent a mistake from happening, that we call it as internal control. If I give you very few simple examples, for example, if you take a scenario of IT company, in the IT company, just like that, anybody can't enter inside the premises. If a person has to enter inside the company's premises, they have to scan their identity card, they have to give their biometric, then only the gate will open. So this is a policy which is set by the management. I can simply call it as internal control. Or let us talk about my organization. So I have an office. I have my office. So I have some article assistants who are coming to my office. But since I'm not always available in the office, I don't know when which employee is coming, when which employee is leaving. Are they spending enough of time in the office or not? I don't know. So that's why what I have done is I have installed a biometric system. So the person, whenever he comes to the office, he will give his biometric, time will get captured. And also when he's leaving the office, he has to give his biometric again. Then also the time will be captured. So this is the policy which I have set in the organization to make sure that no mistake is happening here. Or there is a manufacturing company, they have a very big warehouse where they are storing all their goods and where they are storing all their inventory. I want to make sure that there is no theft happening for that inventory. So the organization has implemented a CCTV camera system, internal control. Or you will see that in big companies, you will be able to find the security guards at each and every entry and exit point. If you have ever visited the supermarket, definitely would have done that. So if you pay close attention, at the entry point, exit point, security guards will always be there. Appointment of security guards is also a kind of internal control. So like this, any policy which is getting designed, implemented or maintained either by the management of the organization or those charged with governance by the top level management of the organization or some other personnel like employees, etc., with the objective of why these policies are getting implemented. If you read here, the policy of implementing these internal controls is to provide reasonable assurance about achievement of entities' objectives, to give the confidence to the management that yes, our organization is working towards achievement of our objectives. Nothing is going wrong in the organization. So to make sure that happens, whatever policies and procedures which are getting implemented, that we call it as internal control. Now, if you take any internal control in the organization, it will try to fulfill at least one of the four objectives. You take any internal control in the organization, you will be able to find that internal control is trying to fulfill at least one of the four objectives. Sir, what are that four objectives of internal control? 99% of the internal controls will be working with the objective of safeguarding of assets. Majority of the internal controls, if you pay attention, they will have a straight away objective of protecting the assets of the company. Like examples I have given, having a CCTV camera and also having a security guard. So these are all nothing but the controls which are making sure that entities' assets are protected, or even I can say physical verification of assets, that is also internal control. So that is one example which is helpful for safeguarding of the assets. Some internal controls will work with the objective of increasing reliability of financial reporting. Some internal controls will work with the objective of increasing reliability to make the financial information more reliable. Some internal controls will be working. If I have to give you example, segregation of duties, which we commonly find in many organizations, like a person will write an entry, some other person will approve it. The person whoever is handling an asset, the same person will not maintain records. Cashier will be handling cash, accountant will be passing entries. So store in charge will be handling the inventory, but inventory related entries will be passed by different person. So these kind of controls, we call them as segregation of duties. So this is one more major control which is ensured with the objective of increasing the reliability of financial reporting. Or I can say BRS, preparation of the bank reconciliation statement. That is also one objective which is working towards that is also one internal control which is working towards the objective of increasing the reliability of financial reporting. Some internal controls will work with the objective of increasing the efficiency and effectiveness of operations. Some internal controls will work with the objective of increasing efficiency and effectiveness of operations. For this, I often use very simple example. If you take in my organization, in my office, I have to work with the systems. So that's why what I have done is I have installed a high-end internet broadband services. I have availed broadband services. So in my office, there are total of some 10 systems. Some 8 staff are working in my office. For all these 10 systems, I have given high-speed internet access. Now, if the system is having access to the high-speed internet, my staff, my 8 staff, whoever are there, since they are working on the systems, they might misuse this internet also. Instead of using that internet for working, they might use it for killing their time, like watching the social media or scrolling through the YouTube and all. So they might misuse it. So if they are misusing this internet, their productivity will get reduced. So what I have done is, in my organization, I have done something called firewall. I have installed something called a firewall function. I have installed. So this basically what this firewall will do is it will make sure that the internet, whatever is available on the systems, that internet will give access only to specified websites. Like in my office, I want access by this internet to only to income tax website, GST website, and other some law related websites, filing related websites. Only the firewall will give access to these websites. If someone tries to access to YouTube, the system will not permit. This firewall will protect. So this implementation of firewall is also an internal control. And if you pay close attention, what is the objective of implementation of this control? To increase the efficiency and effectiveness of my operations. So there could be some internal controls with this objective of increasing efficiency and effectiveness of operations. There will be some internal controls which will be working with the objective of ensuring compliance with laws and regulations. There will be some internal controls which will be working with the objective of ensuring compliance with the laws and regulations. So any controls you pick in the organization, they will try to fulfill at least one of these 4 objectives. Some internal controls might fulfill all the 4 objectives also, but any control you pick up, it will try to at least fulfill any one of these 4 objectives. So what are the 4 objectives? Safeguarding of the assets, increasing the reliability of financial reporting, increasing the efficiency and effectiveness of operations, and making sure with the compliance of laws and regulations. So this is basically the concept of internal control. So let us try to go further and understand remaining concepts relating to internal control. Sir, who is responsible for implementation of internal control? Is auditor responsible for implementation of internal control, or management is responsible for implementation of internal control? It is always the management of an organization who is responsible for implementation of internal control. So it is always primary responsibility of the management. So then what auditor will do? Auditor will verify those controls as a part of test of controls, and depending on that compliance procedures, he will design his substantive audit procedures. So the primary responsibility for implementation of internal control always rests with management. And when I say internal control, as I've already told you now, there will be internal controls regarding different areas. I have given you examples of internal controls which are safeguarding assets. There are some internal controls which are working with the objective of increasing the reliability of financial reporting. There are some internal controls which are relating to efficiency and effectiveness of operations. Some internal controls will be related to objective of compliance with the laws and regulations. So an organization might have n number of controls. It is wrong to assume that all the internal controls will be related to only accounting related information. No, all internal controls are not accounting controls, which means those internal controls which are implemented over the area of financial statements and books of accounts, only those will be falling under accounting controls. But internal controls doesn't include only accounting controls. The term internal control is very broader. If I have to give you one more example, just now as I've told, firewall, restricting the access of the employees to the internet. The firewall is an internal control, but it is not an accounting control. It has nothing to do with the accounts department, but it is an internal control. The term internal control is very wider. It doesn't include only accounting control. There could be controls regarding various aspects. Now the next question comes, sir, if there are so many internal controls in the organization and all internal controls need not be related to accounts, do you think will the auditor have responsibility to verify all kinds of internal controls? No. Generally, auditor will be concerned with only those internal controls which are relating to accounting related information. So basically, if I have to put it, accounting related controls will form part of the scope of the internal scope of the auditor. Auditor need not get concerned about each and every control. Only those controls which have a bearing on the financial data, regarding those controls only auditor will be concerned. That controls only auditor will test. Clear? So this is what regarding scope of internal control. And next one, as I've told, one of the part of the internal control is accounting control. Sir, what features should be there regarding the internal controls which are working regarding accounting system? if you are implementing any internal control in the accounting system, that is, if there are any internal controls which are related to books of accounts and financial statements, what kind of objectives they have to fulfill. So in the accounting department, if you want to implement internal controls, that internal control should fulfill some objectives like, number one, that internal control must ensure that there is a proper authorization. Before any entry is recorded in the books of accounts, someone should approve it. Without approval, no entry should be recorded in the books of accounts. So this is a primary objective which every accounting control should fulfill. Authorization should be there. Number two, that internal control in the accounting department should make sure that all the entries are properly recorded, promptly recorded. There should not be delay in recording of the entry. Entry should be recorded as early as possible. Next one. And also, internal controls in the accounting department should make sure that those records are safeguarded from unauthorized access. Whatever accounting records are there that are confidential information, there should be internal controls to prevent unauthorized access. Like the accounting, the computers in which financial data is stored, that should be password protected. Only some specified person should be given access. They should have given username and password. Only those people can access to that systems where financial data is stored. So that they have to make sure. And assets are verified at reasonable intervals. Nothing but in the accounts department, you should have some internal controls which are concentrating on physical verification, periodical verification. So if an organization wants to implement internal control in the accounting department, it must fulfill at least these four objectives. It should make sure that there is proper authorization mechanism. It should make sure that transactions are getting promptly recorded. It should make sure that those accounting records are safeguarded from unauthorized access, and these assets are getting verified at reasonable intervals. Clear, everybody? So this is what regarding basic concepts relating to internal control. Coming to the next part. So we have a concept called limitations of internal control. See, no matter how effectively you implement internal control, they can only give you reasonable assurance that the objectives will be achieved. So just because you have implemented internal control, there is no guarantee that there is no mistake happening in the organization. No such guarantee will be provided. Like for example, if I have installed a CCTV camera in the warehouse wherever my stock is kept, will that be a guarantee that theft will not happen? Definitely not. Similarly, if I have appointed a security guard in my company's premises, do you think no unauthorized access will happen? No guarantee is there. Similarly, if I have divided duties, if I have implemented segregation of duties, does that mean no accounting error will happen? No guarantee. So no matter how effectively you implement internal controls in the organization, they will give you only reasonable assurance regarding achievement of objectives. They can't give a guarantee. Sir, why internal controls can't give me a guarantee that objectives will be achieved? Why? Because the process of internal controls are suffering from some limitations which are unavoidable in nature. The internal controls are suffering from some limitations which are unavoidable in nature. Those limitations, we call them as inherent limitations of internal control. So if you read this paragraph carefully, this is very powerful paragraph which says internal control, no matter how effective, can provide an entity with only reasonable assurance but not absolute assurance. They can give you only reasonable assurance. They can't give you guarantee about achieving the entity's operational, financial reporting and compliance objective. Why, sir? Why? Because the internal control systems are subject to some inherent limitations. What do you mean by inherent? Something which is unavoidable in nature. So the internal controls are suffering from some limitations which are unavoidable in nature. We call them as inherent limitations. Sir, what are that inherent limitations? So if you see here, first thing I will say, it cannot handle transactions of unusual nature. Take for example, you can implement internal controls regarding those items which you usually expect. Like for example, there is a warehouse. So in this warehouse, the stock is kept. There is a possibility of theft happening to that stock. Sir, how the theft can happen? For example, here there is one entry gate, here there is one entry gate. So management thought generally if someone has to come and commit a theft, he has to come either from this side or he has to come from this side. So what they have done is, here they have appointed one security guard, here they have appointed one security guard. Why? Because management thought that it is a usual way to commit some theft. So they have implemented internal control. They have appointed security guards. But a person might think in an innovative way. He can dig below the ground. He can build a cave below it, and he can come and commit a theft and go out of that way. I'm not telling it will always happen. There is a possibility which is something unusual. So you can implement internal controls regarding those kind of situations which you usually expect to happen. Sometimes unusual things which we don't expect, only because of that ways also fraud can happen. Because of that ways also fraud can happen. So that's why internal controls can handle only usual transactions. It cannot handle unusual transactions, because unusual transactions are those which we even haven't expected that to happen. So those unusual transactions can't be protected by internal control. Number 3, collusion among individuals. The second one more inherent limitation is collusion among individuals. Take for example, with a very good objective, I have divided the responsibilities. I have told the cashier, boss, dear cashier, your responsibility is to receive the payment, receive the collections, make the payments. And I told to the accountant, dear accountant, you are required to pass entries relating to cash. So with a very good intention, the management has divided the responsibilities of the cashier and accountant to prevent the misstatement. But what could happen is this cashier and the accountant both can collude with each other. They can both join the hands together and commit a fraud collectively. So this collusion possibility will always be there. See, if so-called biggest frauds happened in our country, like for example, the recent PNB scam, or you take this ABG shipyard scam. So all these scams we have discussed in detail manner in our regular classes. So if you have paid close attention, if you take the PNB scam, 14,000 crores worth of scam, don't you think in the PNB bank there is no internal control? Yes, there is an internal control, but still 14,000 crores worth of fraud has taken place. Sir, how it has taken place? Why? Because even after implementing internal controls also, different people in the organization PNB have colluded with each other. Top level management, middle level management, clerk, outsider, everybody has colluded with each other and have committed a fraud. So sometimes internal controls can be bypassed even by collusion also. That possibility will always be there. And one more thing, misuse of authority. Those people who are required to implement internal controls, they might misuse their authority. Like management you take. So what the management can do is, for their own personal benefits, they can override the controls. For example, if one of the management, I will tell you one simple scenario. Board of directors, managing director remuneration is linked with the profits of the company. If he wants more remuneration, the company should perform well. So in order to get more profits, in order to get more remuneration, what this MD can do is he can inflate the profits of the company. Just for the sake of receiving higher remuneration, he can inflate the profits of the company. Possibilities are here. What is happening? The person is misusing his authority. Because of that, also internal controls can fail. And cost exceeding benefits. Implementing internal controls is not a simple affair. Implementation of internal controls is a very, very costly affair. Implementation of internal controls require investment in the form of humans, investment in the form of machines, investment in the form of infrastructure, investment in the form of systems. So implementation of internal controls is a costly affair. It requires a lot of money to be spent. So what some organizations will do is they will analyze what is the cost for implementing internal controls. And sometimes they will feel that whatever benefit they are getting from implementing internal control, that is far less when compared to the cost. For example, one supermarket has appointed 2 security guards to prevent the theft. They have appointed 2 security guards. So for each security guard, they have to pay 15,000 rupees of salary. So 15,000 into 2, every month 30,000 rupees of salary they have to pay. So for 12 months, if they calculate, they have to incur a salary cost of 3,60,000 rupees per annum for implementing this simple internal control of security guard. If at all no security guards are there, theft will happen. But maximum in the entire financial year, the theft will happen for the amount of only 50,000. So to get a benefit of 50,000, they have to incur a cost of 3,60,000. So sometimes because of costly affairs in the internal controls also, management might not take the internal control seriously. That's why also internal control can fail. And also manipulations of assumptions and judgments. This is once again similar to this 4th point only. The management sometimes make the manipulations in assumptions. Like as I have told once again, managing director wants higher remuneration, but he will get more remuneration only when the profits are increased. In order to inflate the profits, what the managing director is doing is he's under creating the provision. For example, some debtors are about to go bankrupt. They should have created 100% of the provision, but in order to inflate the profits, they are not creating 100% of the provision. They are creating only 50% of the provision. Under provisioning they are doing to inflate the profits. So like this, those people who are in the top level management, they might manipulate the assumptions and judgments to convey wrong information in the financial statements for their own personal benefits. So these are all various limitations of internal control which can't be avoided no matter what you do. That's why we say no matter how effectively you implement internal controls, they can give you only reasonable assurance regarding achievement of objectives. They can't give you guarantee because of these inherent limitations. So what are that inherent limitations? Number 1, cost exceeding benefits. Number 2, cannot handle transactions of unusual nature. collusion among the individuals, misuse of the authority, and manipulations of assumptions and judgments. Clear? Next one. So this question is very general question number 7, which is talking about what should be the structure of internal controls. They might alternatively ask the question another way. They can say what kind of policies and procedures should be covered in internal controls. Or if I put it in other way around, what are some common controls which we will be able to find? We can also say common controls. Generally, what kind of common controls should be there in any organization? So even if they ask you the question, what is the structure of internal control? Or if they ask you the question, what are the policies and procedures that should be covered in internal control? Or even if they ask you the question, what common controls will be there in any organization? So that list has been given here. These are very much self-explanatory. Number 1, segregation of duties. The most common internal control which should be there in any organization is segregation of duties. One person should not be given the complete control of the transaction. From the beginning till the ending, one person should not be given complete control of the transaction. For example, if I am the person who is handling certain asset, for example, I am the person who is handling inventory, I am responsible for issuing and receiving the inventory. I should not be given the power to maintain the inventory records. If I am the person who is required to handle the cash, I should not be given the power to maintain the cash records. And also from the beginning till the ending, no single person should have complete control. One person should be a maker, one person should be a checker. This we always say, maker checker concept. So this kind of functions should be segregated properly. So if I give you a few examples here, the following functions are to be segregated. What are they? Authorization. Someone should prepare, someone should authorize, someone should execute. Whoever is having physical custody of the asset, like person whoever is holding the cash, the same person should not be given the maintenance of records. And not just that, there should be periodical rotation of the duties. You have to constantly change the duties of the person. One person should not be kept in the same job forever. This is what commonly happens in the finance departments of so-called listed companies. Tomorrow after you qualify your chartered accountancy, if you go and join a job in MNC, for example, you initially have been offered a position in the revenue department. After 2-3 years, they will ask you to change your role from department from revenue to sales, revenue to expenses, or from there to general ledger team. So like that, in the finance department of big companies, various departments will be there, but you will not be kept in the same job for so long. Why? Because if you are kept in the same role for so long, you will gain a lot of control. You will be able to influence so many people. You will be able to manipulate so many people. So that's why companies keep on changing your position. This we call it as rotation of duties. So one of the common internal control which should be there in any organization is segregation of duties. Apart from that, this point we have already covered. Authorization mechanism, authorization of transactions should be there. So if an entry is getting recorded in the books of accounts, it should be checked by someone, whether the details are correct or not, whether entry is going to correct account or not, whether amount is recorded correctly or not, whether correct party is debited and credited or not. So, and also if you take payments, check payments, companies will put a hierarchy. Up to 10,000 rupees, finance manager has to sign the check. From 10,000 up to 1 lakh, deputy finance head should sign the check. For all the checks which are greater than 1 lakh rupees, the finance head should check, finance head should sign. If the amount is more than 10 lakh rupees, CFO should sign. So like this, every company will have some authorization hierarchy will be there. According to that hierarchy, authorization must be there. So that is the second common internal control which should be there in any organization, which is authorization of transactions. Then we have adequacy of records and documents. There should be adequate documents. There should be adequate records. If a transaction has been recorded in the organization, that transaction should have a lot of supporting documents. If a purchase entry is recorded in the books of accounts, there should be a record of the documents supporting the transaction, like purchase invoice should be there, purchase order should be there, goods receipt note will be there, inspection report will be there. So like that, there should be proper documentation. And also entries should be promptly recorded. That too at the correct amounts entries should have been recorded. They should be classified in the appropriate accounts, revenue classification, capital classification, that should be properly done. It should be recorded in the proper period also. It should not be postponed to next year's or preponed to this year's. It should be recorded in the correct accounting period. So yeah, and also there should be accountability for assets, and these records, whatever you are maintaining, that should be protected from unauthorized access. So these records should not go and fall in the hands of unauthorized persons. Only authorized persons should be able to see it. So you should have proper controls over records and documents. And finally, there should be some internal controls for safeguarding the assets also. From the time of acquisition of the asset till the time the asset is disposed of. The moment you are buying the assets, till the time you are selling it, at all the stages, the asset should be properly safeguarded. Sir, how the assets can be safeguarded? By way of physical controls. Sir, what kind of physical controls? Like as I have told, CCTV cameras, security guards, biometric devices. So by using these physical controls, you should be able to safeguard the asset. Not just that, you have to do physical verification, periodical physical verifications also you have to do. Fixed assets physical verification you have to do. Inventory physical verification you have to do. Computers physical verification you have to do. So proper physical verification also you are required to do. And unauthorized person should not be given access. Only authorized person should be given access to the systems. So through these means, even entities assets also should be safeguarded. Accountability, responsibility and safeguarding of assets. Next, independent checks. Now whether in the organization all the activities are happening properly or not, that independent checks also should happen. Generally, for this example is internal audit. Internal audits we have. So internal audit is an example of independent check, or even you can call, in the case of banks, there will be something called concurrent audit. So what are these internal audits and concurrent audits? These are basically nothing but independent checks. Whether whatever has been planned in the organization, whatever policies have been set in the organization, those policies are actually happening or not, someone should independently come and verify, like an internal auditor or concurrent auditor. Periodical checks also should happen. So these are most common internal controls which should be there in the organization. So 5 examples I have told. There is a very rare chance or remote chance they asking a question about this, but one part of the question, one part or one paragraph they can ask as a question. Like they might ask you about write about segregation of duties, or they might ask about write about safeguarding of assets. They might ask about authorization mechanism. One part of the question can be tested. Clear? Next. Now coming to the next important concept, which is what are various components of internal control. What are various components of internal control? So in an organization, if an internal control has to be implemented effectively, it must contain 5 components. The internal controls in the organization will be built up of 5 components. Sir, what are that 5 components? The 5 components of internal control are: number 1 is control environment. Number 1 is control environment. Number 2, entities risk assessment process. Number 3, we have control activities. Number 4, we have information system including related business processes relevant to financial reporting and communication. And finally, monitoring of the controls. So what are the 5 components, guys? Repeat everybody. Number 1, control environment. Number 2, entities risk assessment process. Number 3, information system including related business process. Number 3 is control activities. Number 4, information system including related business process. 5th one is monitoring. Sir, what happens in each of this component? What does each of this component mean? I will try to put it in simple terms. Control environment. Sir, what is control environment? Control environment means creating a good culture in the organization. See, if in an organization, if you have to implement internal control, unless there is a good culture in the organization, unless there is a culture of honesty and ethical behavior in the organization, no matter how good policies you bring, internal controls will definitely fail. Take a typical scenario. For example, the management in the organization are not ethical people. They are not having integrity. They are well known for committing frauds. In that organization, culture itself is very bad. People are not honest. People don't have ethical behavior. So they are not at all honest. In that organization, you tell me, if you bring excellent policy of internal control, do you think that is gonna work? Definitely it will not work. So first thing, if you want to implement successfully an internal control in the organization, work on control environment. Create a good environment, create a good culture, create a culture of honesty, create a culture of ethical behavior. If you create a good culture first, then you implement internal control, see the result, it will work like wonders. But if you are not concentrating on the culture, just you are concentrating on policies, all your internal controls are waste of time. So first thing which the management has to concentrate is creating a good control environment, creating a good culture in the organization. After that, the next thing is entity should do risk assessment. Like the way auditor is studying the organization and identifying the risk of material misstatement, management also should study about their own organization, find out where there is a chance of happening of misstatement in the organization. Basically, internal controls are getting implemented to prevent the mistakes from happening. So in order to prevent the mistakes, first organization should know where there is a chance of happening of mistake. So that's why the management should study about their organization in a deeper manner, find out in which areas there is a chance of happening misstatement, then you can implement internal controls effectively. So that is the second point. Organization should study about themselves and find out where there is a risk of happening of misstatement. Then once you have identified the risk assessment, once you have found out what and all risks are there in your organization, the third step is control activities. Now you have to start planning for internal controls. Control activity means actually what kind of controls you have to implement. Like for example, as I've told, segregation of duties, in which area I have to segregate the duties, where I need to implement authorization mechanism, where I need to do independent checks. So you have to start planning for the control activities. Nothing but actual policies you have to design here. Fourth one, information system including related business process. Today, as we all know, organizations are making extensive use of technology. Today, internal controls are also implemented through a system. Like for example, CCTV cameras. That is a what internal control system which is completely dependent on information technology. If you have visited a supermarket, when you want to bill some items, if you have done a shopping, filled your trolley, you went to the counter, there the person will not enter the prices manually, he will scan the barcode. Once the barcode is scanned, price and discount will get automatically captured. That is also internal control, but that internal control is also implemented with the help of software. So today, so many controls are getting implemented through a system. Today, accounting softwares are examples of internal control mechanism. So like this, today in this environment, a lot of internal controls require information system. So the organization should identify what kind of software they want, what kind of hardware they want, what kind of network they want, what kind of infrastructure they want to implement this internal control. So they have to study all that IT infrastructure and procure and implement that information systems to make sure that controls are working. And finally, after you have installed that information systems also, that's all, your responsibility will get over. You created a good culture, you studied the risk, you designed the policies, you procured the systems. That's all. Responsibility will be over. No, responsibility will not become over. You need to monitor also whatever controls you have implemented till date, whether those controls are working effectively or not. That monitoring also you have to do. Just implementing and leaving out is not going to work out. You need to monitor, you need to review periodically whatever controls we have implemented in the organization. Are they working effectively? Is there any changes required to be made? Are there any modifications required to be made? This continuous monitoring is also required. If you don't do the monitoring, then your controls are not working effectively. So in order to implement internal controls in the organization, it has to go through all these 5 components. Repeat the 5 components, guys. Number 1, creating a control environment. Number 2, doing the risk assessment. Number 3, control activities. Number 4, information systems. Number 5, monitoring. So regarding these components, they will try to explain it here in a detailed manner. Just I will take you through the important points. Like first thing, if you have to see control environment, the organization should create culture of honesty and ethical behavior. So now how the management can create that good environment, sir? By way of communication. The management has to communicate to their staff. Boss, integrity is very important. Honesty is very important. Communication alone will not be enough. You have to enforce also. Like if the management finds some employee who is dishonest, who is committing some fraud, who is committing some theft, they have to immediately fire him. They have to immediately remove him. They should not tolerate. So if the organization wants to create a good culture, they have to communicate. Communication alone will not be enough. They have to enforce also. They have to put into action also. Number 2, commitment to competence. The management should always be committed to the capable persons. At the time of recruiting, recruit only capable persons. Don't give importance to recommendations and all. Organization should always show their commitment to capabilities. Next, participation by those charged with governance. Those top level management should not always sit in their cabins and chill out. They should frequently come and participate and monitor what the low level management and low level staff are doing. The more those charged with governance involves in the business, the more effective internal controls will be, the more good culture will be created. The less they participate in the business, they are always sticking to their cabins, they are not coming out of their cabins. Do you think a good control environment will be created? Definitely not. Next, management philosophy and operating style. They should have a good philosophy. They should have a good operating style. They should always try to focus on passing on good information to the shareholders. They should not be always interested in increasing the share price of the company. If they find even minute mistakes also, they should have a style of rectifying it in a regular manner. So they should have good philosophy and operating style. And organizational structure. There should be a proper structure in the organization. For doing any activity, there should be a process. There should be a framework, not like randomly things are happening. And assignment of authority and responsibility. As I've told, proper authority should be there. You have to divide the responsibility. You have to implement the authorization mechanism. So if to someone you are giving a responsibility of doing some task, to the next higher level of person, you should give authority to approve it. So that division of authority and responsibility should be there. And even in your HR policies also, you should implement some kind of communications, some trainings you have to conduct to your staff. What is the importance of creating a good culture, and you have to train them on a recurring basis. So that's what they say. Through your policies, you have to demonstrate, you have to show important matters in relation to control consciousness. And also you have to train what are the roles and responsibilities, what is expected from them. And even you have to do periodical appraisals also. Periodically you have to verify whether this employee is acting in a proper way or not. If the management implements these steps, then a good control environment can be created. Next one, as I have told, the organization should study about themselves and find out the risk. See, risk can happen from various ways. From various sources the risk can arise. Here they have given a few examples. So this part is very, very important. A risk can arise because of various circumstances. Because of what circumstances risk can arise? Changes in the operating environment. Like traditionally, organization used to work in a manual environment. Now they have converted to technological environment. Because of change in the operating environment, new risk will come. Or change in the management. Recently, all the board of directors have been replaced. So now there is a change in the operating environment. This could also lead to new risk. So risk can happen because of changes in the operating environment. New personnel, when you recruit new people, then also the risk can happen. New or revamped information systems. If you have brought new software, previously you are using Tally, now the company has advanced to SAP. This could also lead to new risk. Rapid growth. Some organizations just like that grow in a short span of time. This happens in the case of startups. So the company in the initial 1-2 years, they are making hardly 10 crores amount of turnover. In the third year, all of a sudden 100 crores of revenue. So when you are growing very rapidly within a short span of time, if you are growing, this would also give rise to new risk. New technology, this is basically just a repetition. I will say C and D points both are same. New or revamped information systems or new technology, both are one and the same. And new business models per products or activities. When a company has added a new product, when they have added new models of doing the business, this will also give rise to new risk. Corporate restructuring, like mergers, amalgamations will happen. Then also it will lead to new risk. Expanded foreign operations, all of a sudden a company has expanded to the export market. They have opened an office in US, they have opened an office in UK. So when you are expanding into foreign operations, now foreign risks also will come, especially risk related to foreign currency transactions. And new accounting pronouncements. Sometimes new accounting standards will come, new NDAs will come, new Schedule 3 requirements will come. That could also pose a significant risk. So these are all the various circumstances which could lead to giving rise of the risk. Then as I have told, control activities. Now you have to, in this stage, you have to actually decide which kind of policies you have to implement. A few examples of control activities they have given. Performance reviews, periodical reviews you have to do. Like you can compare actuals with the budgets, or you can compare operating data with the financial data, or you can do various kinds of analytical procedures you can do. So performance reviews, like review and analysis of actual performance with the budgets, forecast, and last year's performance. Relating different sets of data, like operating data comparison with financial data, or comparing internal data with external sources. Basically various kinds of analytical procedures. Next, information processing. When it comes to internal controls over systems also, there will be various kinds of control, like there will be application controls, general IT controls. This we will see more regarding digital audit. In the digital audit, you will come across this. Very simple. General IT controls are the controls operating over entire organization. Application controls are those controls which are working on specific app. Like for example, for your mobile device, if you have set a face ID recognition unlock. So if this device has to open, then I have to show my face ID. So if it recognizes, then only device will get unlocked. This is a general control. Now inside each and every app, for example, for my WhatsApp, there is a separate password I have set. That is a application control. So screen log is a general control. The passwords which you have for each and every app, that is a application control. If I put it in simple terminology, more you will get to know when we take up the digital audit. Then you should have some kind of physical controls. I have already given you an example. Physical controls means CCTV camera, security guards, and physical verification. All this will come under physical controls. Segregation of duties, we have already covered. There should be proper segregation of duties. We have already understood in a detailed manner. So that is the third component of internal control, that is designing the policies. Now finally, fourth step, as I have told, information system including related business process. Today for implementation of internal controls, we need information system, we need infrastructure like software, hardware, people, procedure, data, and we have to make extensive use of technology and whatever information systems that we are using for financial reporting. Basically, they are talking about accounting softwares. Whatever accounting softwares we are using, they should be able to identify all valid transactions. They should be able to properly classify the transactions. They should record the transactions at a proper value, and they should record in the correct accounting period, and they should present properly all the related disclosures in the financial statements. So in case if you are using accounting software, it should have these capabilities. Okay, why? Because if your information system is correct, then the data generated from the information system will be correct. Today the managements are taking the decision purely on the basis of data, and where they are getting all this data from the software. If the software itself is not okay, then the decision making capability of the management will not be good. So that's why today it is very important to have a proper information system. Next, finally, monitoring of the controls. As I've told, just implementing the controls alone will not be enough. Periodically, you have to review whether those controls are working effectively or not. So like various things you can do, you have to monitor controls like whether really BRS is getting prepared or not, whether internal auditor is properly evaluating the sales contracts or not, whether legal department is working properly regarding compliance with the laws and regulations or not. So like that, whatever internal controls are there in the various departments, all that internal controls you have to periodically monitor. Clear? So this information is very general, you can read and understand it. So these are the 5 components of internal control. From the components of internal control, definitely there will be a question. So very, very important concept. Now coming to the next concept. So now I would like to revise one more concept regarding internal control. What are various techniques of evaluation of internal control? Once again, an important concept from the examination perspective. This we will cover. After this, we will take up the concept of internal check. A small concept is there regarding internal check, that if we cover internal control part, revision also will get over. So, but before we go to internal check, so first we will try to cover this. What are the various techniques for evaluation of internal control? So basically, evaluation of internal controls means, as an auditor, as I've already told you, we need to verify internal controls. We need to obtain audit evidence whether internal controls are operating effectively or not. So in order to evaluate that internal controls, in order to test that internal controls, in order to verify that internal controls, what techniques are available? In order to verify that internal controls, what techniques are available? So broadly speaking, there are 3 techniques available for evaluation of internal control. How many are available? 3 are available for evaluation of internal controls. What are they? Number 1, they say questionnaire. Number 2, they say checklist. And number 3, they say flowchart. I will try to simplify the concept. So first we will try to understand what is the flowchart technique. Flowchart technique you are already aware. So in the flowchart technique, what auditor will do is he will go and study the internal control. He will try to understand how the internal control is working from the beginning till the ending. What are the different stages involved? Who are the different people involved in this internal control from the beginning till the ending? What and all processes are involved? Who and all are the people involved? What and all documents are involved? He will do a careful study of internal control from beginning to the ending. Then he will try to present that understanding in a pictorial format, in a diagrammatical format by way of charts. So that technique we are going to call it as flowchart technique. So he will study the internal control from the beginning till the ending. He will try to identify who are involved in this process, which people are involved, which documents are getting generated, and whatever he has understood, he will try to present everything in a pictorial format, in a diagrammatical format. That technique we are going to call it as flowchart. So if you see here, flowchart is a graphical presentation of internal controls in the organization. So if you look at the flowchart, it is the most concise and comprehensive way of presenting internal control. It is the most concise way. In the form of one simple chart, the auditor is trying to summarize the entire internal control. So out of all the methods, which one will give most concise view of internal control is flowchart. And not just that, it gives a bird's eye view. By looking at the internal control, you will get the overall view of internal control, and even you can easily spot the errors as well. So essentially, a flowchart is a diagram with full of lines and symbols, and it is the most effective way of presenting a internal control. So basically what will be there in the flowchart is at what point a document is raised, what is the starting point, how many number of copies of the document is getting generated, in between what and all intermediate stages are there, to whom these documents are getting distributed, who is authorizing, who is filing, what is the final outcome. So this entire process we are going to present it in a diagrammatic format, that we are going to call it as a flowchart. Then we have two most widely and very popularly used methods or techniques for evaluation of internal control, which are questionnaire and checklist. So now what is this questionnaire and checklist? See, in both the questionnaire and checklist, auditor is going to draft the questions. Who is going to draft? Auditor is going to draft the questions regarding elements of internal control. Regarding various aspects of internal control, he will draft the questions. And the questions will be drafted in such a way that the answer will be yes or no or not applicable. Like questions will be drafted something like, for example, in cash related payments, I want to verify internal control. Now I will draft the questions. Is a cashier preparing a voucher? Question mark. Is voucher signed by the manager? Question mark. Is cashier passing accounting entry? Question mark. Are the vouchers are serially numbered? Question mark. So like this, regarding various aspects of internal control, I will draft the questions, and the questions will be drafted in such a way that the answer will be either yes or no or not applicable. Now, in both the cases, auditor will draft the questions regarding elements of control, and in both the cases, questions will be drafted in the manner of yes, no or not applicable. Then what is the difference between the two, sir? The difference will happen in who is going to give that answers, who is going to fill that answers. In the case of questionnaire, what will happen is auditor will draft all these questions in a piece of paper, and that draft will be given to the management. Either the client's management or client's staff will fill the responses, give it back to the auditor. And the questionnaire, what will happen after drafting all the questions? He will take a printout or he will send a soft copy to the management. Now either the management or the client's staff, they will fill the answers to these questions and give it back to the auditor. Now the auditor, depending on that answers, he will analyze whether internal controls are working effectively or not. On the other hand, in the case of checklist, what will happen is auditor will draft all these questions. He will draft it on a piece of paper or he will keep it a soft copy. He will not give it to the client. He will call his own staff. He will call the auditor's staff, ask them to go and follow that instructions or ask them to go and get back with the answers. Clear, everybody? Able to understand? So in both the cases, questions are going to be there, but the only thing which is changing is who is going to fill that, responses. So in case of questionnaire, those questions will be filled by the client's staff or client's management. In the case of checklist, that questions will be filled by auditor's staff only. And depending on that answers, auditor is going to evaluate whether internal controls are working effectively or not. So that is what basically checklist and internal control questionnaire. So this is a brief concept. You can read it and go through the entire content with this background understanding. You will be able to easily understand it. Clear? So these are the three techniques which are available for evaluation of internal controls. Hope everybody is clear with this. Now we will discuss a concept called internal check. Very small and simple concept. So write a short note on internal check system. Sir, what is this internal check system? I will say internal check system is actually one of the component of internal control. So internal control is a very broad term. In that, one of the component is internal check. And if I further simplify, internal check system is nothing but an other name for segregation of duties. Internal check is nothing but another name for segregation of duties. What did I tell you regarding segregation of duties? Segregation of duties means one person will not have complete control over the entire process. One person will do the work. That work will be checked by another person. So nothing but you have to design the activities in such a manner that the complete process is not in one person's control. It is getting divided among different people. You should not give complete control of one entire process in the hands of one single person. You are going to divide the work among different people so that no one will have complete control over it. So this we call it as segregation of duties. The same thing they will say even for internal check system also. If I put it in simple terms, internal check system is nothing but other name for segregation of duties. If you are not convinced, you read it, you will get it clear. So if you see here, internal check system implies organization of overall system of bookkeeping and arrangement of staff duties in such a way that no one person can carry through a transaction and record every aspect thereof. That means you are trying to convert accounting process in such a way that no one person can carry through a transaction and record every aspect. That means you are designing accounting process in such a way that you are not giving complete control to one person, you are dividing among different people. So this is what I have also called as segregation of duties. So it is a part of overall control system. As I've told, internal check is one of the component of the internal control system, which operates basically as a built-in device as far as organization and job allocation aspects. So it is generally in the organizations that the works are divided in such a way that one person will initiate, one person will verify, another person will give approval, and finally one more person will record it. So this system provides existence of checks on day-to-day transactions which operate continuously as a part of the routine system. Like, for example, I have designed my accounting system in such a way that cashier will write an entry. He will write a voucher. That will go to manager. He will verify the details and he will sign it. Then that voucher will go to accountant. Now accountant will check the details once again. He will check the manager's signature. Then he will pass the cash payment entry. This is their day-to-day job. And if you pay close attention here, as a part of their day-to-day job, the manager is verifying the voucher prepared by the cashier. The accountant is verifying the signing of the voucher by the manager and voucher prepared by the cashier. So their duties are devised in such a way that one person is automatically verifying the work of another person. So this system we are going to call it as internal check system. Sir, why we need internal check system? What are the objectives of internal check system? More or less it will be similar to internal controls only. The following are the objectives of internal check system. It will be helpful for the organization to detect frauds and errors. It will avoid and minimize the possibility of commission of errors. Since the work of one person is being checked by others, it will minimize the possibility of happening errors. It will increase the efficiency of the staff. The work of the staff also will become very good. Why? Because they will have a fear in mind. If I commit any mistake, the other person will find it out. So it will lead to overall improvement of the work of the staff. We can also easily locate responsibility. That means if something goes wrong, we can easily find out which person has committed the mistake, and it will protect the integrity of the business. Nothing but by ensuring that accounts are always subject to proper scrutiny. Because of internal check system, the transactions are getting scrutinized on a continuous manner. It will increase the trust over the books of accounts also, and it will prevent and avoid misappropriations. It will even prevent and avoid theft misappropriations also. Next one. So this C point, the effectiveness of efficient system of internal check depends on some considerations. Whether internal check system will be effective or not, it depends on some factors. Whether internal check system in the organization is successful or not, it depends on some factors. What are they? Clarity of responsibility. While you are dividing the responsibilities, you have to clearly explain to each and every employee what is your responsibility, what will fall in your scope of work, what you are supposed to do, what you are not supposed to do. That you have to clearly communicate. If the staff are clear about the responsibilities, successfully internal check system will work. And also you have to divide the work. You have to properly divide the work. You have to divide the work in such a way that one person is not having complete control. And also you should rotate. This point I have already told you, you have to do rotation of the employees also. And standardization to the extent possible. Whatever process you have set, that you have to document it. In a document you have to prepare and paste it somewhere. Boss, this is your responsibility. This is your responsibility. This is how the process has to be executed. Standardization you have to do. That only we call them as, that documents only we call it as SOPs, standard operating procedures we call them. And then finally, appraisal. Not just dividing the responsibilities, periodically you have to verify also. Performance reviews also you have to do. So whether internal check system will be successful or will not be successful, that depends on these factors. Whether there is a clarity of responsibility, whether the work is divided properly, whether there is a standardized system for doing everything, and also periodical appraisals. The same thing, what are the general conditions pertaining to internal check system? Whatever we have discussed above, all that things will be repeated here once again. So this you can manage it. Clear? So that's all regarding internal control part, guys. I have covered majority of the concept regarding internal control. Here and there, one or two questions are left out. Those are actually covered somewhere else. Like if you see here, write about internal control assessment and evaluation. Here also they say what is standard operating procedure. Just now I have told what is SOP. They say segregation of duties. They say job rotation. So all this we have already covered. So rest of the questions you can manage. But whatever major concept is there, which is very relevant for the examination, so all that things I think I have covered regarding the risk, regarding the internal control part. So our chapter contains 3 parts. risk assessment, internal control, and materiality. Risk assessment part we are already done with. Now we are done with internal control part. We have last one small part, materiality part is there. Will not take much of a time. In 10 to 15 minutes, we can wind up the materiality related revision also. So now we will try to revise the concept regarding materiality. See, as I've already told you, in this chapter, 3 parts are there: risk assessment and internal control part, whatever we have completed. So that is actually the content from essay 315. And whatever discussion regarding materiality that we are going to have now, so we are in fact trying to revise essay 320. So let us try to understand what is this concept of materiality and what does essay 320 say about it. I've already told you at the beginning itself, while we are discussing introduction to the audit, as an auditor, one of our objective is we are required to express an opinion whether financial statements are free from material misstatement. So what is the essay 2? That is actually the objective of the auditor as per essay 200. So they have told that we are required to express an opinion whether financial statements are free from material misstatement. So there I have already explained what is the meaning of the term material. Material means something which is significant, something which is major, something which is important. A misstatement will be considered as material if it could influence the decision of users of financial statements. When a misstatement will be considered material, a misstatement will be considered as material if it could influence, because of a misstatement, if a user of the financial statement is going to change his decision, then we could call them as material. See, materiality is something which is very relative term. It changes from person to person, it changes from circumstance to circumstance, it changes from company to company, it changes from the financial year to year. So it is all a relative term. Whatever is found as material in one organization, the same thing might not be material in another organization. So the example which I have used earlier, for example, in the case of Reliance Industries Limited, there is 5 crores worth of misstatement which we might not consider it as material, keeping in mind the size of the Reliance Industries Limited. But if the same 5 crores amount of misstatement happens in some another company X Limited, which is hardly having a turnover of 100 crore rupees, there we will call it as material. So what is material, what is not material, it all depends on the facts and circumstances. The term materiality is a very relative term, it is a subjective term. But if someone is asking you to define material misstatement, you should say a misstatement will be considered as material if it could influence the decision of users of financial statement. Because of a misstatement, some user is going to change as a decision, then we consider that misstatement as material. Now, how to determine materiality, sir? Sir, I'm conducting audit of the financial statements. I have been appointed as auditor of the client X Limited. So, as you have told, first I have to determine materiality. What is material for this company? What is not material for this company, that I have to determine. Sir, how to determine that materiality? The standard says you have to determine materiality using your professional judgment. How I have to determine materiality? I have to determine materiality completely using my professional judgment. There is no hard and fast rule there here. You have to use your knowledge, you have to use your experience, you have to use your training, and accordingly you have to determine what is material. But essay 320 has given you approach. It ultimately says materiality has to be determined on the basis of professional judgment, but it has given you some guidance. Sir, what guidance standard has given? The standard says an approach for determining materiality. It says you have to determine one percentage. Sir, how much value? How much percentage? Once again, professional judgment. So you have to determine one percentage using your professional judgment. That could be 5 also, 10 also, 15 also, 2 also, 20 also, whatever it is. Using your professional judgment, you have to determine a percentage, and that percentage you have to multiply with benchmark. That percentage you have to multiply it with benchmark. Then you will get something called a resulting figure. You will get that figure will be considered as materiality level. So let me give you one simple example. Sir, in my professional judgment, I considered 5% as material. Now this 5% should be multiplied with a benchmark. Sir, what could be benchmark? Benchmark could be anything. Benchmark could be any item of the financial statement. It could be total expenses, it could be total incomes, it could be net profit, it could be turnover, it could be gross profit. So it could be fixed assets, it could be current assets. So it could be any item of the financial statements. It could be profit before taxes. So depending on your professional judgment, out of all these options available, you have to choose one benchmark. For example, I have taken turnover as a benchmark. What I have taken? I have taken turnover as a benchmark. Now I have to determine what is the turnover. I have determined the turnover as 100 crore rupees. So I have determined one percentage on the basis of my professional judgment, and using my professional judgment, I have determined the benchmark. When I multiply that, I will get a resulting figure. Here, the resulting figure is 5 crore rupees. Now, this 5 crores will be kept as materiality. So, what is the significance of this 5 crores of materiality is, if I have conducted the audit and I performed audit procedures, I obtained audit evidence. On the basis of that, I have found out the misstatement. If the misstatements, whatever misstatements I have found out, I will aggregate it. Collectively, I will determine what is the amount of the misstatement. If the misstatement, whatever I have found, is less than 5 crore rupees, I will not consider it as material. I will give an unmodified opinion. On the other hand, if the misstatements collectively, if they have exceeded, if they are greater than or equal to 5 crore rupees, then I will consider that as a material misstatement. Then I will give a modified opinion. Clear, everybody? So this is what the approach for determination of materiality. So what is the approach? Determine one percentage, multiply that with a benchmark, you will get resulting figure that will be determined as materiality. And also SA 320 says one more thing. You have to determine materiality at two levels. You have to determine materiality at two levels. So as you could see here, we have to determine materiality at two levels. One is overall materiality and the other one is performance materiality. We need to determine materiality at how many levels? At two levels. One is overall materiality and the other one is performance materiality. I will give you an example to make you understand. Take for example, this is a balance sheet of some company you are conducting audit. Now we have fixed assets as 100 crore rupees. Under current assets, you have inventory 50, trade receivables 30, and you have cash and cash equivalents of 20. The total amount of assets is 200 crores. Now, first I will determine a materiality level for entire financial statements. I am feeling that if in my balance sheet, I have determined one percentage as 10%, and I am multiplying it with the total assets as my benchmark, and the resulting figure which I got is 2 crore rupees. So I am saying that, 20 crore rupees. So I am saying that in my entire financial statements, if the total misstatements are beyond 20 crore rupees, then I will consider them as material. I have decided if in my entire financial statements, if the total amount of misstatements exceeds 20 crore rupees, then I will consider it as material. So the moment I say this, this is my overall materiality. This 20 crore rupees of figure I have decided as a materiality for the entire financial statements. So the materiality level which you are fixing for the entire financial statements, that we call it as overall materiality. Okay, here my overall materiality is 20 crore rupees. Now I am feeling that determining one level of materiality for the entire financial statements alone will not be enough. Why? Because take for example, if in fixed assets 2 crore rupees of misstatement is there, I will ignore it. Why? Because it is far below my overall materiality. If in inventory some 7 crores misstatement is there, I might ignore this because it is far lower than my materiality level. If in my trade receivables 5 crores misstatement is there, that also I will not consider because it is far lower than my materiality level. Like this, in multiple items, there could be small misstatements which individually might not be material, but collectively they could be material. But if I fix only one materiality level for the entire financial statements, I might miss out on the small misstatements which could be collectively material. So that's why SA 320 asks you to do one more thing. You decide materiality for the entire financial statements as a whole. In addition to that, for each class of transaction also, for each class of transaction, for each account balance, you can set a separate level of materiality. Like I am feeling that if in the fixed assets, 5% into 100 crores fixed asset value, if in the fixed assets 5 crores worth of misstatement is there, then I will consider fixed assets as materially misstated. In the inventory, take for example 5% into 50 crore rupees. If in inventory 2.5 crores of misstatement is there, then I will consider inventory as materially misstated. If in the cash and cash equivalents, if 10% into 20 crore rupees, that is 2 crore rupees. If in the cash and cash equivalents 2 crores of misstatement is there, then I will consider cash and cash equivalents as materially misstated. So this materiality, whatever you are setting for each item of the financial statement separately, that we call it as performance materiality. What do we call that? Performance materiality. So what is overall materiality? What is performance materiality? The materiality level decided for the entire financial statements. I call it as overall materiality. The materiality level which I am deciding for each item of financial statement separately, that I call it as performance materiality. You tell me which one should be a bigger figure. Overall materiality will be a bigger figure. comparatively performance materiality will be generally lower than overall materiality. This is very important for MCQs. Which one will be lower? Performance materiality will be lower than overall materiality. So whatever it is, you have to decide materiality at two levels, and this is the approach. What is the approach? Take one percentage, multiply it with benchmark. Now you will get a doubt, sir, you have told benchmark could be various options. For selecting benchmark, various options could be there. Turnover could be a benchmark. You told fixed assets could be a benchmark. You told net profit could be a benchmark. You told total expenses could be a benchmark. Net worth could be a benchmark. So these many options are there now. How the auditor will choose one? This also depends on the professional judgment, but for selection of the benchmark, there are certain factors which auditor will consider. That means auditor is going to consider these factors, and keeping these factors in mind, auditor will select a benchmark. Sir, what factors will affect identifying benchmark? So like, first of all, any element of the financial statement can be selected as benchmark. Sometimes there will be an indication in applicable financial reporting framework. What can be taken as a benchmark? Sometimes there could be indication in applicable financial reporting framework. Like Schedule 3 is telling any item which is more than 0.5% of the turnover, stated separately. Now indirectly there is a hint in Schedule 3, turnover can be taken as a benchmark. Or it depends on entity's capital structure, ownership structure. If the entity is more equity financed, then we can take total assets as our benchmark. When entity is more debt oriented, we can take total borrowings as a benchmark. So it depends on entity's capital structure. It also depends on information needs of majority of users in the industry. In an IT company, people are more interested to know about the profits. So if I am conducting audit of an IT company, net profit, I will take it as a benchmark. If I am conducting audit of a FMCG company, people are more interested to know about turnover. So in a FMCG company, I will select my turnover as a benchmark. So it depends on information needs of majority of the users. And also it depends on applicable law or regulation. Sometimes law and regulation itself will tell you what is material, what is not material. Like if you take under Income Tax Act 40A3, if any cash payment is made more than 10,000, it will be disallowed. Now you tell me what will be the materiality level for cash payments? 10,000. How you have decided? It is there in the applicable law and regulation itself. So keeping all this factor in mind, and the auditor using his professional judgment, he will decide which benchmark will be suitable, and to that benchmark he will apply percentage. Now, sir, auditor has considered all these factors and he has decided that he will take turnover as a benchmark. He will take turnover as a benchmark. Now, from where turnover figure should be taken? What is the source for this benchmark? Okay, sir, just now you told what are the various factors which auditor will consider for selection of benchmark. So after considering all the factors, auditor has decided I will take turnover as a benchmark. But this turnover figure, from where they have to take? If the current year financial statements are already ready, from the current year financial statements only they can take benchmark. In case if the current year financial statements are not ready, then they have to look for other sources. They can take it from the previous year's financial statements, they can take from the quarterly financial statements, or even they can take from budgets also. So simple thing, if current year financial statements are ready, no need to look for any other sources. From the current year financial statements, take the benchmark. If current year financial statements are not ready, then you can look for other sources like previous year, quarterly, budgets, etc. And in financial statements, sometimes there could be some items where they will be very small amount, still they will be considered as material. In some organizations, there will be very small amounts, immaterial amounts will be there. The amounts which are far lower than the materiality level set by the auditor, still they influence the decision of users. Any examples? So the examples are, take for example, managerial remuneration. The managerial remuneration is very, very important. Might be in the entire Reliance Industries Limited, the entire team of board of directors is drawing only 5 crores worth of remuneration. This is very small figure when compared with the turnover of the Reliance. But still this is material. Why? Because shareholders want to know how much remuneration managing directors are drawing. Related party transaction. Might be hardly 1 lakh worth of related party transactions happened in the case of Reliance. Still that requires separate disclosure. Why? Because related party transactions are considered material even if the amounts are very, very small. So like this, there could be certain examples of circumstances. There could be certain items of the financial statements where the amounts are very, very small. Still they will be considered as very material, like managerial remuneration, related party transactions, etc. Clear? So what and all we have seen till now? So how to determine materiality? This we have seen. 2 levels of materiality I have told. What are the factors in identifying benchmarks? This we have seen. What are the various examples of benchmarks? I have told you. What from where you are going to select the appropriate benchmark. As I have told, if current year financial statements are ready, from current year, if not, from other sources. Then comes the next part. Sir, at the beginning of the audit, I decided my materiality level. Is there a rule that whatever materiality I have decided at the beginning of the audit, till the end of the audit, should I follow the same level of materiality? Not required. If there is any requirement, you can revise the materiality levels also. There is no strict rule which says whatever materiality you have decided at the beginning of the audit, till the end of the audit, you have to follow same materiality level. There is no such hard and fast rule. Generally, at the beginning of the audit, we decide materiality. During the course of the audit, we can come across various circumstances that might require us to change our materiality level. If you come across such circumstances, you can happily revise your materiality. So some examples they have given. The overall materiality and performance materiality may need to be changed as the audit progresses. It is a common thing because of change in circumstances. Sometimes circumstances might change which require you to revise your materiality. Sometimes you might get additional information which might require you to revise your materiality. Sometimes you might have taken initially, since current year financial statements are not ready, from the budgets you have taken the benchmark. But after a certain period of time, current year financial statements are actually out, actual results are out. If there is a very big difference between actual financial results and budgets, then also you can revise materiality. Like for example, budgeted turnover was 100 crore rupees. After the actual financial statements are prepared, the actual turnover was 200 crore rupees. Since there is a huge difference, now you have to revise your materiality depending on actual financial statements. Or sometimes risk will increase, that might require you to change your materiality levels. Or sometimes auditor might have a additional information regarding client's business. Sometimes knowledge regarding client's business will change. Because of these circumstances, you might be required to revise your materiality, and you can happily do it. Standard has given the permission. And you need to maintain some documentation regarding materiality also. So what kind of things you should document? Like what is the materiality for the financial statements as a whole? What is your overall materiality? How you have calculated? You determine it and document it. And what is the performance materiality? That also you documented. What is the general performance materiality? That you document. In case if you have revised any materiality for, if you have revised any materiality during the course of the audit, document that revised levels of materiality along with the reasons why you have revised that materiality levels. So these are basically documentation requirements. So you have to document overall materiality, performance materiality, their calculation, any revision along with the reasons. So these things should form part of your documentation. So this is what regarding SA 320 talking about materiality. Clear everybody? So with this we are done with revising materiality related discussion also. So we are successfully done with the chapter risk assessment, internal control and materiality. Hey guys, welcome back to the revision series. So in the previous session, we are successfully done with revising the chapter risk assessment and internal control and also materiality. So now in this session, we are going to revise our next chapter, which is audit planning, strategy and execution. Comparatively very small chapter than the chapters whatever we have revised it till now. This chapter is comparatively very small, very limited conceptual discussion will be there. So we can easily wind up this chapter in somewhere around 30 to 45 minutes. So quickly we will try to wind it up. Sir, what basically all this chapter is about? As the name itself says, this is the chapter which is going to talk about planning of the audit of the financial statements. This chapter is mainly going to concentrate on, not mainly concentrating, the only concentration of this chapter is regarding planning of the audit. How we are supposed to do the planning for the audit of the financial statements. What are all the various steps involved in the planning process? So how we have to execute that plan. So we are going to talk more about this. And whatever discussion we are going to have in this chapter, all that discussion has been taken from SA 300. So when I say I am revising the chapter audit planning, strategy and execution, in fact, I am trying to revise the content from SA 300. So SA 300 is a standard which is going to talk about the planning of the audit of the financial statements. Now, let us go into the chapter now. Guys, as we all know, to do any activity, we do a lot of planning. Planning is the most important thing. If you don't have a plan, then you are not going to make anything happen. Like for example, take an example. If I am taking this marathon series, if I am taking this revision series, I have planned this revision series well in advance. So for each chapter, how many hours I have to spend, what will be the total duration, what is the order of the chapters which I have to take, so in which chapters I have to spend more time, and also in each chapter which things I have to concentrate more. So like that, before these videos are getting recorded, I've spent a lot of time in planning. You also do a lot of planning it for your personal activities as well. For example, you want to have a trip along with your friends. So you are going to spend significant amount of time in the planning of the trip or not. So when you are going to start, what is the mode of travel? So what will be the starting point? What will be the ending point? How many days you are going to spend there? During that days, what and all places you are going to visit? So like that, for any activity, planning is going to be damn important. If you have a perfect plan, then there are more chances that that activity will happen. If you just jump without any plan, the outcome will not be certain. So that's why for any activity, we do a lot of planning. Even auditing is also not an exception. So I'm a practicing chartered accountant. Just imagine I'm a practicing chartered accountant. One day a client has come to me, a client X Limited has approached me and he asked me, sir, please act as an auditor for our company. Please do the audit of the financial statements of our company. And he quoted some attractive price also. I said, yes, okay, I want to make money. I told, okay, sir, you pay me the fees, I will do the audit. Now, after you have accepted the audit, one fine day you have to start doing the audit. One fine day you have to start going to the client's premises, verify their books of accounts, verify their financial statements, obtain the audit evidence, and also try to form your opinion, give you a report. All these activities you have to actually execute. Don't you think before I actually start performing the audit, do I need to spend some time on planning of the audit also? 100% yes. So like the way we do the planning for any other activity, even for the audit also, planning is very, very important. It is going to be damn important. 100% you have to spend your time on planning. So now, how that planning of the audit has to happen? How that planning of the audit has to happen? That is what this chapter is going to give the guidance about. So what and all is involved in the planning? What and all are associated? What are the various steps involved in the planning of the audit? So all that we are going to talk about in this particular chapter. So having said that, let me directly jump into the questions now. So essay 300 says that planning of the audit involves three phases. Essay 300 says audit planning involves three phases. When I say I'm developing an audit plan, that planning of the audit actually happens in three phases, or it involves three steps. So what are that three steps which are involved in audit planning? The planning of audit starts with establishing something called audit strategy. Then on the basis of that strategy, we are going to develop something called audit plan. And after the audit plan, we are going to develop something called audit program. So when I say audit planning, the planning of the audit involves all these three phases. It starts with establishment of something called overall audit strategy. Then there will be development of audit plan. After that, we are going to structure audit program. So when we are done with all these three steps, then we can say planning is completed. Now a question comes, sir, what happens in the audit strategy? What happens in the audit plan? What happens in the audit program? Let me try to explain it in a simple way. See, first of all, in the audit strategy, what we do is we just set the overall scope and direction of the audit. We are going to set overall scope and direction of the audit, which means if I have to put it in simple terms, in the audit strategy, we are going to decide only on two things. Number one, what is the time within which we are supposed to complete the audit? With how many resources we are supposed to complete the audit? This is the only thing which we are going to decide. When I say I'm establishing overall audit strategy, I'm setting the scope and direction of the entire audit. So practically speaking, in establishment of audit strategy, I decide on only two things: how much time I require for completing the audit, with how many resources I'm going to complete the audit. Let me give you a practical example to make you understand. I have been appointed as auditor of X Limited. So first, what I will do is I will try to understand about my client, its environment, what is the size of the client, how many branches are there, what kind of businesses they are doing, how many products they are dealing with, what and all is supposed to be covered in my audit. So basically, I try to perform my risk assessment procedures. I get to know about entity, environment, and its internal control. So depending on my understanding of the client's organization, I will decide, okay, for this client X Limited, I am going to complete my audit in 10 days of time with the 10 engagement team members. I'm going to complete the audit of this client X Limited with the 10 engagement team members in 10 days of span. That's all. This is my overall audit strategy. So in the overall audit strategy, the auditor is going to decide only on two things: what time you require for completing the audit, and with how many resources you are going to complete the audit. It is a most summarized version. Okay, I have established the strategy. Let us take this typical example, whatever I was telling. So I have decided I am doing audit of the client X Limited. While establishing overall audit strategy, I decided that I needed 10 days of time. I needed how many resources? That is, my engagement team is going to contain how many resources? My engagement team is going to contain 10 members. Now, by deciding that, my audit strategy development has been over. That's all. Planning is completed. No. Next, what you have to do is, okay, you have decided 10 days of time, you have decided you will do the audit for 10 resources, but you have to divide this time and resources among various tasks which are involved in the audit. Division of the time and resources should happen. Like for example, when I say audit, I have to perform risk assessment procedures, I have to perform compliance procedures, I have to perform substantive audit procedures, I need to verify internal controls in the area of incomes, I need to verify internal controls in the area of expenses, I need to verify internal controls in the area of assets, I need to verify internal controls in the area of liabilities. Similarly, when it comes to substantive audit procedures also, I need to obtain evidence regarding incomes, I need to obtain evidence regarding expenses, I need to obtain evidence regarding assets, I need to obtain evidence regarding liabilities. And then finally, after performing all the audit procedures, I have to form my conclusion. And then finally, I have to prepare my report. So when I say audit, in my audit, these many activities are involved. I should perform risk assessment procedures, compliance procedures in different areas, substantive audit procedures in different areas. Then discussion should happen, opinion should be formed, and a report has to be given. So now, these many activities I have to fulfill. Now I have 10 days of time. I have 10 engagement team members. This time and resources has to be divided among different tasks. So now what I will do is I will develop an audit plan, which will contain what activity is there, which will be done by which person. For example, this activity will be done by engagement partner. Engagement partner will do this risk assessment procedures. How many days? 1.5 days. Next, compliance procedures have to be performed. Compliance procedures, when it comes to internal controls in the area of incomes, Mr. A, article assistant, will do this work. For how many days? For half day. What time allocated for him is half day. Then we have expenses. Expenses related internal controls will be verified by Mr. B. For him, the time given will be 1 day. Then assets related internal controls will be verified by so and so. The time will be so and so. So like this, I am going to delegate different tasks to different people, and also I am going to delegate the time. So after compliance procedures, then substantive audit procedures. Who will take care of substantive audit procedures for incomes? Who is going to take care of substantive audit procedures for expenses? Who is going to take care of substantive audit procedures for assets? Who is going to take care of liabilities? I will allocate a person. Along with that, time also I will give. Then finally, after performing all the audit procedures, for discussion, how many days I am going to spend? So discussion is going to be done by entire engagement team. All the engagement team should come forward and discuss their findings. And for discussion, I will keep half day, and then final audit reporting and conclusion. I will give this work to entire engagement team. For 1 day, this report opinion will be formed and report will be given. So whatever you are able to see here, this simple extract, whatever you are able to see here, this is nothing but an audit plan. This is nothing but what? Audit plan. So if I put it in simple terms, what happens in the development of audit plan is, in the strategy, we establish how much time we want, how many resources we want, but that time and resources is required to be allocated among different activities. So the document which shows the allocation of time and resources to different people, different engagement team members, that document I'm going to call it as a audit plan. Now, after the development of audit plan, I have something called audit program. Now, audit program is the most detailed version. Audit program is most detailed version. So now what will be there in the audit program is, it contains instructions. It contains what? It is going to contain instructions. It is going to contain verification procedures. What verification procedures are required to be performed? It is going to contain details regarding whether to verify on internal controls or not. It is going to contain details regarding what should be the sample size. So detailed instructions regarding each and every area will be contained in one document called audit program. So if I have to give you example once again, so take here, when you come to expenses, from in the audit plan, when I look at expenses related work, expenses related substantive audit procedures was allocated to one of the article assistant, Mr. B. Now he has to do that substantive audit procedures in 1.5 days. Now, in this 1.5 days, what and all things he has to perform? I will write a instruction. Like for example, number 1, the auditor, the concerned engagement team member, whoever is performing substantive audit procedures in the expenses, whatever invoices are there, which are more than 1 lakh rupees, try to get external confirmation. Whatever invoice values are there, which are from 10 lakhs to 1 lakh rupees, you have to take a sample size of minimum 50%. Whatever invoices are there which are less than 10 lakh rupees, there take a sample of 10%. Here you have to do inquiry. Here you have to do inspection. What supporting documents I have to verify. So all the bills you have to verify. Purchase orders you have to verify. What should be the sample size? I have already told you about sample size also. So like this document, whatever is there here, this simple extract, whatever is there here, this I can call it as audit program for purchases. Audit program for purchases. So what is contained in this document? It is containing the details of verification procedures, what instructions are required to be followed, what is the status of the internal controls, what should be the sample size. So all that details will be there in one document called audit program. So like the way we have audit program for purchases, we will have audit program for incomes also, we will have audit program for assets also, we will have audit program for liabilities also, we will have audit program for notes to accounts also. So like that, in each and every area within the time allocated, the person to whom that work has been allocated, what he is exactly required to do, what instructions is required to follow, that details will be there in a detailed document called audit program. Clear? So this is what basically 3 stages of the audit planning. Number 1, audit strategy. In the audit strategy, what will happen? It sets the overall scope and timing and direction of the audit. Basically, we are going to decide on only 2 things, timing and resources. Number 2, on the basis of that audit strategy, we are going to develop a audit plan. What will be there in the audit plan? Allocation of time and resources among different people. Then on the basis of audit plan, we are going to develop audit program. What is going to contain in the audit program? It contains a series of instructions, details, verification procedures, sample size, blah, blah, blah. So all the detailed instructions will be contained in that audit program. And this entire process of development of audit strategy, audit plan, audit program, this entire process, we are going to call it as audit planning. Audit planning is a process. The process of development of overall audit strategy, overall audit plan, audit program, this entire process we are going to call it as audit planning, whereas audit strategy is one kind of document, audit plan is one kind of document, audit program is one kind of document. That's it. Now, when we go to the content of the chapter, you will be able to find while establishing audit strategy, what factors you will consider, what will be the benefits of audit strategy, in plan, what should be included, in audit program, what will be included. So like that, very generic questions will be there, no much concept, all the point wise questions will be there. So we'll go to the chapter now and quickly try to wind it up. So if you see here, the first question which they are asking is, what are the factors which are required to be considered by auditor while establishing overall audit strategy? So just now, as I have told, in the overall audit strategy, I decide only on 2 things. What is the time required? How many resources I require? Now you tell me how I will decide this. How I will decide how much time I want, how many resources I want for completing this audit. I have to take this decision. But how will I take that? Whatever comes to my mind, will I take that? For example, if I'm sleeping, I got a dream that I have to complete the audit within 5 days with 10 engagement team members. That's all. Will I decide that? No. So if you are deciding overall audit strategy, that should be on the basis of some factors. So what things you will try to keep in mind? If you are deciding this much time will be enough, these many resources are required, there should be some basis, no? So what factors you are going to consider in establishing overall audit strategy? How you are going to decide the time and resources? Very simple. First, you have to consider characteristics of the engagement. So what is my client doing? How many components have to do the audit? Am I required to conduct audit of the branches also? What is my client's applicable financial reporting framework? How many locations I have to do the audit? What is the volume of the transactions? So first thing which I have to consider is, what are the characteristics of the engagement? What are the characteristics of the audit? Nothing but what are the features of my client? Like what is their financial reporting framework, to which industry it belongs, what should be my coverage, what kind of relationship exists between parent and component, how is any separate branch auditor is appointed, are there any services which are outsourced to others? So like that, first factor which I have to consider is characteristics of the engagement. Okay, sir, I will consider characteristics of the engagement. After that, what are your reporting objectives? What are your reporting objectives? How many reports you are required to give? Is there any timetable set by the management for reporting? Is there any due date within which the management is expecting? Is there any requirement to prepare extra reports? In the case of banks, you are required to submit 1 report to the shareholders, 1 report to the RBI, 1 report to so and so other persons. So like that, check what are your reporting requirements. Check at what point of time management will be available. Have discussions with the management. Have discussion with those charged with governance. By that, you will get to know what are the reporting requirements. Keeping that reporting requirements in mind, you decide your overall audit strategy. So 2 factors I have told. You have to consider characteristics of the engagement. You have to consider your reporting objectives. What else, sir? Any other significant factors? If you find any other significant factor which is having an impact on your audit strategy, consider that other factors. If you have performed any other engagement for the same client, in the last year, you have done the tax audit for the same client. In case if you have performed other engagements for the client, use your past experience also. You make use of your past experience also. And also we'll try to perform something called preliminary engagement activities. At the beginning of the audit, we perform some activities called preliminary engagement activities. Sir, what will be included in the preliminary engagement activities? Number one, you have to check integrity. Sorry, something we say continuation and acceptance of client relationship, which we will discuss in SA 220. You need to perform some procedures to decide whether you will accept the client or not. Like you will check the integrity of the client. You will check whether you will be able to comply with the ethical requirements or not. And also you will check, are you independent of the company or not? So like that, you will perform some preliminary engagement activities. And also one more activity, you have to communicate with the previous auditor. In case last year audit position was held by somebody else, you have to communicate with your previous auditor. So like that, initially we do some activities which we generally call them as preliminary engagement activities. Even you have to use the knowledge which you have gained from preliminary engagement activities. So that's what they say here. You have to consider the results of preliminary engagement activities, and you can also use knowledge gained on other engagements wherever is relevant. So from the preliminary engagement activities and from knowledge gained on other engagements, a few examples are determination of materiality, finding out in which areas high risk of material misstatement is there, what is the impact of the risk of material misstatement, where they have to where the engagement team members have to maintain questioning mind. In case if the previous year's audit documentation is available, whether you will have access to that documentation or not, what will be the volume of transactions, how much importance organization is giving to internal controls. So like that, you can use all this information also in deciding the audit strategy. So what did I tell you? What and all you will consider? Characteristics of the engagement, reporting objectives, preliminary engagement activities, knowledge gained on other engagements. Not just that, even you have to consider your nature, timing, and extent of resources. So before deciding audit strategy, you should also pay attention what quality of resources you are having, how many resources you are having. For example, I am an audit firm. In my audit firm, totally some 20 staff are there. Out of this 20 staff, 10 staff are already occupied in some other works. 10 staff are already occupied in some other audits. So I have to do my audit with the remaining 10 staff only. So keeping that resources in mind, you decide the time accordingly. If you are able to use all your 20 staff, you could have said, I can complete the audit within 5 days only. Now, if you have to complete the audit with the 10 staff only, you have to increase your time from 5 days to 10 days. So also pay attention to nature, timing, and extent of the resources, and accordingly decide your audit strategy. So when the auditor is establishing audit strategy, he will not do something in a fluke. He will try to consider all these factors like characteristics of the engagement, reporting objectives, nature and extent of the resources, preliminary engagement activities, knowledge gained on other engagements. All these factors he will consider. Then he will establish audit strategy. Now, the next question is, sir, if I establish overall audit strategy, what is the benefit? Why can't I directly do the audit? Why I have to spend the time in establishing overall audit strategy? Why? Because if you spend overall audit strategy as an auditor, you will be benefited. How I will be benefited? If you establish overall audit strategy, you will come to know what kind of resources you want, what kind of resources you deploy. Whether you need experienced team members or you need less experienced team members, you can betterly take that decision. And also, how many number of resources you require, that also you can plan. How many resources you need? Do you need 5 resources, 10 resources? In which area? How many resources you want for physical verification? How many resources you want for cash verification? How many resources you want for substantive audit procedures? How many resources you want? You can betterly plan that. And also, when these resources are to be deployed, see, if you have 10 engagement team members, all the engagement team members need not be deployed from the beginning. At the risk assessment procedures, you might need 3 engagement team members. Once risk assessment procedures are over, while performing compliance procedures, you can add that extra 2. When compliance procedures are also over, when you have to perform substantive audit procedures, then the remaining 5 will come. So you can also take better decisions when to deploy that resources. And by having a overall audit strategy, you can betterly manage your resources also. You can betterly manage your resources also. That is what they try to say here. So 4 benefits of overall audit strategy. Number 1, employment of qualitative resources. Nothing but this is what I have told us. What kind of resources you want? You want experienced team members or less experienced team members? If the risk is high, you allocate experienced team members. In case of less complex areas, you allocate less experienced team members. So you can take better decision regarding what kind of resources you want. Allocation of quantity of resources. Nothing but this is how much. How many resources you want? That also you can betterly plan. Timing of deployment of resources. Nothing but this is what I have told as when you have to deploy the resources, and you can betterly manage your resources. You can betterly direct them. You can properly supervise them. So if you have overall audit strategy, this is how you are going to get benefited. Now coming to the next question, what are the advantages of planning? sir, why we have to spend time in development of audit strategy, planning and program? As I've told, planning means overall process. Planning means it is an overall process of establishing audit strategy, plan and program. That process we call it as planning. Sir, what are the benefits of the planning, sir? So very generic points here you have. If you spend your time in planning, you will get to know what are the important areas to which you have to pay attention. If any problems arise, you can solve that problems in a timely manner. You can properly organize your engagement, and also you can properly select your engagement team members. You can betterly direct and supervise them, and easy coordination also will happen. Out of that, few advantages we have already seen in above, like proper selection of engagement team. The same thing it is telling employment of qualitative resources and direction and supervision. This advantage anyhow we have seen here, better management, direction and supervision. So repeated points, very generic question. So these are the benefits of planning. Next, what are the factors that affect nature and extent of planning? See, will you spend more time in planning or will you spend less time in planning? That depends on what factors. The meaning of this question is, when they ask you the question, what are the factors that affect nature and extent of planning? What do they mean by this is, will you spend a lot of time in planning or will you spend less amount of time in planning? That depends on what factors. Number one, it depends on size of the client. If the client is very big, I have to spend more amount of time in planning. If the client size is small, I will spend less amount of time in planning. Complexity of my client. If my client is doing very complex transactions, I spend more time in planning. If my client is doing very simple transactions, I will spend less time in planning. It also depends on how experienced the auditor is. See, if the auditor is well experienced, he has already done this kind of audits in the past. Since I have already past experience and expertise, I spend less amount of time in planning for this year. On the other hand, this is my first audit, or this kind of client I have never done the audit before. If that is the case, I will spend more amount of time in audit planning. So it depends on auditor's past experience and expertise also. It also depends on facts and circumstances of each and every case. So how much nature and how much time and how much extent of time auditor is spending in planning, that depends on various factors like size and complexity of the auditing. Audit in the sense client, it depends on past experience and expertise. It also depends in changes of the circumstances. Understood? Now, the next question comes, sir, what will be the contents of audit plan? As I've told, audit plan will contain everything. Like it will contain who will do risk assessment procedures, who will do further audit procedures. In that further audit procedures also compliance, a substantive, and also it contains the details of any procedures required to be performed by the standards. Nothing but whatever you are about to do in the audit, all the things will be included in the audit plan. The same thing they say, the auditor should develop an audit plan that should include the nature, timing and assessment, extent of risk assessment procedures. It should contain details of further audit procedures, any other audit procedure which is required as per the standard, that procedures also will be included. And one more question here, between audit strategy and audit plan, which one is more detailed version? Audit plan is much more detailed than audit strategy. In fact, first auditor will establish overall audit strategy. On the basis of that audit strategy, detailed audit plan will be developed. And also development of audit strategy and audit plan, not two separate activities. They both are very closely related with each other. If you make change in one, automatically the other thing is also required to be changed. If you make a change in audit strategy, automatically the change will be required in the audit plan also. So both the development of audit strategy and audit plan are closely interrelated with each other. They are not two separate activities. They are very closely interrelated activities. Clear? So this is what regarding contents of the audit plan. Now, this is one more thing here. Planning, this statement is very important. Planning is not a discrete phase of an audit, but rather an continual and iterative process, repetitive process. They are telling planning is not just a one-time activity, it is a repetitive activity. It is a continuous process. When I say I'm doing planning, I'm going to do it continuously. It is not like at the beginning only I will develop the plan, I have to follow it no matter whatever happens. The standard did not say that. So at the beginning, we will develop the audit plan, audit strategy and audit program. During the course of the audit, if required, we can make changes to our audit plan and strategy. There is no objection. There is no objection at all. So that is what the meaning of planning is not discrete phase. Planning is a continuous process. It happens continuously. It doesn't mean throughout the audit we'll be doing only planning. If throughout the audit we are doing only planning, then when we will do the audit? It doesn't mean that. So what that sentence means is, at the beginning, we will do plan, we'll develop strategy, we'll build a plan, we'll develop audit program. But during the course of the audit, if at all required, I should be ready to make my changes to audit strategy, planning and program. It is not any violation. You can happily do it. SA 300 also permits it. So that is what the meaning of the sentence. Planning is not a discrete phase of an audit, but rather it is an continuous and iterative process. Now a question will come to your mind, sir, because of what reasons we might be required to make a change in the planning? Because of what circumstances we might be required to make changes in our plan or strategy? So various examples could be, there could be results of unexpected events. All of a sudden, some unexpected event will happen. Like for example, we planned the audit with the 10 engagement team members. But out of this 10 engagement team members, 2 engagement team members became extremely sick. They are unable to come for audit. Now I planned, in the plan, I have allocated the work for all the 10 people. But 2 people are unable to come. Can I go and force them? No, whether you die also, I don't bother. Come and die at the client's premises. I have to follow my plan strictly. Will you be so rigid like that? No. These 2 people are unable to come. Then what will happen? Whatever work these 2 people are supposed to do, that work has to be taken up by remaining 8 persons. That means you are making a change to your plan. So like this, sometimes unexpected events could happen, which may be required you to make changes to your plan and strategy. Or sometimes conditions will change. Whatever conditions that are there at the beginning of the planning, the same conditions might not be there during the course of the audit. That also might require you to make changes. Or sometimes you obtain extra audit evidence. Sometimes you obtain extra audit evidence. Like for example, at the beginning, you thought that internal controls are strong. So that's why you planned for less substantive audit procedures. But later you realized that actually internal controls are not at all effective. Internal controls are very weak in the organization. Now you have to change your decision. You should spend more time for substantive audit procedures now. So like this, sometimes you might obtain extra evidence because of which you might be required to make changes to your planning decisions. And one more thing here, sometimes you might come to know about revised risk. Sometimes you might be required to revise your risk. If you are revising your risk, automatically changes are required to be made to your procedures as well. And also sometimes changes in the law will happen, government notifications will come, government policies will change. Because of that also you might be required to change your overall audit strategy and plan. So there could be n number of reasons why you might be required to make a change to your strategy and plan. And whenever those circumstances happen, you should be ready to do that. You should not be so rigid. You should be ready to accept that changes to your strategy and plan. Now, next one, let us talk about, it is whose responsibility to prepare audit strategy and audit plan? You tell me guys, it is whose responsibility to prepare audit strategy and audit plan? Undoubtedly, it is always auditor's responsibility to build the audit strategy and audit plan. But do you think auditor single-handedly will develop audit strategy and audit plan? Without the help of anybody else, do you think auditor single-handedly will develop audit strategy and audit plan? The answer is no. So ultimate responsibility for development of audit strategy and audit plan rests with the auditor, agreed. But in the process of development of audit strategy and audit plan, the auditor is going to involve different people also. Sir, who are that different persons who will be involved in the development of audit strategy and audit plan? Undoubtedly, the auditor is going to involve his engagement team members, like his article assistants, his audit managers, his paid assistants. He has to involve his engagement team. Because if you involve engagement team, you will come to know what are the capabilities of the engagement team. If you get to know about their capabilities, you can betterly allocate the work to them. So undoubtedly, the auditor is going to involve his engagement team in the development of audit strategy and plan. Now, sir, do you think in the development of audit strategy and audit plan, should the auditor involve clients management and clients staff also? I'm asking you a question. Do you think, is there a requirement for the auditor while establishing audit strategy and audit plan? Is there a requirement for the auditor to include clients management and client staff also? The answer is yes. Why? Because if we have to do the audit at various instances, we need the help of the clients management and staff. For example, if I wanted to conduct inquiry of the sales in charge, whenever I want to conduct that inquiry, that sales in charge should be available. So if you let them know when you are going to do the inquiry, they will become available at that point of time. So we have to do the audit taking the help of the management and clients staff. So better you involve clients management and clients staff also in the development of strategy and plan. But here you have to be very careful. when I say you have to involve clients management and clients staff, you should not discuss a detailed audit plan with them. If you discuss a detailed audit plan with them, whatever you're going to do become predictable and there is no purpose of doing the audit only. So that's why involve the clients management and clients staff only to the extent their involvement is necessary. Don't discuss a detailed audit plan with them. If you do that, your audit effectiveness will be lost. So final conclusion is ultimate responsibility for establishment of strategy and plan rest with the management, rest with the auditor. But in that development, the auditor is going to involve the engagement team. He's also going to involve clients management and clients staff. Next one, sir, whatever audit strategy I'm developing, whatever audit plan I have developed, is there any requirement to document it? 100% yes. You are required to document your audit plan and strategy. Sir, what and all I have to document? Overall audit strategy, whatever you have established. What is your audit plan? If at all you have made any changes to your audit strategy and audit plan during the course of the audit, that changed audit strategy and audit plan along with the reasons why you have made that changes, that reasons are also required to be documented. Sir, why document is important? Why documentation is important? If the auditor documents audit strategy, audit plan, how he will be benefited? He will be benefited because if you document it, there will be a record of all the important decisions you have taken. At the planning phase, you take various important decisions. If you document it in future, if you want to revisit that important decisions, it will have a record. So that is first advantage. And also it is a record of nature, timing and extent of risk assessment procedures. If tomorrow someone is coming and asking you, boss, did you plan your procedures properly? What nature of audit procedures you have performed? What extent of audit procedures you have performed? Whether you did the work properly or not? If I have my audit documentation in which I have included my strategy and plan, I can show them, boss, see my strategy, see my plan. I have performed a proper audit procedures. I can show them. And not just that, even you are recording for reasons for changes in the strategy and plan. In case if you have changed your audit strategy and plan, if tomorrow someone is coming and asking you why you have changed your audit strategy and plan, I will have the reasons also. See, these changes I have made, because of these reasons I have made the changes. So it will act as a record of key decisions. It will act as a record of nature, timing and extent of procedures you have performed. It will also act as a record of reasons for making changes in the audit strategy and audit plan. So that is how the auditor will be benefited in case if he documents his strategy and plan. Clear? So till here, whatever questions are there, those are actually talking about strategy and plan. So two parts we are done, but we have one more component of audit planning, which is audit program, that we will discuss now. We have one question regarding audit program. If we discuss that one question, we can happily wind up the chapter. So let us have a look at that last concept relating to audit program. So let us try to discuss this question number 10. So as I've already told you, what will be there in the audit program? So audit program is going to contain, it is a more detailed document. It is going to contain instructions, verification procedures. So all the details are going to be there here. So like as you could see here, an audit program is commonly prepared to allocate work to team members, which will include the list of audit procedures, what instructions are to be followed by the member. So detailed document within the time allocated, within the duration, what verification procedures are required to be performed, what instructions are required to be followed, all that things will be there. And it will also contain audit objectives for each area, and it will have sufficient detail to serve as a set of instructions or to the assistants involved. Nothing but 1 and 2 both are trying to convey same point, just they are going to play with the language. Sir, when I have to establish an audit program, like I gave you one example, for purchases we have developed an audit program. Sir, while developing this purchases audit program, what things I will try to consider? Like if you remember, I have written various instructions in our audit program. I wrote various instructions like whatever invoices are there which are more than 1 lakh, try to get external confirmation. 10 lakhs to 1 lakh, take a sample size of 50%, do inquiry, do inspection. These instructions I have added, no? On what basis I will add? What factors I will consider generally for developing this audit program? So first I will consider what is the nature of the business in which the organization is engaged. What kind of business my client is doing. How I will come to know what kind of business my client is doing? By visiting the client's office. Go and visit the client's office. If it is a manufacturing entity, go and see their production process. See what kind of records they are keeping, what kind of internal controls they are following, how the accounts department is organized, who and all are different people involved in the accounts department. So if you visit the client's office and get to understand all these things, then you will come to know which instruction will be appropriate, what document you have to verify, which technique you will follow. You will get better clarity only when you understand what is the nature of the business in which your client is involved. And how to know about that nature of the client's business? Go and visit the office. As simple as that. Okay, so I will consider nature of the business. What else I will consider, sir, in establishing audit program? Overall plan. One thing you should always remember, my audit program should be in line with audit plan. For example, in the audit plan, while developing audit plan, for purchases, I have allocated 2 days of time only. Then when I am developing audit program, it should contain only those instructions which could be completed within this 2 days of time. It should not be like in my audit plan, I have allocated 2 days of time, but in the audit program, I am giving those many instructions which will easily take 4 days of time. You tell me, will that be an appropriate audit program? 100% not. So that's why you need to build an audit program which is in line with audit plan. If at all required, first change the audit plan, then only develop the detailed audit program. So this is the second most important thing which you have to consider while establishing audit program. It should be always in line with audit plan. Next one, you should also pay attention to internal controls and accounting procedures. You should also try to understand what kind of internal controls are there in that area, whether those controls are working effectively or not working effectively. So what is the control risk from there? What kind of accounting software the client is following? Are they using Tally? Are they using customized software? What are that internal controls within the accounting software? So before establishing audit program, you should also study the client's internal control system and their accounting procedures. Finally, you should pay attention to size of the organization and what is its management structure. Should also try to understand information regarding organization of the business. When I say organization of the business, you should also try to understand what is the client's history, how long they have been in business, read the past few years financial statements and all. And even you should understand what kind of policies management is following. What kind of accounting policies, what kind of management policies are there in the organization. You should study all these things. Then you have to develop the audit program. So if they ask you the question, what factors you will consider in development of audit program, what you are going to write? Number one, nature of business in which the organization is engaged. Number two, it should be in line with overall audit plan. Number three, you have to study the internal control system and their accounting procedures. You have to study about the size of the organization. And also you need to understand information as regard organization of the business. And then finally, you should also understand their accounting and management policies. Now, if you remember, I told you that you will establish audit strategy and audit plan. If required, you can make changes to your audit strategy and audit plan, right? Can we do that for audit program also? Initially, we will develop an audit program. If required, can we make changes to that audit program also? 100% yes. There is no hard and fast rule which says once you have developed an audit program, you have to follow it strictly. There is no such rule. If required, we can make the changes to our audit program. So because of what circumstances we can change our program? Like sometimes there could be changes in the circumstances. Unexpected events could be there. What we expected that might not happen, or we might get some extra evidence. So because of all these reasons, we might be required to make changes to our audit program, and you are permitted to do it happily. No objection from the standard. So that's what they say. Given below are few examples of the circumstances where audit program could be changed. So initially you designed audit procedures for a certain volume of turnover, but later the turnover has actually increased. See, you have started doing the audit before closure of the financial year. You thought, since year is not yet closed, you thought, okay, this company hardly will make a turnover of 100 crores. Accordingly, I have designed my instructions. But after the closure of the year, you realized that the turnover of the company has gone to 500 crores. Now what you should do? Initially, you planned the instructions assuming the turnover of the company will be 100 crore, but actual turnover became 500 crores. You tell me, will you make changes to your audit program or not? 100%. And also, when during the course of an audit, it has been discovered that internal control procedures were not effective. Initially, you thought internal controls were effective. Accordingly, you designed your instructions. But later you came to know that your conclusion was wrong. Internal controls are not effective. They are suffering from various weaknesses. Now will you make changes to your audit program or not? 100% yes. And when there is a significant increase in the book debts or inventory as compared with the last year, then also you will make changes to your audit program. And if you have any suspicion, then also you make changes to your audit program. So these are the few examples of the circumstances. Once again, I'm telling this is not a conclusive list. These are only illustrative examples. So these are the few examples of the circumstances because of which you might be required to make changes to your audit program. That's all. This is what regarding audit program. Then you will have one small concept called audit execution. This is not anything new here. If you want to do the audit, if you want to complete the audit, if you want to execute the audit, what and all are various phases involved. First, as we have just now seen, first we have to do the planning. Execution, we have to plan. Audit, we have to plan. Like we have to establish audit strategy, audit plan, audit program. All this we have to do. That is the first phase. Then risk and control evaluation. Nothing but you have to perform risk assessment procedures and compliance procedures to study the internal controls to verify whether the controls are working effectively or not. After that, you have to do the actual testing. Nothing but here is where we perform substantive audit procedures, and from there we get evidence, and on the basis of that evidence, whatever our findings are there, on the basis of that findings we have to prepare our report. Is it something new we are discussing? No, we already know it. So when we say execution, what are the key phases in audit execution? These are 4 phases. First, you have to do the planning. Then you have to do risk and control evaluation. Nothing but risk assessment and compliance procedures you have to do. After that, you have to do actual testing. Nothing but substantive audit procedures you have to do. Then you will get evidence. Then you will have findings. Depending on your evidence, depending on your findings, you have to prepare your audit report, which contains your opinion. That's it. Clear, everybody? So this is what regarding audit execution. That's all, guys. We are successfully done with the chapter audit strategy, planning and program. Nothing more left here to discuss. Okay, right. Hey guys, welcome back to the revision series. Now we are going to revise in this session the chapter quality control. So in the previous session, if you remember, we have successfully revised the chapter audit strategy, planning and program. So where we have understood, where we have revised actually the content from essay 300, we understood what is the concept of the entire planning process, what is audit strategy, what is audit plan, what is audit program. So how we are going to establish that. Even I have given you some practical examples to make you understand the concept even in a much better way. So on the same lines, we are going to revise now. We are now going to take up the next chapter, which is quality control. So this chapter is going to be once again very simple chapter, very small chapter. And in fact, in this chapter, we are going to discuss 2 standards. One is SQC1 and the other one is SA220. So when I say I'm revising the chapter quality control, I'm going to revise 2 standards, SQC1 and SA220 I'm going to talk about. First of all, let me give you a brief about this chapter, what exactly this chapter is all about. So this chapter is about, as the name itself says, quality control. So basically, this chapter is going to talk about we as a chartered accountant. The moment we qualify our CA final examination, we will become a chartered accountant, and as a chartered accountant, we offer various kind of services to the society. We offer various kinds of services to the society. Like we do audit, we do various other kinds of engagements. So different kinds of services we are going to offer to the society. Now, these services, whatever we are going to provide as a chartered accountants, do you think is there a requirement to maintain the quality in the work which we are delivering? Just think practically, we chartered accountants are offering different kinds of work. Do you think is there any requirement, is there any moral responsibility on us to maintain quality in whatever work we are doing? 100% yes. Why? Because as a chartered accountant, we are providing those kind of services whose output is going to be used by so many people to make their financial decisions. Like simply, if I have to put an example, we chartered accountants, we do audit. As we all know, the entire outcome, the complete outcome of the entire process of the audit is audit report. So we are going to give the audit report. Now this audit report is going to be used by so many people to make their financial decisions. Like an example, if I have to give, a shareholder will use the audit report to make a decision whether to invest in the company or not. A banker is going to make use of the audit report to decide whether to give a loan to one particular company or not. A government is going to make use of your audit report to decide whether these particular SSC has made payment of taxes in an appropriate way or not. So whatever work we are doing, depending on that work, so many people are basing their financial decisions. They're going to take the decisions about their money on the basis of whatever opinion we are expressing. So don't you think when these many kind of stakeholders, be it government, be it bankers, be it shareholders, be it potential shareholders, creditors, debtors, whoever it is. So whoever may be that stakeholder, these many people are relying on our work to make their financial decisions. So because of this fact, there is a moral responsibility on each and every chartered accountant to maintain the quality in your work. You should not be compromising on the quality of the work. If you compromise on the quality of the work, if you don't deliver qualitative outcomes, not just 1 or 2% of decisions are going to get affected. There are thousands of people's lives which are at stake. So that's why it is 100% important to maintain the quality in whatever work auditors are doing. So how to maintain that quality as a chartered accountant, that guidance has been given under standard. And in fact, that guidance regarding maintaining quality, what we chartered accountants can do, what kind of policies we have to follow, what kind of procedures we have to follow in order to maintain the quality in the work we are doing, that guidance has actually been given under two standards, SQC1 and SA220. See, first of all, I will try to explain what is the difference between SQC1 and SA220. What is the difference between SQC1 and SA220, how these two standards differ from each other, that I will spend some time to make you understand. Once we are clear with that, then we can understand the content of the standards. So before I could explain this, I have to say one more thing. As I've already told you, once you become a chartered accountant, we are going to offer different kinds of services to the society. One kind of service which we offer to the society is audit. One kind of engagement which we offer by which we can make a living is audit. We can provide audit services to the clients, and from that we can make a living. From that we can generate revenue. But it is wrong to say we are going to generate revenue only from audit. Audit is one of the services. Auditor can provide a portfolio of services. In that, one of the service which auditor can provide to the society and make a living is audit. Audit is not the only service which a chartered accountant will provide. There are various other engagements also which a chartered accountant can do. So auditor can also do some engagements which are called as review. Auditor sometimes will perform engagements called review. So what is the difference between audit and review is, in the audit, we verify historical financial information and we try to obtain reasonable assurance. Audit is such a kind of engagement where auditor is going to verify historical financial information and is going to obtain reasonable assurance, high level of assurance we are going to get. But review is such an engagement. Here also we are going to work on historical financial information only, but we are going to obtain limited assurance, very little amount of assurance we are going to get. If I have to give you an example, see, listed companies will prepare quarterly financial statements also. Sir, will these quarterly financial statements also will be verified by the auditors? Yes, quarterly financial statements also will be verified by the auditor, but we don't call that engagement as audit engagement, we call it as review engagement. So audit is a much more detailed verification, whereas review is a limited verification. We don't go much deeper into the details, we do limited verification in the case of review engagement. So one kind of engagement which we chartered accountants can offer to the society is, we can do audit, we can do review. Sometimes we will not always be associated only with historical financial information. Sometimes we might be required to work on other than historical financial information. When I say other than historical financial information, that could be non-financial information also, that could be future financial information also. We not only work only on historical financial information, sometimes we are required to work on other than historical financial information. Like in some cases, a client will appoint you to only verify their internal controls and give a report. Non-financial information. They're not asking you to verify their books of accounts and financial statements. They're asking you to only verify the internal controls and give a report. So here, if we accept such engagement, we are not working on historical financial information, we are working on non-financial information. That kind of engagement, we call them as assurance engagements. Or future financial information. Sometimes the client will ask you to verify their future financial information. You might have heard, if you are into articleship, we say something called projections. So the client will come to you, ask you to sign their projections for the coming 4 or 5 years. They will estimate their financial position of the coming 4 or 5 years, and you are required to certify it. So like this, sometimes you might be required to verify with the future financial information or non-financial information when you are associating yourself with other than historical financial information. That engagement, we are going to call it as assurance engagement. And one more kind of engagement we also perform. See, sometimes sometimes as a chartered accountant, we will not only be asked to verify, sometimes the client will ask us to perform something called agreed upon procedures. Sometimes the client will ask us to perform something called what? Agreed upon procedures, which means client will ask you to do something and you are supposed to do. One example if I have to give, the client is asking you to compile their financial statements. Some client X Limited is there, they maintain their books of accounts, but they don't know how to prepare the financial statements. They approached you, you are a chartered accountant. They told, sir, we have our books of accounts. From that books of accounts, you prepare the financial statements. We will pay you some fees. So here you are not doing verification. Here you are doing agreed upon procedures. So sometimes we chartered accountants might be required to perform these kind of agreed upon procedures also. These kind of engagements, we call them as related services. We call them as what? Related services, where we are going to work upon agreed upon procedures. So like this, being a chartered accountant, we don't do only audit assignment. We are going to do different kinds of engagements, like we are going to do review engagements, assurance engagements, and related services. So all these are 4 examples I have given: audit, review, assurance, related services. All these 4 we collectively call them as engagements. We are going to call them as what? Different kind of engagements which a chartered accountant can do. So now you tell me, is there a requirement to maintain the quality in only audit, or is there a requirement to maintain quality in all kinds of engagements? If I am doing audit, then also I am required to maintain quality. If I am doing review engagement, then also I am required to maintain quality. If I am doing assurance engagement, then also I am required to maintain quality. If I am providing related services, in those services also I am required to maintain quality. So how to maintain quality in all kinds of engagements? That is dealt by SQC1. As a firm, take for example, we are an audit firm, A, B, C and Co. We are an audit firm. So we have partners of chartered accountants. So as a firm, we can do audit assignment also, we can do review assignment also, we can do assurance assignment also, we can do related services also. So whatever may be the assignment we are doing as a firm, we need to maintain quality in all kinds of engagements we are doing. And how to maintain quality for all engagements, that guidance has been given under SQC1. So SQC1 requirements, whatever are there, they become applicable for audit engagement also, they become applicable for review engagements also, they become applicable for assurance engagements also, they become applicable for related services also. So whatever may be the engagement you are doing, you need to comply with SQC1, which will guide you how to maintain quality. So SQC1 operates at the firm level and it is applicable for all engagements. So then what is SA 220? SA 220 has been drafted in lines with SQC1. SA 220 has actually been a part of SQC1 only. So SA 220 talks about only how to maintain quality of audit. It is a special standard which is talking about how to maintain quality, how to control quality in the audit engagements. That only SA 220 talks about, whereas SQC1 talks about how to maintain quality in all kinds of engagements. So that's why I say SA 220 has actually been drafted in line with SQC1. It is actually a part of SQC1 only, whereas SQC scope is much wider. It is applicable for all engagements. SA 220 will become applicable only for audit engagements. Clear, everybody? So that is the difference between SQC1 and SA 220. So this difference, if you understand, now we can jump into SQC1. What does SQC1 say? What guidance it is giving? How to maintain quality in all engagements? What SA 220 is telling in order to maintain the quality in audit engagements? So both the standards are going to be more or less similar. If we understand SQC1, almost all we are done with SA 220 also. Why? Because as I have told, SA 220 has been drafted in line with SQC1 only. So whatever we see in SQC1, 90% of the content will get repeated in SA 220 as well. Clear? Right. So having said this, I will try to explain SQC1. We are going to start now SQC1. So what does SQC1 say? If you look at the title of the SQC, so SQC title is something like this: quality control for firms, quality control for all kind of firms that perform audits, reviews of historical financial information and other assurance engagements and also related services. So as I have told you, this SQC1 is going to talk about how to maintain quality, how to control quality in audit engagements also, in review engagements also, in case of other assurance engagements also, in case of related services also. So now how to maintain the quality? So what is the objective of SQC? Why SQC has been given? So SQC1 is asking the firms, the audit firms, to follow some policies and procedures. What SQC1 is telling? SQC1 is asking the firm to establish some policies and procedures which will give them reasonable assurance that whatever work that firm is doing, that is done as per standards on audit, that is done as per professional standards, whatever work they are doing, that is done as per laws and regulations, and whatever reports they have given till date, those reports are appropriate. So what does SQC1 say? If you want to maintain quality as a firm, if you want to maintain quality, you need to have a system of some policies and procedures. In your firm, you have to establish some policies and procedures. And those policies and procedures should give you confidence that by following those policies and procedures, whatever work we have done, that work is as per professional standards. Whatever work we have done, that work is as per laws and regulations, and whatever reports we have given, those are appropriate. That confidence you should get. It should not be like you have done some work and you are having sleepless nights. So for example, today if I am a chartered accountant, I have done some audit, I have signed my audit report, I should not have a sleepless night making me think that, okay, today I have signed my audit report, tomorrow I don't know which authority will come and catch me. You should not fear. So that's why in your firm, when you are doing any work, you have some policies and procedures which will give you confidence. Yes, whatever work I have done, that work is as per professional standards. Whatever work I have done, that is as per laws and regulations. Whatever report I have given, that report is appropriate. That confidence you have to get. So that is what the objective here. The same thing they say here. So SQC1 requires the firm should establish a system of quality control designed to provide it with reasonable assurance that whatever work they have done, that is as per professional standards, legal and regulatory requirements, and whatever reports you have given, those are appropriate. Now, SQC1 goes further. It says that yes, you are required to follow some policies and procedures, and those policies and procedures are required to be implemented in 6 areas of your firm. How many areas? In 6 areas of your firm, you need to establish policies and procedures. Sir, what are those 6 areas in which the firm should maintain policies and procedures? Number 1 is regarding leadership responsibility. Why to write it unnecessarily? Here we already have. So what are the elements of system of quality control? In which areas you need to have policies and procedures? The SQC1 says in 6 areas we need to implement policies and procedures, and those 6 areas are: number 1, leadership responsibility for quality within the firm; ethical requirements; acceptance and continuation of the client relationships; human resources; engagement performance; and monitoring. So these are the 6 areas in which the firm should establish some policies and procedures. Repeat everybody along with me. What are that 6 areas? Number 1, leadership responsibility. Number 2, ethical requirements. Number 3, acceptance and continuation of the client relationships. Number 4, human resources. Number 5, engagement performance. Number 6 is monitoring. So let us try to understand about each and every area in a detailed manner. First, I am going to start with this leadership responsibility within the firm. See, if you are a firm, for example, you are a firm ABC and Co. In your firm, 3 partners are there. Totally 3 partners are there. Along with that, some 30 staff you have. Article assistants, paid assistants, audit managers. So like that, 30 staff you have. So my firm totally contains 3 partners along with 30 staff. In my firm, 33 people are there. Now, whatever work my firm is doing, that firm should do the work in a qualitative manner. If I want to make that happen, if I want to make sure that whatever work my firm is doing, in that work quality should be there, can I assign that responsibility to everyone? Can I go and say each and every one of you will be responsible for maintaining quality? Yes, you can say that. But unless someone comes forward and takes the leadership responsibility, that purpose will not be achieved. You can't split the responsibility among everybody. Someone should come forward and take the leadership responsibility. So for this firm ABC and Co, I will take the leadership responsibility. I will become the leader of this firm. I will take the leadership responsibility. I will make sure that my firm is doing the work in a qualitative manner. So someone should come forward and take the leadership responsibility. Sir, who should come forward in the firm to take that leadership responsibility? SQC1 says either the firm's chief executive officer or the firm's managing partner should come forward and take the leadership responsibility. For example, in this firm ABC and Co, Mr. A is the managing partner or Mr. A is the chief executive officer of this entire firm. So Mr. A, who is a managing partner, he should come forward and say, so in my firm, I will be the leader. I will make sure that every person in my firm, whatever work we are doing, they will do the work in a qualitative manner. So like that, firm's CEO or managing partner should come forward and take the leadership responsibility. And as a leader, what he should do? He should promote an internal culture. He should build a good culture in the organization. He has to communicate everybody how they have to maintain good culture, how they have to do the work in a qualitative manner, why it is very important to do the quality. So quality is essential. As a leader, you have to communicate your engagement team members, create a good culture and make them realize how important it is to maintain the quality in the engagements. So as a firm's leader, you should encourage the inner culture in your firm. And not just that, so as a managing partner, you have good leadership responsibility, but you will assign the work to your staff? No. All the work managing partner himself will not do. He will assign the work to different people in the firm. Now, the people to whom you are giving the operational responsibility, as a leader, you have come forward, but to whomever you are assigning the responsibility, you should make sure that those people who are given the responsibility, they have sufficient knowledge, they have sufficient expertise, they can understand and do the work in a proper manner. That also you have to make sure. So that is what they say here. The persons assigned with operational responsibility should have sufficient and appropriate experience, ability, and necessary authority. So as a leader, you should be supreme. In addition to that, whatever work you are allocating, to whomever you are allocating the work, your team also should be sufficient and appropriately experienced and capable. And also, as a leader, you should make sure that commercial considerations are not overriding quality. You should not be like, as a firm, you should not give importance to your commercial consideration. Whatever assignment you are accepting, fees should not be your top priority. Doing the work should be a quality, it should be your top priority. So as a leader, you should make sure that commercial considerations do not override the quality. And also you should do proper performance evaluation, compensation, promotion designed to demonstrate firm's commitment to quality. If you are promoting some person, you should promote only those persons who are committed to that quality. If you are giving any increased compensation, if you are giving any reward, if you are giving any incentive, identify those people in the firm who are doing the work in a qualitative manner and award them compensations, award them promotions. Don't show favorism. If you are very favorable to one person, don't give priority to that. Give the recognition only to that person who has committed to quality. And also you should devote sufficient amount of resources for development, documentation and support of quality control policies and procedures. You should dedicate certain amount of team. You should dedicate some at least 2-3 people who will continuously work on that documentation of policies and procedures, etc. So like this, someone should come forward and take the leadership responsibility for maintaining quality within the firm. So tell me guys, what is the summary of this leadership responsibility? What kind of policy should be there? Firm's managing partner or CEO should come forward and take the leadership responsibility. You should promote a good inner culture in the organization. The person to whomever you are assigning the responsibility, they should also have appropriate experience, knowledge and capabilities. And you should make sure that commercial considerations do not override the quality. You are doing compensation, promotion, who are showing commitment to the quality. And also you should devote sufficient amount of time and resources for documentation, development and support of policies and procedures. Okay, so that is the first area. Second area in which you need to have policies and procedures. Second area is ethical requirements. So as we all know, we have 5 ethical requirements. What are the 5 ethical requirements? Integrity, objectivity, professional competence and due care, confidentiality and professional behavior. Regarding these 5 ethical requirements, we'll try to understand in a deeper manner when we take up the chapter professional ethics. So, but for the time being now, there are how many ethical requirements? 5 ethical requirements are there. What are they? Integrity, objectivity, professional competence and due care, confidentiality and professional behavior. And you should always try to give importance for these fundamental principles. You should always give priority to that fundamental principles. Sir, how the firm can give priority? So fundamental principles should be emphasized, should be highlighted by way of actions of the leaders. Whatever the way in which the leaders are acting, they should display that ethical requirements. They should spread awareness and training. They should do monitoring whether really employees are complying with that ethical requirements or not. And in case if you find someone who is not complying with that ethical requirements, what kind of process you are following. So there are 5 ethical requirements, and these 5 ethical requirements should be highlighted by the actions of the leaders, by spreading awareness, by doing monitoring, and also you should have proper process if you find someone who is not complying with this ethical requirements. And when I am talking about ethical requirements, the most important thing is independence. The most important is what? Independence. So you should always give top priority to independence. As a chartered accountant, as a firm, whatever work you are doing, you have to do that works in an independent manner. So how you have, what kind of steps you are required to take to make sure that you are doing the work in an independent manner? 4 steps they will say. Number 1, as a firm, you have to communicate to all your engagement team members. You have to communicate to all your staff what is the importance of independence. So why we have to comply with the independence requirements? How we can be independent? What kind of actions we have to take? We have to take proper communication should happen. So as a firm, you should properly communicate with all your team the importance of independence and how to comply with the independence. Number 2, you have to identify any threats. Identify threats or relationships. Have to identify any threats or relationships that can become a threat to the independence. Like for example, one of the partner in your firm is having a relative, his brother is a CEO of one client company. So it is leading to familiarity threat. That relationship is creating a threat. So those kind of threats you have to identify. The first step, you have to communicate. Number 2, identify relationships that create threat to independence. Number 3, try to eliminate that threats or try to reduce that threats by appropriate safeguards. Try to take some actions. Think how you can reduce that threat, how you can eliminate that threat. In case if you find that threat elimination or reduction is not possible, then you have to withdraw from the engagement also. What you should do? Then you should withdraw from the engagement also. So this is what you are required to do regarding independence. So as a firm, you should communicate independence to your staff. You should identify what kind of relationships create threat. Then you should take action to eliminate those threats or reduce them. In case if you are unable to reduce them, then you have to withdraw from the engagement. And one more thing, if you any breach of independence, if anybody has done the breach of independence, that should be immediately brought to the head of the firm. And also there is one practice which will be generally followed in all the entities: at least annually, at least once in every year, the firm should obtain written confirmation. This point is very important. The firm should obtain written confirmation from its staff that they are complying with the independence requirements from all their staff, from all the firm personnel. At least once in a year, they have to get a written confirmation that they are all complying with the independence requirements. So under ethical requirements, the most importance is given to independence. And also you have to pay more attention to familiarity threat. Sir, what is familiarity threat? When you have some close relationship, when the chartered accountant, when the client and the professional, so when they are having some sort of personal relationship, that will lead to familiarity threat. And also when a firm is continuously doing one position, continuously providing some service for so long, that also will lead to familiarity threat. Take for example, there is an audit firm ABC and Co. For the last 10 years, they are only acting as an auditor for the company X Limited. They are not changing the auditor. Company is not changing the auditors. So because of this long relationships also, threat independence can be affected. This is, we call it as familiarity threat. So that's why under Companies Act, we have a concept of rotation of auditors. Under Companies Act, we have a concept of rotation. What does the concept of rotation say? If you want to appoint an individual as an auditor, you can't appoint them for more than one term of 5 consecutive years. If you want to appoint a firm as an auditor, you can't appoint the firm for more than 2 terms of 5 consecutive years. Yes or no? So these rotation requirement is also to prevent that familiarity threat only. So you have to even pay more attention for familiarity threat also. Clear? So these are the policies which you need to have regarding ethical requirements. So what we have seen, there are 5 ethical requirements. These ethical requirements should always be highlighted. You should always give more importance to independence. When I say independence, 4 steps: communication, identification, taking appropriate actions, if not possible, withdrawal. And at least annually, you have to get written confirmation from all your engagement team members. And also you have to pay more attention to familiarity threat. So this is what the second area in which you need to have some policies and procedures. Third area, acceptance and continuation of client relationships. So for example, if you are an audit firm ABC and Co, one new client is coming. Take for example X Limited, a new client has come and asking you to do the audit for them. Now you have to take a decision whether to accept this client relationship or not. Sometimes what will happen is ABC and Co, you are already a auditor. You are already auditor for the client X Limited. Just now you have completed current year's audit. The client is asking for you, next year also you only act as an auditor. Now you have to take a decision whether to continue this client relationship or not. So whenever you are supposed to, whenever a client is approaching you and asking you to do some assignment for them, when he's asking you to act as an auditor or whatever, you have to take a decision whether to accept that client relationship. If it is a new client, you have to accept. If it is already a existing engagement, existing client, existing engagement, then you have to take a decision whether to continue the client relationship. Let me give you one example. Take for example ABC and Co. There is a firm ABC and Co. First time a client X Limited, first time, you don't know this client. This client came to you and asked, sir, please act as a company auditor for us. Now you have to take a decision whether to accept it or not. Next case, ABC and Co, you are conducting company audit. You are already conducting company audit for the client X Limited. Last year, for the financial year 2023-24, for this company you conducted company audit. For the financial year 24-25, the same company X Limited is asking you to act as a tax auditor. The same company is asking you to act as a tax auditor. So existing client only. Last year you have done some work for this client, but existing client is asking you to do new engagement. Last year you done the company audit for them. This year client is asking you to do tax audit for them. Here also you have to take a decision whether to accept this new relationship with the existing client. Now one more case, ABC and Co, a company, last year for the financial year 23-24, you have done company audit for them, for the client X Limited. Now for the financial year 24-25 also, the same company is asking you to do company audit only. So here existing client only is asking you to do existing engagement only. Existing client, existing engagement. Last year you did the company audit for the same client. In the current year, they are also asking you to do company audit only. The existing client only, they are asking you to do existing engagement. Now you have to take a decision whether I can continue that client relationship or not. So like this, whenever a client is approaching you and asking you to do some engagement for them, depending on the facts and circumstances, sometimes you have to take a decision whether to accept, sometimes you have to take a decision whether to continue. Now, how you will take that decision? whether to accept a client relationship or whether to continue a client relationship or not, how you can decide? You will consider some factors or not. So what factors you have to consider? What kind of policies you should have? So here SQC1 says, whenever you have to take a decision whether to accept or client relationship or not, you should consider some information like integrity of the client, its promoters and key managerial person. So how honest my clients top level management are? Are they well known for good decisions or well they known for frauds? If I came to know that one client is coming me whose top management are well known for committing frauds, will I accept the audit or will I try to stay away from that? I will try to stay away from them. So one important thing which you have to consider before taking that decision regarding acceptance and continuation of client relationship is integrity. Second one, competence. Okay, client is coming to you and asking you to do some engagement for them, but you should be able to decide whether you are capable enough. Client came, for example, I have a small office. Just imagine I have a small office. We are 2 partners. We have some 5 staff. One day Reliance Industries Limited came to me and asked me to do the audit for them. Out of excitement, I accepted. But later I will realize that I don't have enough of time and resources to complete that audit. So that's why well in advance, before you say yes to the client relationship, before that only you analyze, are you competent enough? Are you capable enough to do that engagement? And also you need to check, will you be able to comply with the ethical requirements? If you accept this client relationship, if you continue this client relationship, will you be able to comply with ethical requirements? So before you take a decision whether I can accept or continue the client relationship, these are the 3 factors which you have to consider: integrity of the client, competence of the engagement team, and then compliance with the ethical requirements. Now you will get a doubt, sir, you are telling I have to know about client's integrity. How I will come to know whether my client is having integrity or not? You are telling the first factor which I have to consider is whether my client is having integrity, whether the promoters are honest, integrity in the sense honesty, whether the top level management is honest or not. Sir, how will I come to know? How can I get to know whether my client is having integrity or not? Very simple. You have to consider various things like find out what is their business reputation, what kind of reputation they have in the market, and also what kind of operations they are doing, what kind of business practices they follow. And also you should check the attitude of the client, what kind of attitude they are having. And also you should check what is their approach towards audit fees. Are they ready to pay more audit fees for the qualitative work? Are they ready to pay only less amount of fees no matter what is the output of the work? So check what is their attitude towards audit fees. And also what are they putting any inappropriate limitation on the scope? Are they restricting your work? Are they permitting you to do your work freely, or they are putting any restriction? So check that as well. And sometimes there will be indication that the client might be involved in money laundering or other criminal activities. If you came to know client has already some cases going on, better to stay away. They're not having integrity. And why they have appointed you now? Why they have not reappointed the previous auditor? Do they have any issues with the previous auditor? Check that. So by considering all these factors, you will get to know whether the client is having integrity or not. And one more factor which I have told you to consider is competence. Sir, you are asking us, before we say yes to an engagement, decide whether we are capable or not. So when deciding whether we are capable or not, what factors I will consider? To decide whether I am capable or not, what factors I will consider? Let us see. So matters that the firm considers in determining whether the firm has capabilities, competence, time and resources to undertake the engagement. Sir, what and all I have to consider to know whether I am capable or not? Number one, you have to consider whether as a firm you have knowledge of the industry, to whatever industry your client belongs, to have the knowledge of that industry. Do you have experience with that laws and regulations? Do you have experience with that reporting requirements? Or do you have sufficient staff? Do you have enough of team to complete that? Are experts available in case experts are required? Do you have the availability of experts? And also, did your team meet the criteria to perform the engagement? And also, will you be able to complete the engagement within the deadline? If the client has set a deadline, sir, you have to complete the audit within 1 month. Do you have the resources to complete the audit within the deadline? So you consider all these factors, then you take the decision, are you capable enough? Are you capable enough? The next one, sometimes what will happen is there will be a conflict between the firm and the client. You have accepted the audit, but client and the practitioner, client and the chartered accountant is having some sort of conflict. What you should do? If there is any conflict between the firm and the client, you should try to resolve it before accepting the engagement. As much as possible, you try to resolve it. And also you try to consider whether there are any professional and legal responsibilities. In case if any conflict happens between client and the firm, try to understand as a practitioner, do you have any professional and legal responsibilities to communicate this matter to regulatory authorities? If client and auditor both are having disagreement, find out, is there any law or regulatory requirement to communicate with the regulatory authority? In case if you are unable to resolve that issue, withdraw. If that issue is not getting resolved, that conflict is still going on, what you should do? Better option is withdraw. Don't accept the audit. Don't accept it. If you have already accepted, withdraw. Sir, if I'm withdrawing, then what I should do? If you are withdrawing from the engagement, then also follow some protocol. It is not like just you are calling the client and telling, hey, client, get lost. You are a dirty fellow. You are a shitty fellow. I don't want to work for you anymore. Can you do that? Is that acceptable? No. We are all professionals, right? So when we are accepting the engagement, we are so professional. When you are in case, if because of unavoidable circumstances, you have to withdraw from the engagement, then also follow some protocol. Sir, what protocol I have to follow? First, to go and discuss with the client's management and those charged with governance. Go to the concerned person in the organization, discuss with them. Sir, these issues I am facing. Try to resolve it kindly. So first, go and have a formal discussion. In case after the formal discussion also the issue is not getting resolved, if you find it is appropriate to withdraw. Even after discussion also resolution is not happening, then withdraw. But before withdrawal, discuss with the management and those charged with governance the reasons. Sir, because of so and so reasons, I'm unable to continue. I will withdraw. Discuss the reasons with them. And in some cases, when you are withdrawing, there will be a professional, regulatory, or legal requirement to communicate with the regulatory authorities. Sometimes because of legal responsibility, in case if you are withdrawing, you might be required to communicate with legal authorities. Like for example, in the case of a company, if you want to retire as an audit, if you want to withdraw from the position of auditor of a company, you have to submit one form number ADT3. So you have to submit that form. So like that, in some cases, there will be legal responsibilities to communicate with the regulatory authorities, communicate your, fulfill your requirements. And finally, whatever issues are there, whatever consultations are there, whatever conclusions are there, you have to document all that. Because of what reasons you have withdrawn, what communications you had, to whom you have reported. So all these things you have to document. So these are the few things which you need to follow regarding acceptance and continuation of client relationship. Very important thing is 3 factors you have to consider: integrity, commitment, integrity, competence, and capability. How you can get to know about integrity, how you can decide whether you are competent or not, and what if there is a conflict of interest. If you have decided to withdraw, what protocol you have to follow. So that is the third area in which you need to have some policies and procedures. Now coming to the fourth part. Fourth area in which you need to implement some policies and procedures is human resources. Human resources means your staff. Regarding your staff, you need to follow some policies and procedures. What kind of policies I need to follow? I need to have sufficient personnel with capabilities, competence, and commitment. I should recruit those kind of people who are capable, who are competent, and who are committed to quality. And also I should have proper policies in my HR area, like recruitment. At the time of recruitment, I should be recruiting only qualitative people. I should offer them enough of compensation. I should give them training. I should give them career development. I should review their work, whatever you're doing. So these kind of policies you need to have, like recruitment, compensation, training, career development, performance evaluation, and continuous professional development you have to give. If someone is doing very well, give them recognition, increases compensation, give them promotion. So that continuing professional development you have to offer. And there should be some policies and procedures where what is the role of engagement partner, that should be communicated with the client, that should be communicated with the engagement team. And engagement partner also should have appropriate capabilities, competence, and authority. The partner to whom the work is assigned, that person we called as engagement partner. We should make sure that that person is also having proper capabilities, competence, and authority, and all the responsibilities are clearly defined in the firm. What is whose responsibility, that has to be clearly defined. Clear, everybody? So this is what regarding human resources. Regarding your human resources also, you need to follow some policies and procedures. Now comes the next part, most important part. Fifth area in which I need to implement some quality control policies and procedures is engagement performance. When you are actually performing any engagement, then also you need to follow some policies and procedures. So what procedures I need to perform when the engagement is actually getting performed? Number one, first thing, you have to do briefing. For example, my firm has got audit. My firm has got audit of client X Limited. So one fine day, I have to start doing the audit. I have taken 10 of my engagement team members and we went for doing the audit of X Limited. I should not be asking all my team members go and do the audit. First, I should have some discussion. Tell my engagement team members, boss, this is how we are supposed to do the work. These are our objectives for this engagement. This is how we have to comply with the standards. This is how we need to work. You have to give them training. We have to give them supervision. And during the time when they are working, even you have to review their work also. So that is the first point, briefing of engagement team. You have to brief, you have to give an introduction to your engagement team before you ask them to do the work. So discuss with them what are the objectives, discuss with them the processes, how they can comply with the standards. You have to do them proper supervision and training. And once they have done the work, you have to review their work also. Don't blindly believe, you have to review their work also. Next, in case if anyone is suffering during the course of any engagement, if there is any issue, if there is any difficult matter, there should be proper consultation happening. So if one article assistant has faced any difficulty while doing his work, he should come and consult. He should not take his own decision. There should be proper communication happening. And that communication can happen internally also or externally also. If within the firm only all the expertise, all the people having expertise are there, you can consult internally. In case if the firm is not having that much internal resources, even they can go for external consultation also. So consultations will be required in difficult or contentious matters, and these consultations can happen with individuals within or outside the firm who have special expertise. And whatever consultations you had regarding that, proper documentation also you have to maintain. So regarding engagement performance, first one, there should be proper briefing happening. Number two, consultation should happen in difficult matters, and there should be something called engagement quality control review. So now what is this engagement quality control review? Nothing but, if I have to give you example, so this firm ABC and Co has got audit of client X Limited. Now in this firm totally 33 staff are there, but all 33 people will not work on same project. So what has happened is, Mr. A, being an engagement, he took the responsibility for this client X Limited, so he became engagement partner. Out of the remaining staff, some 10 staff he has picked. So this Mr. A, engagement partner, along with some 10 staff, these collectively has went for doing the audit of the client X Limited. Now these people, we call them as engagement team. Now this engagement team has gone and done the audit of this client X Limited. They have done audit procedures, they have obtained audit evidence just before they express the opinion. After they have done all their work, after they have gathered all the evidences, just before they express the opinion, whatever judgments this engagement team has made while doing the audit, whether they have done that judgments in a proper way, whether they did the work properly, whether they have taken proper decisions, whether they have obtained proper documentation, whether they have obtained proper consultation or not, someone should come and check this. Someone should come and check this. That review we call them as engagement quality control review. So just before, after you are done with all the work, just before you express your opinion, someone either within the firm or outside of the firm should come forward and check whether the judgments made in the audit are appropriate or not. That review should happen. That process we are going to call it as engagement quality control review. And engagement quality control review is mandatory for listed companies, not for all companies. For listed companies, engagement quality control review is mandatory. Clear, everybody? So that is what they say here. Engagement quality control review should happen. Whatever significant judgment that are made in the engagement should be reviewed by an engagement quality control reviewer. Okay. And as you could see here, engagement quality control review, this process is mandatory for all audits of financial statements of listed entities. For listed entities, it is mandatory. And also there is a guidance given in case engagement quality control review is happening for listed entities, engagement quality control reviewer should compulsorily verify these things. In the case of listed entity, the person whoever is conducting that review should compulsorily verify these things in the case of listed entities. So what basically engagement quality control reviewer will verify? Whether the firm has done the work in an independent manner or not. Did they comply with independence requirements? How they have handled the significant risk? What kind of judgments were made, especially with regard to materiality? Whether appropriate consultation has taken place or not. In case of difficult matters, proper consultation has taken place or not. And what is the effect of corrected and uncorrected misstatements? Whatever matters which are required to be communicated with those charged with governance and management, whether those matters are communicated or not, whether they have maintained proper working papers or not, whatever report they have issued, whether that report is appropriate or not. So these are the basic things which are required to be verified by engagement quality control reviewer. Clear, everybody? Now, sometimes what will happen is there will be difference of opinion between engagement partner and engagement quality control reviewer. So take this example only. In this case, for this client X Limited, Mr. A is acting as an engagement partner. Okay. Then another partner, Mr. B, he acted as a engagement quality control reviewer. This engagement team has done the audit in which Mr. A is an engagement partner, but review is done by another partner, Mr. B. Mr. A is an engagement partner, Mr. B is an engagement quality control reviewer. In 99% of the cases, what will happen is both will have common opinion, both will have common conclusion. But in some cases, what will happen is there will be a difference of opinion between engagement partner and engagement quality control reviewer. Like engagement partner is telling, depending on whatever audit we have done for this client, we will give unmodified opinion. But engagement quality control reviewer is telling, no, you have to give here modified opinion. Have to give here modified opinion. So generally 90% of the cases, both will sit together, discuss, and they will come to one mutual understanding. But in some cases, what will happen is the difference will not get resolved. This person is insisting, no, we have to give unmodified. Engagement quality control reviewer is telling modified opinion. Now what should happen? There is a deadlock here. Engagement partner is not agreeing with engagement quality control reviewer. There is a difference of opinion. Now what should be done? Now what should be done is, in that cases, the firm might have set a policy. The firm might have set a policy. So every firm will have a policy. They will draft a policy in case of conflict between engagement partner and engagement quality control reviewer, what they should do. Every firm will have a policy, follow that policy. Like take for example, this firm has set a policy that in case if there is a difference between engagement partner and engagement quality control reviewer, they will go to some another auditor, another firm. They will go to so and so firm, some XYZ Limited, and whatever that XYZ and Co, and whatever that firm says, that will be final. So like that, every firm will have one established procedure, or some firms might have a policy that engagement quality control reviewer decision will be final. Some firms might have a policy that engagement partner decision will be final. Like that, every firm will have a policy. As per that firm's policy, this issue has to be addressed. This is important thing here. So there might be difference. See, I'm reading this. There might be difference of opinion within the engagement team, with those consultant, and between engagement partner and engagement quality control reviewer. To the extent possible, you have to resolve it. In case recommendations of engagement quality control reviewer are not accepted by the engagement partner and the matter is not resolved, the matter should be resolved by following established procedures of the firm. Every firm will have an established procedure. That procedure you have to follow. Then at the time of performing the engagement, you have to maintain proper documentation also. So we have to prepare audit file within 60 days from the date of auditor's report. So you would have performed all the engagement. So for example, in this case, we have 11 engagement team members. Every person will have some part of documentation regarding whatever work we have done. All that documentation of 11 engagement team members should be assembled in the form of one single file. There will be documentation with different people. So all that documentation should be clubbed together and assembled into one file. Sir, within what time limit that assembly process should be completed? Assembly of final audit file should be completed within 60 days from the date of auditor's report. The moment audit report has been given, from that date, within 60 days, you have to complete that assembly process. And also you have to document various matters. You have to maintain various matters like confidential. This documentation, whatever you have maintained, that should be kept confidential. That should be in the safe custody. There should be integrity over it. Accessibility and retrievability should be there. You can maintain documentation either in paper form, or you can also maintain documentation in electronic form. Okay, clear? And even you have to maintain documentation regarding engagement quality control review also. In case if engagement quality control review has happened, then you should document what procedures were followed regarding engagement quality control review, whether engagement quality control review has been completed or not, has the reviewer has any unresolved matters, like if there is any conflict between partner and reviewer, what we should do. So whether you have come across those circumstances. So these matters regarding engagement quality control review also must be included in the documentation. Sir, who is the owner of that audit documentation? Auditor. The firm is the owner of that. It is a property of the firm. The documentation, the engagement documentation is going to be the property of the firm. A firm will have exclusive rights over it. They need not share even the extracts even to the client also. It is completely at their discretion. So if they want, they will share it. If they don't want, they will not share it with anybody. It is completely property of the firm. And how long those documents are required to be retained? Those documents are required to be retained in case of audit. The documentation is required to be retained for not shorter than 7 years. So you have to retain that documentation also. You should not throw it away. You have to retain that documentation for a significant number of years. So these kind of policies you need to have regarding engagement performance. So what are the things we have seen here, guys? Number one, briefing of the engagement team should happen. If there is any difficult matter, consultation should take place. There should be a process called engagement quality control review. What things will be verified by the engagement quality control reviewer? What we should do if there is difference of opinion between engagement partner and engagement quality control reviewer? What kind of documentation you have to maintain? How long you have to assemble it? It is whose property, and how long it should be retained. So this is the fifth area in which you need to follow some policies and procedures. Now we have the next thing here. The next area in which we need to follow some policies and procedures is monitoring. In the above 5 areas, we have implemented policies and procedures. Just implementing that policies and procedures alone will not be enough. Whatever policies we have implemented, whether they are adequate, whether they are getting practically followed, in case is there any requirement to update those quality or update those policies and procedures, that continuous monitoring also should happen. Just by implementing policies, your responsibility is not going to come to an end. You need to, what you need to do, you need to monitor also. You need to review them also. The same thing they are telling, you need to verify whether quality control policies are relevant, adequate, whether they are operating effectively, whether really they are getting applied or not, that we need to see it. And we need to do ongoing consideration. Continuously, we have to evaluate the system of quality control in case. And what we need to do, quality control of engagements has to be monitored, taking into account the following factors: whether they are appropriately designed or not. Whatever policies we have designed, are they appropriate or not? Because of any change in professional standards, are we required to update our policies and procedures? And you have to give this monitoring responsibility to one partner or other persons. Even for monitoring also, for checking also, this responsibility also you should give to someone. And you need to check whether there are any allegations against the firm. See, even after following all the policies also, if you are receiving allegations from the outsiders, that means somewhere your policies are lacking. So check whether there are any complaints or allegations against the firm, and what remedial actions the firm is taking, and what kind of deficiencies are there in the firm's quality control policies and procedures. From all these perspectives, you have to monitor also. Understood? So these are all the various areas in which you need to follow some policies and procedures. So 6 areas SQC1 has told. In those 6 areas, you need to implement policies and procedures for every engagement you are doing to make sure that you are doing that engagement in a quality manner. The next standard which we have to take up for discussion is SA 220. As I have told you, SA 220 is only talking about how to maintain quality in audit engagements. Entire standard is going to remain the same. Entire standard is going to remain the same. We can quickly wind it up in 5 minutes. SQC1, what is objective? SQC1's objective is every engagement you are doing, you should get reasonable assurance that your work done is as per professional standards, as per legal and regulatory requirements, your reports are appropriate. Then what will be objective of SA 220? Whatever audit engagement you are doing, that audit you are doing as per professional standards, that audit you are doing as per legal and regulatory requirements, that audit report is appropriate. Same, exactly copy pasted. SQC1 they say engagement, SA 220 they say audit. Next, here also you need to implement policies and procedures in 6 areas. What 6 areas? Leadership responsibility, relevant ethical requirements, acceptance and continuation of the client relationship, assignment of engagement teams, nothing but this is something related to human resources, engagement performance and monitoring. Same 6 areas, no? Whatever SQC1 says, SA 220 also says the same thing. Now, talking about leadership responsibility, sir, who should come forward and take the leadership responsibility? At the firm level, in SQC1, I told at the firm level, either firm's managing partner or CEO should come forward and take the leadership responsibility for the entire firm. Now, at the audit level, who should come forward and take the leadership responsibility? Engagement partner. They say what? Engagement partner. At the firm level, managing partner or CEO will take the leadership responsibility. At the engagement level, at the audit engagement level, engagement partner should take the leadership responsibility. So same thing they say there, leadership responsibility of an engagement partner is to take the responsibility for overall quality on each audit engagement. And as a leader, as an engagement partner, how you can fulfill that leadership responsibility? You can fulfill that leadership responsibility by emphasizing, by highlighting the importance of quality. And you have to communicate with your engagement team members how important it is to do the work as per professional standards, how important it is to comply with the policies and procedures, whatever policies and procedures we have set at the firm level as per SQC1, why we have to comply with that. We have to highlight, and also we have to highlight why we have to issue appropriate audit report. And you should create a very good culture where everybody can raise their concerns without any trouble. And you should also highlight that quality is always important. So simple summary of this is, as an engagement partner, you should take the leadership responsibility for quality of audit. And as a leader, you have to highlight how important it is to maintain the quality, how important it is to comply with the professional standards, why they have to raise their concerns. If they face any trouble, they should be able to raise the concerns without any fear. And also you should highlight that quality is important, quality is essential. So this is how you need to fulfill leadership responsibility. Second one, relevant ethical requirements. This discussion is going to remain common. So you have to comply with 5 ethical requirements. If you come across any threat to independence, try to eliminate it. If you are unable to eliminate it, withdraw from the engagement. This we already know. Acceptance and continuation of client relationship. We have to consider various factors. I have already told you before accepting or continuing client relationship. You have to check integrity. You have to check the competence, that is capability. You have to check the compliance with ethical requirements. And one more point they add here, any matters which have arisen during previous assignment. In case if you have already worked for this client, whether any significant matters have arisen during the previous audits, that also you consider. Like for example, last year I have done company audit for the client. Current year also the same client is asking me to do the company audit. But last year the client troubled me a lot. They did not give me evidence. They made me ask a repeated number of times. Sometimes they shouted at me. If that client is coming to me in the current year and asking me to do the audit for the current year also, what I will say? I will better stay away from the audit. Sir, no thanks. I will not do your audit. So like that, one extra point they have added. in addition to the 3 factors which you will consider as per SQC1, integrity, competence, and ethical requirements, you should also consider any significant matters that have arisen during previous audit assignments. Next one, you should properly assign your engagement team, nothing but your human resources. Proper team should be there. Your team should be competent. Your team should be capable. They should have knowledge of professional standards. They should comply with legal and regulatory requirements, similar to human resources. Then when the engagement is getting performed, when the audit engagement is getting performed, then also you need to follow some policies and procedures. You have to properly supervise them and review the work. And you should make sure that you are giving appropriate audit report. Why? Because for the audit report, ultimate responsibility will be with the engagement partner. If something goes wrong, not entire engagement team will go and sit in the jail. Engagement partner will go and sit in the jail. So that's why he has to understand that the ultimate responsibility for audit report is always going to lie on engagement partner. And you have to check whether your engagement team has maintained proper documentation or not. You should check whether they have obtained sufficient and appropriate audit evidence or not. And as I have told, if there is any difficult matter, whether consultation has taken place or not. So these are steps you have to follow when the engagement is getting performed. And finally, monitoring you have to do same way like SQC1, whatever policies and procedures you have implemented for quality control in audit, whether those policies are complied or not. Is there any requirement to update them? Are there any deficiencies? This monitoring also should happen. And you should include certain things in the documentation. So as an engagement, these things also we have seen. So you should include in your documentation how you have complied with ethical requirements. Have you complied with independence requirements or not? In case if any threat is there, how you have dealt with that? What factors you have considered regarding acceptance and continuation of client relationship, and regarding which matters you have taken consultation. And also, in case if engagement quality control review happened, this point we have already covered in SQC1, you have to document what procedures are performed for engagement quality control review, whether review has been completed or not, are there any unresolved matters. That's it. So these things must be included in documentation. Clear, everybody? So this is what this chapter is all about. This is what SQC1 and SA 220 is talking about. Even though for namesake we have 2 standards, if we understand SQC1, if we read SQC1, automatically we have read SA 220 also. Clear? That's all regarding this chapter. That's all regarding this chapter, guys. So with this, we are successfully done with SA 220 and SQC1 quality control chapter we have completed. Clear? Right. Hello my dear students, welcome back to the revision series. Now in this session we are going to revise the SA 200 series of the standards. What we are going to revise in the session, 200 series of the standards we are going to discuss, and particularly when I specify the standards which we are about to discuss in the standard, so those are 4 standards: SA 240, SA 250, then we are going to revise SA 260. Along with that, we are also going to revise SA 299. And the content of these standards you will be able to find in our material in the chapter General Auditing Principles and Auditors Responsibilities. So when you open this particular chapter from our material, you will be able to find all these 4 standards under 200 series, which are what? 240, 250, 260 and 299. All the 4 standards we are going to discuss. SA 240 is a standard which is going to talk about auditors' responsibilities relating to fraud. So it is mainly going to talk about the fraud and related matters. SA 250 is going to talk about what is auditors' responsibilities regarding compliance with the laws and regulations. SA 260 is going to talk about communications with those charged with governance, and SA 299 is going to talk about joint audit and its related matters. So that is what going to be the subject matter of all our discussion. And one more thing here, for the purpose of explanation of these standards, I'm going to make use of this charts. So I have prepared this interactive charts. I've already told you where you can find the material. So where you can find this charts also. So just visit our website www.fingansacademy.com. In the description also you'll be able to find the link. So in that website you have to go to the resources section. In that resources section you will be able to find all the resources whatever I am using here. So for these standards, instead of revising from the direct main material, I have prepared these kind of interactive charts. From these charts we will try to revise it. Okay. So my suggestion will be, first at least once you should have read the main material. So whatever this main material content is there, at least once you should have read that standard. After you are comfortable reading the content of the entire main material, then only you use these charts for the purpose of your revision. So these charts are meant for revision. These charts are not meant for first time preparation. So I will tell you what will happen when you rely completely only on this. See, today in the market, these things are very popular. So they say something like summary notes, summary charts, a lot of things you will be able to find it in the material. But what is a mistake? I'm not telling they are bad, they're good actually. But what is a mistake which most of the students will do is they read only from that summary material. They read only from the charts. They read only from that summaries. Then the problem will be you will not be able to present the answers in the examination. That is not a proper way of preparation. So what you should do is you should read the content from the main material. For revision purposes, you have to make use of the summary notes, charts, whatever it is. Use it for revision purposes, not for the main preparation. If you are going to prepare only from that summary notes and all, then you are going to face a lot of struggle in the examination. You will not be able to write the content. Clear, everybody? So now I will be revising. We will start our revision with SA 240. Sir, what does SA 240 deal about? As you could see, the title of the standard, it is talking about auditors' responsibilities relating to fraud in an audit of financial statements. So this standard is going to talk about, as an auditor, if you are conducting audit of some entity, in case if you came to know about any fraud, or if you have suspected any fraud, if you found any risk of material relating to fraud, as an auditor, what are the responsibilities you should fulfill? What are the obligations you have to fulfill? So as an auditor, whenever you are conducting audit of any client, if you came to know any fraud has taken place in the client, or you suspected any fraud, or there is a risk of material misstatement regarding fraud, as an auditor, what responsibilities you have to fulfill? That is what the standard is going to talk about. But first of all, we have to remember, we have to go back to our basics. See, in the introduction chapter, I have explained you what are the objectives of the auditor. There are two objectives of the auditor. So ultimately, auditor is required to express an opinion, and that opinion is required to be expressed regarding two things. Number one, whether financial statements are free from material misstatements, and whether financial statements are prepared as per applicable financial reporting framework. We all know this very long ago in the introduction to audit. We have understood this. So now here, most important thing is financial statements should be free from material misstatements. Financial statement should not contain any material misstatements. And I was already told you the meaning of the term misstatement. What do you mean by misstatement? Misstatement means we have understood as any difference between amount classification, presentation, disclosure, which is there in the reported financial statements, and amount classification, presentation, disclosure required as per applicable financial reporting framework. Simply, if I have to put it, a mistake in the financial statements, we are going to call it as a misstatement. And a misstatement can, in the financial statements, a misstatement in the financial statements can happen either because of fraud also, or a misstatement in the financial statements can happen either because of error also. The misstatement in the financial statements can happen because of two reasons. It can either happen because of fraud, or it can happen because of error. Sir, what is the differentiating factor between the two? As you all are aware, fraud is something which is done intentionally, knowingly, willfully. You know that you are committing wrong, but still if you are committing it, that we call it as fraud, intentional. Whereas error is something which is unintentional. Error is something which is what? Unintentional. So a misstatement in the financial statements can happen because of either fraud or error. But you tell me, which is a matter of more concern for the auditor? Regarding which misstatement auditor has to be more concerned about? So auditor has to be more concerned about fraud. See, both have the potential, fraud and error, both have the potential to cause a material misstatement in the financial statements. But as an auditor, you have to be more concerned, you have to more worry, you have to perform more procedures, you have to face a lot of struggle for identifying the fraud, because it is intentional. When someone is doing an act intentionally, no one will do it in such a way that they will get easily caught. They will take all the precautions, they will take all the measures to make sure that this fraud is not coming to anybody's notice. So since it is committed intentionally, it is always going to be damn difficult for the auditor to identify the fraud. So that's why, since a fraud is such a crucial matter, such a critical matter, such a difficult matter, ICA has given a dedicated standard. Okay, dear auditors, you don't worry. I'm going to give you guidance, what responsibilities you are required to fulfill, what procedures you have to follow, what techniques you have to follow, in which and all ways fraud can be committed. We will teach you, we will guide you. You can use the standard to fulfill your responsibilities. With that intention, SA 240 has been given. So now, having said that, let us directly go into the standard. First of all, what is the definition of the fraud? How can you define the term fraud? So the fraud has been defined something like this. Fraud is an intentional act. When something is done intentionally, fraud will always be done intentionally. It is not by mistake something is happening. When I say fraud, someone is doing it intentionally, knowingly. So it is an intentional act. It can be committed by one individual or more than one individual. Either one single person can commit a fraud, or different people can collude together. More than one individual can also collude together and then commit a fraud. Sir, who can be that individuals? You are telling fraud is an intentional act. It can be committed either by one or more individuals. Sir, who can be that individuals who can commit fraud? those individuals who are committing this intentional act, they could be from management, they could be from those charged with governance, they could be from employees, or they could be from third parties. Either management can do the fraud, those charged with governance can do the fraud, or employees can do the fraud, or even third parties like debtors, creditors also can commit a fraud. Sometimes all these people can collude with each other and can commit a fraud. Management, those charged with governance, employees, third parties, all are colluding with each other, and then also they can commit a fraud. This is what happened in the case of so-called bigger scams in our country, like PNB scam. It happened because people at different levels have colluded with each other. So fraud is an intentional act. It can be committed by one or more individuals, and those individuals can be among management, those charged with governance, employees, or third parties. And it always involves the use of deception. When you are committing a fraud, you are using deception. Sir, what do you mean by deception? You are cheating. By committing fraud, you are not doing any noble act. By doing fraud, you are cheating. It involves the use of deception. Sir, why we are cheating, sir? To obtain an unjust or illegal advantage. So you are committing that intentional act, you are cheating someone. Why? Because you want to get some illegal advantage, you want to get some unjust advantage. Unjust means for which you are not entitled to. You wanted to get some advantage, wrong advantage you want to get. So such an act we call it as fraud. Such an act we call it as what? Fraud. Clear, everybody? So this is what the definition of fraud. Come on, repeat everybody once again. Fraud is an intentional act committed by one or more individuals. Those individuals can be among management, those charged with governance, employees, third parties. It involves the use of deception and to obtain an unjust or illegal advantage. Now, so if you come to the next part, the next most important thing, let us talk about responsibility. Who is responsible for prevention and detection of fraud in the company? Let us take an example, Reliance Industries Limited. So there is a company, Reliance Industries Limited. Now, in this Reliance Industries Limited, who is responsible for preventing and detection of the fraud? Who is responsible for stopping the fraud from happening? Who is responsible to detect the fraud if at all it happens? The standard also says the primary responsibility, the major responsibility, the first and foremost responsibility for prevention and detection of fraud rests with management and those charged with governance. Who is primarily responsible for ensuring prevention of frauds and detection of frauds? Management and those charged with governance. So then what is auditor's responsibility? See, nowhere the standard has told no standard has told auditor is responsible for prevention and detection of frauds. So even SA 200, the first and foremost standard, also says the responsibility of auditor is to obtain reasonable assurance whether financial statements are free from material misstatements. And also we know that there are some inherent limitations of audit. The process of audit is suffering from some inherent limitations. No matter how effectively you do the audit, still there is a chance of some misstatements not getting detected. So auditor cannot be expected to prevent a fraud. Auditor will not be able to detect all kind of frauds also. The responsibility of the auditor is to obtain reasonable assurance whether financial statements are free from material misstatements or not. And because of some inherent limitations, auditor sometimes may not be able to find out a fraud also without his mistake. Now, whether auditor will be able to detect a fraud or not, it depends on so many factors. Whether auditor will be able. So if you see this point here, the auditor's ability to detect a fraud depends on various factors. Sir, what are the factors? Number one, it depends on skillfulness of the perpetrator. Skillfulness means the person, whoever is committing the fraud, how much skillful he is. See, if the fraud is committed by a very skillful person, very talented person, then what will happen? It becomes very difficult for the auditor to detect. On the other hand, the fraud is committed by a useless fellow. He is not so skillful. The auditor can easily identify it. It also depends on frequency and extent of manipulation. How frequently the fraud is getting committed. If the fraud is getting committed very frequently, somewhere it will come in my sample, it will be easy for me to detect. It also depends on degree of collusion, whether one person is committing a fraud or group of persons colluded. If one individual is committing a fraud without collusion, it is easy to detect. If so many people are colluding with each other, it is very difficult to detect. It also depends on the relative size, how much amounts are getting manipulated. If a very bigger amount of fraud has committed, somehow it will get attention. If small, minute amount of frauds are getting happened, it becomes very difficult to detect. It also depends on seniority of the individuals involved. What is the seniority of the person whoever is committing a fraud? If the person committing the fraud is very senior person, it becomes very difficult. If he is a new person, somewhere he will go wrong, we can get easily caught. So whether auditor ability, that is whether auditor will be able to detect a fraud or not, it depends on all these factors like skillfulness of the perpetrator, frequency with which the fraud is getting committed, how much degree of collusion is involved, what is the size of the amounts which is getting manipulated, and also seniority of the individuals. So you have told all this, but when auditor will be held responsible? If the auditor is unable to find out a fraud, if the auditor is unable to detect a material misstatement resulting from fraud, will he always be punished? will he always be held responsible? The answer is no. SA 240 says the auditor will be held responsible for non-detection of fraud only when it is purely because of negligence. So if you see this, the liability of the auditor for failure to detect a fraud exists only when such failure is clearly due to not exercising reasonable care and skill. That means if the auditor has acted in a negligent manner, that's why he was unable to find out. That's why he was unable to find out the fraud. Then he will be definitely held punishable. However, if the auditor has put all the effort, he was not negligent, he was sincere, he was honest, he did everything in his control, but still he is unable to find out the fraud, then he will not be punished. Now the doubt comes, so it is whose responsibility to prove. Whether he did the work in a careful manner or he was negligent while doing the audit, it is whose responsibility to prove? It is always and always auditor's responsibility to prove using audit documentation. Clear? So this is what regarding prevention and detection of fraud responsibility. Number one, primary responsibility is with management and those charged with governance. Summary of the auditor's responsibility is auditor will be held responsible only when he is unable to detect the fraud because of negligence. Now, sir, what is the objective of the auditor? Very simple. This standard SA 240 puts three objectives on the auditor. As an auditor, you are supposed to do three things. First of all, you should find out whether there is any risk of material misstatement due to fraud. Risk means you have to find out the probability first. By performing risk assessment procedures, you need to find out, is there any risk of material misstatement resulting from fraud? Is there any chance of happening of misstatement from fraud? So first you need to find out risk of material misstatement because of fraud while performing risk assessment procedures. In case, if you find a risk of material misstatement regarding fraud by performing risk assessment procedures, then you need to perform further audit procedures and obtain sufficient and appropriate audit evidence. First thing, perform risk assessment procedures and find out whether there is a risk of material misstatement relating to fraud. Number two, in case if you found there is a possibility of risk of material misstatement of fraud, then you need to perform further audit procedures to obtain sufficient and appropriate audit evidence whether fraud has actually taken place or not. In case by performing the further audit procedures, if you have actually found out the fraud, if you have identified the fraud, if you have suspected the fraud, then you have to respond appropriately. Then you have to fulfill your reporting responsibilities. So three objectives: find out risk of material misstatement. If you find risk of material misstatement, try to obtain evidence by performing further audit procedures. By performing that procedures, if you have finally found out the fraud, respond appropriately, fulfill your reporting requirements. These three are the objectives of auditor. Next. And next thing, we can divide frauds into two categories. So the two different categories of the fraud are, one is fraudulent financial reporting and the other one is misappropriation of assets. What are the two kinds of frauds, guys? There are the two kinds of frauds are, number one, fraudulent financial reporting, and the other one is misappropriation of assets. So now what is fraudulent financial reporting? As I've already told you, financial reporting means the process of preparation and presentation of financial statements. Fraudulent financial reporting means what? If the management of the organization is preparing financial statements in such a way that they are giving a wrong picture by doing omissions from the financial statements, by misapplying the accounting policies, if the management is trying to convey wrong picture through the financial statements, that kind of fraud we are going to call it as fraudulent financial reporting. On the other hand, the next category of fraud is misappropriation of assets. Sir, what do you mean by misappropriation of assets? Misappropriation of assets refers to those kind of frauds in which there is a theft, damage or loss happening to the entity's assets. So in misappropriation of assets, it involves theft of an entity's assets, or even it could involve damage of an entity's assets. So in this manner, we can divide frauds into two categories. Number one, fraudulent financial reporting, those frauds in which management is trying to convey wrong picture through the financial statements. Assets are not getting damaged, but they are trying to convey a wrong picture in the financial statements. That we call it as fraudulent financial reporting. Another category of fraud, which we are going to call it as misappropriation of assets, where entities' assets are getting stolen, damaged, misused, etc. You tell me, in which kind of fraud always management involvement will be there? In the fraudulent financial reporting, management involvement always will be there. Whether without the management's involvement, fraudulent financial reporting is not going to happen. Because if the financial statements have to convey wrong position, that couldn't happen without the involvement of management. So always the top level management will be involved in the fraudulent financial reporting. Whereas misappropriation of assets, the stealing of the entity's assets and all, this is mainly conducted by employees and low level staff. So you tell me which one is more difficult between fraud and error. Fraud is more difficult to detect. In the fraud also, between misappropriation of assets and fraudulent financial reporting, which one is more difficult to detect? Fraudulent financial reporting. Logic behind it, the top level management is involved in it. Next one. Next thing, what are the instances which induce the management or employees to commit a fraud? Sir, why management will commit fraud? What causes the management to commit fraud? For example, if the management is trying to commit a fraudulent financial reporting, if they want to convey a wrong picture to the financial statements, what causes them to do that? Similarly, if an employee wants to commit a misappropriation of assets, if the employee wants to steal the assets of the company, what causes that employee to do that? You take any fraud, be it fraudulent financial reporting or misappropriation of assets, for any fraud to happen, there are three instances which must be present. So what are the three factors because of which any fraud will happen? Number one, incentive or pressure. Number one is what? Incentive or pressure. If a management is committing a fraud, they might commit that fraud because they are under some pressure, or they find some incentive in committing the act. If an employee want to steal the assets, why he is stealing the assets? Either there will be pressure on him, might be because of financial obligations and all, or he finds some incentive. If he steal the assets, sells it outside of the company, he can make the benefit out of it. Incentive, reward. So first factor for any fraud to happen, the first thing which should be present is there should be either incentive or pressure. Next one. See, having an incentive and pressure alone will not be enough. There should be an opportunity also. Like for example, an employee is having a lot of pressure to steal the assets of the company, but the company is having a strong system of internal control. Do you think fraud can happen? No. So there should be some opportunity, like a weakness in the internal control. So there should be incentive or pressure. That should be supported by a perceived opportunity, and these two alone will not be enough. For example, I am an employee, I have a strong pressure to commit a fraud. I find there is a weakness in the internal control also, but I have a very good attitude. I am unable to justify my wrongdoing. If I commit the theft of the asset, I will not be able to rationalize. I will not be able to justify. I have a very good attitude. Then also fraud will not happen. So the concluding factor, which is the final step, which induces a person to commit a fraud, is rationalization, attitude. You should have such a bad attitude to justify your wrongdoings. If you commit a wrong thing, you should not be able to justify it. If you are able to justify, then only you can commit a fraud. Able to understand? So that justification attitude also should be there. What should be there? That justification attitude, bad attitude also should be there for any fraud to happen. So you take any fraud, whether management fraud or employee fraud, for any fraud to happen, there should be three things which must be present. Either there should be incentive or pressure, and there should be an perceived opportunity, and there should be rationalization. There should be bad attitude to justify your wrongdoings. If these three things are present, then only any fraud can take place. Now coming to the next part, sir, you told fraudulent financial reporting. So fraudulent financial reporting means management will try to convey a wrong picture through the financial statements. How the management can do it? There are different ways in which management can commit fraudulent financial reporting. So now they are addressing how fraudulent financial reporting may be committed by entities. So how they can do it? Number one, they can do manipulations. They can do falsification like forgeries and all. They can do alteration of the accounting records. They can manipulate the accounting records or even supporting documents. This is one way. Or they will do intentional omissions. Intentionally, they will omit some items from the books of accounts and financial statements. Like for example, they are omitting to create a provision to inflate their profits. Quite possible. Or intentionally, they will misapply accounting principles. Capital expenditure, they will treat it as revenue expenditure. Revenue expenditure, they will treat it as capital expenditure. Intentionally, they will misapply the accounting policies. And also, sometimes management themselves will override internal controls. As I have told, for fraudulent financial reporting to happen, management should be involved. So what management will do is, they will only implement internal control, but sometimes they themselves will violate the internal controls to commit that fraudulent financial reporting. So what are the different ways in which they can override the controls? So as you could see here, they can record fictitious journal entries, fake journal entries they can record, particularly close to the end of the accounting year. Or they will play with assumptions. Under provisioning, over provisioning, more depreciation, less depreciation, they can play with the assumptions like anything. Omitting, as usual, they can omit entries. Advancing or delaying recognition. Like future year expenses, they will recognize in the current year. Last year's expenses, they will recognize in the current year. They can either advance recognition or delay the recognition. Or they can conceal the facts. They can hide the important facts from the shareholders. They will hide the contingent liabilities like pending cases and all. That is also fraudulent financial reporting only. Or they will intentionally engage in the complex transactions. They will engage in difficult transactions so that ordinary person cannot understand. If the ordinary person does not understand, they will not ask the questions. Next one. Or they can even alter records and terms relating to significant unusual transactions like related party transactions. So these are all the different ways in which the management can commit fraudulent financial reporting. Similarly, sir, how misappropriation of assets will be conducted? What are the different ways in which employees can commit misappropriation of assets? Number one, they can embezzle the receipts. Like a cashier is there, he's collecting the sales amount, he's collecting cash from cash sales. Instead of recording it in the books of accounts, he might manipulate it. Or they can steal physical assets or intellectual property, stealing of inventory, stealing of fixed assets, stealing of stationery. They can steal the fixed assets. Or they are causing an entity to pay for goods and services not received. Nothing but employees submitting fictitious bills, fictitious vendors are getting created, actually expenses not incurred, fake bill was submitted to the company and causing the company to pay for that. Or even sometimes entities can use the company's assets for personal purposes also. So these are all the different ways in which misappropriation of assets can be accomplished. 4 ways they have told: embezzling receipts, stealing physical or intellectual properties, causing an entity to pay for goods and services by submitting fictitious bills or fake bills, and using the entity's assets for personal purposes. Clear? So what we have discussed in the standard till now, we have seen what is the meaning of the fraud, responsibility for prevention and detection of frauds, what is the objective of the auditor, what are the various types of fraud, and how these frauds can be committed. So this concept I will come at the end of the standard. So fraud risk factors, I will talk about it later. Let us discuss various other things. See, as I have just now told you, the first objective of the auditor. What is the first objective of the auditor? To find out risk of material misstatement relating to fraud. So while performing risk assessment procedures, you need to identify, is there any risk of material misstatement relating to fraud? Sir, how can I identify that risk of material misstatement related to fraud? The standard is telling a few steps here. Sir, what are that few steps? If you see here, when you are performing risk assessment procedures, when you are understanding entity and its environment, you should try to obtain information whether there is a risk of material misstatement due to fraud. How, sir? Number one, simply you have to go and inquire the management. What you should do? Go and inquire the management and others like those charged with governance, internal auditors. Go and inquire with them and ask them, sir, is there any fraud which has taken place during the year? First step, go and do the inquiry. Then second step, you understand how those charged with governance exercises oversight of management processes for identifying and responding to risk of fraud in the entity. Nothing but second thing, you need to understand what role those charged with governance is playing. What role those charged with governance is playing, how far they are verifying the management activities, what is the role in the organization, that you try to understand. Third one, we need to identify what kind of internal controls management has implemented to prevent that risk. So try to verify that internal controls. And even you find out, are there any unexpected relationships identified in performing analytical procedures? That means you try to perform analytical procedures, you try to study the relationship between financial and non-financial information, and you find out whether there are any huge deviations, like number of employees have increased, salary decreased. This is a huge variation. This also would give you a hint that there could be a fraud happening in the employee benefit expenses. So like this, the standard simply asks you to do 4 steps in order to identify whether there is any risk of material misstatement due to fraud. What are that 4 steps? Number 1, understand or do the inquiries of the management. Number 2, understand the role of those charged with governance, how frequently they are monitoring the management activities and all that you have to do. Third one, you need to verify what kind of internal controls are there. Number 4, perform analytical procedures and find out whether any unusual relationships are there. So by doing that 4 steps, you will try to identify whether there is any risk of material misstatement relating to fraud. And by performing that 4 procedures, if you came to know that there is a risk of material misstatement, now what you should do? You should respond to that risk of material misstatement. How you should respond to that risk? How you should respond to that risk of material misstatement? By performing further audit procedures. So you basically performed here risk assessment procedures to identify the risk. If you have identified the risk, then you have to respond appropriately by performing what? Further audit procedures. And I told you in the risk assessment chapter, risk of material misstatement can be at 2 levels. Risk of material misstatement at the financial statement level, risk of material misstatement at the assertion level. If the risk is having the potential to cause a misstatement in the entire financial statements, if the risk is having a potential to cause a misstatement in the entire financial statements, we call it as financial statement level risk. However, if the risk is having the potential to cause a misstatement in just 1 or 2 items, that we call it as assertion level risk. Just go back to risk assessment and internal control chapter. We discussed about this in a detailed manner. And between the risk of material misstatement at the financial statement level and at the assertion level, which the auditor has to concentrate more? the auditor has to concentrate more on risk of material misstatement at the financial statement level. Why? Because it is having a potential to cause a misstatement in the entire financial statements. So just go back and watch that risk assessment chapter. You will get more clarity. So after performing risk assessment procedures, you might find out risk of material misstatement at the financial statement level or risk of material misstatement at the assertion level. If you find that there is a risk of happening fraud and that risk is the risk at the financial statement level, that means auditor has to pay more attention to that. How you can tackle that? How you can tackle that is, if you find that risk of material misstatement is a financial statement level risk, you have to allocate your engagement team who is having a lot of skill and ability. Nothing but experienced individuals you have to allocate in that area. Why? Because there is a risk of happening fraud, that too at the financial statement level. So use the best staff in your team to that area. And also you have to particularly check the selection and application of accounting policies, particularly regarding subjective measurements and complex transactions. So you have to pay more attention to that provisions, assumptions, estimates. In that area you have to pay more attention. And finally, incorporate an element of unpredictability. To the extent possible, try to do the surprise checks. What you should do? Surprise checks you have to do. So if you find risk of material misstatement, that too if the risk is at the financial statement level, these are 3 steps you have to follow. First, allocate the most skilled and talented resources in that area. Number 2, try to pay more attention for estimates and assumptions. Number 3, incorporate surprise checks. Whereas if you find a risk of material misstatement at the assertion level, then what you should do is simply you have to perform further audit procedures to address to that risk. That means you have to perform compliance procedures and substantive audit procedures in a normal way. And also, if at all you find that there's a requirement to change your nature, timing, and extent of audit procedures to obtain the best possible evidence, you have to change your nature, timing, and extent of audit procedures as you wish. So nothing but if you find risk at assertion level, we will plan our normal further audit procedures. If at all required, we may even revise our nature, timing, and extent of audit procedures to obtain the best possible evidence. Simply what they are trying to say is, when you do the comparative study, when you find financial statement level risk, you have to be more careful. If you find risk of material misstatement at the assertion level, do the normal further audit procedures. And also audit procedures responsive to risk related to management override of the controls. See, as I have told you, management will always be in a dominant position to override the internal controls in the organization. Who will implement internal control? Management. Since management themselves have implemented internal control, they will also have the power to override the controls as well. Yes or no? So that's why you have to perform some procedures to make sure that management did not override the controls. Because there is always a chance, since the management are the top people in the organization, they can always have a chance of committing the fraud. They will always have a chance of overriding the controls. So particularly with regard to this area, you need to perform some procedures to make sure that whether management has overridden any controls or not. So how you can do that? How you can do that is by testing the appropriateness of journal entries. You have to spend some amount of time for analyzing journal entries. Particularly accounting estimates you have to verify, like provisions and depreciation. These areas compulsorily you have to verify. And you should understand what is the business rationale, what is the logic for undertaking transactions which are outside the normal course of business. If you find any unusual transactions, you should find out what is the business logic for that. So this is what the third area. You should perform these audit procedures which are responsive to risk related to management overriding controls, to know whether management has overridden on controls or overridden the internal controls or not. Particularly, you need to perform these steps. You need to verify journal entries. You need to verify the accounting estimates. You should understand what is the business logic for unusual transactions. So this is how you will respond. Okay, right. So first, what you have done, risk assessment procedures you have performed. Then you have found out risk of material misstatement. In accordance with that risk, you have responded to that risk by performing further audit procedures. Now, by performing these above steps, you will obtain audit evidence. That audit evidence, what you should do? You should evaluate. You should analyze that audit evidence, whatever you have got, by performing the procedures which are responsive to risk of material misstatement. Guys, you have to understand the sequence here. First, we perform risk assessment procedures, identified the risk. Then we perform further audit procedures. By performing that further audit procedures, we get evidence. Now, that evidence we have to analyze. So, what steps we have to follow in analyzing evidence? For example, if you obtain evidence and that evidence indicates that there is a misstatement indicative of fraud. You performed audit procedures, you obtained evidence, and that evidence is indicating that there is a misstatement from fraud. then what you should do? So in case if the auditor identifies a misstatement, the auditor should evaluate first whether it is indicative of fraud. Is the misstatement is because of fraud, that you have to analyze. Yes, if there is such an indication, yes, the misstatement has happened and that is because of fraud. Now what you should do is evaluate implications of the misstatement on other aspects of the audit. So you found a misstatement and you came to know that, for example, you are verifying purchases. In the purchases, you came to know that there is a misstatement and you came to know that that misstatement is not an error, that is a fraud. Now you have to evaluate if in the purchases area only there is a fraud, why can't there be a fraud in the sales? Why can't there be a fraud in expenses? Reevaluate. Once again, go deeper in other areas also and find out is there a fraud in other areas. So if you obtain audit evidence and that evidence is indicating that there could be existence of fraud in one area, you have to evaluate its impact on other areas of the audit as well. Next one. Sir, you obtain audit evidence and that evidence is indicating that there is a fraud, and not just a fraud, there is a management involvement in the fraud. If you have obtained audit evidence and that evidence is clearly indicating, yes, there is a misstatement, and in that misstatement, who is involved? Management is involved. That indication is there on the basis of your evidence. What you should do now? Now what you should do is, so if you find there is a misstatement, that too, who is involved there? Management is involved. That misstatement could be material or could not be material, but you have to be very cautious. In case if the management is involved in the misstatement, whether that misstatement is material or not material doesn't matter. You have to be more focused here. Why, sir? Why? Because since the top level management is involved, you need to do certain things like reevaluate risk of material misstatement. Initially, you don't know that management is doing these kind of activities. You thought management are honest and you assessed the risk of material misstatement as low. You might have performed less audit procedures. But now you got to know what is the true nature of the management. So what you should do? You should perform more audit procedures. You should reassess the risk of material misstatement and increase your nature, timing, and extent of further audit procedures. Clear, everybody? So if you came to know there is a misstatement in which the management is involved, first you need to re-evaluate risk of material misstatement. Since you have reassessed the risk of material misstatement, make changes to your nature, timing, and extent of the audit procedures. And if conditions indicate that there is a collusion and there is a further indication that there is a management involved in the fraud, not just a management, there is a collusion. So many people have colluded with each other. Then what you should do? Then what you should do is you have to reconsider the reliability of evidence previously obtained. Now you got to know management colluded. Management colluded with the different people and committed a misstatement. What about the evidence you have obtained till now? Might be you need to recheck it once again, because whatever evidence you have obtained till now, in that also there could be fraud. So now you got to know. So go and recheck the evidence, whatever you have obtained till now. And if appropriate, even you can consider implications on the auditor's opinion. If those misstatements and all are material, even you can give modified opinions as well. That is what the meaning of considering the implications on auditor's opinion. Clear, everybody? So this is what you are supposed to do in case if your evidence indicates that there is a misstatement in which management is involved. And finally, you need to perform analytical procedures also at the end of the audit. Try to perform analytical procedures, try to study the relationship, try to compare that results of analytical procedures with the understanding whatever you have obtained. If you find any huge deviation, that also you try to analyze. Clear? Basically, they are asking you to perform analytical procedures also. So this is how you need to evaluate evidence. What if the evidence indicate there is a misstatement because of fraud? What if the evidence indicate there is a management involved in the misstatement? What you are supposed to do regarding analytical procedures. And then finally, sometimes because of fraud, the auditor might come across some circumstances in which he is unable to continue the engagement. Sometimes you might come across this. Some extreme circumstances auditor will come across, because of which he will think that because of this fraud, I don't feel it is suitable for me to continue the audit. It will be better if I withdraw from the audit. That kind of circumstances you can come across. You can fall into that dilemma. You are conducting audit, you came to know there is a fraud in that client company, and now you are in a confusion. Oh, this much bigger fraud happened, whether I should continue this engagement or should not continue this engagement. In such circumstances, what you do? In such circumstances, what you should do is first determine whether there is any professional and legal responsibility to report to the persons who made the audit appointment. If you are coming across these circumstances, first determine, is there any professional responsibility on you? Is there any legal responsibility on you to go and communicate this? Sir, I came across these and these circumstances. I am in a confusion now. Whoever has made your appointment, go and communicate with them. Sir, I am coming across these circumstances. And also, in some circumstances, you might be required to communicate to the regulatory authorities also. Like in the case of banks, if you come across those circumstances, you might be required to communicate with RBI. So like that, if you come across such extreme circumstances, determine whether there is any professional responsibility or legal responsibility to communicate those matters to the persons who have appointed you and also to regulatory authorities. After communication, determine is it appropriate and permissible to withdraw. After communications also matters are not getting resolved, then determine is it possible for you to withdraw. Yes, it is possible. If you want to withdraw, yes, withdraw. No one will stop you. Withdraw happily. So you withdraw from the audit, but fulfill some formalities. If you are withdrawing, discuss with the management and those charged with governance the reasons why you are withdrawing. And also determine whether there is any professional or legal responsibility to report these reasons to the persons who have appointed you or to the regulatory authorities. Like in the case of a company, if you are withdrawing, you have to communicate with ROC. So simply the summary is, in case if you come across exceptional circumstances where you are into dilemma whether you should continue the audit or withdraw from the audit, no problem, but fulfill these responsibilities. And also you should obtain written representation from the management and those charged with governance. You have to obtain written agreement from the management and those charged with governance regarding which matter, sir? Regarding that they accept their responsibility for implementing internal control, and they have disclosed it to the auditor all the risk of material misstatement which they have came to know about it, and they have also disclosed it to the auditor if they have come across any fraud, and they have disclosed it to the auditor their knowledge of any allegations of fraud or suspected fraud by employees, etc. Basically, whatever management has got to know about the fraud, everything they have communicated to the auditor. That written confirmation you get from them. Clear? Next. And finally, communication to management and those charged with governance. If after performing all the audit procedures, if you came to know about fraud, what you should do? You have to go and communicate that fraud to appropriate management on a timely basis. If you came to know about the fraud, what and all frauds you have came to know, that you have to go and communicate with the management. Along with that, you should also communicate with those charged with governance also. In case if you came to know management themselves have committed a fraud, in case if you came to know management themselves have committed a fraud, then don't go and report to the management once again. Directly go and report to those charged with governance and discuss with them nature, timing, and extent of audit procedures. Finally, the auditor shall also communicate any other matters related to fraud, not just the fraud. If any related matters with that fraud is there, that related matters also you have to go and communicate. Simply communicate with management, communicate with those charged with governance. If management themselves are involved, don't communicate with the management once again. Directly go and communicate with those charged with governance. And then finally, in some circumstances, in addition to communicating with the management and those charged with governance, you might be required to communicate the fraud to regulatory and enforcement authorities also, like RBI and sometimes ED, sometimes some other regulatory authorities. In addition to communication with management and those charged with governance, you might be required to communicate with regulatory authorities. Not in all the cases. In some cases, if there is any requirement of law or regulation, then you should fulfill those requirements also. So that's what they say. The auditor shall determine the need to report the occurrence or suspicion of a suspicion to a party outside of the entity. Determine is there any requirement. Sometimes legal responsibilities will be there which will override the confidentiality. You should not say, for example, if the Banking Regulation Act is saying if you find any fraud in the course of audit, communicate to RBI. You cannot say no, I have to maintain confidentiality, I will not communicate with the RBI. You can't say that. Legal responsibilities will override confidentiality. And in some cases, the auditor may have a duty to report to authorities like ED and all. In some cases, it will be there. In those circumstances, you have to fulfill that as well. In some clients, the requirements for reporting fraud may be subject to audit mandate or legal laws and regulations. If any such requirement exists, please go and communicate with that regulatory authorities also. And finally, you have to, whatever you have done regarding the fraud, you have to document it, like what risk of material misstatement you have identified, how you have responded, what further audit procedures you have performed, and how you have evaluated audit evidence, what communications you have done, to whom you have communicated, what is the manner of documentation. Nothing but whatever we have seen above in the standard, all that things you have to include in your documentation as well, that you can go through. So one part I have left from this standard, which is not suitable for revision, which is the concept of fraud risk factors. This I will give you a brief. You can refer to this summary on your own. So there is a small concept called fraud risk factors. Sir, what is fraud risk factor? See, as I have told, the fraud can be of two categories. One is a fraudulent financial reporting and the other one is misappropriation of assets. And I told you that any fraud can happen because of three reasons. One is incentive or pressure. There should be opportunity. There should be rationalization. Even for misappropriation of assets also, to happen misappropriation of assets, three things should be there. There should be incentive or pressure. There should be opportunity. There should be rationalization. Now, what SA 240 is telling you, dear auditor, I will help you. The standard is trying to help out the auditor by giving you few examples of the circumstances that indicate, that give a hint to the auditor that there could be a fraud in the organization. What SA 240 is telling, dear auditor, I will tell you few events or circumstances. If you come across these events or circumstances, that will be a hint that there is a possibility of happening of fraud. And those events or circumstances, the standard has given a name called fraud risk factors. Fraud risk factors. So that's what they say here. Fraud risk factors means those events or conditions that indicate there is an incentive to commit a fraud, that indicate there is a pressure to commit a fraud, or that indicate there is an opportunity for committing a fraud. Nothing but they have given some circumstances. Like for example, you came to know that your client is having a high degree of competition and your client is having declining of margins. Your client's margins are declining. Now there is a clear indication that there is a pressure on the management for committing fraudulent financial reporting. Yes or no? Or you came to know that your client is involving in so many related party transactions. That is an indication that since there are related party transactions, there is an opportunity for the management to commit the fraudulent financial reporting. So like that, the standard has identified few events or circumstances which give a hint to the auditor that there could be a possibility of fraud in the company. And what SA 240 has done is, SA 240 has given fraud risk factors for misappropriation of assets separately, for fraudulent financial reporting separately. And under each category of fraud also, the SA 240 has identified those risk factors which indicate incentive or pressure, which indicate opportunity, which indicate rationalization. And for fraudulent financial reporting also, they have given separately fraud risk factors which indicate incentive or pressure for committing fraudulent financial reporting, which indicate opportunity for committing fraudulent financial reporting, which indicate a rationalization for committing fraudulent financial reporting. So SA 240 has given fraud risk factors for misappropriation of assets separately, for fraudulent financial reporting separately, and for each fraud category also, they have given the factors which indicate incentive or pressure, opportunity or rationalization separately. So like this, they have given under total 6 categories. Under total 6 categories, they have given fraud risk factors. Like as you could see here, these are the examples of the fraud risk factors which indicate there is a possibility of fraudulent financial reporting. And here they have divided which factors indicate incentive or pressure for committing fraudulent financial reporting, which factors indicate opportunity for committing fraudulent financial reporting, which factors indicate attitude or rationalization for committing fraudulent financial reporting. Similarly, they have given fraud risk factors relating to misappropriation of assets, which indicate incentive or pressure for committing misappropriation, which indicate opportunity for committing misappropriation, which indicate an attitude for committing misappropriation. So like this, if few examples are given here, there is no much concept here, only examples are there that you can refer from this summary. Clear everybody? So this is what regarding SA 240. With this, we are successfully done with SA 240 revision. Clear everyone? So since we are done with SA 240 revision, the next standard which we are going to take up is SA 250. So SA 250 is a standard which is going to talk about consideration of laws and regulations in an audit of the financial statements. So here also, first we will try to understand what does this standard talk about? What is the purpose of the standard? What is the objective of the standard? Like SA 240 we have seen, SA 240 is a standard which is talking about auditors' responsibilities regarding fraud. Now, if you have paid close attention, SA 250 is going to talk about laws and regulations. SA 250 is going to talk about what? Laws and regulations. So what are the auditor's responsibilities regarding laws and regulations? And this SA 250 is going to talk about those laws and regulations which the client has to comply with. Those laws and regulations which who has to comply with, which the client has to comply with. Let me give you an example to make you understand. See, you are a practicing chartered accountant. You are appointed as auditor of Infosys. You are appointed as auditor of Infosys Limited. So Infosys Limited is your client and you are an auditor. Now, as we all know, every business, depending upon their legal form, depending upon the nature of business, depending upon the products which they are dealing with, depending upon their operations, there are numerous laws and regulations which a client has to comply with. Like if you take the example of this Infosys Limited, Depending on the nature of the company, this Infosys company is required to comply with so many laws and regulations. Like number one, they are required to comply with the Companies Act. Since it is a company incorporated into Companies Act, they have to comply with the provisions of the Companies Act. And since they have employees, they have to comply with the PF Act. They have to comply with the Gratuity Act. They have to comply with the Income Tax Act. They have to comply with the GST Act. They have to comply with IT related laws, Information Technology Act, they have to comply with. So like this, depending upon the nature of the client, every client will have numerous laws and regulations which they have to comply with. Similarly, if you take Reliance Industries Limited, since it is a manufacturing entity, they are also required to comply with the Companies Act. They are required to comply with Industries Act, Factories Act. Sorry, they are required to comply with the labor laws. They are required to comply with pollution-related laws and regulations. They are also required to comply with Income Tax Act, GST Act, PF Act, Gratuity Act. So, like that, depending upon the nature of the business, the client's legal form, and their legal structure, there are numerous laws and regulations which the clients have to comply with. If you are an auditor of the client, what are your responsibilities regarding this laws and regulations? What are auditors' responsibilities regarding the laws and regulations which the client has to comply with? So this standard does not talk about those laws and regulations which auditor has to comply with. This SA 250 actually talks about those laws and regulations which my client has to comply with. And as I've given you examples, depending upon legal form, depending upon nature of entity, there will be numerous laws and regulations which your client has to comply with. As an auditor, what is your responsibility regarding it? So first I will ask you one simple question. You tell me, it is whose primary responsibility to ensure compliance with all these laws and regulations? It is whose primary responsibility to detect any non-compliances? I'm asking you a simple question. It is whose primary responsibility to ensure that the operations of the business are conducted in accordance with laws and regulations? That is, it is whose responsibility to ensure the compliance with laws and regulations? Or if at all any non-compliance happened, it is whose responsibility to detect that non-compliances? The primary responsibility is always going to be the management and those charged with governance. So management and those charged with governance, they are collectively responsible for ensuring the compliance with the laws and regulations, and to detect the non-compliances, that primary responsibility is going to be with management, not auditor. Can we expect the auditor to ensure compliance with laws and regulations? Do you think is the auditor appointed to make sure that entity complies with all laws and regulations? The answer is no. Can we expect the auditor to ensure detection of all non-compliances? The answer is no. So we can't expect the auditor to ensure the compliance. We can't also expect the auditor to detect all kinds of non-compliances. So the auditor's objective is to obtain reasonable assurance whether financial statements are free from material misstatements. So it is not the primary responsibility to ensure compliance. It is not the responsibility to detect all non-compliances. Does that mean auditor should not be concerned about the laws and regulations and all? No. We can't say auditor has nothing to worry about laws and regulations. He need not check the compliances. We can't say that also. Auditor cannot completely ignore. We can't make the auditor fully responsible also. Then what are auditor's responsibilities? Sir, you are neither agreeing to, we are neither telling that auditor is fully responsible, you are neither telling auditor is not responsible. Then what is auditor's responsibility, sir? That responsibility SA 250 says. Okay, so the primary responsibility for ensuring compliance and detection is management. So then what about auditor's responsibility? Then what about auditor's responsibility? For the purpose of auditor's responsibility, laws and regulations are divided into two categories. For the purpose of auditor's responsibilities, the laws and regulations which are applicable to the client can be divided into two categories. Those laws and regulations which have a direct effect on amounts and disclosures in the financial statements. Those laws and regulations which have a direct effect on determination of amounts and disclosures in the financial statements. And other broad category, we call it as other laws and regulations. Other laws and regulations. So what is this? What are those laws and regulations which have direct effect on financial statements? What are those laws and regulations which do not have a direct effect on financial statements? Let us try to understand this in a deeper manner. If we understand the difference between type 1 and type 2, 50% of the standard will be over. So this I call it as type 1 laws and regulations. This I call it as type 2 laws and regulations. So what are type 1 laws and regulations? So they say those laws and regulations which have a direct effect, those laws which are going to directly affect the amounts and disclosures in my financial statements, they will fall under type 1. Can you give me a few examples of those laws and regulations which have a direct effect on my financial statements? Like for example, if you take Companies Act. Companies Act is a law which is going to have a direct effect on the financial statements. We are preparing financial statements as per Schedule 3. That Schedule 3 is given under Companies Act. Income Tax Act is also going to have a direct effect on my financial statements. That provision for income tax which you are going to create, that will be calculated as per Income Tax Act. GST Act is also an act which has a direct effect on financial statements. PF Act, that provision, that provident fund amount, gratuity amount, bonus amount, whatever you are calculating in the financial statements, they are directly determined by these laws. So these are the examples of type 1 laws which have a direct effect on determination of amounts and figures, amounts and disclosures in the financial statements. Whereas other laws and regulations are those laws and regulations which don't have direct effect on financial statements. They don't have direct effect on the financial statements. Even though they don't have direct effect on the financial statements, but still compliance with these laws is also required either to avoid penalties or which are fundamental to continue the business. Under other laws and regulations, those laws will come which do not have direct effect on the financial statements, but still compliance with that laws is also required if you want to avoid penalties, or if you don't comply with that laws, you will cease to continue the business. Example, if I have to say, pollution related laws. Pollution related laws. See, pollution related laws will not have a direct effect on my amounts and disclosures in the financial statements. But still, entity has to comply with pollution laws. If they don't comply, what will happen? Either they have to pay huge penalties, or sometimes their factories will get seized. Or child labor law. Child labor law. So, child labor law is also one of the examples of the law which do not have direct effect on the financial statements, but still you have to comply with that child labor laws. Why? Because if you don't comply, what will happen? If you don't comply, either you have to pay a huge penalty or it is fundamental to continue your business. Or if you are a restaurant industry, food related laws and regulations. FCI norms, food related laws and regulations. So food related laws and regulations are also those laws which fall under other laws and regulations. They don't have direct effect on determination of figures and amounts in the financial statements, but still compliance is required. If you don't comply with it, either you have to pay a huge penalty or you will be required to close down your business. So like this, for the purpose of auditors' responsibilities, we divide laws and regulations into two categories: direct laws and those laws and regulations which have a direct effect on the financial statements, other laws and regulations. You tell me, using your common sense, let us ignore what the standard is telling. You apply your common sense and tell me regarding which laws and regulations the auditor has to be more concerned about. Regarding which laws and regulations auditor has to be more concerned about. So obviously you will say, yes sir, auditor has to be more concerned about type 1 laws and regulations, those laws and regulations which have a direct effect on financial statements. Regarding that, auditor has to more worry about. Yes, 100% you are correct. So that's what standard also told. SA 250 told that regarding type 1 laws and regulations, auditor should obtain sufficient and appropriate audit evidence. That means you need to treat that direct laws and regulations as a normal item of the financial statement. You have to perform in-depth audit procedures like any other financial item, and you need to obtain sufficient and appropriate audit evidence regarding compliance with type 1 laws and regulations. You have to treat it like any other ordinary item of the financial statement, perform in-depth audit procedures, and try to obtain sufficient and appropriate audit evidence. Sir, what about type 2 laws and regulations? What about other laws and regulations? The standard told you need not perform in-depth audit procedures. You perform limited audit procedures or specified audit procedures also, you can say. What you can say? Specified audit procedures. So standard is telling we don't expect you to perform in-depth audit procedures regarding type 2 laws and regulations. Regarding other laws and regulations, we don't expect you to perform in-depth audit procedures. We will specify. We will give you some 2-3 specific audit procedures. If you do that, it will be enough. So perform specified audit procedures regarding type 2 laws. When it comes to type 1 laws which have a direct effect on the financial statements, you perform in-depth audit procedures and you try to obtain sufficient and appropriate audit evidence. Clear, everybody? Sir, what are that specified audit procedures? We will see it. What are the specified audit procedures? We will see it in the standard. Everybody till here comfortable with the concept? So what did we speak about? We spoke about what is the management responsibility, what is auditor's responsibility, and for the auditor's responsibility, laws and regulations are divided into two categories, and what is auditor's responsibility regarding each category we have seen. So if you see it here, first we have seen primary responsibility for ensuring compliance with laws and regulations. It is whose primary responsibility, guys? It is always the responsibility of management and those charged with the governance. They have the primary responsibility to ensure compliance with laws and regulations. In order to make sure that for the management to make sure that their organization is complying with laws and regulations, they will implement various policies and procedures.
As I've told, management and those charged with governance, they are the primarily responsible for ensuring compliance. So the management and those charged with governance, they should have some policies in their organization to prevent the non-compliances or to detect the non-compliances. So what kind of policies generally management will implement in the organization to prevent non-compliances? So like here they have given few examples. The management should continuously monitor what are their legal requirements, which laws they have to comply. They should have a list ready, what laws and regulations they have to comply with, what operating procedures they have to follow to monitor that legal requirements. So they should have a list of all the legal requirements. They have to continuously monitor which laws and regulations they have to comply with. Then they should have proper system of internal control. They should also draft some internal control to make sure that their organization is complying with laws and regulations. Then they have to develop a code of conduct. Nothing but detailed policy should be there. A detailed code of conduct they have to establish. And you have to properly train your employees. You have to educate your employees what laws are applicable, how they have to comply. Train your employees. And in case if you find any employees not doing their activities as per laws and regulation, you have to bring disciplinary mechanism also. You have to punish those employees. You have to remove those employees who are not doing who are violating the laws and regulations. And if required, you have to engage legal advisors. That's why reputed companies all will have reputed lawyers. They will recruit the reputed lawyers. So engaging legal advisors. And also you have to maintain a register of all the laws and regulations and also a register of complaints. In large entities, what they can do is they will assign this function related to laws and regulations to internal audit function, or if there is audit committee, they will assign this a task to audit committee, or they will have a dedicated compliance department in the organization. So by implementing all these policies and procedures, management has to make sure that management, along with those charged with governance, they have to make sure that their organization is complying with all laws and regulations. And as I've told, when it comes to auditor's responsibility, we can't expect the auditor to prevent non-compliances. We can't expect the auditor to detect all non-compliances. For the purpose of auditor's responsibilities, we can divide laws and regulations into two categories. What are they, guys? Laws and regulations having direct effect in financial statements on amounts and disclosures in the financial statements, and number two, other laws and regulations. Those do not have a direct effect, but still compliance is required to avoid penalties and which are fundamental to continue the business. Clear? Once again, I'm telling you, this chart you have to use it for revision purposes. At least once you should read the content from the main material. Okay, we have seen what is auditor's responsibility, what is management responsibility. Now, what are the objectives of the auditor? As per SA 250, as we have told, when it comes to category 1 laws and regulations, when it comes to those laws and regulations which have a direct effect on financial statements, the auditor should obtain sufficient appropriate audit evidence. As I have told, regarding category 1 laws and regulations, since they have a direct effect on the financial statements, you are not given any privilege there. You have to perform in-depth audit procedures, obtain sufficient and appropriate audit evidence. Whereas when it comes to other laws and regulations, what is your responsibility? If you perform specified audit procedures, that will be enough. If you perform specified audit procedures, that will be enough. Sir, what are that specified audit procedures? We will see now. And by performing these procedures, if you find out any non-compliances, that is, when it comes to type 1 laws and regulations, you will perform in-depth audit procedures. When it comes to type 2 laws and regulations, you will perform specified audit procedures. By performing these things, if you find any non-compliances, you have to report appropriately. Sir, how to report it? That also we'll see it in a while. So 3 objectives: obtain sufficient and appropriate audit evidence regarding category 1, perform specified audit procedures regarding category 2, and by performing this, if you obtain sufficient and appropriate, if you obtain any non-compliances, if you found out any non-compliances, you have to respond appropriately, you have to report appropriately. How to report it? We will see it now. Sir, as an auditor, what audit procedures you are required to perform regarding laws and regulations? As an auditor, what responsibilities, what things you have to do with regard to checking the compliances with the laws and regulations? As usual, first, when you perform risk assessment procedures, as we all know, first audit procedure we are going to perform is a risk assessment procedure. In risk assessment procedure, what we do, we try to obtain an understanding of entity, we try to obtain an understanding of environment, we try to obtain an understanding of internal controls. So as a part of your risk assessment procedures, when you are trying to understand entity, environment and its internal control, you should also try to understand regulatory environment. So as a part of risk assessment procedures, you should also try to understand what kind of regulatory framework is applicable to your client, what industry they belong to, what kind of laws and regulations are applicable for them. So which kind of non-compliances could be there. So that also should be included in the risk assessment procedures. So that's what they say. As a part of risk assessment procedures, The auditor shall obtain general understanding of legal and regulatory framework. What laws and regulations are applicable for your client? You have to understand that, and you should also try to understand how the entity is complying, what processes your organization is trying to comply, trying to follow to make sure that they comply with that laws and regulations. So this should be included in my risk assessment procedures. And if you remember, in the objectives we have seen, when it comes to type 2 laws and regulations, you need to perform specified audit procedures. No, sir, what are that specified audit procedures? Here they are telling, sir, what are that limited audit procedures which we have to perform regarding other laws and regulations? Very simple. They say 3 simple steps just to go and inquire with the management and those charged with governance. So go and inquire with the management and those charged with governance. Sir, did you comply with all the other laws and regulations or not? Number 2, inspect correspondence with relevant licensing or regulatory authority. Nothing but check whether you got any notices from the pollution board, whether you got any notices from the food department. So check whether any correspondence happened with the licensing and regulatory authorities. And also certain other laws and regulations may need particular attention. Some laws and regulations require more attention, like pollution laws, food laws require more attention. Pay more attention to that. So simple 3 specified audit procedures. What are the 3 specified audit procedures? Inquiring with the management and those charged with governance, inspecting the correspondence with licensing and regulatory authorities, pay attention to certain laws. So these 3 are the specified audit procedures which you need to perform regarding other laws and regulations. Whereas when it comes to category 1 laws and regulations, in-depth audit procedures you have to perform. So when it comes to audit procedures, first thing we have seen, as a part of risk assessment procedures, try to obtain understanding of regulatory framework and how the entity is complying. Perform specified audit procedures regarding type 2, that is other laws and regulations, and remain alert to instances of non-compliances. If you came across any circumstances which indicate that there could be non-compliance, you have to remain alert to that, and even you need to obtain written representations from the management. Ask the management to give a written confirmation that they have complied with all the laws and regulations. If at all non-compliance is there, they have informed that to the auditor. So ask the management to give a written confirmation as well. So these are basic audit procedure which auditor needs to perform regarding laws and regulations. And particularly when you identify or suspect a non-compliance, if at all, if you find out any non-compliance, if you suspect any non-compliance, then what you should do? These are general audit procedure. And particularly when you identify non-compliance or when you strongly suspect a non-compliance, what you do? So what you do is, if the auditor suspects non-compliance, then he shall obtain understanding of the nature of the act and circumstances. So what is that circumstances which is creating that non-compliance? Which act is creating that non-compliance? That you have to understand, and you need to obtain further information to evaluate what is the effect of that non-compliance on the financial statements. Is it have a material effect or it is not having a material effect? Is it pervasive, not pervasive? You have to consider that effect. And finally, the auditor shall also discuss with management and those charged with governance. Whatever non-compliances you have identified, you have suspected, first to go and discuss with management. If the management is not giving you proper information, then consider need to obtain legal advice. If you discussed regarding the non-compliance with the management and those charged with governance, if they give you complete information, well and good. Sometimes management and those charged with governance also will not be able to give complete information. Then what auditor should do? He should go and obtain the legal advice, go and consult some external reputed lawyer. And after considering all the information, then you have to consider what will be the effect on my auditor's opinion. Nothing but if external legal advisor also unable to give you any advice, that will be a case of non-availability of audit evidence, and depending upon what will be the possible effect of that non-availability of audit evidence, we have to modify. That is, we'll give either qualified or disclaimer. So particularly when you find out non-compliance or when you suspect non-compliance, what procedures you have to do? First, try to understand which act related to that non-compliances, which circumstances led to that non-compliances, try to obtain further information. Number 2, go and communicate with management and those charged with governance, get the required information. If the management or those charged with governance are unable to give you required information, try to obtain legal advice. If you are unable to get that legal advice also, try to consider the impact on the opinion. Clear? So after doing this, you will decide whether there is a non-compliance or not. So finally, after performing all these audit procedures, you will have observations. Now, depending on that observations, you will consider the impact on your opinion. See, there could be 3 circumstances. There could be 3 circumstances. First, I will talk about the opinion, how non-compliances will have an impact on the opinion. You obtained audit evidence and you came to know that all the laws and regulations are complied. You came to know that all the laws and regulations are complied. You performed all the audit procedures as said now, and you concluded there is no non-compliance. All the laws and regulations are complied with. The management is very good management. What you will do? Will you give unmodified opinion or modified opinion? There is no purpose of giving modified opinion here. We will happily go and give unmodified opinion. Okay. Second case. You have obtained audit evidence. You have concluded, you have obtained audit evidence that there is a non-compliance. There is non-compliance. Your client did not comply with some laws and regulations. You have a clear-cut evidence. You have a pakka evidence that your client has violated so-and-so law and regulation. Now what you will do? Directly modified? No. Standard says one more thing. If you find non-compliance, first you need to check whether it is adequately disclosed or not adequately disclosed. Adequately disclosed or not adequately disclosed. Which means I came to know that management has violated some law and regulation, but it was properly disclosed. It was adequately disclosed. What do you mean by adequately disclosed? So management violated some law and regulation. They did not hide it. Might be because of some mistake they violated some law and regulation. Because of that they have to pay some penalty, some consequences they have faced. Management is very honest. They did not hide anything. In the notes to accounts they have clearly explained why they have not why that non-compliance happened, what consequences they have faced, what penalty they have paid, and even that penalty was also recognized in the statement of P&L. That is what the meaning of adequate disclosure. So management made a non-compliances, but they did not hide anything. Clearly they have given the effect in the financial statements. They did not hide anything. Why non-compliance happened, what consequences they face, what penalty they have paid, everything clearly explained in the financial statements. Now you tell me, in that case, are the financial statement misleading or not misleading? They are not misleading because management given all the information. So that's why here also standard says no need to give modified opinion. You can give unmodified opinion because management did not hide anything. No, financial statements are giving true and fair view only. In case if the management not adequately disclosed, management violated some laws and regulations, but they are trying to hide it. You know there is a non-compliance, but management is not giving that information in the financial statements. You tell me, in that case, are the financial statements giving true and fair view? Financial statements are not giving true and fair view. You have to modify your opinion. And what kind of modification you will give? Since you have a evidence, there is a non-compliance, and you know that it is not adequately disclosed. If the effect of that misstatement is, if the effect of that non-compliance is only material but not pervasive, you will give only qualified. If the effect of that non-compliance on the financial statements is material and also pervasive, you will give adverse, because this is a case of availability of audit evidence. Now, third case. First case, you have obtained audit evidence, all the laws and regulations are complied. Second case, you have obtained audit evidence that there is a non-compliance. Third case, auditor unable to obtain sufficient and appropriate audit evidence whether there is a compliance with the laws and regulations or not. Whether laws and regulations are complied or not, the auditor is unable to obtain audit evidence. Unable to obtain audit evidence. Then what you should do? Then also you have to give modified opinion. Since it is a case of non-availability of audit evidence, you will give either qualified or disclaimer. If the possible effect of that non-compliance is only material but not pervasive, you will give qualified. If you are unable to obtain audit evidence and the possible effect is material and also pervasive, you will give disclaimer of opinion. Clear, everybody? So this is what the impact which will be there on my auditor's opinion. So the same thing I have told here, reporting of identified or suspected non-compliances, how you have to report your non-compliance in the auditor's report I have told. If the auditor concludes means audit evidence is available. So if the auditor concludes that the non-compliance has a material effect and has not been adequately reflected, that's what we have seen. If it is not adequately reflected, then only modify. If there is a non-compliance but it is adequately reflected, no need to modify. So you have concluded, you have evidence that there is a non-compliance, but it has not been adequately reflected, then the auditor shall give either qualified or adverse. If the auditor is unable to obtain sufficient appropriate audit evidence, then the auditor should give either qualified or disclaimer. So this is how you will report non-compliance in your opinion. In addition to that, you have to report whatever non-compliances you have found out with those charged with garnets. So that's what they're telling. Before you modify your opinion, you should also communicate with management and those charged with garnets. So if you find any non-compliance which is committed by the management, you will go and report to those charged with garnets. Sir, if those charged with garnets themselves are involved in non-compliance, what we should do? If the management did the non-compliance, we go and report to those charged with garnets. Sir, what if the top level management themselves have done the non-compliance? then what we will do? So if those charged with governance themselves have involved in the non-compliance, determine whether there is any next higher level of authority. Generally, there will not be. If there is any next higher level of authority, you go and report. Sir, what if there is no next higher level of authority? Go and consider legal advice. Go and consult a lawyer, ask him what should be done in that case. So that's what they say here. If the auditor believes that there is a non-compliance, go and communicate with those charged with governance. If the auditor suspects that management or those charged with governance themselves are involved in non-compliance, determine next higher level of authority. If it exists, generally it will not exist. Where no such higher authority exists and or they are not acting upon even after communication, then you have to go and obtain legal advice. So this is what regarding reporting non-compliances to those charged with governance. And in addition to that, in some circumstances, you might be required to non-compliance to regulatory and enforcement authorities also. In some circumstances, you might have a legal obligation to go and report this non-compliance to regulatory authorities like ED, ROC, or banking to RBI. So these kind of authorities also you might be required to report if required. So determine whether any such responsibilities are there. If yes, fulfill that reporting requirements also. And whatever you have done regarding all this laws and regulations, what are your audit procedures, how you have identified the non-compliances, what evidence you have obtained, what communications you have done, everything has to be included in the audit documentation. That's all. Very simple standard. This is what regarding SA 250. So we are done with SA 240 and also we are done with SA 250.
So we'll be beginning our discussion. We'll be commencing our discussion with SA 260, which is talking about communication with those charged with governance. What is the title of SA 260? Communication with those charged with governance. So from this title, let us try to derive what this standard is actually trying to achieve. What is the objective of the standard? What is the purpose of the standard? See, the purpose is there needs to be effective communication with those charged with governance. Sir, who need to have effective communication with those charged with governance? Auditor. So there is a requirement that there should be a proper communication happening between those charged with governance and the auditor if audit has to happen effectively. If you want the audit has to happen in an effective manner, if you don't want to have trouble during the course of the audit, so there should be a proper communication between the auditor and those charged with governance. And this standard is basically talking about the responsibility, the communication responsibilities of the auditor with those charged with governance. So we have to first understand the objective of the standard. So SA 260 is putting some responsibilities on the auditor. They are suggesting certain matters which are required to be communicated mandatorily by the auditor with those charged with governance. If I put it in other way around, SA 260 is going to tell the efforts which auditor is required to put to make the communication effective between management and those charged with governance. See, SA 260 does not talk about the responsibilities of those charged with governance. Standards on auditing will be talking about the auditor's responsibility, not with the management and those charged with governance responsibilities. So SA 260 is going to tell us certain responsibilities, certain matters which the auditor has to communicate with those charged with governance so that there will be effective communication happening between both the parties. And ultimately, if there is effective communication between the auditor and those charged with the governance, overall audit efficiency and effectiveness will get increased. So now we are going to discuss in the standard what are those matters which auditor is required to communicate with those charged with governance, what things he has to communicate, what should be the manner of communication, what responsibilities will be there in case of listed entities, what method of communication should be followed. So all that things we are going to discuss. See, before we talk about communication requirements, first let us try to understand who are actually those charged with governance. Who will fall under this definition of those charged with governance? First, let us try to understand it. So the standard has defined the term those charged with governance as the persons or organizations with responsibility for overseeing strategic direction of the organization and obligations relating to accountability. Very, very important definition. So whom do we call as those charged with governance? Those people or those organizations within the entity who are having responsibility for overseeing strategic direction. Those who are responsible for supervising, those who are responsible for looking after the strategic direction. Sir, what is strategic direction? For example, every organization wants to grow. Now, what strategy they have to take for growing? Like, for example, what products the company has to deal with, whether they have to go for manufacturing or they have to go for outsourcing, or they have to, if they are making profits, what should be done to that profit? Should it be distributed among the shareholders or should it be reinvested back in the company? Able to understand? Or if they want to expand or they want to cut down, they want to do further investments or they have to dilute their investments. So like this, the overall strategic direction, taking the organization ahead, that crucial decision making responsibility, those people are having that responsibility of taking that crucial decision making, those who are having the responsibility for overseeing the strategic direction. And not just that, those who are having the obligations relating to accountability. Sir, what do you mean by accountability? So if someone goes wrong, if something goes wrong in the organization, who we are blaming? If something goes wrong in the organization, who we are blaming? So those persons who are having that responsibility for accountability, obligations relating to accountability, that people we call them as those charged with governance. Clear and comfortable, everybody? So the definition you have to remember, you have to reproduce the definition as it is. Those persons or organizations with the responsibility for overseeing strategic direction and who are having the obligations with regard to accountability. See, it is very difficult to identify those charged with governance, especially in the organizations like companies. In small organizations, like for example, in the case of sole proprietor or in the case of partnership firm, it is very easier to identify those charged with governance. For example, I will give you one simple example. Take, for example, I'm a sole proprietor. For example, I'm a sole proprietor. As a sole proprietor, I started a restaurant business. I'm the owner of this restaurant business. But since I'm not able to look after day-to-day operations, for example, if I have to run a restaurant, I have to make a decision regarding which dishes have to be cooked, or who should be the chef, and what kind of items are required to be served, what quality of ingredients I have to use, all the decisions I have to take. See, I'm the ultimate owner. But since I'm not, I will take all the decision, what products I have to sell, which cuisines I have to offer. So all the decisions will be taken by me. But since I will not be available all the time at the restaurant, I will not be able to execute that decisions. So what I have done is I have appointed a person, I have appointed an employee, gave him the role manager. Now this person will execute the responsibility. He will manage the staff, he will make sure that customer is satisfied. So all that responsibilities will be actually taken care by this manager. Now in this organization, being the owner of this restaurant, I will fall under those charged with governance. And this manager, since he is having the execution responsibility, since he is required to execute, actually he has to make the operations at the ground level, this person will fall under management definition. Now, why I am being the owner, why I am falling under those charged with governance is why? Because I am responsible for overseeing the strategic direction. So whether I have to open a new branch, whether I have to close the existing branch, should I add new products, should I not add new products, that decision is taken by whom? Being the manager myself. So I am looking after the strategic direction. And also I am responsible, I have to face the obligations relating to accountability. For example, if one customer ate the food in my restaurant and he became sick, so who will be ultimately punished? They will not punish this manager. Being the owner, they will come and punish me. So that means I have the responsibility relating to accountability also. I will be held the face. I will be made responsible if something goes wrong. So those people who are responsible for overseeing strategic direction and those people who are required to face the obligations relating to accountability, that person we call them as those charged with governance. Whereas those who are actually executing the operations, that we call them as the management. So generally in the companies, what will happen is it is very difficult to differentiate between those charged with governance and management. Why? Because in the company, if you take, who are required to make the decision making, like investment decisions, dividend decisions, who will make that decisions? Board of directors. Board of directors. So generally the board of directors will fall under those charged with governance definition. But actually what will happen in most of the companies is these board of directors only will execute that decisions also. In most of the organizations, for example, if you take Reliance Industries Limited, there will be a team of 10 board of directors. The 10 board of directors will be those charged with governance. Now, each of the director will head one department. For example, one director will be heading the production department. One director will be heading the HR department. One director will be heading the operations department. One director will be CEO. So that means the people, the board of directors are only making the decisions. They are only executing the responsibilities as well. So in most of the companies, it is very difficult to differentiate between those charged with governance and management. Why? Because in the companies, both the roles will be played by board of directors only. So board of directors only will play the role of those charged with governance. They will only play the role of management as well. So in the case of companies, it is very difficult to differentiate. Why? Because in most of the organization, both the roles will be played by board of directors only. But we can easily identify the differentiation between those charged with governance and the management in case of small organizations like sole proprietor, partnership firms, etc. Clear? So, but whatever it is, one thing you have to make it clear, the definition you have to remember. All this you keep it aside. Definition is very, very important. The persons or organizations with responsibility for overseeing strategic direction and who are responsible for
obligations relating to accountability. Those people in the organization, we call them as those charged with governance. Okay, we understood who are those charged with governance. So now what are the objectives of the auditor? So what auditor is supposed to do, or what are the responsibilities on the auditor as per SA 260? What matters auditor is required to communicate with those charged with governance? So what SA 260 is telling? So SA 260 says that as an auditor, you are required to communicate certain matters with those charged with governance, and these are mandatory. There are certain matters the auditor is required to communicate with those charged with governance, and those matters are given in the standard only, and the communication of these matters is mandatory. So what matters auditor is required to communicate with those charged with governance as per SA 260? Number one, he has to communicate with those charged with governance the responsibilities of the auditor. As an auditor, you have to go to those charged with governance and say, what are your responsibilities? Like you should say, sir, I am responsible only for expression of opinion, and I will not give any guarantee. So as an auditor, you are required to go and communicate with those charged with governance your responsibilities, and also you are required to communicate overview of planned scope and timing of the audit. You should not go and communicate the detailed plan. You should communicate you have to give an overview of overall plan and scope and timing of the audit. Like for example, sir, I will do the audit within 10 days. I will, we 15 people will come for the audit. Like that, a overview of overall plan and scope and timing of the audit you are supposed to communicate. So first matter which is required to be mandatorily communicated by the auditor with those charged with governance is what? Communication of auditor's responsibilities and also giving a overview of planned scope and timing of the audit. Number two, and whatever other information you feel relevant, if you feel some information is relevant for carrying on the audit, it is also your responsibility to obtain that relevant information from those charged with governance. And also whatever your observations are there arising from the audit, you have to communicate that timely observations with those charged with governance from the audit. Whatever your observations are there, even that observations also you are required to communicate with those charged with governance, that too on a timely basis. And as an auditor, you should always move ahead to promote an effective two-way communication. So as an auditor, you have to take that first step to promote a effective communication between the management and those charged with governance. So if they ask you what are the objectives of the auditor as per SA 260, these 4 points you are required to write: communication of responsibilities of auditor, and also overall planned scope and timing of the audit, provide obtaining relevant information from those charged with governance, whatever your observations are there that you have to on a timely basis communicate with those charged with governance, and as an auditor you have to promote a effective two-way communication. Now specifically they talk about each and everything. See, in the objective they are telling as an auditor you are required to communicate with responsibilities of auditor. What specifically you will try to communicate? That I have explained it here in a detailed manner. And also they are asking you to communicate overview of planned scope and timing. When it comes to planned scope and timing, what exactly you have to communicate? That I have added one more paragraph here. And you are required to communicate other matters. You are required to even communicate significant findings. As I have told, whatever your observations are there arising from the audit, that also you are required to communicate. So what specific findings you will communicate with those charged with governance? So everything I have given in a detailed manner. So nothing but in the objectives they told certain points you are required to communicate. What exactly you are required to communicate regarding that points, that we have elaborated in a detailed manner in this paragraph. So number one, as I have told, as an auditor, you are required to communicate what are your responsibilities. So what specifically you will say there? You will say that the auditor shall communicate that auditor is responsible only for expression of opinion. You have to tell them that, sir, I am responsible only for expression of opinion. And also you should say that just because appointment of auditor, the management and those charged with governance will not be relieved from their responsibilities. So you should even communicate that audit does not relieve management or those charged with governance of their responsibilities. See, the meaning of this term is you have to communicate with those charged with governance, sir, as an auditor, my responsibility is to expression of opinion. Just because you have appointed as an auditor, your responsibilities will not come down, your management responsibilities will not come down. Like for example, sir, you are appointing me as an auditor. Just because you have appointed me as an auditor, you can't expect me to prepare the financial statements. The management is still responsible for preparation of financial statements only. So just because you have appointed me as an auditor, neither your responsibilities nor your management responsibilities will be reduced or relieved. Your responsibilities will remain intact. So this is what specifically you have to communicate when I say you have to communicate the responsibilities of auditor. Number two, you are even required to communicate overview of planned scope and timing. No. So when I say you have to communicate planned scope and timing of the audit, what exactly you will communicate? So they say that discuss with those charged with governance only overview of planned scope and timing of audit, including communication of significant risk. What major risk we have identified? What is your
overview of planned scope and timing. Once again, you have to remember, you should not discuss detailed plan and scope with those charged with governance. If you explain the detailed plan, what will happen? Whatever you are going to know, that those charged with governance will come to know, and they will take all the precautionary measures to make sure that you will not be able to find out any misstatement. So that's why you have to just communicate only overview, and whatever significant risk that you have identified, that also you have to communicate. And apart from that, I told whatever your observations are there, that also you are required to communicate. No. So what specific significant findings, what exact findings you will, what kind of findings you will communicate with those charged with governance? Like for example, if you found any significant qualitative aspects, if you have any observations regarding accounting policies, so that you will try to communicate. Number two, inappropriateness of accounting policies. If you came to know that the management is following certain accounting policy which is suitable as per applicable financial reporting framework, but that you are feeling it as inappropriate. Like for example, client is following SLM method of depreciation. That is suitable. That is required as per applicable financial reporting framework. But the consumption pattern is not going to be uniform. So the machinery was, like I gave you example for fair presentation framework. The company is buying a plant and machinery, and the plant and machinery is of such a nature that it will exactly produce at a number of units. For that kind of plant and machinery, production units method will be more appropriate. But what the management is doing, as per the applicable financial reporting framework, they are following either SLM or WTV. So you found that whatever accounting policy your client is following, even though that is accepted as per applicable financial reporting framework, but that is inappropriate. If you have such observations, inappropriateness of accounting policies, that also you go and communicate. Similarly, if you are facing any significant difficulties during the course of audit, if you face any significant difficulties, if certain areas are troubling for you, those matters also you can go and communicate with those charged with governance. And unless all of those charged with governance are involved in the management, that means if management and those charged with governance both are different parties, then whatever matters you have discussed with the management, that you discuss once again with those charged with governance, and whatever written representations that you have requested from the management, communicate with those charged with governance once again. But however, see, as I have told, in most of the organization, those charged with governance and management, both the roles will be played by same persons. So if those charged with governance and management are same, then you need not communicate these matters once again. Why? Because whatever matters you have communicated with the management, you need not communicate it once again with those charged with governance. Why? Because both are same. See, these are 2 points you are required to be communicated only when those charged with governance and management both are different parties. That is what the inference from this term, unless all of those charged with governance are involved in the management, which means if management and those charged with governance are both are two different persons, then you communicate whatever matters you have communicated with the management with those charged with governance once again, and whatever written representations you have requested from the management, that you ask it once again from those charged with governance. If both are same, no need to do this part. Next one. And also you can communicate the circumstances that affect the form and content of the auditor's report. For example, if because of some reason you are modifying your opinion, if some matter you want to include it in the key audit matter paragraph, if some matter you want to include it in the emphasis of matter or other matter paragraph, that also you have to communicate with those charged with governance. These things we have seen in SS 700 series itself when we are discussing audit reporting chapter, and any other significant matter as per your professional judgment. So they might ask you a question, give a few examples of significant findings from the audit which auditor is required to communicate with those charged with governance. Then you are required to write this points. Clear? So what we have done till now, we have understood what is the meaning of those charged with governance, what are the objectives of SA 260, and specifically what matters you have to communicate regarding each of the objective, that also we have seen now. And the standard specifically says, in case if you are conducting audit of listed entities, in case specifically you are conducting audit of listed entities, in addition to the above matters, even you are required to communicate certain matters regarding auditor's independence also. Which means if you are conducting audit of unlisted entity, if you communicate these above matters, that will be enough. If you are conducting audit of unlisted entity, if you communicate these matters, it will be enough. But in case if you are conducting audit of listed entity, the above matters plus independence requirements also you are required to communicate. So what specifically I have to communicate in case of listed entity in addition to the above matters? So the auditor shall communicate with those charged with governance in case of listed entity, whether their engagement team or their firm or their network firm, whether everybody has complied with the ethical requirements or not. Your firm, your engagement team, your networking firms, everybody have complied with the ethical requirements or not, that you have to communicate. And in addition to that, you should also communicate any relationships that might affect the independence. And specifically, when I say relationships that might affect independence, you have to communicate with those charged with governance what kind of audit services you are providing, either yourself, your firm, or networking firm, what audit services you are providing. If you are providing any non-audit services like management consultancy, if any non-audit services are getting provided either by yourself or your networking firms, you have to communicate what non-audit services you are providing. And along with that, you should also communicate with them what fees you are charging for audit assignments and what fees you are charging for non-audit services. These things are specifically required to be communicated in case of listed entities. So once again, I'm telling you guys, in case if you are conducting audit of unlisted entity, only these things. In case if you are conducting audit of listed entity, this plus independence requirements, both you have to communicate. Clear? Next, sir, what should be the communication process? How you have to communicate? In case if you are conducting audit of a listed entity, compulsorily you have to communicate in the writing. In case if you are conducting audit of a listed entity, the matters which you are required to communicate with those charged with governance, that must be communicated in writing. In case if you are conducting audit of unlisted entity, there you will be given an option to even communicate in oral also. In case if you feel oral communication is inadequate, then you have to give the communication in writing, which indirectly means in case of listed entity, you have to compulsorily do it in writing, no option. But in case of unlisted entity, if you want, you can do it in the oral way also. But in case if you feel oral communication will be inadequate, which will always be, we have to do it in the writing. Clear? But practically what will happen, both in case of listed entities and unlisted entities, always the communication will happen in written format only. Why? Because the proof is required. No, that you have communicated. That proof you will get it only when it is in written format. Clear? And whatever matters that you are communicating with those charged with governance, everything should be included as a part of your audit documentation. Clear and comfortable? So this is what regarding SA 260. So what matters are required to be communicated, what should be the communication process, and that matters which you have communicated should be included in the audit documentation as well. Clear? So with this we are done with SA 260. So now we will be revising the next standard, which is SA 299, which is talking about the concept of joint audit. Very simple standard, very small standard, we can wind up in no time. So let us try to revise what is this SA 299 about. So as from the title you can see, SA 299 is a standard which is talking about joint audit of the financial statements. First of all, what is the meaning of joint audit? First of all, what is the meaning of the joint audit? I will tell you meaning, then I will give you a few examples to make you understand what exactly is this joint audit. So joint audit means when more than one auditor is conducting audit of same entity for the same financial year and also having same scope of work, then we call such assignments as joint audit assignments. So when do we call an assignment as joint audit? When more than one auditor is getting appointed for the same entity for the same financial year and also they have the same scope of work, then we call such audit engagements as joint audit engagements. So this is what the meaning of the joint audit. Now let me give you a few examples. From that you are supposed to say whether the assignments are joint audit assignments or not. Take for example, there is a company X Limited. They have appointed a firm A, B, C and Co, a firm of chartered accountants as auditors, in which three partners are there, A, B and C. All the three are practicing chartered accountants. Can we call this assignment as joint audit? For a company, a firm was appointed in which more than one practicing chartered accountant partners are there. Can we call that assignment as joint audit? No. See, in a firm, there could be numerous partners, but you have appointed only one auditor. One audit firm has been appointed. So that's why this assignment, we can't call it as a joint audit assignment. So there is a company, X Limited, for the financial year 22-23, they have appointed ABC and Co, an audit firm, as a company auditor. For the financial year 2023-24, they have appointed another firm XYZ and Co as a company auditor. Can we call this as a joint audit? No, because for two different financial years, two auditors were appointed. This also we can't call it as joint audit. Same, X Limited, for the financial year 2023-24, they have appointed Mr. X, an individual practicing chartered accountant, as a tax auditor. They have appointed for the same financial year 2023-24, Mr. Y, another practicing chartered accountant, as a company auditor. Can we call this as a joint audit assignment? No. Why? Because here the scope is changing. One person is appointed as tax auditor, one person is appointed as company auditor. X Limited, the company, for the financial year 2023-24, they have appointed Mr. X, who is a principal auditor of the company. For the same financial year 2023-24, they have appointed another person, Mr. Y, another practicing chartered accountant, as a branch auditor for the same financial year.
Can we call this assignment as a joint audit assignment? Here also the answer is no. Why? Because here also the scope is different. Principal auditor will have scope as entire company. Branch auditor will have a scope of only that specified branch for which he is appointed. So this also can't be called as joint audit assignment. X Limited, for the financial year 2023-24, they have appointed a firm ABC and Co as a company auditor, and for the financial year 23-24, another firm XYZ and Co, they have also been appointed as company auditor, and both the firms are signing the audit report. Can we call that as a joint audit assignment? Yes. Same entity, same financial year, same scope of work, more than one auditor appointed. This we can call it as a joint audit assignment. Or X Limited company, for the financial year 2023-24, they have appointed a firm ABC and Co, and for the same financial year they have appointed another individual practicing chartered accountant, Mr. X. Both are conducting company audit, both are signing the audit reports. Can we call it as a joint audit assignment? Yes. So when more than one auditor, when I say more than one auditor, more than one audit firm, or more than one individual practicing chartered accountant, or a combination of audit firm and individual practicing chartered accountant are appointed for the same financial year, for the same company, having the same scope of work, we call that assignment as joint audit assignments. So does the joint audits really happen? Yes, they do happen. When you open the Reliance Industries Limited audit report, you will be able to find the partners from two different firms would have signed the audit report. So let me show you here. Where are annual reports? Yes, here I have the annual reports. Shit, here it is not there. Yes, here is the audit report for Reliance Industries Limited. So if you see the audit report, at the end of this audit report, as you could see here, at the end of this audit report, as you could see here, two firms, partners from two firms would have signed the audit report. So here, I guess, where it is. Okay, so this is some another year. This, yes. Come on. Okay, yeah. See here. So this is the audit report of Reliance Industries Limited, and as you could see, there is one partner who is signing on behalf of the firm Deloitte Huskins and LLP. There is another partner who is signing the audit report on behalf of the firm Chaturvedi and Shah LLP. So for the same financial year, for the same company, for the same scope of work, two firms have been appointed, Deloitte and Chaturvedi and Shah. So the Reliance Industries Limited audit is a joint audit. Not just that, similarly, if you download the audit report of the SBI, you will be able to find yeah, this one. So if you download the audit report of the SBI, you will be able to find some partners from 14 audit firms who would have signed the audit report. That means 14 audit firms have been appointed as company auditors for the SBI, as a statutory auditor for the SBI, and the partners from all these 14 audit firms are signing the audit report. So like this, yes, joint audits do really happen, where more than one auditor is getting appointed for the same entity for the same financial year and also having same scope of work. But there is no mandatory requirement for the time being. Now joint audit is not mandatory, but in the coming future they can make that mandatory for certain large companies. But for the time being now, joint audit is not mandatory. It is completely voluntary decision of the client. If the Reliance would have appointed joint auditors, that is a company management's voluntary decision. If the SBI has appointed joint auditors, that is a voluntary decision of the SBI. So now a doubt will come, sir, why joint audit? What is the purpose of having the joint audit? Why an entity needs more than one auditor? Very simple. If you have joint auditors appointed, there are various advantages. Companies are finding huge advantages in appointment of joint auditors. Sir, what are that advantages? Number one, sharing of expertise. If you appoint more than one individual or one audit firm, they can share their expertise. Advantage of mutual consultation. Since two people are collaborating and working together, they will have mutual consultation that will ultimately benefit the client. Lower workload. On each auditor, workload is going to get reduced. Quality of performance, quality of work is going to get increased, and service to the client is also going to get improved. So like that, various advantages are there because of the joint audit. That's why companies are voluntarily going and preferring for the joint audit. But the joint audit is not just coming up with advantages. Along with it, there are various disadvantages also. There are various disadvantages of the joint audit. What are the main disadvantages of the joint auditors? Problem of coordination. The joint auditors might not coordinate with each other. And one more main problem for the auditors is reduction in the fees. reduction in fees. Last year for the Reliance Industries Limited, assume one audit firm only has acted as an auditor. They got an audit fees of 10 lakh rupees. Now in the current year, Reliance told, no, we will appoint joint auditors. We will appoint two firms. Now they are telling for each firm we will pay only 7 lakh rupees. Last year, since you have single-handedly done the audit, you got 10 lakh rupees of audit fees. Now you have to share your work with other person. Your fees also will get reduced. Lower fees. Superiority complexes, ego complexes will be there. Joint auditors might not coordinate with each other because of the ego complexes, and sometimes because of mistake done by one joint auditor, other joint auditor must also face the consequences. So like that, joint audit is coming up with advantages, not just advantages, the joint audit along with it, bringing the disadvantages also, but advantages are outnumbering the disadvantages. That's why some companies are voluntarily coming forward and getting their joint audits done. Now, sir, how the work will happen? When more than one auditor is appointed, how the work is going to happen? Do you think Reliance Industries Limited have appointed two firms as the auditors? Do you think each audit firm will do the audit separately? Will 2 times audit of Reliance is going to happen? That is not the purpose why joint audit is done. Similarly, SBI, if they have appointed 14 audit firms, does that mean each audit firm will do audit separately and 14 times audit of SBI is going to happen? No, that is not the purpose. So generally, when the joint auditors are appointed, the work will be divided among all the joint auditors on some suitable basis. If Reliance has appointed two audit firms for conducting their audit, these two audit firms will divide the work among themselves on different basis. If SBI has appointed 14 joint auditors, these 14 joint auditors will divide the work among themselves on some basis. You tell me on what basis work can be divided? The work can be divided on the basis of items of the financial statements. Like Reliance Industries Limited auditors are telling, one auditor is telling, I will look after incomes and assets, other auditor is telling, I will look after liabilities and expenses. They can divide on the basis of period. On the basis of period of the financial statements, they can divide the work. One joint auditor is telling, I will look after first 6 months of data. Other joint auditor is telling, I will look after the next 6 months of the data. The work also can be divided on the basis of geographical locations. For example, Reliance Industries Limited is telling, I will look after some 10 states, and Reliance Industries Limited, one of the joint auditors is telling, I will look after 10 states. Other joint auditor is telling, I will look after the remaining states. So like that, work can be divided on the basis of geographical location, and even work can be divided on the basis of identified units. Like Reliance is having multiple products, petroleum they have retail, they have fashion segment, they have telecommunication. So one joint auditor is telling, I will look after petroleum and retail. Other joint auditor is telling, I will look after fashion and telecommunication. So like that, whenever joint auditors are appointed, generally the work will be divided among all the joint auditors on some suitable basis, and that basis could be on the basis of items of the financial statements, or that could be on the basis of period of the financial statements, that could be on the basis of geographical locations, or even that could be on the basis of identified business units. Now, okay, we have seen how the work is going to happen. Now, what about responsibility? There will be two kinds of responsibility. One is separate responsibility and other one is joint responsibility. See, since work has been divided among each of the joint auditors, each joint auditor will be held responsible only for the work which was allocated to him. Take for example, Reliance Industries Limited auditors have divided. Two auditors are there, A and B. A was allocated the work of first 6 months from April to September related data that will be verified by A. B is going to verify the next 6 months of data, October to March. Now, A will be held responsible only for the work which was allocated for him. B will be held responsible only for the work which was allocated for him. Like for example, if tomorrow it was found out that there was a fraud which has happened in the month of August, and these joint auditors were unable to identify. When the fraud has happened, August 2024 fraud happened, but auditors were not able to identify. Now you tell me, if this fraud was not identified, will both the joint auditors be punished or only one joint auditor will be punished? Only one joint auditor. Joint auditor A will be punished. Why? Because that period falls in the work of Mr. A. So like this, when work is divided among the joint auditors, each joint auditor will be held responsible only for the work which was allocated to him. He need not face the consequences for the work allocated to others. But however, standard also says one thing, there are certain areas where there will be joint and several responsibility. They have told a few areas. In those areas, if something wrong happens, every joint auditor has to face the consequences. Sir, what are those areas where there will be joint and combined responsibility? So if we have a look at that, so what are those areas where there will be joint and combined responsibility? Here is the list in respect of audit work which is not divided. if some work is not divided among any of the joint auditors. Like for example, 14 joint auditors of SBI are there. So they have divided the work, but one area of work was not divided among any of the joint auditors. Like if I have to give you example once again, SBI 14 joint auditors are there. They have divided the work on the basis of different kinds of services which the SBI is offering. So one joint auditor is looking after housing loans. One joint auditor is looking after personal loans. One joint auditor is looking after vehicle loans. Like that, all the 14 joint auditors divided the work on the basis of business. Now, credit cards was not allocated to any of the joint auditors. Credit card was not allocated to anybody. It is an undivided work. If in the credit cards, if something wrong happens and if auditors were unable to identify, who will face consequences? All the joint auditors. Why? Because this is an undivided work. So first area where there will be joint and several responsibilities in respect of undivided work. Similarly, when decision has been taken by all the joint auditors collectively, some decision has been taken by all the joint auditors collectively, who has to face consequences if something goes wrong in that decision? All the joint auditors. Why? Because the decision was taken by all. If something goes wrong in that decision, everybody has to face the consequences. Similarly, in respect of matters brought to the notice of all the joint auditors, I will tell you one interesting thing here. Take for example, one of the joint auditor, C. He was verifying vehicle loans, and while verifying vehicle loans, he found some misstatement. This misstatement, he did not keep it to himself. This all the 14 joint auditors, they have a WhatsApp group. They have what? WhatsApp group. In that WhatsApp group, whatever misstatement this person, Mr. C, has found out in the work which was allocated to him, he posted that message in the WhatsApp group. He posted that message. All the 14 joint auditors have seen it. All the 14 joint auditors have seen it. Now, C did not take any action while making the opinion. He did not bring this point. He did not give modified opinion. Since he is not concerned, remaining 14 joint auditors also did not speak anything, and all of them collectively gave an unmodified opinion. Later, this misstatement came to the public notice. Now, who will be held responsible? Now, everybody will be held responsible. You will say, sir, it was work allocated only for C. No, C only should be held responsible. Okay, C should be held responsible, but C did not keep that information to himself. No, it was brought to the notice of all the joint auditors. If C is not taking action, since as a other joint auditor, you have that information, you should have taken the action. See, if you don't know and that's why you did not take action, okay, you will not be punished. But even after knowing also, if you did not take any action, then also you have to face the consequences. So if the matters has been brought to the notice of all the joint auditors and none of them has taken action regarding that, also everybody has to face the consequences. Similarly, whether presentation and disclosure of the financial statements is as per applicable financial reporting framework or not, checking that is also responsibility of all the joint auditors. Nothing but presentation of the financial statements, whether they are prepared as per Schedule 3, whether all the disclosure requirements of accounting standards are there or not. So checking this presentation is also everybody's responsibility. And in that presentation, if something has gone wrong and none of the joint auditor has taken any action, everybody will be held responsible. And finally, preparation of audit report that complies with the relevant statute. Nothing but preparing the audit report as per the standards on auditing is also responsibility of everybody. If audit report is not prepared as per standards, then who will face consequences? All the joint auditors are going to face the consequences. So this is what regarding responsibility. So two responsibilities: separate responsibility, joint responsibility. Generally, each joint auditor will be held responsible only for the work which was allocated to him. But there are certain areas where every joint auditor will be held responsible. 5 areas they have notified: undivided work, decisions taken by all, matters brought to the notice of all, and presentation and disclosure of the financial statements as per applicable financial reporting framework, and preparation of audit report as per relevant statute. In these 5 areas, there will be joint and combined responsibility. Now, sir, how the reporting is going to happen? How the reporting will happen in the case of the joint audit? In case of SBI, there are 14 joint auditors. Do you think each auditor will give separate report? Will there be 14 joint audit reports? No. In normal circumstances, what will happen is, once the audit gets completed, all the 14 joint auditors will sit together. They will discuss all their findings and they will come to one common conclusion. They will form one single opinion. That opinion will be drafted in the audit report, which will be signed by all the 14 joint auditors. This is what normally will happen. So in the case of joint audit, all the joint auditors will sit together, discuss their findings, discuss their conclusions, and form one single opinion, which will be signed by all the joint auditors. This is what will normally happen. So if everybody comes to one common conclusion, fine. But when the problem will arise, when there is a disagreement between the joint auditors. Take a typical scenario. Out of this 14 joint auditors, 13 joint auditors are telling unmodified opinion is appropriate. But one joint auditor is telling he's a freshly qualified chartered accountant. He wants to use all his skill in his first audit only. This joint auditor, in the work whatever has allocated to him, he found misstatement. And it was not that material. So remaining 13 joint auditors are telling, okay boss, you found a misstatement, but that is not material. We will give unmodified. But this fellow is arguing, no, I found a misstatement. In my opinion, that is material only. I will give modified opinion. So 13 joint auditors are telling unmodified opinion. One joint auditor is telling I will give modified opinion. Now what should happen? Should this one person go with the majority? Should this one person go with the majority? The answer is no. There is no requirement to go by majority. There is no requirement to go by majority. Then what can be done, sir? Then what can be done is you need not go with the majority. In this case, what will happen is these 13 people will give a single audit report which contains the unmodified opinion signed by 13 joint auditors. This one person can express his separate opinion in a separate audit report signed by this one single joint auditor. There will be two reports here. So the thing is, in case if there is disagreement, no need to go with the majority. That disagreeing joint auditor can give his separate audit report through a separate opinion. Clear? So now there are two audit reports. Take this typical scenario. Two audit reports are there. 13 joint auditors are giving unmodified. One joint auditor is giving modified. Which report will be circulated to shareholder? Both the reports will be circulated to shareholder. Which report shareholder should rely? That is his headache. That is his headache. Let him take that decision. So, but when there is more than one joint auditor's report, all the reports will be circulated. Let the shareholder himself decide. He will read the report, he will read the basis for opinion, and he will take the decision accordingly, which report should be relied, which report should be thrown away in the dustbin. So this is how reporting is going to happen. Clear, everybody? Next. And one more thing here, when there is more than one report, in each report that should contain a reference to the other report. Which means in this case, 13 joint auditors are giving a single audit report in which they are giving unmodified opinion. No, in their report they should mention that this is the audit report of us 13 joint auditors. There is one more audit report which is given by another joint auditor. Similarly, this person, while preparing his report, he should add a note in that report. This is my audit report. There is another report of remaining joint auditors. Like that, reference should be there. Clear? So this is what regarding reporting. This is the reporting responsibilities. And yeah, special considerations. One last part regarding SA 299. When joint audit is happening, what are the special considerations? Special considerations are nothing. In normal audit, one auditor will decide audit strategy, audit plan, audit program. But in the case of joint audit, all the joint auditors should be involved in planning. Everybody should participate in the engagement discussion. They have to develop one joint audit plan. They should have a joint audit strategy. On what basis they have divided the work, that should be documented, and that document should be signed by everybody. How they have formed the conclusion, what discussions they had, everything should be documented. So that's what they say here. Simply, whatever we do separately in a normal audit, that we do jointly in a joint audit. Like if you could see here, the engagement partner and other members of the engagement team from each joint auditor should be involved in planning. While developing the planning, while doing the audit planning, every joint auditor should involve. It is not like one joint auditor will develop and rest of them will follow. Everybody should involve. Members from every joint auditor should be involved in planning the audit. And they will establish one joint audit strategy which sets the scope and timing and direction of the entire audit. They will not have separate strategies. Everybody will develop one single audit strategy. And in developing the joint audit plan, in the joint audit plan, you have to include how the work was divided, what are your reporting objectives, factors that are significant, preliminary engagement activities, nature, timing, and extent of resources. You will find this familiar. Why? Because the same points we have discussed in the chapter audit strategy, planning, and program. If you remember audit strategy chapter, if you open the first question, you will find what factors are required to be considered while developing audit strategy. Same factors you will be able to find. But what they are telling here is, in case of normal audit, one auditor will do it. In case of joint audit, everybody, all the joint auditors will consider all these factors and establish a joint audit plan. Next, and they have to collectively assess risk of material misstatement, and they should document what procedures they are performing for separate areas, what procedures are performed for collective areas, undivided areas, who is going to do what. So like that, they have to document the nature, timing, and extent of audit procedures for common and specific allocated areas. And they should get one common engagement letter. There will not be separate engagement letters. Everybody will get one common engagement letter, and they will get common representation letters. Written representations also management will give collectively for all the joint auditors. They will not give separately written representation for each joint auditor. And finally, on what basis work was allocated, as I have told, that should be documented, and that work allocation document should be signed by all the joint auditors, and that work allocation document should be communicated even with those charged with governance. Nothing but, as I've told, whatever we do in normal audit, that only we will jointly and collectively do in the case of joint audit. That's it. So these are the special considerations as per SA 299. So with this, we are done with revising the chapter, general auditing responsibilities, general auditing principles and auditors responsibilities, where we have covered 4 standards: SA 240, 250, 260 and 299. So with this, we have wound up the revision of this chapter as well. Hello, my dear students. Welcome back to the revision series. In the previous session, we have completed revising SA 200 series of the standard, where we have revised 4 standards specifically. So we are done with SA 240, which is talking about the responsibilities of the auditor regarding fraud while conducting audit of the financial statements. SA 250 we are done, which is talking about what are the auditor's responsibilities regarding laws and regulations while conducting audit of the financial statements. Then we have spoke about SA 260, which is talking about communication with those charged with governance. Then we are done with SA 299, which is relating to the concept of the joint audit of financial statements. So now what we will do is we'll take up one small chapter, one small topic called internal audit. We'll try to complete the revision of the small chapter, internal audit. Very simple chapter, very easy chapter. Along with that, there is also one related standard regarding this internal audit, which is SA 610. So in this video, our prime focus is going to be regarding completion of the concept of internal audit along with the related standard SA 610. Both will try to complete in this session. So without any delay further, let me jump into the discussion. So what is this concept of the internal audit? First, we will try to understand what exactly is this concept of internal audit. See, till now we spoke about various matters related to audit. So we spoke about audit evidence, we spoke about audit procedures, we spoke about audit reporting, we spoke about various other scenarios like risk assessment, internal control. So all these things we have seen till now. So whatever concepts relating to audit, whatever we have covered till now, those are actually relating to the external audit. Whatever concepts relating to audit we have discussed till now, those concepts we have actually understood from the perspective of an external audit. So first of all, what is external audit? The audit which is required as per some law or regulation. Those audits which are actually required by some law or regulations, those audits mainly we call them as external audits. Like for example, if there is a company, if there is a company and that is incorporated under Companies Act 2013. As per the Companies Act 2013, the company has to undergo something called company audit. They have to undergo something called company audit, which we can also call it a statutory audit, where an external person, a person outside of the organization, an external person will come and verify the client's books of accounts, give the opinion and go away. Yes or no? And also you can say tax audit. The tax audit which is required under Income Tax Act, that is also an example of external audit, where an external person will verify, will come and will verify our books of accounts, will verify our tax computations, whether we made a correct amount of depositing of the tax or not. That we will verify. That is also one example of external audit. So whatever concepts we have discussed till now, those are actually from the perspective of external audit. So see, there is already a concept called external audit. We have discussed so many things regarding this. Now, what is this internal audit? When we already have an audit mechanism in the form of external audit, what led to the introduction of this concept of internal audit once again? Why this double audit? Why this unnecessary complication? Let me try to simplify that. So first, we will try to mainly focus on the differences between internal audit and external audit. So to understand the differences, first we will try to understand what exactly happens in the external audit. We'll try to understand with the help of one company audit scenario. See, basically, take for example, there is a company Infosys. So if the company audit, see definitely since Infosys is a company registered under Companies Act 2013, statutory audit must happen. So take for example, Infosys has appointed Deloitte, an audit firm, an external audit firm, something who is external, who has nothing to do with the Infosys. So they are not a shareholder, they are not part of management, some external person, Deloitte, they have appointed. So now Deloitte they have appointed as a company auditor, as an external auditor. Now what this Deloitte will do? Do you think Deloitte will come to the Infosys every day to do the verification? No. So number one, there is no continuous interaction. We can't expect the external auditors to come daily and verify the transactions of the client company. That we can't expect. Number two, and one more thing. So Deloitte is someone who is an external person. Deloitte is someone who is an external person. He will only verify, he is only concerned with financial statements and books of accounts. Yes, little bit of internal controls he will be concerned, and he will also verify only those internal controls which are related to the financial statements. Accounting controls only external auditors are more focused. External auditor, what is the main scope of work? Number one, once in a while he will come. In case of big listed companies, once in a quarter they will come. For every 3 months, some 10 days, 15 days, auditors will come, verify the transactions and books of accounts on sampling basis. And external auditors are more concerned only with the financial statements and accounting controls. Yes or no? And these external auditors, they will report to whom? To the stakeholders, basically shareholders. External auditors are going to report to the shareholders of the company. Number four, these people are going to verify the transactions on sampling basis. Little bit of verification they do. Very little bit of verification they do. Hardly 10 to 15% of the sample sizes they are going to verify. And one more thing here, these external auditors, their responsibility is only to express an opinion whether the financial statements are giving a true and fair view. What external auditors will do, they will verify financial statements, books of accounts, and only they will leave their comment whether those financial statements are giving a true and fair view or not. They have nothing to do with giving the suggestions to the client company. They will not give suggestions. They have nothing to do with value addition. They have nothing to do with developing the client company. They have nothing to do with making the client company better. So basically, external audit is just one compliance mechanism. What is external audit? It is just one compliance mechanism. Once in a while, an external person will come, verify the transactions on sampling basis, will be concerned only with the financial statements and books of accounts, and he will only express his opinion. He has nothing to do with the development of the company. He has nothing to do with giving suggestions of the company. We can't even expect also whether the company is making profits, making losses, what we can do to improve the profits of the company, what we can do to improve the overall organization of the client. These are all not matters of concerns of the external auditor. He has nothing to do with all these aspects. So that's why what industry thought is, okay, external audit is just one compliance mechanism. In big organizations, there is more robust audit mechanism needed, which will overcome the problems of the external audit. So the problems of external audit, as I've told, there is no continuous interaction. So industry thought there should be one more audit mechanism where there will be continuous interaction with the client. Someone who is coming to the client on a regular basis and verifying the transactions on a regular basis, some continuous interaction of the audit is required. Number two, external auditors are only concerned with financial statements and books of accounts. We need one more robust audit mechanism where the auditor is going to concentrate even on operational aspects also, like production, quality, HR. So we need one more audit mechanism which just doesn't concentrate only on financial statements and books of accounts. We want some audit mechanism where the auditor will be concerned with the financial matters also. At the same time, he will also be concerned with operational aspects also. And number three, we need an audit mechanism where the reporting is not going to the stakeholders, to the external person. Reporting should happen to the management. Management should know what is going wrong in their organization, where they have to focus more, where they have to less focus, in which areas they have to implement more internal controls. Like management also needs some reporting mechanism. So we need one audit mechanism where the auditor is not going to report to the external persons. He is going to report to the management only. And we want one more robust mechanism where the auditor will verify the much more detailed verification. External auditor is doing only random verification, very limited amount of verification he is doing. So industry thought there is need for such an audit where there will be much more detailed information. And most important thing, external auditor is not at all concerned with giving suggestions and improving the organization. We need such an audit mechanism where the auditor is going to find out weaknesses in the internal controls, weaknesses in the organization, weaknesses in the operation, and he will also give suggestions for improvement. What he's also going to do? He's also going to give suggestions for improvement. Such a robust audit mechanism is required. So this is what the industry thought. External audit alone is not enough for big companies. We need one more robust audit mechanism which will overcome all the problems of the external audit. Like there will be continuous interaction. The auditor is going to concentrate on operational aspects, and he will report to the management. He will do much more detailed verification, and also he will work for overall development of the organization. And the kind of audit which fulfills all these kind of things is internal audit. This is what basically we call it as internal audit. Sir, is internal audit mandatory for all the companies? No. As per the Companies Act 2013, Section 138 has given applicable criteria. Only those companies which fulfill that criteria, those companies are only required to make an appointment of internal auditor. For other companies, it is not mandatory. It is their voluntary choice. But internal audit is not mandatory for every organization. There are only a handful of companies which fulfill criteria given under Section 138. Only those companies are required to appoint the internal auditor. So we will say what is that criteria. We'll go to the material and we'll see what is the criteria. So first of all, let us have look once at the definition of the Internal audit. So if you see here, as defined in framework governing internal audit provides independent assurance on effectiveness of internal control. So see here, they are all together changing the definition. In the external audit definition, they say auditor will do independent examination of financial information. Their financial information is only scope. But here, if you see, they are telling internal auditor is providing assurance on effectiveness of internal controls, risk management, proper risk management in the organization, and to enhance governance and improve, enhance in the sense to improve the governance, to improve the overall management of the organization and help the organization to achieve their objectives. All these things are not there in the case of external audit. They will simply say you have to express the opinion, that's all, your responsibility will come to an end. But see the scope of the internal auditor. He is responsible for improving the effectiveness of internal controls. He should help the organization for better risk management, and also he should enhance the governance and help the organization to achieve its objectives. This is what I basically call it as value addition. There should be value addition. Clear? So, and also we will try to have a look at the differences between external audit versus internal audit. So there will be one small question here. So if you see, so what are the differences between internal audit versus external audit? If you see here, who will perform internal audit? Internal audit will be performed by internal audit function within the organization. So either the company, some big companies, what they do is they have their own staff. They have their own employees to whom they will give the role of internal auditors. And also some organizations, they will not appoint their own employees for doing internal audit function. They can also go for external auditor. But in the case of external audit, only outside part, a firm or an auditor who is not a part of the management, not a part of the organization, an external person will come and do the external audit. Whereas internal audit, even internal employees also can do. Next point of difference, examination. What will external auditor examine? External auditor examines accuracy and validity of financial statements. As I have told, external auditor mainly concentrates only on the financial information. But if you see internal auditor, he is going to examine operational aspects, not just financial, operational aspects. In the operational, finance also will come, but beyond finance, he will look after various aspects like production, sales, HR, marketing, internal controls. So all these things also he will examine. Who will appoint internal auditors? Internal auditor will be appointed by audit committee. If there is an audit committee in the company, so that audit committee will make an appointment of internal auditor. If there is no audit committee, board of directors will make an appointment of internal auditor. That means internal people only will do the appointment. But you all are aware, in the case of company, external auditor will be appointed by shareholders of the company, not by the management. Shareholders will make an appointment. Now, who will use the report? In case of external audit, the report will be used by stakeholders. When I say stakeholders, they will be shareholders, creditors, bankers, government. These are the stakeholders for whose purpose external audit will be done. But internal audit report will be used by the management themselves. It will not be given to the external parties. It will be used by management themselves. To whom the report, what kind of reporting will happen? We know in the case of external audit, auditor is going to express an opinion on true and fairness of the financial statements. But in the internal audit is going to report on weaknesses in the internal controls, and even he's going to report on effectiveness of operational aspects. Overall organization is working in a proper way or not. He's going to give a report on effectiveness of operational aspects. But external audit is only giving opinion on true and fair view of the financial statements. So what is the status of the auditor? External auditor will always be a outside person. He should not be an employee. External auditor can never be an employee of the company, but internal auditor can also be an employee of the company. And one more point of difference also I will tell you here. See, the external auditor, whatever company audit, whatever statutory audits that are happening, the guidance for all that external audit comes from standards on audit. The guidance for all the external audit comes from standards on audit. How to do the audit, how to do the reporting. So all that guidance will be given by standards on audit. Like the standards we have seen till now, 240, 250, 700 series. These are all the standards which are talking from the perspective of external audit. When it comes to internal audit, there are altogether different category of standards, which we call them as standards on internal audit, SIA. So the guidance for external audits will be given by standards on audit. The guidance for internal audit will be derived from altogether different series of standards, which we call them as SIAs, standards on internal audit. So like that, dedicated standards are there, which are talking about internal audit related matters. So SIA is going to give the guidance regarding internal auditors. Clear? So we have seen what is the meaning of internal audit. How does that differ from external audit? Now I told internal audit is not applicable for all the companies. There is a criteria given. Where that criteria is given? In section 138 of the Companies Act, the criteria is given. So what is that criteria, sir? Let us see. Number one, every listed company. If the company is listed on any stock exchange, no need to look for any criteria. If the company is listed, it is mandatory for that company to make an appointment of internal auditor. In case if the company is a public company but not yet listed, public limited company but not yet listed, in that case it has to fulfill any of these four conditions. Not all, guys. Even if one of that four conditions are fulfilled by a public unlisted company, then also it is mandatory for them to make an appointment of auditor. So what is that criteria for a public company, unlisted public company? So four criteria: 25, 50, 100, 200, twice the previous number. Start with the 25, twice the previous number. So if the company is having outstanding deposits of 25 crores or more at any point of time during the financial year. See, I already told you what is the significance of at any point of time. So if you see here, outstanding deposits of 25 crore rupees or more at any point of time, not as on the balance sheet date, at any point of time during the preceding financial year. That means if you have to decide whether for the financial year 24-25, should I make an appointment of internal auditor or not, if you have to decide it, you have to go to the preceding financial year. 23-24 you have to go. At any point of time throughout this financial year, at any point of time, if the outstanding deposits are 25 crores or more, they have to compulsorily make an appointment of internal auditor for the financial year 24-25. Next, second one is 100. Okay, so once again, if you come back here, 100, 50, 25 to 50. So they say paid up capital is exceeding, paid up capital is 50 crores rupees or more. So if you see here, if the company is having a paid up share capital of 50 crores or more during the preceding financial year. So in the last financial year, if the paid up capital is more than 50 crores or more, then also the internal audit will become applicable. Then the next figure is 100. Sir, what is 100, sir? Outstanding loans and borrowings. Outstanding loans and borrowings if they are 100 crores or more. So if you see here, once again, outstanding loans or borrowings from banks or public financial institutions. Same thing as we have seen in CARO. Not all borrowings, only from banks and public financial institutions. If the outstanding loans and borrowings has exceeded 100 crore rupees or more, here also most important thing, at any point of time during the financial year. What they are telling, at any point of time, if the outstanding loans or borrowings only from banks and public financial institutions. And the last one is turnover. If the turnover is 200 crores or more, then also internal audit will become applicable. So all the four conditions should be satisfied, or any one condition. Even if one of the condition gets satisfied by a public company which is unlisted, the internal auditor becomes mandatory. So what are that four conditions? Outstanding deposits of 25 crores or more at any point of time during the financial year. Paid up capital of 50 crores or more during the financial year. Then outstanding loans and borrowings from banks and public financial institutions of 100 crores or more at any point of time during the financial year. Then finally, turnover during the preceding financial year is 100 crores or more. Sir, what if it is a private limited company? What if it is a private company? So if it is a private company, then the act is telling you need to check only two conditions. You have to check the conditions of borrowings, outstanding borrowings of 100 crores or more, and you have to check the condition of turnover of 200 crores or more. That's all. Only these two conditions you have to check. For a public limited company, we have to check any of that four conditions. For a private limited company, check only two conditions. So that's what they say. Every private company having turnover of 200 crores or more during the preceding financial year, or if they're having outstanding loans or borrowings from banks or public financial institutions exceeding 100 crores or more. So this is the applicability criteria. Any company which fulfills this criteria, they are required to mandatorily make an appointment of internal auditor. So what about other entities? That is up to their choice. But if they want, they can appoint. If they don't want, they need not appoint it. And also one more thing here, sir, who can be appointed as an internal auditor? What kind of legal form can be appointed as an internal auditor? An individual person can be appointed as an internal auditor. A partnership firm also can be appointed as an auditor. And most important thing, body corporate also can be appointed as internal auditor. Body corporate other than LLP can't be appointed as a statutory auditor, but body corporate can be appointed as an internal auditor. There is no objection in the Companies Act regarding that. Next one, sir, what about the qualifications, sir? Who can be appointed as an internal auditor? For acting as an external auditor, he must be a practicing chartered accountant. But who can be appointed as an internal auditor? The act says a chartered accountant, whether in practice or not, a cost accountant, whether in practice or not just these two, any other professional as may be decided by the board of directors. Any other professional.
So finally, the conclusion is you need not be a chartered accountant, you need not be a cost accountant for becoming internal auditor. The management can appoint any professional for conducting internal audit, that is up to their choice. So that's what they have told. Can be either a chartered accountant, can be either a cost accountant, whether in practice or not, or such other professional as the board of directors or management may deem fit. Sir, who will decide the scope of the internal auditor? What internal auditor should do, what internal auditor should not do, what is included in his scope, what is not included in his scope? Who will decide it? If audit committee is there, audit committee will decide. If audit committee is not there, then board of directors will decide. So if audit committee is there, they will sit with the internal auditors, do the proper consultation, decide what will be the scope of internal auditor. If there is no audit committee, the board of directors will sit with the internal auditors and they will finalize what will be the scope of internal auditor. Next, sir, what are the critical activities of internal auditor? What and all are the major activities which he has to do? So the major activities, the most of the things are going to remain common like external audit only. Like if you see here, the major critical activities are like external audit. He has to plan, scope and determine the methodology of internal audit function. He has to do the planning of the internal audit. He has to decide what will be the scope, and he has to even develop a methodology of how to conduct that internal audit. Then he has to oversee and monitor various audit assignments, their proper planning, execution, and reporting of findings and subsequent closure of reported observations. Obviously, after you have done your internal audit assignment, you have to report your findings. You have to check what observation, you have to give your observations. You need to check how those findings are getting rectified. So those steps you have to follow. So first one, do the proper planning, deciding the scope and all. Second step, you have to monitor and report. Finally, for doing that internal audit function, whatever resources are required, acquire that resources, properly train the internal audit team, develop their staff, develop their talent. Nothing but it is your responsibility to have a strong internal audit team also, which contains competent, capable staff. And then finally, you have to, if required, even you need to get the help of external experts also. Sometimes for doing internal audit, you might require the help of experts like lawyers, actuaries. Even you have to arrange that experts as well. And whatever your observations are there, you have to make sure you are properly communicating with all the key stakeholders, whoever is concerned with the internal audit process, whoever is involved with this internal audit process, whoever is getting benefited by this internal audit process. With all that stakeholders, you have to do timely communications also. And then you have to maintain quality as well, quality and improvement program. Whatever work you are doing, that you have to maintain the quality as well. So these are all the main critical activities of internal auditor. If I have to put it in simple terms: planning, reporting of the findings, then you have to resources, plan, acquire and engage and review the resources, then take the help of experts wherever needed. Communication, proper communication is also required, and quality you have to maintain. And particularly with regarding to accounting function and financial records of the organization, what are the responsibilities of internal auditor? So the previous point talks about overall responsibilities. Now, in the second point, they're specifically talking about with regard to accounting function, with regard to finance department, what internal auditor should do. Same here. First, he will check internal controls, whether the client is having proper internal control system in the area of accounts, like proper segregation of duties, proper authorization mechanism, hierarchy, approvals, physical controls. So like that, first, like external auditor, he will also need to verify adequate internal controls are there or not. And also, he must operate independent of the accounting staff. He should not be one of the accounting staff, independent. That means without any influence from the accounting department, he has to work. Next one, he should not involve in performance of executive functions. Most important thing, internal auditor should not be given executive responsibilities. You can't employ a person as internal auditor and ask him to pass the journal entries. You can't appoint an internal auditor and ask him to maintain the assets. So those kind of execution responsibilities should never be given to internal auditor. And also, he has to observe the facts and situation and bring them to the notice of authorities, which regarding various policies, any deficiencies if he finds out in the accounts department, in the finance department, he has to report it to regulatory authorities as well. And to work closely with the management and try to understand knowledge of various policies which are getting followed in the organization. Finally, he must always enjoy an independent status. So with regard to accounting function, these are the responsibilities of internal auditor. What are they? Number one, he will verify internal controls. Number two, he should be independent of accounting staff. Number three, no execution responsibility should be given to him. He has to bring to the notice of authorities if he finds any lapses and deficiencies, closely associate with the management. And finally, he must enjoy an independent status. That is anyhow repeated point. And not just verifying this, one more point they say, he should also give advisory inputs.
what internal auditor should do, should also give advisory inputs to the management. Advisory inputs means, as I have told, not just telling where something is wrong, should also tell what can be done to overcome that problem. What can be done to improve the organization. That advisory inputs are also required to be kept in mind, are also required to be given by the internal auditor to the management or those charged with governance. Clear, everybody? Now going forward with the remaining concepts. So now we will see quickly question number 2, which is simply talking about what considerations to be kept in mind while developing internal audit plan. Same like statutory audit. Similarly, when you're working for internal audit also, like I have told, we have to spend a lot of time on planning. For statutory audit also we do it. Similarly, for the internal audit also, before we directly jump into the process of audit procedures and all, we have to spend significant amount of time even in planning of the internal audit. So while developing that internal audit plan, what are the various factors you are going to consider? So we are going to consider various factors like, first of all, as an internal auditor, we have to develop the audit plan after consultation with those charged with governance and management. So as I have told, audit committee or board of directors will sit with the internal auditors and then they decide the scope of work, right? Similarly, when the internal auditor wants to develop an audit plan, he has to consult with those charged with governance or management and then finalize the final audit plan. And whatever audit plan he has developed, he has to develop and document for each internal audit engagement in an efficient manner. And also, he should, in his plan, he should not just concentrate only on the financial matters, he should also concentrate on operational aspects also. That is the main difference between internal audit and external audit. External auditor only concentrates on financial matters, but internal auditor concentrates on financial as well as operational aspects. And various other factors which he needs to consider while developing a plan is, you have to study the risk. Similar to external auditor, he also should perform risk assessment procedures and try to understand the risk. And also, to prevent that risk, what kind of internal controls are getting implemented and how much effort you have to put it for each area, how many efforts you have to put it, how many days, how many hours, how many resources that you have to decide. And even risk appetite, risk taking capability of the organization. And you have to make sure that in your audit plan you are covering all auditable areas. Whatever is included in your scope, you should develop audit plan in such a manner that you are covering all that areas in the audit. You should cover all auditable areas. So do you find anything new here? Nothing new. So whatever factors those are basically considered by an external auditor while developing audit plan, the same factors more or less will be considered even by internal auditor also. Then this is the next most important concept. What and all areas will be verified by an internal auditor. So as an internal auditor, what and all areas you are supposed to cover in your internal audit? So as I've already mentioned, internal auditor will not concentrate only on financial matters. He will cover various aspects. So those aspects only they have listed out in a detailed manner. So just I will tell you broader areas. Inside the content is very general, very layman content will be there. So just we'll try to understand overall perspective of the answer. So basically in this question, they are going to ask you what and all areas will be reviewed by internal auditor. Number one, he is going to verify internal control system. But the difference between external auditor and internal auditor is, external auditor also will verify internal controls, but he will verify internal controls which are mainly relating to accounting and finance area. So if I put it in other way around, external auditor will be more concerned with accounting controls. But internal auditor is not like that. He will not just verify internal controls in the area of finance and accounting. He will verify internal controls in all operational aspects. What kind of controls are there in production? What kind of controls are there in HR? What kind of controls are there in attendance? What kind of controls are there in the warehouse? What controls are there in the accounting department? So like that, that is one main point of difference. External auditor will be concerned only with accounting controls, but internal auditor will be concerned with all controls. That is the first thing he will do. He will verify internal control systems and procedures. And along with that, he will also verify custodianship and safeguarding of the assets. This is basically part of the internal controls only. So internal auditor is going to concentrate more on verifying whether assets are properly safeguarded. Safeguarded in the sense protected. Like proper physical controls are there or not, periodical verification is happening or not, segregation of duties are there or not, proper records relating to assets are maintained or not. When I say assets here, it includes all the current assets and fixed assets. Every kind of asset will come into picture here. So whether entities assets are properly safeguarded. When I say assets, it even includes intellectual properties also. So all kind of assets are properly protected or not, that also will be mainly verified by internal auditor. So first he is going to verify internal controls, then he will verify whether assets are properly safeguarded and protected. In addition to that, the internal auditor is also going to verify whether the entity is complying with all the laws, rules and regulations.
So compliance with the laws and regulations, all the, for example, if the client is a company, whether they are complying with the Companies Act, if it is a manufacturing entity, whether they are complying with pollution related laws and regulations or not, if it is a food related industry, whether they are complying with food related laws and regulations or not, so Factories Act. So the internal auditor is even going to concentrate more on verifying compliances with laws and regulations. Finally, he will verify review of relevance and reliability of information, all the information that is getting generated, be it accounting records, be it inventory records, be it financial statements, be it employee related data. So he is going to verify reliability of information. And we also know today all the information is not getting generated manually. Computer systems, softwares are getting used for the purpose of generation of information. So he is going to concentrate even on verification of that information systems, what kind of softwares the client is using, how they are integrated, is it an inbuilt software or outsourced software, are there any lapses in that software they are using, with what frequency data is getting generated, who are the IT people in the organization, who is managing that IT system, to whom which power was given. So he has to do an in-depth study of information systems as well. Then he will verify organizational structure in the sense hierarchy. So who are top level management, what are their responsibilities, who are management, what are their responsibilities, who are at operational level, who are at executive level, who are at the ground level, if a transaction has to happen, what is the flow. So something there will be called standard operating procedures, SOPs will be there. SOP in the sense nothing but documented form, how a transaction should happen. Like for example, if a purchase transaction has to happen, what are the various steps involved? Like purchase department has to make a purchase requisition note, it should go to the vendor, then it will go to negotiation team will finalize the vendor, then a purchase order will go, then the vendor will send the goods, verification should happen, GRN should be raised. So like that, for purchases one complete process will be there, that they will try to document in one paper, in one piece of paper, and they save it. That we call it as SOPs. So these kind of organizational structure also the internal auditor is going to verify. Basically hierarchy, procedure, policies. So all these things he is going to verify. And along with that, he will also verify whether the resources are utilized in a proper manner, whether the organization is utilizing the resources in such a way that there is no wastage, there is no leakage, there is no abnormal losses. For example, if the company is inputting the raw material, proper output they are getting or not, input output ratio which you study in the costing. And unnecessarily the company should not be recruiting the staff and keeping them on bench. This is what mainly happens in the IT company. IT company recruits so many people and they will keep them on bench. That means they will not allocate them any work, they will just keep it on bench. So that is not a proper utilization of resources. So be it physical resources, be it labor resources, be it capital resources, be it technological resources, there should not be wastage of the resources. Resources should be utilized in such a manner that maximum benefit is getting utilized. There should not be any abnormal losses. So that utilization of resources also will be verified. And finally, even whether the organization is achieving all its goals and objectives. The people are working, like the management is working for achievement of objectives, employees are working for the achievement of objectives, and those charged with governance is having that in mind. So when an organization is running, it should not be running for the personal benefits or personal objectives of one or two people. If there is an organization, overall organization will have their objectives, like vision, mission statement will be there. So whether the organization is working towards achievement of that goals and objectives or not, that also should be verified by internal auditor. If you pay close attention, this will never be included in the external auditor scope. External auditor has nothing to do with verifying whether objectives are achieved or not. Just he will verify financial information. So these are all the various areas which will be covered by internal auditor. So what are all they? Number one, he will verify internal control system. Number two, he will verify whether the assets are safeguarded or not. Number three, he will verify the compliance with the laws, regulations, or policies. Number four, he will check the reliability of the information systems. He will verify organizational structure, and he will verify proper utilization of resources and whether the organization is achieving its goals and objectives or not. And like external auditor, even internal auditor is also required to comply with some ethical requirements like integrity, objectivity, and independence. Even internal auditor also should be independent. He should be able to do the work without any influence from others. Whatever he feels as right, that he should be able to say. If he finds something as wrong, he should be able to say something as wrong. So he should work in an independent manner. But here, if you remember, the internal auditor can be an employee also, the internal auditor can be an external person also. Tell me who will be more independent? When external firm is appointed as an auditor, they will be more independent than when employee has been appointed as an internal auditor.
But whatever it is, to the extent possible, internal auditor also should try to work in an independent manner. He should not get carried away by any kind of influences. Then he should be having integrity. Sir, what do you mean by integrity? Integrity means he should be honest, sincere, straightforward. He should not convey wrong statements. He should not associate himself with wrong information. So he should be truthful, honest, sincere, and straightforward. And objectivity, see, more or less objectivity and independence convey the same thing. Objectivity means no bias. There should not be any bias, there should not be any partiality. He should be able to do the work free from bias, free from partiality. So that nature we are going to call it as objectivity. So these things are not new to us. These ethical requirements will be even complied by external auditor. Similarly, internal auditor has also required to comply with these requirements: integrity, objectivity, and independence. Clear? Next. So what should be the qualities of internal auditor? If you want to become a good internal auditor, what kind of qualities you should possess? Number one, we should have good knowledge of accounting. We should have good knowledge of laws and regulations. We should have good knowledge of communication. Since as an internal auditor, we are required to communicate with so many people, you should have good communication skills. You should have good knowledge about the management policies. You should have knowledge of the client's business. You should know how the internal control systems will work. You should have proper drafting skills, because you have to prepare reports and all. You should have proper drafting skills. So very much common sense here. So what kind of qualities you have to possess? Like as you could see here, a few things I will try to highlight. You should have special expertise for evaluating internal control systems. You should have expertise. You should know how the internal controls will work. All that knowledge regarding internal controls you should have. And you must have accounting and financial expertise. Obviously, you should have very good knowledge of accounting and financial related matters. You should know the operations of the organization, technology, commercial practices. Today you have to do the audit in a digital environment. You should have a good knowledge of ERP systems, EDP systems, quantitative methods. This also you should have. And also you should, this once again, accounting software, ERP system, this you should have a good knowledge. You should know good about management policies. What kind of policies make a good management? What best policy should be there? You should have that knowledge as well. And also you should maintain confidentiality. You are expected to maintain confidentiality. Sir, what do you mean by confidentiality? Secrecy over the client's affairs. As a part of internal audit, you get to know a lot of confidential information regarding the client. You should not go and disclose it. If you have a YouTube channel, you should not go and post a video disclosing all the confidential information of the client. So you should be maintaining confidentiality. So these are basic qualities of an internal auditor. Then we have one more concept. What are the 5 steps of performing internal audit? If you want to perform internal audit engagement, what and all are various steps? This also will be similar to the functions of external auditor. Like if you remember, in the external audit, first thing what we do, risk assessment procedures we do. In the risk assessment procedures, what will happen? We will try to understand entity, environment, and its internal control. So to know about risk of material misstatement, that will be done even by the internal auditor as well. If you see, that is a step 1, you have to obtain knowledge of the business and its environment. Basically, risk assessment procedures you have to do. Sir, how can I obtain understanding regarding client's business? First, you have to go and conduct meetings with the stakeholders. You have to go and speak with management, those charged with governance, board of directors. You have to read their annual reports. So you have to go and conduct meetings with key stakeholders. And you should read various business documents like standard operating procedures, MOAs, AOAs, read that documents. And also you should try to understand technology landscape, what kind of softwares they are using, what kind of information systems they are using. Even you should try to understand regulatory landscape, what kind of laws and regulations applicable to your client. So basically you should try to do risk assessment procedures. This only we call it as risk assessment procedure. Okay, I have done risk assessment procedures. What you should do? You have to plan for audit, no? Develop a audit strategy, audit plan, all that things you have to do. So even you have to plan also, spend significant amount of time in planning. And also I have told what factors we are required to consider while developing plan, that we have already seen one question. And one more important thing, internal audit plan should be approved by audit committee or board of directors. There is no such requirement in the case of external audit. You need not get your plan approved by anybody in the case of external audit, but in the case of internal audit, you will develop a audit plan, but that audit plan should be approved by whom? Management or those charged with governance. That is, audit committee is there, audit committee will approve. If audit committee is not there, then board of directors must approve your audit plan. So after considering all the discussions, you have to spend significant amount of time on planning. And after conducting the planning, you are required to verify various kinds of information. No? To verify information, first you have to gather it. So gather all the information which you have to verify. Like for example, if you have to verify internal controls, first gather all the information regarding internal controls. You have to verify accounting data. First gather all that accounting data. You have to verify production data. You have to gather all that data. Check whether you have got complete data or not. So first gather all that information, whatever is required. Once you gather all that information, then what you should do? Have gathered all the required information, then what you should do? Perform your procedures, do the checking, do inspection, do observation, do verification, do analytical procedures, study the relationship, find out the misstatements. So that is what the next thing, you have to perform audit checks. Nothing but this is what in the external audit terminology I call it as performing further audit procedures, which includes compliance procedures, which includes substantive audit procedures. So that you have to do. From the external audit terminology, we call them as further audit procedures. From the internal audit terminology, we call them as audit checks. So whatever it is, try to perform analytical procedures, try to select the samples, try to perform audit procedures, try to obtain sufficient and appropriate audit evidence. Like external auditor, we have to do all that audit checks. So I have told you 4 steps. What are they? Number 1, risk assessment procedures, nothing but obtain an understanding of entity and its environment. Number 2, spend amount of time on planning. Number 3, gather all the required information. Number 4, you have to perform test checks. Sorry, you have to perform audit checks. And finally, by performing this audit checks, what you will get? You will have all your findings. You will have observations. What you have to do to that observations? Report it. Report to the management and those charged with governance. Whatever your findings are there, that all you have to report. Not just reporting the findings, even you have to report suggestions also. You have to give suggestions also. You will report what are your observations, what mistakes you have found. But you should not stop with that. After reporting all your findings, you should also give suggestions for improvement. What actions can be taken by the management for overcoming that weaknesses, that also should be given. And you should not just stop with giving suggestions, you should also check how far that suggestions are implemented. Whether management has really implemented that rectification steps or not. That also you need to do a follow-up and give a report on that once again. So that's what they see here. Whatever finally your audit issues are there, you have to report all that internal audit issues. First, you have to prepare a draft report, and then you have to give it to the concerned management. So first you have to give a draft audit report. Along with that, you should also develop management action plan. What management should do to overcome these problems, that action plan also you have to give. And you should verify whether management has implemented that steps or not. Not just giving them suggestions. We need to also check, we need to also review how far that steps are implemented by the management. And finally, whatever your final audit report is there, that you have to circulate it to the audit committee. Understood, everybody? Since we spoke about reporting, let us go to the reporting part here. What should be the format of the audit report? But before that, just have a quick recap of this question once again. So what are the various stages of the internal audit function? Number 1, risk assessment. Number 2, planning. Number 3, gathering data. Number 4, performing checks. Number 5, reporting of all your findings. Since I spoke about reporting, let me talk about the reporting here. What should be the contents of the audit report and all? Yes, so this is one. With this last question, I will try to wind up this chapter. So what should be the reporting requirements? So first thing, reporting. So first, there will be 2 kinds of report here. After the completion of internal audit, there will be 2 kinds of report. Number 1, one is periodical reporting. First I will talk about periodical reporting. Sir, what is periodical reporting? For example, if internal auditor has been appointed once in a quarter or once in 6 months or once in a year, the chief internal auditor will give a report on the entire quarter. For the entire internal audit process, he will give one report on a periodic basis. In addition to that, after completion of each and every audit task, also a separate report will be given. Like for example, when I say internal audit is happening for Reliance Industries Limited. It is having 10 branches, it is having some 15 divisions which are required to be done. So now what will happen is, once internal audit of one department is done, a separate report will be given. Once a internal audit of one branch is done, for that branch, separate internal audit report will be given. So like this, as and when each task is getting completed, a separate report will be given. In addition to that, after the completion of entire audit, like for example, in one quarter, entire internal audit got completed. So at the end of this quarter, a consolidated audit report will be given for the entire audit process. So like that, 2 reports will be there. One is after completion of each audit assignment. Number 2 is overall report on periodic basis. So two types of reports will be given by internal auditor. And what should be the elements of internal audit? What and all contents should be there in the internal audit report? So there should be a few contents, like you have to explain main elements, key elements of the internal audit report will be, you have to speak in your internal audit report regarding your objectives, scope and approach. What is your objective as an internal auditor? What is your scope? What is your approach? That you have to say a few words. And you should say that internal audit has been conducted as per standards on internal audit. You should mention the fact in your internal audit report that you have done that internal audit as per the standards on internal audit. Then you have to give a key observations. What are your observations from the entire internal audit process? You have to give a summary of all your observations. And along with that, as I have told you, not just observations, you have to give summary of corrective actions. What actions have to be taken by the management? That also should be given. And what kind of assurance you are giving? That also you have to speak about it. And when it comes to format of the audit report, there is no specific format. In SA 700 for external audit, we have a specific format, but like that, we don't have any specific format for internal audit report. It is completely up to the professional judgment of the auditor. It is completely up to the professional judgment of the auditor. So the internal auditor will sit with the client and finalize how the reporting should happen. So there is no specific format when it comes to internal audit report. It is completely on the basis of professional judgment of the internal auditor and discussions with the client. But a few common points, a few common contents which will be generally there, a few common paragraphs which will be there in the internal audit reporters. So there will be, like as you could see here, the typical internal audit report should include the following. What should be typically included in the internal audit report? Basically, a normal internal audit report will contain these contents. What contents? You have to give one audit scope paragraph. You have to talk about audit period. You have to give an executive summary like we have seen. Then you have to critical findings, whatever are there, that summary you have to give. Detailed audit findings which are impacting the business and root causes. If you find any issues which are having a deep impact on the business, that you have to explain. Rating of highlighted issues. Even you have to give rating for the issues also. For example, I have found out various issues in the purchase department, but all issues might not be very significant. Some issues are very highly important. Some issues are moderate. Some issues are low in importance. So that rating also you have to give. And in addition to that, you have to give recommendations also. As I have told, never stop with reporting only findings for internal auditor. We have to even give recommendations. And along with that, what responses you have received from the management. You told rectification actions, you gave suggestions. What responses you have got? Did the management give you any timeline? Did the management say, okay sir, these suggestions, this suggestion number 1 we will implement within 1 month, suggestion number 2 we will implement within 15 days? So what replies you have received from the management, that also you have to include it. And like external auditor, you have to also maintain documentation. Even internal auditor is also required to maintain the documentation like external auditor. So this is what the major concept relating to internal audit. We have some other questions also in this chapter, but these are very general and vague questions that you can go through it. When it comes to conceptual clarity, this is what the major conceptual clarity regarding the concept of internal audit. Hope you guys are able to understand it. So since we are done with understanding the concept of internal audit, now we will try to discuss one of the related standards of the internal audit, which is SA 610. So let us try to understand this concept. Let us try to revise quickly the concept of SA 610, which is almost related to the concept of internal audit. So once again, here I have a summary for you. This entire standard has been summarized in this form in 2 pages. So this will be, you know where to get it. So just visit our website www.fingansacademy.com, go to resources section. There I will upload it. You will be able to find it there. So what does this standard talk about? What exactly is the standard about? So if you pay close attention, if you look at the title of the standard says something like this: using the work of internal auditor. Using the work of internal auditor. From the title, let us try to understand what exactly this standard is talking about. As I have told, SA, standards on audit, are actually giving guidance regarding external audit. And SA 610 title says that using the work of internal auditor. So from the title, I want you to understand one thing. I'm asking you one question. I expect an answer from you. So from the title which says using the work of internal auditor, they are trying to say someone is trying to use somebody's work. Using the work of internal auditor, from that title, this standard is trying to say someone is going to make use of someone's work. I want to know whose work is getting used. Whose work is getting used and who is using that work. Whose work is getting used and who is using that work. I will give you options also. Number 1, internal auditor using the work of external auditor. Number 2, external auditor using the work of internal auditor. Number 3, internal auditor using the work of management. Number 4, management making use of internal auditor's work. So what do you think this standard is talking about? Who is going to make use of whose work? So from the title, it is very clear. Using the work of internal auditor. Whose work is getting used? That is very much clear. Internal auditor's work is getting used. Now, who is using it?
standards on auditing are going to give guidance to the external auditor. So this standard is going to talk about external auditor making use of internal auditor's work. What does this 610 deal about? External auditor making use of internal auditor's work. Sir, can the external auditor make use of the internal auditor's work? Can the external auditor make use of the internal auditor's work? Let us keep aside what the standard is telling, but let us think practically. See, as I have told, external auditor only will be concerned about financial information. But internal auditor is, the scope of internal auditor is very wider. He covers various operational aspects. Along with that, he will also verify financial information. So external auditor is going to verify only financial information, but internal auditor is trying to verify all the various operating activities. Along with that, he is also trying to verify financial information. So basically, whatever work external auditor has to do, that work is already done by internal auditor. Whatever work external auditor is required to perform, that work is already getting done by internal auditor. So in some areas, whatever external auditor is supposed to do and whatever internal auditor is supposed to do, both are same in certain areas. So when whatever work which external auditor is required to do is already done by internal auditor, do you think as an external auditor, can I make use of the internal auditor's work? Practically, it seems okay. Practically, it seems okay. Why? Because whatever work you are doing, the same work he's also doing. So yes, practically you can make use of the internal auditor's work. Do you think standard permits it? Yes, standard also permits it. SA 610 also permits external auditor to make use of the internal auditor's work if he wants. It is not a compulsion, since whatever you are required to do, that work is already getting done by internal auditor. If you want, if external auditor wants, you can use it. We don't have any objection. That's what SA 610 is telling. So SA 610 has given the permission for the external auditor to make use of the internal auditor's work, but however, it is not mandatory. If at all external auditor decides to make use of the internal auditor's work, what precautions he has to take, in what different ways you can make use of the internal auditor's work, what are the different approaches you have to follow, to which matters you have to be careful, what are the things you have to be cautious about, that all guidance is provided under SA 610. So if the external auditor decides to make use of the internal auditor's work, then SA 610 will come into picture and will give you guidance what exactly you are supposed to do when you decided to make use of the internal auditor's work. See, this standard is very simple if we understand one simple concept. If you understand one simple concept, this standard is going to be damn easy, which is external auditor is going to make use of internal auditor's work in two ways. External auditor can make use of internal auditor's work in two ways, which is using the work of internal audit function, and using the internal auditors for direct assistance. If you understand the difference between the two, for the sake of our convenience, I will say this is type 1 usage, this is type 2 usage. So if we can understand what is the difference between type 1 usage and type 2 usage, standard is going to be damn simple. So let us first focus our time on understanding this. So external auditor can make use of the internal auditor's work in two ways. Number one, using the work of internal audit function. Number two, using the internal auditors for direct assistance. Now, what is the difference between the two? I will try to explain in a very simple layman terms. See, take for example, you are conducting audit of X Limited. You wanted to verify whether income tax provisions are calculated correctly or not. As an external auditor, you wanted to obtain audit evidence whether income tax provision has been calculated properly or not. But you don't have enough of time. You don't have enough of resources. You don't have enough of time. As an external auditor, you are running very tight on schedule. You have no enough of time. Very scarcity of time is there. So you wanted to obtain audit evidence regarding whether income tax provision has been calculated correctly or not. But you came to know that this verification has already been done by internal auditor. Internal auditors, as a part of their internal audit assignment, they have already verified whether income tax provision is correctly calculated or not. They have already verified it and they have given their observations in the internal audit report. Internal audit has already verified income tax provisions and they have included their observations in the internal audit report. So as an external auditor, what I thought is, let me do one thing. Since I don't have enough of time to verify income tax provision, I will open the internal audit report, which will be very detailed report. So I will open the internal audit report. In that internal audit report, I will go to that particular section where internal auditors are telling their observations regarding income tax provision.
I opened that respective page. I started reading the observations of the internal auditor regarding income tax provision. They gave some one page of information regarding income tax provision. By reading all that page, my conclusion is internal auditors are telling income tax provisions are appropriately calculated. What internal auditors spoke about income tax provision? They have told income tax provision has been correctly calculated as per the provisions of the Income Tax Act. So what I thought is, okay, I will do one thing. Since I don't have time to perform audit procedures by myself, I will rely whatever internal auditors have told in their auditor's report. See, since internal auditors in their internal audit report, they have told that there is nothing wrong regarding income tax provision, I will also come to the same conclusion, whatever internal auditors have told. So this type of usage we call it as using the work of internal audit function. This type of usage we are going to call it as what? Using the work of internal audit function, where as an external auditor, you are using the work of internal auditor which is already performed. Internal auditors have already done some work. They have given their observations in the internal audit report. And as an external auditor, you want to use the work which is already performed by internal auditors. This kind of usage I'm going to call it as type 1 usage, or using the work of internal audit function. So now what is direct assistance? What is using the work of internal auditors for direct assistance? Here I will give you one more example to make you understand this. Take for example, once again, there is a client X Limited. In this client X Limited, you wanted to, as an external auditor, you wanted to obtain audit evidence regarding internal controls. Whether internal controls in the area of fixed assets are working effectively or not, you want to obtain audit evidence. But you don't have enough of time and resources. You don't have enough of time and resources. So what you are doing is, you are going to the internal auditors. You went to the internal audit team and told, boss, as you all know, we are external auditors. We need to obtain audit evidence whether internal controls in the area of fixed assets are working effectively or not. But we don't have enough of time and resources. You do one thing. Since you are also internal auditors, you also know audit procedures, you also know importance of audit, you also know how to obtain audit evidence. Why don't you perform these procedures on our behalf? We are required to verify internal controls. We are required to perform some procedures, but we request you to perform it on our behalf. Now you do the work. I will direct, as an external auditor, I will direct you. I will give you instructions what needs to be done. I will supervise you. If at all you are facing any trouble, I will help you out. And after you have done the work, I will review your work also. So in this case, I'm going and requesting the internal auditor to perform some work for me now. In the type 1 usage, I use the work which is already performed by internal auditors. But in the type 2 usage, I am going to the internal auditors. In the case of direct assistance, I am going to the internal auditors and asking them to perform the procedures now. The procedures which I am supposed to perform, I am asking the internal auditors to perform by them, and I will give them instructions. I will direct them, I will supervise them, I will review them. So under the direction, supervision, review of the external auditor, I am getting the procedures performed by internal auditors. So I'm not using their past work, I'm getting their work done. That we call it as direct assistance. Whereas if you are already using the work which is performed by internal auditors, that is simply if you are referring to the internal audit reports, that we call it as type 1 work, which is using the work of internal audit function. If you are able to understand this too, then standard has been mostly completed. So what is the summary till now? Whatever we have discussed, yes, external auditor can make use of the internal auditor's work. It is not a compulsion. It is up to the choice of the external auditor. And if at all he wants to make use of the internal auditor's work, he can do it in two ways. Number one, using the work of internal audit function. Number two, direct assistance. Now what the rest of the standard says is, if you want to make use of internal audit function, if you are going for type 1 usage, what factors you are required to consider? If you are going for type 2 usage, what factors you are required to consider? So like standard says, if you are using type 1 usage, if you want to use the internal audit function, what you should verify. So first what you should do is to decide whether I can make use of the past work of the internal auditors or not. So first thing what you need to do is 3 factors you have to evaluate. So what is the organizational status given to the internal auditors? That means what level of independence has been given to the internal auditors? Are they permitted to do their work in an independent manner? So to whom they are reporting? Are they given the supreme power? Are they reporting to the top level management, or they are reporting to the low level management? Nothing, but I will try to understand first what is the status given to the internal auditors. If I'm going for type 1 usage, 3 factors I have to evaluate whether I can use type 1 work or not. To determine that, I have to consider 3 factors. Number one, what is the status which is given to internal auditors? Are they permitted to act in an objective manner or not? Without any bias, internal auditors are able to do their work or not. Number two, I will try to analyze competence, whether internal auditors are competent enough. Whatever internal audit team is there within the company, are they competent? Are they capable? Number three, I will verify whether the internal auditors did the work in a systematic and disciplined manner. We'll try to verify whether internal auditors done their work in a systematic and disciplined manner. So I have to analyze these three factors: whether internal auditor has been given appropriate status in the organization to act in an objective manner, is he competent enough, is he capable enough, did he apply systematic and disciplined approach. If I got positive responses for all these three questions, if for these three questions I got positive responses, yes, he has been given a proper organizational status, he has been given top powers, he has been treated at par with management, so he will be able to do the work in a more objective manner, in a more unbiased manner. I came to know he is competent, he is very much capable, his internal audit team is very strong, they have good knowledge, they are all professionals, they have a proper approach, then I will be very comfortable using the type 1 work. Third thing I have to analyze is systematic and disciplined approach. Did the internal auditors do their work in a systematic manner? Did they have proper audit documentation? Did they properly plan their internal audit? Did they consider all the risk factors? So if I got positive responses for all these three things, I will comfortably go and make use of the type 1 usage. I will simply go and use the internal auditors report. If for any of this question I got non-satisfactory responses, like I came to know that internal auditors are not independent, they don't have enough of capability, they did not properly do their internal audit, do you think will I be comfortable in using the internal auditors work there? 100% not. So that's what they say here. If you see, if you want to make use of the internal audit function, if you want to make use of type 1 usage, what factors you have to evaluate? Number one, you have to evaluate what is the organizational status and whether policies and procedures support the objectivity, support the unbiasedness of the internal auditor. What is the competence of the internal auditor? Did he apply a systematic and disciplined approach? For these three questions, if I got positive responses, I will accept it. I will use a type 1 work. For these three questions, if I got negative responses, then I will not use a type 1 work. Like if you see here, circumstances when the work of the internal audit function cannot be used, when you should not use a type 1 work. When the function's organizational status and relevant policies and procedures do not support objectivity, or the system lacks competence, or they do not apply systematic and disciplined approach. Simply for the three questions, if I got negative responses, then I will not make use of the type 1 usage. Clear? And you will be able to find in the standard how you will evaluate objectivity, how you will come to know whether internal auditors are having objectivity or not. Like I will check what is the organizational status given to them and whether those charged with governance are involved in employing the internal auditors. Did the management put any restriction on the scope of the internal auditors? Is the internal audit function free of any conflicting responsibilities? So I will analyze these factors. From that, I will come to know whether I will try to analyze these factors. By that, I will come to know whether the internal auditor is objective or not. Similarly, you have to check competence. How you will check internal auditors are competent or not? So I will check whether they are properly resourced. Is there a strong team? Reasonable number of people are there in the internal audit department or not? Whether the internal auditors are properly trained and whether they have technical and proficiency in auditing or not. I will also check whether they possess all the required knowledge of applicable financial reporting framework. If I got positive responses for all this, then I can decide that yes, internal audit team is competent. Third factor which I need to evaluate whether internal auditors did a systematic and disciplined approach. Sir, how I will come to know whether internal auditors did their work in a systematic and disciplined manner or not? So I will try to consider, is there a documented procedures, whatever they have done, for all that proper documentation is there or not? Are they following quality control policies and procedures or not? So by analyzing these factors, I will come to know whether they have followed a systematic and disciplined approach or not. So for these three factors, if I got positive responses, I will use type 1 work. If I got negative responses, I will not use a type 1 work. Similarly, if you want to use the internal auditors for direct assistance, here also some factors you have to consider. Whether I can allocate the work to the internal auditors or not. See, as I have told you, under direct assistance, I will ask the internal auditors to perform the procedures now. I will not use their past work. I will ask them to do the procedures on my behalf. So before I can decide whether I can allocate the work to the internal auditors for direct assistance or not, before I take that decision, here also some factors I will consider. Sir, what factors you will consider? Here also I will consider objectivity and independence. If I allocate the work to the internal auditors, are they able to carry out the work in an independent manner? Will they be able to carry out the work in an objective manner? That I have to analyze. Second one, here also I need to check competence. Here also I need to check what? Competence. If I allocate the work to the internal auditors, are they in a position to do the work in a capable manner? Are they capable to do the work? Do they have all the skill, training, knowledge, whatever it is to do this work? Do they have all that skill or not? That also I have to analyze. Here, this third factor will not come. Whether they applied a systematic and disciplined approach, that will not come. Why? Because I'm not using their past work. Now I will give them directions. Now I will do the supervision of them. Now I will super review their work. So that's why I need not check whether their past work is having systematic and disciplined approach. So if I have to decide whether I can allocate the internal auditors for direct assistance or not, two factors I have to evaluate. Number one, if I allocate the work to them, will they be in a position to do the work in an objective and independent manner? Do they have sufficient capability? For these two questions, if I got positive responses, well and good, I will allocate the work to the internal auditors. For these two questions, if any of the question, if I got negative response, like I decided that if I allocate the work to the internal auditors, they will not be able to do it in an independent manner. If I allocate if I allocate the work to the internal auditors, they don't have capability to do that work, then I will not allocate the work to the internal auditors, then I will not use type 2 usage. So same factors they have told here. So if you want to make use of the type 2 work, here also two factors we will evaluate. One is level of independence and objectivity, and whether they have capability or not. When you are prohibited from using type 2 work, for these two questions, if I got negative responses, like I came to know that there are threats to objectivity or they do not have sufficient capabilities. And one more thing, standard says, if you want to allocate work to the internal auditors for direct assistance, you can do it. If you got positive responses for this two, like you came to know that if I allocated the work to the internal auditors, they can do it in an independent manner, they are also capable. Now you can happily go and allocate the work to the internal auditors. But one thing you have to remember, certain areas you should not allocate. Even though you came to know internal auditors are independent, even though you came to know they are capable, you allocate the work to the internal areas, but certain areas you don't allocate. Other areas you can allocate. Sir, what are those certain areas which I can't allocate? Even though they are independent, even though they are objective, even though they are competent, certain areas you please don't allocate to the internal auditors. Which areas, sir? Wherever there are significant judgments like estimates, provisions, assumptions, these areas you don't allocate to the internal auditors. Why? Because these areas have a high chances of misstatement in the estimate, assumptions and all. Management can play with them. That is a high risky area. Don't allocate that area for direct assistance. Similarly, areas where there are high risk of material misstatement. For example, you are conducting audit of an IT company. You felt that in the revenue recognition of an IT company, the risk of material misstatement is very high. Will you go and allocate that area to the internal auditors? Don't do it. Similarly, if you came to know work with which internal auditors are already involved. If you came to know that in the preparation of some data, internal auditors are already involved. You came to know that income tax provision has been calculated by the internal auditors themselves. Don't allocate the same work to the internal auditors. Why? Because that will be a self-review threat. So three kinds of areas you don't allocate to internal auditors. Number one, wherever there are significant judgments. Number two, high risk of material misstatement. Number three, the work in which internal auditors are already involved in the preparation. These three areas you don't allocate it. Remaining areas you can allocate it. And one more thing also, standard says you have to obtain written agreement. If you want to make use of internal auditors for direct assistance, you need to obtain written agreement from two people. Number one, you need to obtain written agreement from the management that they will permit the internal auditors to work for us and they will not interfere when the internal auditors are working for us. Why? Because for the internal auditors, ultimately remuneration will be paid by management. So internal auditors will follow whose instructions? Management instruction or external auditor instructions? They will give priority to whom? They will give priority to management. So that's why I will go and ask the management, sir, I'm going to use your internal auditors for 2-3 days. You should not interfere in between. And you should not allocate them some other work at that point of time. So ask the management to give a written confirmation that they will not interfere. They will permit the internal auditors to work for us and they will not interfere. Similarly, you should also obtain written agreement from the internal auditor that if at all, they have to keep certain information confidential. As an internal auditor, since I'm allocating some work to you, I will tell you some important things regarding audit. I should ask the internal auditors to give me a confirmation that he will maintain confidentiality. He will not go and disclose that to the client. And also, I should ask a confirmation from the internal auditors that if they face any threat to their independence or objectivity, they should come and intimate me. That's all. So these are two confirmations, one from management, one from internal auditor, you have to obtain. And finally, sir, as an external auditor, the standard has given me permission to make use of the internal auditor's work. So take for example, I'm an external auditor, I made use of internal auditor's work, either type 1 or type 2, I made use of the internal auditor's work. Now, because of using this work, so for example, I'm conducting audit, I wanted to verify information regarding income tax provision. Since I don't have enough of time, I use the internal audit report. And I concluded that, okay, financial statements are free from material misstatements. If tomorrow it was found out that in the income tax provision, there was a huge amount of fraud, now who will be held responsible? Ultimately, external auditor only will be held responsible. Even though if you make use of the internal auditor's work, tomorrow if your opinion has gone wrong, you can't shift the blame onto internal auditor. Entire consequences have to be faced by external auditor only. So you can't shift the blame onto internal auditor. The responsibility of external auditor will not be reduced by using the internal auditor's work. Sir, standard is giving permission. Yes, standard is giving permission, but they did not make it a mandatory. No, as I've already told you, it is only a choice. If you want, you use it. If you want to take that extra risk, you use it. But just because you made use of the internal auditor's work, you can't shift the blame onto internal auditor. You only have to face all the consequences. So it's your choice. It's up to you whether you want to take extra risk or not. Why? Because standard did not make any compulsion. You want to use it and face the consequences. If you don't want to use it, don't use it. Be on a safer side. It's up to you. Clear? So this is what this paragraph says. And finally, you have to include certain things in the documentation. In your audit documentation, you have to include certain things. As an external auditor, if you made use of the internal auditor's work, in your documentation, you have to use certain things. Like if you used type 1 usage, you have to document how you have decided on the organizational status regarding objectivity, how you have decided they are competent, how you have decided they have applied a systematic and disciplined approach. So on what basis, what information you have got regarding this, that you have to document. Similarly, if you are deciding to use for type 2 usage, then you have to include in your documentation what information you have considered for deciding objectivity and independence, how you have decided capabilities, that you have to document. Along with that, whatever written agreement that you are getting from the management and whatever written agreement that you are getting from the internal auditors, these things also should go and sit in your documentation. So this is what some extra things which has to be included in the documentation. So you can refer this documentation paragraph for extra clarity. Clear, everybody? So this is what regarding SA610. As I have told, this summary will be uploaded in the website. There you can download it and you can use it for your revision. Clear? So with this, we are successfully done with the revision of internal audit chapter along with SA610. Hope you guys are able to enjoy it.